But they are pointing higher, and that's in contrast to what we've seen in Asia, where we saw MSCI Pacific down by 4% by the end of the day. The Kospi under a lot of pressure there. So it's despite what we've seen in Asia, it's also despite, Tom, what we see in US futures, which are pointing lower still. But the European futures picture does look positive.
Yeah, looking through that significant sell-off that we've seen in the Asian markets, to your point. And a sell-off, of course, yesterday of around 3% for European stocks. Today, pointing higher, futures by about 0.6%. It was banks, it was financial services that were most under pressure yesterday. Today, there's a little bit more resilience, it seems, but we know the headline risk, of course, continues around the conflict in the Middle East. FTSE 100 futures pointing to gains of just 18 points. The IBEX is in focus for us, of course, because President Trump says he wants to cut off all trade with Spain. We'll see if that actually materialises. The complexity of doing that, given that Spain is part of the EU, is a major question. But nonetheless, risk building in to Spanish stocks, it seems, currently pointing lower by 0.9%. What are the individual names you're looking at, Lizzie?
Well, Tom, we've got to keep an eye on the energy sector because of President Trump's proposal that you could see Navy escorts for ships, oil tankers passing through the Strait of Hormuz. Also that the US could provide insurance guarantees to try to head off this energy crisis, but still so many questions about who's going to buy the insurance, what premium the DFC will offer. You flagged Spanish stocks, also watching Adidas after their earnings, Anna.
Yeah, absolutely. We've got some earnings from some German corporates. A lot of volatility in that Spanish futures picture as we head towards the market open. And European equity markets then just getting into their stride. The IBEX doesn't usually take too long to open, so we might get a fairly early print there. But the FTSE 100 just fluctuating between the red and the green. The futures had settled into something quite positive overall for Europe, so we are expecting to go a little bit higher. How long that lasts, we have US futures pointing a little bit to the downside, although the US equities space has not been the epicenter of the selling by any stretch when it comes to Iran-related equity risk. Now, we do have an opening price on the CAC 40. It is up by 0.2%, and we have weakness as expected in Spain, down by 0.7% over on the IBEX. I was looking at the list of exports, covers a lot of sectors of product going from Spain into the United States. But Tom, a lot of confusion as to whether it would even be possible for the United States to cut off Spain specifically, carve it out from European trade policy. But anyway, what are you seeing in the wider stocks this morning?
Right now, media is gaining, up 1.1%. On the downside, interestingly, given the context, of course, we are seeing just 5 sectors right now in negative territory. Energy is down 0.8%. You've seen Brent stabilising, at least for now, around $83 a barrel. Energy is now down at 0.6%. So it's the biggest loser so far, at least. On the upside, travel and leisure, that has been a sector that's been under significant pressure. Hotels, airlines, of course, the closures of airspace in the Middle East. Media up 1%. Tech gaining as well. You've seen a bit of resilience, to your point, around what's happening in the US. The tech space has been something of a haven for some. Tech as a sector is up 0.9%. Names like ASM in focus and seeing some gains, at least, in the session today.
Well, if we just dip into the energy sector, so you've got BP down 1%, Shell down 0.7%, Total only flat to the downside. You mentioned travel, Tom, and of course earlier in this war we had seen big losses for the airlines, but Deutsche Lufthansa actually up 0.9% today. Air France KLM up more than 1%. I'd flagged the earnings story for Adidas, those shares down 1.8% despite forecasting higher profit and promising bigger payouts. Dassault Aviation up 1.8%. They had earnings as well, but you, of course, would expect this to be tied more to the broader geopolitical story. We wait for Conti to open up as well as Bilfinger. But it seems in the defence space, it's a mixed bag, actually. Leonardo is up 1.7%, but the likes of Rheinmetall and Hensoldt today, Anna, in the red.
It's interesting that energy stocks are weaker, and I was just looking back at where the oil price was when we closed yesterday, because it's been so volatile. I know it went over $85 a barrel at one point yesterday, but it was at 83-ish when we closed yesterday, and it's about there now. And these moves to the downside in energy are not huge. I guess it just reflects the fact that the market's focus is elsewhere today. It seems to be on buying those stocks that have been really beaten up. I see travel and leisure as an area of strength, a bit more emphasis on, well, I was going to say away from airlines, but actually you've got TUI up 2%, Accor up 2%. These were airlines, aviation companies, or travel companies rather, and hotels that had been beaten up on the Iran story. So we seem to be buying back a little bit at the margins, some of those areas that were under pressure. Let's bring in Beata Manthi, Head of European Equity Strategy at Citi, and really nice to have you with us this morning, Beata. Thanks for joining us. So we have an interesting session underway here in Europe where we see a bit of resilience coming back into European equity markets. I wonder if this is just a holding pattern. Are we just waiting for more headlines to drop? A new headline risk, as Tom, you were talking about earlier, is no doubt still in our midst. What are you expecting to see from European stocks from here?
Absolutely. So there is still a huge amount of uncertainty. It feels that the market wants to bounce and assumes that this conflict is going to last for a short period of time, and there is going to be resolution. So, of course, the hopes got higher with the yesterday announcements from the President Trump. Well, let's see how fast that can happen. But because what we are seeing for now is that nothing is going through the Strait of Hormuz, right? And as long as the strait is closed, there will be upside pressure on oil and natural gas prices, and probably some volatility in the equity market.
Yeah.
But indeed, it is interesting that today we are buying marginally the previous losers. Right?
Yeah, as you say, just marginally. What kind of playbook are you reaching for then, Beata, for this? We talked to Bilal Hafiz earlier on, who was saying that 2022, Russia's invasion of Ukraine seems to be very much at the forefront of investors' minds, and he sees evidence that that's what people are reaching for this time around. Does that make sense from a European stocks perspective? Are there parallels with that?
When it comes to the performance that we've seen, well, in the 2 days, I cannot believe it's been only 2 days of the working and trading week, right? We see really the market following the pattern, the playbook of Ukraine. Right, so this is, well, except from today. Let's see how these are early minutes. Let's see how the day finishes. But if you look, I'm going to give you some numbers from our commodity strategy on comparison of Ukraine crisis to this one, potentially. With Ukraine, initially, the world has lost 5 million barrels of oil. Soon after, it was only 1 because 4 managed to find its way through other channels. Strait of Hormuz is 15, so potentially 15 times bigger for the oil disruptions than Ukraine crisis, right? Ukraine war. So that's something to bear in mind. And of course, that's the assumption of the market that the situation there in the strait has to be sorted one way or another.
Yeah, maybe because the stakes are so high.
Absolutely. Yeah. So stakes are much higher there for the commodities than they were in the Ukraine.
We had a piece out today, and it quoted analysts saying that the taco trade is dead. Trump always chickens out, but not when it comes to this conflict because he has less control over it. Do we buy into that? There is surely a pain point for this president, whereas gas prices at the pump, they're already at a 5-month high in the US, or a significant sell-off in US equities, which to Anna's point, we have not yet seen. But is there a point at which the markets intervene to some extent, or at least constrain this president in terms of his military ambitions?
Well, it's hard to say when it comes to the military conflict. With tariffs, it's something different, right? This is much more serious, potentially, from the security perspective. And we don't know enough about their strategy. They are not giving us enough information to assume that. But definitely, the market is acting this way. But the US is not the only player, right? There is the Middle Eastern players as well, and there is Israel, who play a role in the conflict.
So we can't assume on a Trump put at this point?
You couldn't, and perhaps you shouldn't, right?
Yeah. Okay.
Because the situation is quite fluid and it's far from resolved.
You put out a note at the start of this conflict suggesting that the UK could be more resilient in this conflict scenario. Why?
So on Sunday, we were thinking, because everybody has been positioned for risk on, for cyclicality, for the diversification trade from the US. And when it comes to geopolitical conflicts, the UK tends to be the biggest hedge. Why? It's a triple whammy. 50%, 50, of its weight is in defensive, so that helps. Then it has a big weight in oil, of course. And the last one, it has the biggest weight in defense, aerospace and defense companies, almost 10%, so triple whammy. However, I'm surprised it still outperforms the other cyclical markets, not the US, and that's the function, of course, of them being more immune to higher prices. They are self-sufficient when it comes to oil and gas, and of course they sold off a lot. And right now, it's not only defensive,ness but also sold off quality that the market is seeking. Right?
But what if this war keeps going on and oil keeps getting closer to $100 a barrel, and traders price out not only BOE cuts, as they already have started to do, but they start pricing in BOE hikes, as we're seeing in the ECB?
Of course, so this is why this crisis has to stop fast and soon, right? So when it comes, so the conflict has to last for at least a quarter. So all the prices for energy have to be high for this period of time to have an effect on inflation. So 10% on nat gas and 10% on oil for around staying there for 3 months. That's around 35 basis points extra on inflation for the Eurozone. That's the translation. Of course, well, we could go very fast for more than 10%, right? So that's the risk.
What about Spain? So we're seeing weakness for the Spanish IBEX today after the president's threat to cut off all trade with Spain. We've pointed out that perhaps that's harder to implement, Spain, of course, being part of the EU. Do you price that as a realistic threat, or is this an overreaction that we're seeing today?
I think it is just another news flow right now that the market is paying attention. Let's see how it plays out. There are bigger things at stake right now when it comes to security of the nations than this point, right? But of course, the IBEX has been one of the best performing countries year to date in Europe and globally, right? So as I said at the beginning, you are seeing a big unwind of these very good trades, very strong trades. People, simply investors, are taking profits, and it's logical, right, given the uncertainty.
Yes, and those profits have been made. So we are watching the Spanish Prime Minister speaking right now in the face of those trade threats from President Trump. Spain saying no to war, in the words of the Prime Minister. Opposes breaking international law and says the Iran war won't lead to a fairer world. So we're bringing you these live pictures coming to us from Madrid of the Spanish Prime Minister speaking now. In terms of the sectoral breakdown, then, going back to the Iran impact, Beata, and what that does to stocks around Europe. I mean, luxury, if you're looking for companies that actually have revenue exposure, it's not actually that high, the revenue exposure, is it, to the Middle East region? But it's just for some companies, they have a lot of exposure, I suppose. I'm thinking of luxury. There's a lot of money in this region, so luxury names, chemical companies.
Absolutely. So chemicals probably is one of the sectors with the highest exposure. For luxury, it's probably 5-6% overall. It's double what it is for the overall European index. So it's not nothing, right? And it's definitely a further disruption for the sector that have already been facing many headwinds in terms of demand beforehand.
Beata, always a pleasure to have you. Beata Manfrey there, Head of European Equity Strategy at Citi. Thank you very much. Well, let's check in on the core six now. We were just talking about luxury. LVMH, actually one of the names that's in the green this morning, high at 0.5%. Losses, though, today for Rheinmetall after we saw gains for the defence sector earlier in the week. But it's green across the screen for most of our names in Europe this morning. A contrast to previous days, but it looks like we are inching into a more risk-on mood today in Europe. Let's dive into some of the other individual stocks on the move today. Chloe Melly is here with more. Chloe.
Good morning, Lizzie. It seems that ASM is doing pretty well. We're up almost 5% this morning for that chip-making equipment manufacturer, and that is because it issued a very upbeat outlook last night, and that is thanks to strong demand from AI customers for its equipment, but then also a recovery in the Chinese market that is seen as quite positive. So we are very firmly in the green this morning for ASM. Not the same can be said for Adidas, which is down this morning quite significantly, almost to 7%. So it's actually forecasting higher profits in 2026, expects to gain market share, is also promised bigger payouts. But it is down this morning because it seems that the profit expectation was actually below that analysts had expected. And so we are seeing quite a lot of weakness in that stock this morning. Same is the same for Continental, which also has expected higher margins, but it seems that there are lingering concerns around the fate of ContiTech, which is the unit that has been trying to sell. And so we are down a little bit this morning for Conti, about 1.7%. D'Ieteren is up this morning. It is in the green after it was said to have appointed Rothschild to explore options for its controlling stake in Belron, which is a car repair business. And some of those options include an IPO in either the US or Europe. And so this update is being taken pretty well by the market, up almost 2% this morning. And finally, the UK house builder Vistry is taking a major hit this morning, down more than 20% after the CEO is set to retire, and the earnings were a little bit disappointing. And so we're down very, very significantly for that company this morning.
Chloe Melly, thank you very much indeed for some of the stocks on the move this Wednesday session. We're checking back in on what we've been hearing from the Spanish Prime Minister, who has been clear in his opposition, of course, to the war against Iran pursued by Israel and the US. The latest lines then coming through from the Spanish leader saying that Spain demands an end to the war, an end to the Iran war. That is according to Pedro Sanchez, the Prime Minister. Spain will work with Middle East countries that favour peace, he says. The war in Iran won't lead to a fairer world, according to the Spanish Premier. And Spain, again, the Spanish Prime Minister reiterating that Spain opposes breaking international law. Of course, we heard from President Trump yesterday in the Oval Office saying that he wanted to cut off all trade with Spain because of Spain's opposition to this conflict, though, of course, the complexities of doing that remain a significant question.
Yeah, absolutely. And so, as a result, we see some weakness on the IBEX, although recovering from earlier losses and now nearly back to flat on the Spanish market. Coming up, oil very much still in focus. Oil extends gains despite the US promising naval escorts in the Strait of Hormuz. We will have the latest on that story next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
To the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
President Donald Trump speaking yesterday at the White House during his meeting with the German Chancellor Friedrich Merz. Meanwhile, oil extended gains as fresh attacks flared in the Middle East, and traders weighed a U.S. plan to ensure and escort tankers passing through the Strait of Hormuz. Stephen Sapczynski, who leads our Asia energy coverage, joins us now from Singapore. Stephen, good morning. How's the market pricing the different routes this conflict could take now?
Well, I mean, I think right now the market is still likely pricing in a somewhat short-term conflict. I think there are a few things that the market is looking at very closely. So there are two, right? Two really key points. One is the Strait of Hormuz. Obviously, that is something that oil tankers and gas tankers have largely stopped traveling through. And then two is what's the impact on the surrounding infrastructure? Because if the Strait of Hormuz were to open tomorrow, okay, trade, it continues, fantastic. But the thing that the market is closely monitoring is there damage to infrastructure. There was an attack on Saudi Aramco's largest refinery, an attack on the large liquefied natural gas export facility in Qatar. There's also questions about other infrastructure pipelines. So the market wants to know if the Suez were to begin and travel were to continue and you could get all your insurance figured out, would the flows continue? Would there actually be any impact on the physical barrels being exported from these countries?
What does that tell us about the plan to have naval vessels, presumably largely U.S. naval fleet, in the Straits of Hormuz to escort these ships? Like this has been done before, not under this administration, of course, but there is a playbook, I guess, to some extent for this. If we look back in history, is that to what extent would the markets take reassurance from that part of the story?
It would be part of the reassurance, but I think when you look at Hormuz, there are a few different issues. So clearly there is a security threat. And if you do have, some sort of guarantee from the U.S. or a Navy assisting with the ships going through, that would alleviate the issues surrounding security. The second is just insurance, right? If you have the ships going through, does that change the calculus for insurers? Because that's been a very big issue as well for these ships. Going through the strait, getting their war coverage, it's actually going to be ending later this week. So are owners of ships willing to pay higher insurance rates? Are the insurance rates going to decrease if you have that guarantee? Trump also said that he could insure. He could use U.S. insurers to assist with that as well. But the details of that are also fuzzy. So it is one aspect of it. But I think there's also just an expectation of what's going to happen next? Because Trump says a lot of things. Will he actually deliver?
Stephen, thank you very much indeed. Stephen Sapczynski, who leads our Asia energy coverage. European gas prices up just 4% so far in the session, but up about 75, close to 76 or so percent since the start of the conflict. Now, to what's happening in the private credit and private equity space. Some of the leaders of Wall Street's biggest private markets firms have been weighing in on the challenges facing the industry. Apollo Global Management CEO Mark Rowan told Bloomberg, "We should expect a shakeout in the private credit markets."
The entirety of the companies that you see that are public today, everyone was $40 billion in 2008. Yeah. We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term.
This will be a shakeout. It may not be short term. Rowan, speaking with Bloomberg editor-in-chief John Micklethwaite at the Bloomberg Invest Conference in New York. For more, let's bring in our senior reporter, Silas Brown, who's been covering the private credit unravelling to some extent, at least, if that's the way we frame it. There was this pretty remarkable story about Blackstone and some of the managers there having to kind of dip into their own pockets around what is a flagship fund. How unusual is that, Silas? And is there more of that to come, do you think?
Yeah, I think it is unusual, but I think it's symptomatic of where we are when it comes to non-traded BDCs in private credit, which is a source of about 250 billion of AUM in the industry. I think investors, no matter how much the leaders of private credit defend the solid performance of the asset class, which I think it is fair to say, investors can't seem to shake the feeling that we're at a late stage of the credit cycle.
Is that mostly retail investors?
It's mostly retail investors, and I think they're quick to point out that institutional investors are still, are still kind of open to the asset class. But I think the difficulty with the retail investors is that because of their courting of the retail investors, they've developed these vehicles that allow them, a small portion of liquidity, and no one's quite worked out what will happen when they want a big portion of liquidity and what to do. And at the moment, I liken this moment to a sort of like high finance's version of a blinking contest. No one wants to be the first to tell investors that they can't withdraw the amount that they want. And they're going to great lengths to avoid being the first. And I think Blackstone is a kind of relatively good example of that.
Yeah, that's really interesting that you took us in that direction, Silas, because I was drawn to actually some comments from Goldman Sachs yesterday that said limiting, so we haven't seen anybody blink in your terminology, but Goldman Sachs saying that limiting fund withdrawals is a feature, not a bug, of private markets. As if the fact that it's supposed to protect assets from fire sales, so to be able to shutter them is entirely the point. In their view.
And this
so
is,
how will that play out?
This is like the central. I mean, it's kind of almost funny because no one disagrees with the principle of gating in the industry. Everyone thinks it's a very good thing, and I think for pretty solid reasons. I mean, it basically, it's an illiquid asset class. It does protect people from fire sales, and yet there's a kind of real reticence to use it, and there's a real reticence in the industry, even though people are going over the 5% threshold, to say to investors, basically it's a very placating environment for investors.
Why is that though? Because you can't offer more liquidity to the people who bought the product than there exists in the underlying assets. Isn't that the basics?
I think it's a febrile time. I think people have seen what's happened, to fund managers. Blue Owl has kind of gone through a lot of the brunt of this, and they've seen the risk of being the first to do this sort of thing. And I think reputationally, people are trying to work out quite how impactful that will be. And so I think, look, I think if I was a betting man, and if I'd, knowing people in the industry, I think the amount of redemption requests that will come in the next quarter will be more rather than less of this quarter. And so I think that, at some point someone is going to have to blink, but it hasn't quite been yet.
Exactly. Just going back to Bloomberg Invest, you had Soros Fund Management's Dawn Fitzpatrick saying it's going to be a painful 18 to 24 months for private credit and private equity. Surely this chipping in to paper over the cracks can't continue much longer.
Yeah, well, I mean, I think it's also fair to say that actually what's quite eerie about this time is that private credit performance has remained relatively flat and quite strong. I mean, like Blackstone itself, I think, it was about, I think, over 9% of annual returns since inception for BCred's fund. And I think you haven't yet seen among the larger managers a kind of an impact on performance. And yet, I think it's fair to say, look, it's a very bad environment to sell for private equity, and that should have an impact on private credit.
Silas, thank you very much. Silas Brown, our senior reporter. Oil prices at $83 a barrel. Seems a good time to talk renewables. We will talk to the CEO of EDP. That conversation is next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and we are seeing a modest rebound for European stocks this morning after a steep two-day decline. So breaking with the mood that we've seen in the Asia session earlier and with what we're expecting to see in the US session later on. Particular weakness, however, coming out of Spain. We have had remarks this hour from the Spanish Prime Minister responding to President Trump's threat to cut off trade with Spain. Fighting talk in response from Pedro Sanchez, and you're looking at the IBEX down nearly 1% this morning. Tom, what are you seeing under the hood?
Yeah, headline risk is still there. We're hearing from Iranian officials just in the last couple of minutes saying that the war can continue. They're not having any talks with the US. But to your point, there is a bit more stability across the European space today. And you're seeing that in terms of the breakdown between the laggards and the leaders, in terms of the members as well. So you have currently, as things stand, 337 members in positive territory. A very different dynamic to yesterday, where, of course, you had a significant number of individual names significantly lower, and across the benchmark drops of around 3% by the end of the close. Today, across those members that are lower, 238. Volumes also higher, but less in terms of the spike that we saw yesterday. We saw a much more significant spike in volumes yesterday. Today, volumes about 17% versus at that 20-day average. In terms of some of the individual names, on the leaders' side, it's tech as a sector that is top of the list right now. Banks under pressure. Tech, so ASM over in the Netherlands. ASML, of course, the maker of lithography machines. You've seen a bit of resilience in terms of the tech space in the US, and that starts to be feeding in to the European space as well. For how long, of course, because the supply chain challenges are also there. Up 1.4% then on ASML. SAP in the software space, interestingly, of course, because that's been a focus prior to the war of the software sell-off, currently up 1.2% for SAP, listed over in Germany. Let's flip the board and have a look at some of the laggards then. We're looking at the individual story. This is an idiosyncratic story, really, Adidas, in terms of the forecast. This is not linked to the conflict as much as it is to concerns about the forecast and currency effects, tariff effects as well for Adidas. And so that's selling off pretty sharply in terms of that retail company, down 6%. Bayer, the chemical space, of course, lower by 3.4%. And BP, the energy stocks, a little softer in the session today after the rally that we've seen since the start of this conflict. BP currently down 0.9%. Anna.
Tom, let's get an update on the wider news flow this morning. Asian stocks have plunged the most in nearly a year amid mounting concerns over the Iran war. In South Korea, the Kospi dropped, closing down 12%, its biggest drop on record. Bloomberg understands several Chinese financial firms are scaling back exposure to Middle Eastern debt as hostilities raise concerns over China's extensive lending in the region. We're also told regulators are tightening up checks in parallel. And President Donald Trump says he's directed Treasury Secretary Scott Bessent to cut off all trade with Spain. The move comes after the European nation denied access to its military bases for Trump's Iran bombing campaign. A few moments ago, the Spanish Prime Minister Pedro Sanchez says his country won't change position out of fear of retaliation and called for an end to the war.
European gas prices are up 70% since Friday's close as the conflict in the Middle East chokes shipping through the Strait of Hormuz. This level of market volatility has not been seen since the 2022 energy crisis. For a context from the corporate perspective and a company that has exposure particularly to the renewable space, let's bring in Miguel Stilwell-Andrade, CEO of EDP. The stock is up about 50% in the last 12 months. Thanks for coming in. How is this conflict in the Middle East impacting your business?
Well, first, thanks for having me. I think the first thing to say is obviously it's introducing a lot of volatility. And so we're seeing something that is at the early stages similar to what happened back in 2022. But I think really the important thing is that this just highlights how important it is to be diversified from an energy perspective. And so one of the things we've been advocating for many years now is the investment, for example, in renewables, which is much more insulated from these type of exogenous shocks. And so for many years, we've been a leader in the clean tech space. We've been investing in renewables both in Europe and in the US. And you have actually a fantastic example in Portugal, which is more than 75% renewable generation, and which managed to navigate through the crisis back in 2022. And so I think we'll also navigate through this crisis, basically as a result of having a lot more sources that are not exposed to this type of volatility in the market.
To your point, Europe is vulnerable. We don't have the stockpiles of energy. We know that inventories around gas are low. Oil, of course, is an impact. We import significant amounts of oil into Europe, into the UK as well. Are you hearing from investors, are you hearing from governments a greater urgency to invest in renewables as a result of this conflict? Do you expect greater inflows? Do you expect more investment? Do you expect more interest?
Yes, we do, and that's something that we've been seeing actually over the last couple of years. As I say, going back to 2022, it became very clear that the issue around energy independence, diversification, affordability, and competitiveness, all those issues are very conducive to actually investing more in renewables, where you actually can take advantage of your natural resources without having to import fossil fuels from outside. So we've been seeing that push, and we think that will be just strengthened really by what we're seeing today.
So if the war means the relative economics of wind and solar have improved dramatically, how fast can you fulfill that demand?
Listen, we've been pushing to invest 2-3 times faster than actually what's been happening in the past. I think one of the big bottlenecks that has existed over the last couple of years has been a lot of the administrative and bureaucratic, red tape that a lot of times makes it difficult to actually build out these projects. And so we've been saying and advocating you need to be much faster in cutting the red tape, making sure that you can fast track these projects so that you can actually reduce that energy dependence on fossil fuels.
And how exposed are your supply chains to the conflict and the closure of the Strait of Hormuz effectively?
So more than 90% of our generation is actually renewables, either hydro, wind, or solar, or batteries. So our exposure is actually relatively limited. We are also very low risk because we have a lot of long-term contracted revenues, either from our networks business, which is totally regulated, or our sort of PPAs with our renewable sources. So actually from a risk perspective, we are relatively de-risked from this type of conflict.
So you paint a picture there of quite a bit of visibility then, which sounds like a positive, and many businesses probably don't have a lot of visibility right now. I noticed, I think just recently you've been tweaking your CapEx guidance, and I wonder what your appetite for CapEx looks like right now. With on the one hand, a lot of volatility, but on the other hand, you're in an industry that maybe is structurally set to benefit from that volatility. So what do you do around CapEx with that in mind?
So we have over 12 billion euros projected to invest over the next 3 years, and most of that is going either into networks to make them more resilient, or going into renewables, as I say, into the US or into Europe. I think it's not just the issue around volatility. One of the big macro trends that we're seeing is just an increase in demand for power coming out of AI, data centers. All of that is driving that demand. And so we are seeing tremendous opportunities to actually invest to supply that power for those AIs. So I think it's actually a great time to be in the sector because you're not just having all of this demand, which is obviously positive, but I think it's also very plugged into, increasing this energy independence.
Yeah. So a number of structural shifts then playing to your advantage. I wonder, the conversation in the United States around renewable energy is so influenced by politics right now. There's a lot of that, and there's a lot of commentary from the White House specifically on renewables. Does that just absolutely have no impact here in Europe because of the things that you've talked about, because there's European commitment to energy security and because of AI build-out? Does that mean it just doesn't cross the Atlantic?
Yeah, I don't think it crosses the Atlantic, but to be fair, even in the US, I think there's a difference between actually what's happening on the ground and some of the rhetoric. On the ground, what you're seeing is a tremendous amount of demand for power, and actually the type of supply that can be deployed the fastest and sort of the most competitively is actually solar and batteries in the very short term. So we're actually seeing a tremendous amount of demand. It's one of the best times actually we've seen over the last 20 years to invest in the US in this space, precisely because of this demand. So I think I would separate some of that sentiment and rhetoric from actually what's on the ground.
And to be clear, that's really interesting in terms of the demand picture in the US, given the politics that Anna talks about. Is the federal government not getting in the way then? Because they've been getting in the way of turbines. We know that. Are they getting in your way at all in terms of meeting that demand?
So one of the things that was actually established last year with the Big Beautiful Bill was this framework, which essentially they kept out till 2030 of support for renewables, primarily I'd say solar and batteries, which is continues to be sort of a big part of our business there. So the truth is that we are continuing to see that regulatory stability there, and they're not actually getting in the way. So if you actually look at the numbers, there's a tremendous amount being installed as of today and expected to be installed over the next couple of years.
And you've touched on AI, and clearly the US is leading in terms of the build-out of the infrastructure and data centers around AI. Give us a projection in 5 years' time, or 2 years' time, what percentage of your revenues come from serving data center demand?
Well, from our renewables business, it's either directly, sort of our biggest customers globally are Amazon, Microsoft, Google's, those are our typical customers, but also utilities that themselves are having then sort of this additional load coming through from the big tech. So it's actually a very significant percentage. But what I'd say is that demand is driving, 2-3% CAGRs, compound annual growth rates over the next 5-6 years plus. So that's a very attractive environment to be investing in. And that's true on the renewable side, but it's true also on the network side. And so just to give you one very interesting statistic, in Portugal, for example, we're actually seeing a huge amount of investment as well in data centers. Just one data center in Portugal is going to represent 20% of Portugal's consumption. Wow. So over the next couple of years, you're going to see that really drive that demand in the country.
Given all of these changes to the backdrop, do you still hold to saying that there won't be any M&A?
Listen, I think we are very comfortable with the plan that we have. We think it's a plan that is solid, built on organic growth. As I say, very attractive investment opportunities, and so, we are steering our path.
Okay, focusing on organic growth. Miguel, thank you for joining us in the studio. Miguel Stillwell-D'Andrade, CEO of EDP. Well, turning to Spain, the Prime Minister Pedro Sanchez has been speaking in Madrid, saying that he won't change his position and demanding an end to the war. We're joined now by Bloomberg's Chief Europe correspondent, Oliver Crook. Ollie, are we seeing a splintering of EU nations when it comes to Iran?
Yeah, they're certainly getting some different views from a number of different nations from across Europe, and really the Spanish have been the most outspoken over the last few days after the strikes in Iran commenced over the weekend, with the government saying effectively that the war was sort of an illegal operation and that basically all the sort of international rules should be respected, and really coming out quite aggressively, and especially on the show yesterday when you spoke to the Spanish foreign minister, against U.S. and Israeli action within Iran. We've just heard from the Prime Minister of Spain, who, as he was saying, he basically is not going to change his position on the threats that Donald Trump made yesterday, saying that effectively the United States would put a full trade embargo on Spain, and effectively that could complicate another conversation that is very sort of present in the minds of Europeans here, which is that the European Parliament today is supposed to vote on whether or not to continue unfreeze the process of ratifying their trade deal with the United States. Of course, as we know, the trade is not negotiated at the individual level for these European nations. It's done as a bloc, as a whole. So if this threat by the United United States is taken seriously, this could delay yet again trying to get that trade framework moving forward, which has been obviously first derailed by Greenland, then by the Supreme Court ruling that basically dismantled the sort of core of the Trump tariff policy. And of course, this is the issue that the Chancellor of Germany wanted to seek clarity of from the President of the United States yesterday when he was in Washington, D.C., and I doubt very much whether or not he was able to do that. That being said, you've had the French also and the UK indicating that these strikes by the United States might have been illegal within Iran. But of course, there's always the Ukraine put from the Europeans. There's only so far they can go because they still do need support from the United States and Donald Trump in their support of Ukraine. So it's a very delicate balance, but we're starting to see where the red lines are for the Europeans. We learned where they were on Greenland. We'll wonder where they are here on Iran and on trade.
Yes, and so really interesting to see the different stances being charted, the different courses being charted by these countries. Now, France and the UK have been talking about sending military presence to assist for various reasons, specifically around Cyprus and protecting Cyprus, but also in the French case, talking about shielding Middle Eastern shipping and using military assets to try and do that. What's the latest there, Ollie?
Yeah, so the French are deploying a number of different ships. There was a sort of early in the events with Iran over the weekend, we understood that the French were sending some more naval ships to support a sort of EU mission that was in the region. But most recently, we heard from Emmanuel Macron, who addressed the nation last night, saying that they will be deploying the aircraft carrier Charles de Gaulle towards in the Mediterranean, towards the east of Cyprus. So the sort of main sort of position for this that the French are sort of suggesting, this is about safeguarding economic interests, economic assets, and of course the French, of course, have got assets within the region. But I think that we have to see the other side of this. This is also about creating a reaction function from the European side when there is a military threat to Cyprus, an EU country, that the French are willing to step up and deploy their military operations. That is not really just a message to the Iranians. That is a message to the Russians as well, to say what the reaction function is at a time when the Europeans are very concerned about whether or not the United States would have, they would enjoy the full backing of the United States if there were any infractions on NATO. So I think it's very much also about telegraphing that to the Russians. That being said, we should also say that any other news cycle, when the French government is talking about expanding their nuclear arsenal, talking about deploying their military capabilities and their nuclear capabilities in neighboring European countries, admittedly on a temporary basis, that would really be headline news. And that is exactly what happened yesterday. We are now having conversations from the Polish Prime Minister saying that Poland is considering developing its own sovereign nuclear capability. These are massive changes in this sort of framework and the way that we think about European defense that at any other time would get more coverage. But again, it's all being sort of overshadowed by the situation in Iran. But there are enormous things and enormous conversations happening on the European continent, particularly on nuclear deterrence.
Yeah, really significant. And President Macron, to your point, really kick-starting that conversation about the European nuclear umbrella. Oliver Crook, thank you very much indeed, our Chief Europe correspondent. Coming up, we will bring you the latest on the state of play in the energy markets as the US promises naval escorts in the Strait of Hormuz. You've had a bit of calming in terms of European gas prices in the session today, at least. More on that coming up. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 8:48 here in London, and we see European equity markets overall in the green, but we have moderated those gains. We're up just 0.2%. Weakness still coming through in the Spanish market. That seems to be an area of focus, but that related, of course, to trade and the geopolitical situation in Iran as well, but related to President Trump's threats around trade when it comes to Spain. Let's get back to Iran and what is happening there. Iran says it has no intention of negotiating with the United States. An advisor to the late Supreme Leader told Iran's state-run television channel that they have no trust in the Americans. Bloomberg's Jumana Basechi is in Dubai for us. Jumana, bring us up to speed with the latest. Iran saying then that it can continue this war for as long as necessary.
Yeah, that's right. Not backing down on their resolve to keep retaliating against the ongoing strikes that the joint U.S.-Israeli operations are having on Iranian target sites. The Central Command saying that they've hit over 1,000 sites, over 2,000 sites, I should say, across Iran since the inception of the war. Israeli ongoing operations continue as well. And yesterday, they actually targeted a building where supposedly there was we were going to see a meeting of this assembly of exporters, so that's what they're called, the group of clerics who were planning on meeting to decide who was going to be the successor to the Supreme Leader. Now, in return for that, Iran says that they will keep on retaliating, specifically targeting U.S. assets in the region, and the resolve is not really diminishing in that respect. They're reiterating, this is something they said earlier in the week, that they don't plan to negotiate with the United States. So what we're seeing here is what some people are describing as a war of attrition, and to see which side's munition can hold out longer in addition to their defense systems. And the longer this goes on for, the less perhaps we'll see in terms of frequency of attacks, and more targeted, impactful attacks should be expected. At the same time, you know, one of the calculations that Iran is making is that they're going to inflict so much economic cost, not just on Arab countries, but also around the rest of the world, that there will be calls for this to de-escalate somehow.
And in that war of attrition, of course, Jumana, as you well know, Gulf states are being drawn in, and they are in the middle of that war of attrition. How are Gulf states reacting in this moment?
Yeah, so far they've been acting in a self-defense capacity. It was interesting to hear from the UAE yesterday. They did a very special, extraordinary press conference with multiple ministries represented. And what what they said essentially is that they have managed to successfully intercept almost 1,000 drones and ballistic missiles that have been directed towards the UAE. That's 1,000, a huge number, just contextually. And that they reiterate the right to act in self-defense, but also the act to respond. And I think, we're beginning to get a different tone out of some of these Gulf states, especially now that over the course of this week, some of their key infrastructure sites have been targeted, energy infrastructure, as we've been talking about, logistics hubs. The airports is still barely functional at this point. And so, yes, the economic costs are mounting. The hope, of course, is for an off-ramp for a diplomatic solution. But I think if you listen to both the language and also some of the actions taken by these individual countries, the UAE closing down its embassy in Tehran, the Saudi Arabia calling on the Iranian ambassador, it does suggest that we've entered into a different phase now. And the Gulf states will have to make perhaps some difficult decisions about whether they will actively seek to reopen those diplomatic channels or somehow even respond even more forcefully, given the bombardment, the daily bombardment that comes through from Iran.
Jomana, thanks for the update. That's Bloomberg's Jomana Basecci in Dubai. She'll be back with Horizons Middle East and Africa at 5 a.m. London time tomorrow. We are looking at Brent back above $84 a barrel now. But let's take a look at what else we're watching throughout the day. At 10 a.m. London time, we'll get the latest euro area unemployment rate. This interesting to get a read on the labour market before the impact of the war on the economy. Traders already starting to price an ECB hike this year. Later on, the European Commission will be unveiling its Made in Europe plan. Then at 7 p.m. London time, we'll get the Fed's beige book. Could give us some insight into how businesses are interpreting the Supreme Court's rejection of tariffs, of course. And then earnings will be continuing throughout the day. We get Bayer at 9 a.m. London time, Campari just before 5 UK time, and then stateside Broadcom and Okta reporting, Tom.
Okay, let's get back to the markets and bring in Bloomberg MLive Skylar Montgomery-Koning for a take on what we're seeing. Skylar, we're seeing gas prices in Europe higher by just 2%. So in the context that we've seen since the start of this week, pretty modest. There seems to be some equilibrium maybe being found in the gas pricing, still up about 75% since this week. To Lizzie's point, Brent is back above $84 a barrel. How are you thinking about... We're seeing a bit of stability in equity markets. Is that tied to what we're seeing in the energy price markets? Were we finding some stability and sustained stability in terms of how markets are pricing this?
I think now that we've had that surge higher in energy prices, and it was very substantial, right? From the lows on Brent, you're up something like 40%. So you know those have economic consequences. What you don't know at this point is what the policy response will be. So you don't know, are we going to get fiscal to help energy prices out in Europe? Are we going to get monetary policy that skews more hawkish as a result of that? And so I think now we're increasingly thinking, well, how high or how long are we going to have energy prices stay high? Are we actually going to have U.S. ships start helping transit through the Strait of Hormuz? And so there's more questions now, and so I think you then take a chance to pause and reassess what you're thinking about, and you also think about what are the starting conditions. And risks very much look asymmetrically skewed to the downside from that for bond markets, for example, because if you think about European inflation data earlier this week, that came in hotter. So if your starting point is hotter, that skews risk to more inflation. And so we'll look at ISM services later today and the prices paid component with that in mind.
Yeah, and I wonder how bond markets chart through all of that, because with all this talk about inflation, we've seen bond yields go higher. We certainly saw that over the last couple of days in Europe. And today, also, we have yields going higher, just not as dramatically as they were for the last couple of days. It's interesting hearing the UK government talking about being there for families and consumers if they need to be, and maybe other European governments, as you mentioned, could also want to help out. But that's going to be, something the bond market's going to be paying attention to, isn't it? But at the moment, not too many jitters around that kind of narrative.
Yeah, I think it depends on whether or not energy prices stay elevated for quite a significant period of time. I think, too, part of the bond market reaction you're seeing is the fact that yields were very low heading into this. Particularly in the U.S., you had 3 cuts priced this year, which seemed very high considering that the economic backdrop was one of strong growth and core PCE around 3%. And so this just adds those inflationary wins. I think particularly in Europe and the UK, because there's so much fiscal concern, because their markets, especially the UK, that tend to be more reactionary, more negative, it is, very concerning the prospect that you would get more spending.
Okay, so we watch that fiscal response to what we're seeing in terms of the economic damage of the war in the Middle East. Bloomberg, Skylar Montgomery-Koning, of course, in terms of the market reaction. There is a bit more stability in the European equity market today, up 0.2% on the benchmark Stock 600. US futures, though, pointing lower by 0.3 on the S&P E-minis. Fed Governor Stephen Myron, on that Fed conversation, of course, that Skylar was talking about, is on surveillance at 1:30 p.m. London time. So that would be a pretty fascinating conversation for his take.
Yeah, how convinced is he still that we need rate cuts in this environment? That certainly will be a conversation to tune in for. 8:56 here in London. European equity markets then just edging higher, but they're giving up a lot of those earlier gains. US futures point lower, down 0.3% on E-minis. That is it for Wednesday's programme. The Pulse is up next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
President Trump says the U.S. will ensure safe passage of oil from the Middle East, but investors don't seem convinced, with Iran's Revolutionary Guard reportedly saying it has complete control of the Hormuz Strait. Conflict in the Middle East rekindles fears of inflation in the UK. We'll bring you more of our exclusive interview with the Chancellor, Rachel Reeves. And Wall Street's biggest private market firms say investors have reason to be concerned, with the Apollo chief executive warning a, quote, shakeout is coming. So there is quite a lot of news out there. Of course, the Middle East dominating all of our headlines. If you look at what the market is telling us, look, for the moment, there's still a little bit of panic. For example, Korean stocks see their biggest one-day crash on record. A lot of the focus is, of course, on stocks and bonds. Euro dollar 115.97. When you look at oil, it's jumping despite, again, this U.S. plan to escort tankers through the Strait of Hormuz, and then Chinese financial firms seem to also start to cut a lot of the exposure to Middle Eastern debt. In picture, European stocks, I would say, avoid the sell-off that we saw in Asia as investors grapple with all of this uncertainty. It's not looking great, but we don't see the sell-off that we saw over the last 10 hours in Asia. So for the conversations that matter and the insights you need, let's get started.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, energy markets appear unconvinced by President Trump's announcement that the U.S. will ensure and escort tankers passing through the vital Strait of Hormuz. Joining us now is John Bilton, Global Multi-Asset Strategy Head for JP Morgan Asset Management, and Paul Wallace, Bloomberg's Managing Editor for the Middle East. So thank you both for joining us. John, I mean, the concern actually with oil is that despite the U.S. assurances to keep that strait open, it just seems very unlikely. And so a lot of oil tankers are going down the longer route.
Yeah, well, I think, when we think about the disruption in the market, it's reasonable to price the very near term. But actually, if we look at the backwardation in the curve, the market's behaving surprisingly rationally. We had the front contract in Brent up around 15% or so since this all started. But if you go back to the December 26 contract for this year, it's only up about 2 or 3%. So as a result, what it's telling you, I think, is that, yes, there are concerns, and rightly so. But remember, we've got decent-sized strategic reserves. China have over 1 billion barrels. U.S. strategic petroleum reserves around 420 million barrels. And across Europe, of course, we have the directive which requires 90 days of imports or 61 days of onshore usage to be held as a minimum reserve. So, yeah, reserves are down a bit, but it's not the world at the moment where I think we've got this sudden and immediate pass-through to, oh, my goodness, inflation, oh, my goodness, the ECB must hike. I think that's taking things a little too far.
Yeah, I mean, I guess the concern, Paul, is that, it's the intensity of the attacks. It's the fact that Iran is really pounding some of the Gulf countries as well. How do you see this developing? I don't know whether there's even diplomatically an off-ramp, right, on the Israeli and U.S. side.
Yeah, and that is the big question. I think it's pretty clear that the intensity and the extensiveness of the Iranian retaliation has taken certainly some people in Washington by surprise. I mean, they didn't have any planning, for example, before they began this attack for escorting oil tankers through Hormuz, for the simple fact they didn't think it would be needed. And now they're having to rush to put these plans into place, as well as evacuating American civilians from Gulf countries and so on and so forth. So is there a diplomatic off-ramp? The short answer is not yet. The Iranians are coming out and saying they will not negotiate. Yeah. They are trying to make out that they are able and willing to continue with their counterstrikes for the time being, whether that's several days or even weeks, we don't know, but they are showing that they have, plenty of ability to continue striking the UAE, Saudi Arabia, and, probably tankers and container ships. And that's what they want to do.
I mean, Paul, again, we don't really have a good handle on the arsenal, right, that's available for the Iranians right now. And so even if you escort, I mean, if you have a tanker escorted by, warships on the side, you have some missiles that you can't really protect them, can you?
It's extremely difficult. I mean, the fact is the Iranians don't need a navy to target ships going through Hormuz. They can use sea drones. They can use short-range missiles, which they have in an abundance. I think the best thing to look at is the southern Red Sea, the Bab al-Mandab Strait, and the Houthis. The Houthis have way less sophisticated weaponry than the Iranians do, and the Houthis effectively closed the southern Red Sea for 2 years. In fact, in some ways, it's still closed. That was just by raising the threat to such a level that Western ships, in the case of Bab al-Mandab, would simply not go through there. They couldn't get insurance. The risks were too high. And even military vessels had problems. Remember, the U.S. did actually face big problems when it was bombing the Houthis. They lost, I think it was two F-18 jets, not in the sky, but when one of their ships had to take a sudden maneuver to avoid Houthi torpedoes or a water drone or something. So it's extremely dangerous, even if you have a military escort.
But, John, I mean, you seem to suggest, I mean, given all of this, you hear Paul talk, and you kind of say this is not going to end well, or certainly this is going to be protracted. So do you think the markets are overreacting?
Well, I don't think they are. I think the markets are reacting rationally. They're repricing things such as oil. They're repricing particularly areas where you've got some level of perhaps needing delay on rates. So we saw what was perhaps unsurprising was the front end of the US curves beginning to price out some of those rate cuts. You've got in the VIX curve, you've got a gradual decline now out to about couple of months out from now, which suggests some level of continuation of what's going on right now, but eventually the need on all sides to find some sort of negotiated solution. Sure, we're right in the hot point of this conflict, and I think we all hope it's over quickly, but the idea that it's suddenly going to sort of disappear, I think that might be wide of the mark. But equally, I don't think markets should be panicking, because if we look at what's happened, look at the best performers year to date. It's been Europe, it's been Japan, it's been emerging markets. Past few days, all of those markets in equity terms down 5-6%, but they're still, with the exception of Europe, which is now flat, reasonably well up on the year for other reasons. The continuation of demand for chips, etc., which means that even something like Kospi, which got hit so hard, as you mentioned earlier, it still doubled last year, and it's still up about 20% this year, because the underlying economic stories are still intact. This certainly creates a degree of volatility, a degree of uncertainty, but markets are doing what they should do, which is rationally pricing the risk. When that breaks down, if that breaks down, that would be more concerning. But this seems to be a sensible market reaction thus far.
Now, strikes on Iran, of course, continue, with Israel appearing to have attacked Iran's Assembly of Experts, the clerical body tasked with choosing also the next supreme leader. Now, Tehran has hit back, including a reported drone attack on a CIA station in Saudi Arabia. Let's get straight to Jumana Bersachi in Dubai. Jumana, so how, this is also a critical part of what we're living through. How are the Gulf states responding on day 5 of the war?
Well, we were just looking at the tally of how many incoming missiles and drones the Gulf states have received since the inception of this war. It's something like 1,800, of which almost 1,000 have been directed to the UAE alone. Just to give you the context here of how much of this, how much of the UAE has been a recipient of many of these missiles and drones. Of course, most of them have been intercepted, but some of the debris from the broken drones and missiles have actually managed to sustain damage. And what we've been talking about over the last couple of days is the fact that Iran has started to target key infrastructure hubs, energy infrastructure, logistics hubs. There's still, the airports is still not fully operational. And so the economic costs are beginning to mount here. Now, the language that has come through from many of the Gulf states, they are reiterating their right to self-defense. Yesterday, the UAE had a special press conference repeating that message, but then also reminding Iran that they do have the right to respond as well. And you're hearing that being echoed across many different Gulf states. And so they're in a position now where clearly they want to bring down the temperature and look for a de-escalatory stance. But at the same time, they're still under attack and being forced to go into defensive mode. And the risk here, obviously, is that things escalate even further, and the Gulf states are drawn into a war that they have been trying for almost, the better part of the last year to avoid getting involved in.
Jumana, how much progress has there been on the evacuation of people stranded in the Middle East?
So very important point, Francine. Since the beginning of this war, it's estimated that about 12,000 flights have been canceled. The major airports are not still fully operational. Over here in Dubai, there are lots of stories and anecdotes, and we have an article up on this on the terminal talking about people who've chosen to travel by car. So many travelers are choosing to choose the route via Oman or to Riyadh, where the airports is still open. And actually, this morning, I believe, the first chartered flight to take out British nationals who've been waiting in Oman is set to take off. There are about 130,000 British people who've registered their interest in going back home. But also this morning, the UAE have announced that they've opened up special safe air corridors that will allow for as many as 48 flights an hour, and another 80 additional flights are also scheduled with a capacity of about 27,000 passengers. So we're beginning to see a slow easing up, but for the most part, the big airlines in the region, Qatar Airways, for example, extending their suspension of travel until Friday. Emirates today, but will likely be extended to tomorrow, similar to what we're hearing from Etihad Airways. So we're not fully up and running yet, but some contingency plans have been kicked into action.
Jumana, thanks so much. Jumana Bersachi there in Dubai. Now we're back, of course, with John and Paul. Paul, I mean, if you're a Gulf state right now, you'd want this to be over. And again, we're talking about the off-ramp, but are we expecting Iran to be much more aggressive in targeting energy infrastructure? Because they have only to lose if this continues. And so can they convince the U.S. to back down?
It is. I mean, as far as the Arab Gulf states are concerned, yes, they want this over straight away. They wanted it over, they want this over yesterday. This is, it's not a cliche or an exaggeration to say this is a nightmare scenario. If you are Dubai, if you're Abu Dhabi, if you're Riyadh, if you're Doha. In terms of Iran, yes, of course, it looks completely irrational for them to carry on and take these huge losses. But I think it's important to remember that Iran is not, let's call it a normal country. It's certainly not looking at, the balance sheet and losses and gains in the same way that the US would. Right. Its paying threshold is much higher, and it's very much logical from its point of view because survival is now the goal. It's an attack's come, and the US has all but said this is about regime change, and Israel has said this is about regime change explicitly. So for them, survival is what they want. So for them, it makes perfect sense to up the carnage in and around the Persian Gulf as much as possible, get oil prices as high as possible, LNG prices as high as possible, stop container ships going through Hormuz, because that raises the pain and the hurt that the US is feeling, and that may force the US to try and find an off-ramp. Of course, Trump will be loath to take that off-ramp without declaring victory, but it certainly makes it harder for him, because things aren't looking great from Trump's point of view right now.
Yeah, especially with Congress maybe starting to breathe down their neck. John, what does this mean for bonds and dollar?
So I think first and foremost we do have this general expectation that dollar probably does weaken. A lot of the issues that have gone on in the US in terms of tariffs, etc., point to a weaker dollar, and there's a willingness on behalf of the administration to see it come down. However, it's doing what the dollar does at times of stress. It is behaving as a safe haven. So, of course, for the period that this is a hot conflict, we would expect the dollar to have a little bit more support. We think euro dollar's moved into a range. It's more sort of 116 or so up to the low 120s, and our long-term projection continues to be around 126. The thing we know about currencies is they never go there in a straight line. And, this is something where, we are seeing that little bit of hedging going on in portfolios, which is going to lean a little bit dollar. Some of it's taking positioning down as well. Bonds are a more interesting one because, there's a general undertone of growth around the globe. I mean, for all we're talking about some pretty awful events going on right now, at the end of the day, the growth picture around the globe, particularly because of fiscal spending, capex going up significantly, generally was okay. I mean, this is going to dent confidence to some degree, but it doesn't remove that underlying growth momentum. That probably points to steeper curves over the intermediate term. The risk near term, though, is that folks misunderstand and think that that's been driven by persistent inflationary threats. No. Our general view is that oil demand we had expected to come down naturally anyway. It's beginning to decline, certainly as we see electrification picking up, running into the sort of early 2030s. And, if anything, the rise in prices will take that decline down, which should take a little bit of steam out of inflationary risks.
Very quickly, I mean, when do we start worrying about inflation? So how long does this conflict last until you actually start thinking when you're going to change your inflation expectations?
Well, I think, first and foremost, generally it hits CPI, not CPI core. 10% move in oil generally equates to around a 30 basis point on headline CPI, maybe 5 to 10 on core CPI. We actually think that that's going to take 6 to 9 months to potentially come through. So this is a significant lag when we think about the inflationary pass-through.
I mean, could you see a world, Paul, where a lot more countries actually try and make sure that the Strait of Hormuz is safe? So involving countries like Europe?
One or another, yes. I think it's very difficult to imagine a situation in which world powers are going to be happy with Hormuz being effectively shut for weeks, let alone months on end. Going back to Bab al-Mandab and the southern Red Sea, which effectively closed the Suez Canal for so many shipping companies as well, the world could cope with that. It wasn't so bad going around southern Africa. Yes, it added to shipping costs, but it didn't really do anything as far as CPI was concerned for sort of the US or Europe, whatever. Hormuz is in another league. Just the amount of energy, oil and LNG that goes through there, the amount of container traffic, it's huge, and then all alternatives. There's no, separate route you can take. Yes, the Saudis have a pipeline that goes to their western shores. The UAE has a pipeline that avoids Hormuz by going to Fujairah in the Gulf of Oman. But those pipelines cannot take anything like the amount of oil and energy that tankers going through Hormuz can.
Okay, thank you both for joining us. John Bilton, Global Multi-Asset Strategy Head for JP Morgan Asset Management, and Paul Wallace, Bloomberg's Managing Editor for the Middle East. Now, coming up, conflict in the Middle East rekindles fears of inflation in the UK. We'll bring you more from our exclusive interview with the Chancellor, Rachel Reeves. This is Bloomberg.
Business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The UK Chancellor, Rachel Reeves, says the UK won't make decisions about the war with Iran based on US trade ties. Now, she sat down exclusively with Bloomberg after delivering her spring statement.
When it comes to decisions around using British armed forces to take part in conflicts around the world, it is very important that we judge those on whether it is legal and whether it is the right thing to do. You can't make a decision about whether to get British armed forces involved in a conflict because it may or may not make it more likely to get a trade deal. And we judged that there was not a legal basis for offensive action on Iran. But of course, once Iran responded, particularly...
Sorry, not a legal basis for the UK, but presumably not for the US either? If you're making a
we can only make
that.
judgments for ourselves, and that was the judgment that we came to based on our legal advice, and it's up to other countries to explain what action they've taken and on what basis. But once Iran responded in the way that they did, including with missiles being launched into our allies who are not involved in the offensive action, and the risks to our military bases in Cyprus, of course it was right that we became involved in defensive action, and we were involved in that from Saturday, and of course on Sunday we gave permission for US jets to use British assets from which to launch those defensive actions, and that's a decision that we've taken as a government.
Well, that was the UK Chancellor Rachel Reeves speaking exclusively with our Stephanie Flanders. Now, the OBR warns that the conflict in the Middle East could have a very significant impact on the UK economy. Joining us now is Jill Rutter, a senior fellow at the Institute for Government. Jill, as always, thank you so much for joining us. I mean, I have a million questions on this because actually the Chancellor, we knew, wanted this as a non-event, and this is what she got. But does it actually serve a purpose, or does the UK need a bit more radical thinking on growth?
So this wasn't really about growth. This was if you like, a legal obligation that the Office for Budget Responsibility has to publish 2 forecasts every fiscal year. So the Chancellor couldn't avoid having this, but she was determined to downplay it. And I think, actually, given the backdrop against this, the forecast looks out of date the moment they published it, because the inflation assumptions look potentially very optimistic, things about the sort of fuel price and things like that. But against such an uncertain backdrop, this wasn't a terribly valuable forecast to have. So I think it was quite important that she didn't use it to make big fiscal decisions, because I think she would risk looking like Rishi Sunak looked, if you remember that budget back in March 2020, when he made his big budget statement and then a week later had to come back and take much bigger measures to deal with the COVID pandemic. Obviously not on that scale, but I think big decisions would have risked looking very out of date very quickly.
What does the inflation path forward look like, given all of the uncertainties in the Middle East with oil?
Well, what was really interesting about the statement, I thought, was that the Chancellor chose, in her sort of 20 minutes, very short outing in Parliament, to make much of the fact that the OBR was showing a lower path for inflation, and also to claim a lot of political credit for inflation being lower under Labour compared to the big spike under the Conservatives, that spike that was induced by the Russian full-scale invasion of Ukraine. And that looked a bit politically unwise, given now the big uncertainty that your previous guests were talking about when will this feed through, what difference will that make to consumer prices? Will the government be forced to act on energy prices, as Rishi Sunak did as Chancellor and then as Prime Minister in 2022, 2023? So I think the Chancellor actually possibly scored a political own goal by laying so much of the blame for the inflation spike that we experienced in the early 2020s at the door of the Conservative government, when really it was world events. She might find herself victim to that as well.
How does it change your thinking on, again, the labour market and what the Bank of England can do?
It's very interesting because, the immediate takeout is, does this mean inflation will be persistently higher in the UK? We've seen those divisions in the Bank of England between the people who aren't convinced that the UK is yet on a safe downward trajectory, and those people, the more dovish people who think, there's a lot of slack coming in the labour market, it's time to cut rates. So I think the immediate reaction seemed to be that actually the prospects of rate reductions through the coming year was receding slightly, but we'll have to see. I mean, as everybody says, a lot depends on whether this is a very short, contained blip or whether it really lasts and we feel the hangover effects for the rest of the year.
But Jill, there's so much going on. I mean, we could be importing deflation from China. There's also a big question mark on AI and whether that helps with productivity, but also just gets inflation down and the unemployment up. I mean, what are your 3 big questions that you think we don't really have a handle on yet?
I think we don't yet know. I mean, the OBR itself has said that it needs to look more at some of the effects of the tax system on incentives. So we've got a sort of big thing there of what's that actually doing to work incentives in the UK. I think that's interesting. They single that out. They've also got big question marks about taking into account for the future trajectory the big fall that's coming through now on migration numbers. So there's a big labour market that. The Chancellor herself said she's going to return to the question of growth, not in this statement, because she was so determined to make it so uninteresting, but in a couple of weeks' time at the May's lecture, and that she may return to some of these issues around the labour market. So I think it's a really interesting question about where is the labour market really, really going. We saw that the OBR said yesterday that unemployment would spike this year, but spike higher than was expected. So that does look like there's quite a serious softening going on. But the UK is very vulnerable to energy prices. We already have very high industrial energy prices. We have very high domestic energy prices, and that feeds into this big issue for the government that people just don't feel better off. People have had stagnating living standards for so long.
It's also a feeling, isn't it? Is that there's a lot of people that just feel unhappy with this government for real reasons, but also just a general feeling of unease.
Yes, I mean, we have a government that came in with a huge majority on an agenda of change, and I think the feeling, year and a half in, we saw that by-election result when Labour came third in a seat that they held, lost to the 2 insurgent parties, to green and reform. So UK politics should be in a period of stability. A government with a strong majority can basically, do what it wants, a prime minister with huge authority. That's what you'd expect to see at this time. But actually what we see is a prime minister whose authority is under attack, where the question is not whether there'll be a challenge, but when there'll be a challenge, and is there only not a challenge because they can't identify an alternative, and that feels unable to push through decisions, lots of changes of staff in Downing Street. So it's a really sort of looks a weak and uncertain government.
Jill, thank you so much. Jill Rutcher there, Senior Fellow at the Institute for Government. Coming up next, Continental becomes one of the first big companies to alert investors to the risks from the Iran conflict. We'll be speaking to the tire makers chief executive next. This is Bloomberg.
We've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says the U.S. will ensure safe passage of oil from the Middle East, but investors don't seem convinced, with Iran's Revolutionary Guard reportedly saying it has complete control of the Hormuz Strait. Conflict in the Middle East rekindles fears of inflation in the UK. We'll bring you more of our exclusive interview with the Chancellor, Rachel Reeves. And Wall Street's biggest private markets firms say investors have reason to be concerned, with the Apollo chief executive warning a, quote, shakeout is coming. Well, Continental shares lower this morning as the tire maker warns its forecast for higher returns may be derailed by the war with Iran. The earnings outlook makes Continental one of the first big companies to alert investors to the risks from the Iran conflict. Well, we're now joined by Christian Coates, the Continental Chief Executive Officer. Thank you so much, sir, for joining us. Talk to me a little bit about how you're expecting Iran and the oil prices to impact your earnings going forward.
So first of all, good morning and thanks for having me. So, I mean, obviously, we are very early in this situation. For us as a tire maker, but obviously also for our ContiTech business, the Middle East is not necessarily a major market directly for us, but our products are made out of a lot of raw materials which are crude oil based. So one of the potential impacts of the military conflict is obviously on raw material costs. Again, way too early to quantify, but if oil prices continue to rise significantly, we will see impact on our raw material cost side. That's the one potential impact. And the second part is, again, way too early to quantify what the military conflict means for the overall, let me say, economical sentiment. Also very questionable, creates even more uncertainty, which could impact us as any other company.
But Mr. Coates, again, I think there's always a lagging time between, when you're hit by costs and you can pass them on to customers and consumers. I think it's usually 6 months. Will you have to raise prices in the second half of the year because of what's going on in the Middle East?
Well, first of all, yes, there's a lead time between raw material cost developments and even longer lead time when you talk about feedstocks like crude oil and when those costs will impact our production, our P&L. The crude oil price is obviously only one parameter to determine our raw material cost developments. The other part is the development of the supply and demand balance. And that part is not to be quantified right now, so lots of uncertainty in this area. So, I mean, like in any other crisis or situation we have seen before, we need to handle the challenges. We are confident that we will be able to handle also potential raw material cost impacts coming our way this time, as we have done this in the past.
When will you know, again, how long does the conflict have to last for you to have to pass on these prices? Is it too soon to say, or do you look at previous spikes in the price of oil and oil derivatives, some of the materials that you use to make the tire, and give an educated guess?
Yeah, so I mean, you asked for the duration of the military conflict. Obviously, the longer the duration, the more it escalates, the more potential impact it has on oil prices as one consequence. And the stronger the impact, obviously, potentially also the stronger the impact on our raw material bill. To talk now about a quantified lead time, so when do we need to make decisions? It's way too early to tell, but it's clear, and that's why we raised this point as well. It is a potential impact for us. Again, too early to quantify.
Give me a sense. I mean, you're also, going from, I guess, a 3-division company to a pure auto tire, company, and so you have to spin off some of the other divisions. Does the timeline get complicated because of the war with Iran? Because markets are a lot more volatile than they would have otherwise been.
So we've started the transformation of Continental in the meantime a little bit more than a year or a good year ago. So the first step was the spin-off of our former automotive business, which we have successfully completed last year. And since September of last year, our Movio is now an independent company successfully operating in its own space. The second step was the sale of our OE, so original equipment solution business of ContiTech, which we also successfully closed by the end of January. And now the last step is the intended sale of our ContiTech business, so the industrial piece of the ContiTech business. So we continue to be confident that we will be able to complete also the last step of this transition during the course of this year. And we don't currently see really that the military conflict in the Near East is influencing the spend or impacting the spend.
I mean, I understand. I mean, if you look at some of, you have a 2% margin, I understand, and you expect the first half of this year to remain pretty challenging. So where do you see the upside for Conti Tech in the second half of the year?
So, I mean, so we will see, we are pretty confident that we will see for Conti Tech sequential improvements over the year. Why? Number one, we have started a lot of self-help improvement measures, cost-saving measures, restructuring efforts already in the past, so months ago. And we will continue now to see the positive impact onto our P&L during the course of this year with increasing amount. Second, during the course of last year, we have had some one-times, especially in the first quarter, which had, let me say, burdened the results in Q4, which will help us a little bit during the course of this year. And third element is, at a certain point in time, yes, we believe that the industrial markets, the underlying industrial markets, will start to rebound and improve again. And we will need this help, obviously, as well to get into this sequential improvement. But we are confident that this is going to take place during the course of this year.
Christian Kotz, how are you expecting margins to develop in the medium to shorter term?
So, I mean, we believe we can improve our margins this year versus last year. So you have seen our results. As a tire business, we have completed last year at 13.6%. Our guidance for next year is now 13 to 14.5%. Why do we use this broad corridor? We use this broad corridor because there's such a huge high level of uncertainty. We just talked about this. And also in the past, like in the Corona crisis, the chip situation, we have used and we have learned that this broader guidance span is helpful to be the reliable partner than being able to deliver then also our results within this corridor. On the Conti Tech side, we intend to improve our margins from last year to 7 to 8.5% during the course of 2026.
Thank you so much for joining us. Christian Kotz there, the Continental Chief Executive. Now, the U.S. President, of course, Donald Trump's war with Iran has shaken oil markets and their supply chains. If high prices sustain, the shock threatens to unleash a wave of global inflation. So that's the subject of today's Big Take. And I'm joined now by Ziad Dawood, the Chief Emerging Markets Economist at Bloomberg Economics, who co-wrote the piece. Ziad, first of all, thank you so much. And thank you for all of the great work that you and your team have really, put in over the last couple of days. The situation is really changing very rapidly in Iran. How could oil prices be impacted by further developments, first of all?
Would have been massively hit by the war in Iran. Our current estimate is that out of the $84 per barrel, the price of oil now, about $19 is due to the war in Iran. So a significant proportion of the oil price is due to war risk. And I think there are two significant war risks here. One, attacks on energy infrastructure in the region. And we've seen already attacks on Saudi Arabia, on Qatar, and on the UAE. And the second thing is the closure of Strait of Hormuz, which is a very important trade route for crude oil and natural gas. And that's what's caused the lift in oil prices. In terms of what's going ahead, I think there are two factors that will determine how oil prices will evolve in the future. One is the intensity of the war and the attacks, and they've gone as intense as possible, but maybe we'll have more targets. And the second thing is a duration of disruption. We've already had a few days of disruption in the Strait of Hormuz. The question is, can the global economy and the oil market handle longer disruption there? And if it doesn't, we think oil prices can basically go up above $100 per barrel if the current disruptions continue.
So who could stand to win or lose from this oil spike?
Well, in terms of countries, I suppose, if you want to be a winner, I think you need two conditions. One, you need to be an oil producer and exporter. And the second thing, you need to be outside the Middle East. So the countries that fit these criteria are countries like Russia, like Norway, like Canada, that produce and export oil, but they're not impacted by the disruption in the Middle East. The opposite set of conditions will apply to other countries that are set to lose from this. So if you're Europe, if you're China, if you're India, big net oil importers, you'll be hit by the higher oil prices, your growth will be impacted, and your inflation will be higher. And also in terms of sectors, that's in terms of countries. In terms of sectors, I mean, all companies that operate outside the Middle East may benefit from higher oil prices, but consumers all over the world will be impacted by this because higher oil prices does two things. It raises the price for everyone and consumers are hit by this, and it shifts income from oil consumers to oil exporters, and that creates winners and losers.
Thank you so much, Ziad. As always, Bloomberg Economics Chief Emerging Markets Economist Ziad Dawood, who co-wrote today's Big Take on the potential inflationary impacts of the Iran war. Read more on the terminal. Now, the Spanish Prime Minister, Pedro Sanchez, speaking from Madrid, says he won't change his position on the Iran war, calling for de-escalation.
We will not be complicit in something that is harmful to the world and that goes against our values and interests simply out of fear of retaliation from anyone.
Well, we're now joined by Bloomberg's chief Europe correspondent, Oliver Crook. Hi, Ollie. Says Spain's response is highly critical compared to other European nations. Are we seeing a division when it comes to Iran?
Yeah, it's been really interesting to watch this unfurl over the last few days. As you mentioned there, Francine, Spain has really been the most outspoken, the most critical of the United States over the last few days in terms of the European Union member states. We've had some indications also from the UK and from France that basically their view is that the United States may have violated international law. They obviously had some misgivings. I think everybody in Europe has had some misgivings, but they've been, relatively less or more vocal about it. Of course, Pedro Sanchez is in focus now because Donald Trump has now threatened to put a full trade embargo against Spain. This is obviously significant for the Spanish economy. You can see that represented in the IBEX today, which is sold off materially, but it also has massive implications, Francine, for the EU trade deal. The European Parliament was supposed to vote today as to whether or not to continue work on ratifying the trade deal between the EU and the United States. Remember, that work had been frozen after the tariff threats that the United States made around Greenland and also on the Supreme Court ruling, and there's a lot of questions about that trade deal going forward. Now, if the United States is threatening to put tariffs or to put a trade embargo on Spain, what are the Europeans going to do? The Europeans negotiate trade at the EU level, not at the national level, so it throws up about another 1,000 questions for the Europeans whose trade deal and the fate of that is already in total question, Francine.
So we also have Chancellor Merz's visit to Washington, and that's seemingly been overshadowed by the war in Iran. Has the German Chancellor achieved any of his intended goals?
Yeah, I mean, Francine, if his sort of main goals going into this conversation with Donald Trump, the first of which was to seek clarity on the trade situation, as we've just outlined, it was actually in the press conference with Friedrich Merz, who you basically didn't get to see because all of the questions were directed at Donald Trump, in which Donald Trump announced that basically he put a trade embargo on Spain. And again, after that press conference and after his conversations with Donald Trump, Friedrich Merz basically said there is solidarity with Spain. You can't have basically a bifurcated trade policy within the European Union. So he did not get a great deal more clarity on trade. If not, things are much more sort of opaque as a consequence of that meeting. That being said, we should say that the Germans have been much more supportive of the United States and Israel in terms of their actions in Iran, unlike the French, the UK, and the Spanish, who have been a bit more critical. The Germans have sort of stood behind Donald Trump. But we should also say that the Germans are very sensitive to this idea and to the price of gas sort of elevating. Obviously, it's been a massive story in Germany. The industrial decline over the last few years has been in large part a consequence of those rising energy prices, which is only getting worse over the last few days. But also for the Germans, key is trying to get Donald Trump's year on Ukraine. There's a certain Ukraine put on how critical the Europeans can be. And if the two goals were to try to get clarity on trade, clarity on Ukraine, I have to say that the Chancellor of Germany leaves Washington, D.C. potentially a little bit disappointed today.
Ollie, thanks so much. As always, our Bloomberg Chief Europe Correspondent, Oliver Crook. Now, there is a headline, an important headline coming in from the Mer news agency saying that Iran Supreme Leader options have been identified and that Iran is close to selecting a new Supreme Leader. So a very important development that we'll be watching very closely. Now, coming up, a British engineer company, Weir, slumping this morning after it reported earnings. We'll be speaking with John Stanton, the company's chief executive. That's next, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Now, the chief executive of Apollo Global Management says a shakeout is coming for private credit firms as concerns mount over defaults on loans to software companies. Speaking at Bloomberg Invest, Mark Rowan told us the impact will not be short-term, emphasizing the importance of strong risk management.
The entirety of the companies that you see that are public today, everyone was $40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management. Or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk.
Apollo Chief Executive Mark Rowan speaking to John Micklethwaite, Editor-in-Chief at Bloomberg Invest in New York. Now, Weir Group under a little bit of pressure this morning as a British engineering company reported profit broadly in line with estimates. Citi analysts said the lack of guidance beats will have disappointed some, while its organic orders growth was weak. I'm joined by John Stanton, the CEO of Weir Group. John, this market is brutal if you don't exceed expectations. I mean, in general, do you feel like it's just a tough market to please shareholders?
Yeah, well, good morning, Francine. Thanks for having me. Yeah, I think it is a pretty febrile market at the moment. And look, we're really happy with the performance that we've delivered in 2025. Another great year of strong operating profit growth, up 15% year on year. You know, the business is performing incredibly well. We're growing. The demand backdrop is highly active.
Highly active, as in a mess.
Yeah, there's lots of no. There's a lot. The demand is strong. There's a lot going on. There's a very positive outlook for our business. So yeah, I think we're seeing you know, the effects of a febrile market this morning.
John, I was going to actually say, and I was joking when I said, you know, is it a mess? But in terms of pipeline, like, so when you see all of the geopolitics, when you see the trade and tariffs uncertainty, the customers want more? Does that actually benefit the pipeline because they say, actually, I want it now because I don't know what happens in longer term, or does it make customers hesitant?
Well, I think the underlying fundamentals for us in terms of demand for gold, copper, and other critical minerals is just really, really strong. I don't think any of the things that are going on in the world at the moment really change that in any significant way, other than the geopolitics of it is going to have an impact on when new capacity gets built. And we do need new supply of all those minerals for a whole bunch of reasons that we all understand. And what's been quite interesting over the last couple of years is just the political response by governments around the world in terms of trying to free up the regulatory frameworks that will enable more investment to happen in mining to deliver those minerals, backed up by the sort of, requirement for now national critical mineral security for. It was all about net zero, but now it's about, much broader than that in terms of national security and defense, the whole AI theme. So if anything, it sort of strengthens the fundamentals for us, and it's about now getting on and delivering the investment for the growth.
So which are the commodities you're seeing the most demand for?
So our top three are copper and gold and iron ore. Copper and gold are incredibly strong, a very, very high demand environment at the moment in terms of the equipment and services and software that we supply. Iron ore is remaining pretty resilient as well, and within iron ore there's going to be a big push towards higher and higher grades of iron ore as the steel industry tries to abate CO2, so that's again positive for us. And then some of the things that we help to produce, such as nickel and lithium and the platinum group metals were softer last year, but even they're bouncing back now as well. So we're seeing a recovery in some parts of the complex that were a bit weaker last year.
And John, do you see even at the margins like some of the hesitancy to convert what's in the pipeline to firmer orders, or not so much?
No, I don't think there's any kind of hesitancy among our customers. There's not hesitancy. It's about the practicality of being able to do it. It's all about getting the permits and the licenses to be able to build new mines and expand new mines, to have the water and energy to do that. And the political response, as I talk, is really trying to free that up and enable investments to accelerate. So it's difficult to predict when that's going to happen, but we see that coming.
What's your forecast on margins?
We've achieved our objective of becoming a 20% plus operating margin company over the last few years, so I'm delighted.
Which is not nothing, so congratulations.
No, so I think, it's the hallmark of the quality of the business that we have today. And we're now in a position where we want to sustainably stay a 20% plus operating margin company. And we can continue expanding, but also have the ability to invest in the business and new technologies and R&D and our new software businesses to provide more to our customers.
So what are the key drivers, I guess, for the next leg of improvement when it comes to margins? I mean, it's, is it software, is it pricing, is it some of the offerings?
For us from here, we've done a lot of structural change in the business over the last few years, which has been about, improving margins, but also about making sure that we've got the right capacity in the right place around the world from a manufacturing and service perspective to deliver on the growth that's coming. So we're now finishing that phase of the story, and that will then evolve into a sort of ongoing continuous improvement efforts across the business, which will continue to sustain good margins. But the next chapter for Weir is really about growth, and it's really about leaning into that opportunity. And what we've been building alongside the capacity changes that we've made is a pipeline of new products and solutions, and the software businesses. So our relevance to the global mining industry is ever growing, and we have a great opportunity in the years ahead.
Working capital increased during the year. Should we expect this to revert closer to historical levels in 2026?
That we should. We had a specific spike at the end of 2025, reflecting actually some of those manufacturing changes where we were holding extra inventory to make sure that we supported customers while we were closing plants and moving production around. You've also got the effects of tariffs. So we passed all the tariffs on to customers in terms of price increases, so protecting our margins. But they're added on to all the inventory you've got at the end of the year where you've paid those tariffs. So that was also a little bit of a headwind for us. But as the platform normalizes, the working capital should come back down to our target of around 20%.
Yeah, just very quickly, there's a lot of volatility also when it comes to currencies and markets. Does that impact your thinking? Do you hedge? Do you need to hedge, for example, when it comes to currencies?
We don't really have much transactional exposure. Obviously, we're a sterling company, so we have translational exposure, and we operate in many countries around the world, so we have that. But we don't have much of a need to hedge anything from a transactional point of view. And look, I mean, it's the world's been quite volatile for a few years now, so we're getting used to working our way through it and being resilient as usual.
John, thank you so much. John Stanton, there, Chief Executive of Weir Group, joining us this morning. Now, there is a significant headline coming out of the Gulf, Saudi Arabia, saying there was an attempt to attack the Ras-Tanura refinery. We understand there was no damage. Again, this is Saudi's largest oil refinery, so any attempt or actually any attack that would have been successful would have had a huge impact on the price of oil, something we're watching very, very closely as we are the Strait of Hormuz. Up next, Bloomberg Brief, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheets.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stock losses deepen, oil extends gains as hopes fade for a swift end to the Iran war. President Trump says the U.S. will ensure a safe passage of oil from the Middle East as Israel and Iran continue to exchange airstrikes and missile fire. And primary results are in for one of the biggest contests of the 2026 midterm elections. We'll look at what Texas results could mean for Republicans in November. Let's take a look at those markets then, because several headlines yesterday seemed to calm markets, including the idea that President Trump was somehow going to ensure ships going through the Strait of Hormuz and maybe even have the Navy escort them. Well, that definitely sent a calm through markets yesterday, but we are seeing a little bit of a rise again today in oil and gas markets. Not quite the moves that we've been seeing in the last 2 days, but nevertheless, traders deciding that maybe it might take a little longer for anything that the president could come up with to actually get implemented. RBC oil analyst Halima Croft saying it's more of a concept of a plan She's questioning whether there's been any coordination actually with international tanker insurers and how the DFC is going to get to interested parties, given that the DFC has told them to contact the DFC. Let's look at futures, because we had a terrible session in Asia. The Kospi was down 12%, its worst day in history. S&P futures are now unchanged as the market makes a decision on what to do next. But inflation fear is still there, with the 10-year yield 4.08. The dollar index actually giving back some of its gains over the last week. Let's get to some individual movers now for some stocks to watch. Here's Abir Abu Omar. Abir.
Good morning, Vani. So despite a weak trading session in Asia this morning, the U.S. picture actually looks a little better than yesterday. But let me start with a stock that's doing quite well this morning. Moderna is gaining about 5% in the pre-trade session this morning, and that is on the back of this litigation settlement. So Moderna has agreed to pay $950 million regarding tech that it used to deliver its COVID shots back when COVID was a thing in 2020. So the investors are looking favorably at that information, and that is because it removes this looming financial risk that was haunting Moderna. But another stock that is doing quite well this morning, and we flip the page, that is Latham Group, and that is a pool designer, Vani, and it's looking pretty nicely this morning, also adding about 19% in the pre-trade session, and that is on favorable revenue outlook for the coming year, but also on some M&A action. It's acquired a smaller pool designer as well. And then finally, we move on to SanDisk. Now, the reason I chose SanDisk this morning is because of everything that is happening in the Middle East. So the tensions have created these fears over supply shocks that could happen over the Strait of Hormuz. SanDisk had retreated over the past 3 sessions. It is up 140% for the entire year, but it's doing quite well this morning, again gaining about 3% in the pre-trade session. That is after a close of about 9% down yesterday. So hardware back in our vision, Vani, and SanDisk is one of those poster childs of hardware stocks. And back to you.
That's for sure. Abir, thank you so much. We'll be back to you later in the hour. Also coming up in this hour, we speak to Lindsay Newman of King's College London and Kamakshya Trivedi of Goldman Sachs. The war with Iran showing no signs of a quick end. President Trump has tried to calm markets by ensuring safe passage of oil from the Middle East, or pledging to ensure that. Let's go to our team coverage now with Bloomberg's Jumana Brzezinski in Dubai, Kate Ackley of Bloomberg Government in Washington, and markets reporter Skylar Montgomery Koning. Jumana, let's start with you. Just give us the latest in terms of strikes ongoing and whether anything looks a little better or a little worse today.
Well, the absolute latest, and this was a headline that crossed about 5 minutes ago, Saudi Arabia saying that there was an attempt to attack the Ras Tanura refinery, but that no damage was actually caused. And this is obviously Saudi Arabia's largest refinery. It is one of the largest refineries in the world, and it had been targeted a couple of days ago as well, and has been operating with limited capacity. So yet again, another example of how energy infrastructure is being hit. And the past couple of days, the big theme, I think, for global markets has been the reverberations of this Iran war on energy, on supply chains, and President Trump has taken note. Yesterday, one of the big announcements was that the U.S. are looking to provide naval escorts alongside insurance guarantees to any carriers or vessels that are looking to pass through the Straits. But the Strait of Hormuz, as we've been talking about, is effectively shut down because tankers do not want to carry the risk of passing through it from a security perspective, but also from a cost perspective as well. The reaction, though, I will say this morning has been quite muted because a lot of experts are questioning how easily implementable this plan is going to be by President Trump, and really what the take-up is going to look like, and whether actually these carriers would willingly put themselves at the risk of potential bombardment. Earlier this morning, the Revolutionary Guard saying that they still maintain control of the Strait of Hormuz. So just to wrap it together, Vani, what you're seeing here is ongoing strikes at energy infrastructure alongside a closure of, or effective closure of, the Strait of Hormuz. And there's no wonder that energy markets are taking note, and of course the secondary effects as it pertains to global economics as well.
Yeah, European natural gas up 70% so far this week. Kate, let me come to you because the president certainly seems convinced that he can ease the situation in the Strait of Hormuz, but there's absolutely no guarantee that even if he had the Navy ships to escort every single ship in the Strait of Hormuz, that they'd get away without being attacked by Iran, right?
Right. I mean, it's obviously a very volatile situation, but that did do somewhat to calm the energy sector here in Washington, watching the administration very closely. We're also watching Capitol Hill this week, and the Senate has teed up a vote for today, the House of Representatives tomorrow, to decide whether to rebuke President Trump's, strikes on Iran. So, those are not likely to pass. It's mostly along party lines with Republicans in control of the House and the Senate. And for the most part, his party backing him in this war effort. But it is something that we're watching a lot on Capitol Hill this week.
Skylar, let me ask you, we're seeing somewhat of more muted reaction this morning in markets. That said, in the last couple of days, we've seen huge moves, and then the market is calmed by the end of the U.S. session. What should we expect today?
Yeah, this is the hard bit, right? We know that there's going to be an energy impact. We've seen that massive spike higher in energy prices and gas prices. And when you have Brent in particular 40% off the lows, that's going to have some kind of economic impact. Now, the question from here is how high do energies go and how long do they stay there? So a key question there will be, are we actually going to see ships go through the Strait of Hormuz? And then also, what is the policy response? So some of the worries have been around more fiscal spend related to this. Will we get that from those governments? It's also questions around what will the monetary policy response be? So will there be more inflationary worries from these central banks? And part of that will be, what was the starting point when we came into this crisis? So you'll look at data later today, like US ISM services, to see what the prices paid component was for the starting point for inflation.
We've already seen some central banks having to intervene as well. Overnight, we had Indonesia and India intervening to support their currency. So if the last couple of days' action were to continue for very much longer, it risks getting disorderly in these markets, particularly for the EMs, right?
Yes, absolutely. And that's what's been more concerning in the last kind of 24 hours, is the initial response was very energy focused. So you had your energy exporters doing well, your energy importers doing poorly. No, that's switched. It's more of a deleveraging, de-risking environment where the stuff that did well year to date, so Korea being a key example, is doing poorly now. And even stuff that should benefit from higher energy prices, like Brazilian equities, are doing poorly as well. And so that's more concerning because, A, there's still more to go, as in something like Korea's not undone the year-to-date gains that have been so massive. But also you just have to think about the environment where you have higher yields, where you have a higher U.S. dollar, is more negative for these currencies and economies, particularly in EM.
All right, Skylar, thank you so much. And thanks to our whole team coverage, Bloomberg Horizons anchor Jumana Bersetchi from Dubai, Kate Ackley from Washington, D.C., and Skylar Montgomery-Koning here in London. Now to other top stories trending on the terminal this morning. U.S. Senator John Cornyn and Texas Attorney General Ken Paxton are headed for a runoff in the Republican primary for the U.S. Senate in Texas. Meantime, state representatives James Tallarico defeated Congresswoman Jasmine Crockett in a Democratic race that was marred by legal challenges. The race in Texas is closely watched as Republicans seek to defend their majority in the Senate in November. Private credit funds from Blue Owl Capital to Blackstone are facing a wave of withdrawals, and analysts are warning default rates could soar if AI disrupts corporate America as much as some experts expect. And in private equity, managers are struggling to offload assets and return cash to investors, forcing them to turn to expensive forms of debt to extract returns from businesses they've acquired. And Blackstone talks on $4 billion New World deal hit a roadblock. Sources say that the billionaire family that runs the cash-strapped Hong Kong developer is reluctant to give up control. Blackstone has proposed injecting about $2.5 billion into a special purpose vehicle to become the largest shareholder of New World. Coming up, we look at the under-the-radar trends we should be watching for in the Middle East with Lindsay Newman of King's College, London. This is Bloomberg.
to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
Labor market anxiety sky high.
Could a weak labor market report spook economists?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
There actually are white-collar jobs right now. It's not just doom and gloom.
The narrowness of job gains has always been the question.
The stability is masking some fragility.
Let's pay attention.
The February Jobs Report, Friday on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Lindsay Newman of King's College London says an isolated and cornered Iran was vulnerable to exactly the type of operation the US and Israel commenced on Saturday. And while looking for friends, Iran may have just awoken many more regional adversaries. Lindsay Newman joins us now. Lindsay, you know, you followed, I'm sure, the TikTok day by day. What's your assessment of where we are right now? Is either side ready for an off-ramp yet, or do they need to, you know, strike it out for another couple of days?
Thank you so much, Bonnie, for having me. You know, we are not yet in a position to be deploying off-ramps, but we're not so far off, I wouldn't think. You know, the main issue here is there's going to be an inflection point after which Iran's capabilities, its missile and drone capabilities, are so degraded, its leadership structure is so degraded that it can no longer reasonably continue at the pace that it's going. But the question is, does the U.S. and regional actors have the ability to continue to shoot down these drones and these missiles that Iran is firing, and not just at Israel, but across the region? And as we know, air defense systems are more expensive than drones.
What is your assessment of how Iran has been conducting this operation? We haven't, I mean, one casualty is too many, right? But we haven't seen hundreds or thousands of casualties. Iran seems to be pinpointing certain areas that it wants to hit. And I'm not sure if it's reaching the targets it wants to hit, or what do you think it does want to do here?
Yeah, as I said in that quote that you read from my Substack piece on this, Iran had seen its fortunes really fluctuate quite dramatically over the last 2 years. If you think back, just 2.5 years ago was the October 7th attack by Hamas, a regional proxy of Iran. Iran had very active Houthi proxy in the Red Sea, continues to be active there, and various other proxies working in Lebanon and in Syria. Now, just 2.5 years on, most of those proxies have been degraded or eliminated, and Iran was in a position where it was facing its own domestic challenges, an economy on the brink, an aging leader, protest movements in January. And so Iran was really backed into a corner when the U.S. and Israel struck, and has then shown that it's willing to throw everything at this, that it knows it's an existential, this operation is an existential threat to Iran's regime and its institutional future, regardless of what Iran is projecting at this moment in time. And that's why we're seeing Iran not just target U.S. military bases in the region, although of course it has, not just target Israel, although of course it has, but also target civilian assets, energy assets, economic assets in these regional countries that were otherwise not involved in this war. We're not seeking to be brought into this war. And that has, in fact, awoken in them an animus, a desire to get involved and to see the Iran stop with these pervasive missile and drone attacks.
Sure, but Lindsay, is it not the case that Iran could do a lot more damage if it wanted to? Is it holding back in some way? Because if it goes too far and inflicts major casualties anywhere, well, then all bets are off, right? Then there won't be any sympathy or any road to an off-ramp.
Yeah, I think it's hard to know, Bonnie. I mean, we just don't have the counterfactual here of what the impact would be if the 600 or so ballistic missiles that have been fired just at the UAE alone were actually not shot down by anti-defense systems, anti-missile defense systems. That could have been massive, massive damage and casualties. So we just don't have that counterfactual. And we know seemingly that Iran does not have the nuclear capability, because if this would seemingly be the moment to deploy that. But the question is that have Israel and the U.S. done enough in actually stopping the missile capability, the launching capability in Iran, to prevent the continued deployment of the actual stockpile that Iran seemingly has. And the impact is not necessarily high in casualties, although there have been casualties, as you said, and one death is too many. The U.S. President Donald Trump made that clear when he spoke about the operation over the weekend. But we know overnight we're seeing the impact on financial markets, economic markets, the energy pricing. So this is having vast impact. It is a rewriting. It's a reorientation of the Middle East trajectory that we're watching.
What do you imagine will happen when we get a new supreme leader?
Yeah, we're obviously anticipating that they could be announcing a new supreme leader as soon as today. It appears as though Mojtaba Khamenei, Ali Khamenei's son, is now appears to be the front runner for this position. Israel has been very clear about its intentions that any new leader will be an immediate target for further action. We have to think that after what we've been watching over the last couple of days, that Israeli intelligence, U.S. intelligence, have a pretty good sense of movement and behavior of Iran's leadership structure. And so there are real risks to whoever is appointed the next supreme leader. Now, if that next supreme leader is not immediately targeted, for example, Khamenei's son is another hardliner expected to carry on exactly in the same direction as his father. We're not expecting to see regime change from within the leadership structure. It has not yet been clear that there is anybody been identified by the U.S. administration or otherwise that is a so-called moderate in this Iran regime. So the likelihood of a situation where we're going to see something like Venezuela is quite slim. The real opportunity for change is if, once the dust settles on all of this military operation, how the Iranian people respond. And that is a big question. What is the sentiment of Iranian people right now? And it's a real unknown. It's a real unknown.
Lindsay, thank you so much. Lindsay Newman of King's College London. Coming up, Minneapolis Fed President discusses the Fed's rate path this year. More from that conversation at the Bloomberg Invest Conference. That's next. This is Bloomberg.
Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Minneapolis Fed President Neil Kashkari spoke about the resilience of the U.S. economy and what that means for the Fed's rate path this year. He spoke with Bloomberg's Michael McKee from the Bloomberg Invest Conference in New York.
The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. I think housing inflation is trending down. I've got a lot of confidence in that. Core goods inflation has been trending up because of tariffs. Services inflation, I think, is slowly trending down, tied to the labor market. And the labor market is in a decent place, but showing some signs of softness. And so that's what gave me confidence that, hey, one cut later this year might make sense.
Now, the neutral rate, I don't know. Well, tell us where you think we are compared to neutral, because the question I have is every SEP says that the Fed will hit its target 2 years from now. I know. The next SEP says 2 years from now. Are you ever going to really hit it?
Well, we have to hit it. And I think my colleagues and I are committed for the credibility of the institution and for anchored inflation expectations that we absolutely have to hit it. But where the neutral rate is has been a big question mark. Over the last several years, we kept forecasting that the U.S. economy is going to slow down, and then it just powered through. I thought when we raised rates as aggressively as we did that we'd be slamming the brakes on the economy. We weren't. The economy proved to be much more resilient. In the face of tariffs, it created a lot of uncertainty, created a lot of noise, raised goods inflation went up, but the U.S. economy proved more resilient. And so the fact that the U.S. economy has been this resilient, given the stance of our monetary policy, tells me the neutral rate must be higher, at least in the near term.
That was Minneapolis Fed President Neil Kashkari speaking with Bloomberg's Michael McKee from the Bloomberg Invest Conference in New York. And do tune in for day 2 of Bloomberg Invest. Guests include Ye-Soon Hung of State Street, Bruce Richards of Marathon, and Scott Nuttall, KKR CEO. And the Middle East dominating front pages once again today. The Washington Post leads with the Pentagon identifying 4 out of 6 soldiers killed in the war with Iran. The 4 soldiers were killed in a drone attack in Kuwait. The Wall Street Journal leading with reporting suggesting Israel is blowing up Iran's police state to clear the way for a revolt. The Journal says airstrikes have targeted organizations responsible for suppressing protests and cracking down on separatists. Analysts, though, are skeptical the strategy would work. And the Financial Times leads with Israel vowing to kill Iran's next leader. Israel's defense minister says any candidate would be a, quote, clear target for elimination. Coming up, we'll look at FX havens of choice in an environment of higher oil. Kamakshia Trivedi of Goldman Sachs joins.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing. Because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotels in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stock losses deepen, oil extend its gains as hopes fade for a swift end to the Iran war. President Trump says the U.S. will ensure safe passage of oil from the Middle East as Israel and Iran continue to exchange airstrikes and missile fire. And primary results are in for one of the biggest contests of the 2026 midterm elections. We'll look at what Texas results could mean for Republicans in November. So let's take a look at these markets then, because they are moving on every single headline. Right now, though, Brent crude is still above $83 a barrel and WTI still close to $76 a barrel. This is a market that is jittery. And when President Trump said he could insure, if you like, or reinsure the insurers of tankers that are going through the strait, well, at first it calmed the market, but then analysts started saying, well, hang on a second, how long is that going to take? And has the mechanism started to go into effect? And who contacts who? And has the administration actually talked to any insurers? We'll see what happens there, but certainly gas futures are a little bit lower today, having gone up 70% this week. So that's the context of that 2.6% move. It's really not all that much. Let's take a look at futures, because we had a really terrible session in Asia overnight. Europe was mixed. S&P futures are now actually gaining again. Don't forget, though, Monday we did see a nice rally in tech shares. Microsoft was up more than 1% Monday, so it wouldn't be too unusual to see a rally perhaps today. The 10-year yield, though, still expressing inflation concerns at 407.47, and the dollar index giving up some of this week's gains. Let's get to some individual movers now with Abir Abu Omar.
Good morning, Vonnie. So the picture for U.S. equities this morning is not as bad as it was yesterday, up 0.2%. Moving on to some of the individual movers that are contributing to this gain in the S&P is possibly Moderna. And I'll take you back to COVID days. I know it's unfortunate, but Moderna is gaining nicely this morning, adding to those gains earlier from the pre-trade session, up more than 5%. And that is on the back of settling this litigation over patents, over the tech that it used essentially to deliver the COVID vaccination shots back in 2020. So $950 million that it's paying, and that removes the spookiness that investors had about the financial future of the vaccine provider. Another stock that is doing quite well is smaller, but we flip the page and we see Latam Group here that is gaining about 20%. It's advancing quite well in the pre-trade market in this morning's session. and this is a pool designer. It's up on some fundamentals, so results were pretty good. The outlook for sales over this coming year is pretty good, but also this is moving upwards on the back of some M&A action. It is agreed to buy a smaller pool designer for about $17 million, so not a massive deal, but investors are looking favorably at that. And then finally, we look at the opposite side of the software trade. Now, SanDisk has been doing quite well this year, up 140%. This is despite some retreat that it saw over the past 3 sessions, down 9% yesterday at the close. It's gaining more than 3% this morning, and that is on the back of some easing in the supply shocks that we're seeing coming out of the Strait of Hormuz. And this is SanDisk for you. The hardware story is back in Vision. Vani, back to you.
Yes, it is. Abir, thank you so much, Abir Abu Omar there. Now, central banks in India and Indonesia had to intervene overnight to support their currencies, a knock-on effect from higher oil prices, stoking inflation concerns, while Korean authorities say they'll closely monitor the won. This after the dollar appreciated for a third day. It's getting up some of those gains now, but Kamakshya Trivedi is head of global FX and interest rates at Goldman Sachs, and he joins us now, and he's going to explain everything that's been happening in the last 72 hours. Kamakshya, this intervention, is it a sign that markets are unraveling in some emerging markets where they may not be able to take this kind of pressure that U.S. liquid, hefty markets can take?
I think unraveling is a strong word. I mean, I think that what you are seeing is certainly the volatility has picked up. I think particularly if you are on the oil importing side of, the trade balance, and India is a very good example of that, then I think you are going to see volatility. I think you are going to see weakness. I think there's concern around what that means for the balance of payments if there's a sustained move higher in oil prices. And so I think, some of this intervention reflects an attempt to try and calm that volatility. I think stepping back, though, I think the bigger picture here is that, you're seeing two things come together. One is that, when you have an oil shock of the kind that we've had, the U.S. and the U.S. dollar in particular is a major gainer relative to, say, Europe and Asia. And I think that's one dimension along which the shock is playing out. But the other is that we came into this event over the weekend with markets and investors broadly positioned the other way around. People were generally longer the rest of the world. They were longer equities in Asia. They were longer, fixed income in Europe, for example. And I think what you've seen is this combination of a kind of terms of trade distributional shock around oil prices, but then also positioning unwind, which I think is contributing to these. And I think what you're seeing from policy authorities is trying to moderate that a little bit through these interventions.
Sure. This move that we saw in the 10-year from basically 393 before the war to 407, 15 to 20 basis points in the last few days. Is it justified? Is it expressing concern that will go away as soon as these oil prices go down another $10 again?
I think the direction of travel is justified. I mean, if I think about, again, what has happened, I think it's primarily what we have priced is a kind of inflationary shock, the fact that oil prices are up. And so I don't really have a great problem with the level of bond yields. The move has been relatively rapid, but that reflects the kind of, extent and the, intensity of the shock that we've had. I think from here, a lot is going to depend on how long the shock lasts. I mean, if you look at even oil prices, the interesting thing is, as you mentioned earlier, yes, it's spiked. Yes, it's gone up even today. But the front-month oil price is the highest across the whole curve. So even markets are pricing this as being, so far at least, a relatively short-lived shock. And that's sort of causing some jitteriness in inflation, and that's causing bond yields to move up. So again, I think that all of those reactions make sense. I think the big unknown, the big uncertainty is our markets too complacent to think about this as just a front-month shock or something longer-lived? I think the more it becomes a longer-lived thing, the more it moves from having just an inflationary impact to also broader growth impact. And I think that's what is the shoe that is not yet, something that we've seen.
And we're seeing the same impetus in VIX forward curves and also in shipping prices, so beyond sort of the next week, shipping prices actually go down again. So as you say, complacency. Iran is not Venezuela. It's not going to be sort of sweet-talked into doing a deal with the United States. At the same time, some kind of off-ramp might appear. In that case, are we back to a situation where the markets start pricing in 2 Fed rate cuts again this year?
I think so. I think if you see a very rapid de-escalation, if the energy markets, for example, or some of these other markets are correct in thinking that this is a relatively intense but short-lived event, then I think, yes, I think you will go back to a world where, in general, without this energy price impulse, actually inflation was trending down in many parts of the world. The U.S., is one of those, but it's really a broader phenomenon across, other DM and EM parts of the market. And I think in that sort of eventuality, yes, I think 2 cuts by the Fed, perhaps backloaded into the second half of the year, seem like the right baseline scenario.
Is it binary? I mean, do we either go up substantially from here on oil prices or go down substantially? Because it seems to me that $75 on a barrel of WTI is not the end of the world, even for inflation. But something a lot higher would be, and something a lot lower would be back to where we were.
I think something a lot lower would definitely be back to where we were. Again, I think it depends a little bit on, how the physical disruptions ease, right? Like whether you see a kind of end to this most intense phase, whether you start to seeing the physical supply start to move out of that region into the rest of the world. I think that's the key, right? Like I think, if this starts to last beyond 3, 4, 5 weeks, I think the markets are not quite priced for that.
So the dollar has been the beneficiary here. What currencies are you most focused on, most concerned about, perhaps?
Look, I think that the dollar, is one of the gainers in this kind of terms of trade shock with higher energy prices. I think a lot of people have been looking at the yen, for example, why the yen hasn't quite appreciated as it would have done in other events, where you have risk off. But I think, again, it's important to remember the yen in Japan and a lot of Asia is on the wrong side of this oil trade balance. And so I think that to some extent, the higher inflationary impulse, the higher import energy bill that is going to come as a result of this, I think kind of tends to weigh on the yen. So I think it makes sense that, say, something like the Swiss franc, is a better safe haven in these kinds of geopolitical situations than the yen per se. And then I think, as you spread the gamut wider, places like Canada, Canadian dollar are outperforming here, again, an oil exporter. Places like Hungary, the Hungarian forint underperforming, tends to be very sensitive to kind of higher natural gas prices. All of these things make sense from a fundamental, energy balance perspective, but I think their moves are being somewhat exacerbated by that positioning element that I mentioned. I think people generally came into this, long a lot of carry trades, long a lot of duration, short dollars, long international equities, and some of what you're seeing in the price action, for example, in the Kospi this morning, I think is a reflection of not just that terms of trade differentiation, but also the positioning unwinds that are taking place.
Kamakshya, fantastic stuff. Always a pleasure. Thank you so much. Kamakshya Trivedi of Goldman Sachs. Now to other top stories trending on the terminal this morning. Goldman Sachs CEO David Solomon says he's been surprised by the, quote, benign reaction in financial markets to the Middle East conflict. Speaking at the Australian Financial Review Business Summit in Sydney, Solomon said it will take weeks to understand more about the situation in the region. Several Chinese financial firms are scaling back exposure to Middle Eastern debt. Regulators are stepping up oversight as the conflict raises concerns over the nation's extensive lending in the region. According to Bloomberg data, Chinese bank loans in the region jumped to a record $15.7 billion in 2025, with the bulk going to Saudi Arabia and the United Arab Emirates. And Blackstone takes on the $4 billion New World deal. It did hit a roadblock, though. Sources say that the billionaire family that runs the cash-strapped Hong Kong developer is reluctant to give up control. Blackstone has proposed injecting about $2.5 billion into a special purpose vehicle to become the largest shareholder of New World. Coming up, the results are in for the Texas primaries. We'll discuss what it signals ahead of the November midterms. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
There is simply too much at stake in this midterm election for our state and for our country. The final 2 years of President Trump's agenda hangs in the balance.
I can tell you now that people have been disenfranchised.
Results of the Texas primary races are sending signals for Republicans. The Texas Senate race has implications for which party will control the chamber after the midterms. Meanwhile, incumbent Congresswoman Jasmine Crockett was defeated in the Democratic Senate race. Joining us now from Washington is Kate Ackley of Bloomberg Government. So what lessons will Republicans be taking away today, Kate?
Well, first of all, this primary for the Texas Senate seat was already the most expensive primary for a U.S. Senate seat ever. There was something like almost $130 million spent when you look at the super PACs, the candidates on both sides of the aisle. And now with this going into a runoff between Senator Cornyn and Ken Paxton, the spending is just going to continue to surge on the Republican side. There are a lot of big money donors and groups that are involved in that race. And we're going to just see for the next, till the end of May, there's going to be a real ad blitz for both of these candidates and against both of these candidates. So that's a big takeaway. Big price tag for elections this cycle. This one right now leading the pack on that. You also see sort of this, what is the future of the Republican Party? The criticism for people who didn't vote for Cornyn is that, he's too much the old guard, establishment Republican. So we'll see, does President Donald Trump weigh in on this race? He did not endorse. He was down in Texas and sort of said positive things about the candidates, the Republican candidates in the race, but did not make an endorsement. There will be some pressure. Does he weigh in or just let these two remaining candidates fight it out in the runoff? I'll also say that in terms of what this means for control of the Senate, next year after the November elections this year, there are a lot of Democratic donors that have expressed skepticism that Texas is really, online, live, but you're going to see a flood of excited Democratic small dollar donors, I think, flooding in for Tallarico, who do see this as a potential, decider in the control of the Senate.
Kate, a fascinating evening indeed. Kate Ackley of Bloomberg Government. Thank you. Oil pairing some gains now on the plan to ensure and escort tankers passing through the Strait of Hormuz that President Trump put out there. Joining us now is Bloomberg's Anthony DePaola. Anthony, how possible is this? Can the president guarantee anything in the Strait of Hormuz?
Yeah, hi, good morning, Vonnie. That's a great question, whether he can guarantee everything, because we've seen some analyst reports saying that any U.S. escort ships would be kind of sitting ducks as they go through that narrow passage, because the Iranian Navy, the IRGC Navy, are all looking at that area very closely, and we have already seen some oil tankers that have been hit, even in the first couple of days of this conflict, that have been hit in and around the Strait of Hormuz. So that's a really risky situation there. We did see in the Red Sea, when we had the Houthis in Yemen firing missiles and attacking shipping going through there, that naval escorts were only able to alleviate some of the risk. They weren't able to help all of the situation there, and that was with an adversary in Yemen that had much less advanced weaponry than what we think the Iranians have, and then that can bring to bear in a much smaller portion of sea. So it's a big risk there. You can see also from the markets today that the markets are really a little bit skeptical of that being a successful way of reopening shipping into the Persian Gulf via Hormuz, or even, bringing vessels also out of Hormuz, because there are a lot stuck in there. We've seen oil prices still high. They came off a little bit, as you said, but not that much, not enough to show that the markets are seeing an opening of Hormuz. And we still have European gas prices, which have absolutely skyrocketed, and those are very high because the LNG tankers that are supposed to come out of the Gulf, we've got plants in Qatar, Abu Dhabi, those are blocked and not able to supply the market. So that's why we're seeing those prices really high. The market really isn't seeing the mechanics and the possibility of that opening up Hormuz just yet, Vonnie.
Anthony, thank you so much. That is Bloomberg's Anthony DePaola for us there. Santander Executive Chair Ana Botín says she is confident the U.S. and Spain will repair ties after President Trump threatened to cut all trade with the country. She spoke with Bloomberg's Danny Berger following Trump's comments.
Spain and the United States have had an amazing relationship forever, centuries, and I'm sure that's going to happen again very soon. So Santander, on the other side, we are a big investor in the United States. We see ourselves as a bridge between the United States and Latin America and Europe and the United States. So we all focus on serving our customers. We have close to 5 million Americans that we serve every day. So, this is a great country, and we're investing more.
Are you concerned about any greater impact when it comes to either Spain or Santander itself? If this is what happens, if there is trade cut off, how big of a ramification could that have?
So at the end, we're here to serve our customers. And if our customers need our support, that's what we're here for. So, we are a great connector. Trade is one of our big activities. We're one of the big trade finance banks in the world. And again, what we see is that the trade continues and is very strong, and that's the numbers. So there is still a lot of connection, increasing connection between our countries.
So you're confident on the relationship between the U.S. and Spain, between Santander and the U.S., regardless of what the headlines are? Is that fair to say?
Yes. The long-term relationship is strong, and I think that's where you go back to, again, we're living very extraordinary times.
Can I ask, because you also did a deal recently, announced you were buying Webster in the U.S. Given some of the political volatility, how do you think about your regulatory outlook? Are you concerned that that might come under greater scrutiny if there are relationships fraying?
So at the end of the day, our business model is perfect for what's going on in terms of fragmentation. So we invest in the countries where we operate. We have subsidiaries. We bring a lot of capital. That is exactly what, countries are looking for right now. So we don't operate from one country into another. We actually invest, and we have physical presence with employing thousands of people. So our model is very well suited for today's more fragmented world.
Just one final point on sort of some of this dislocation we're seeing, because a lot of this obviously came up after war broke out in Iran. How are you thinking about your Middle Eastern presence and how that might affect Santander?
We have a very limited Middle Eastern presence. We're basically one of the largest banks in the world by number of customers, 180 million in Europe and the Americas. And as we see the situation today, clearly there's a risk that growth will slow down if this goes on for, months. But our presence right now across the Americas will be, I think, least affected than almost any other part of the world. So again, slower growth potentially, but for Santander, actually, our footprint is in the least affected regions.
Are you thinking about inflation at all as a potential risk?
Absolutely, yes. I think inflation is a risk. Stagflation at the end is the risk we're facing if this lasts. But it's very early days. We don't know.
Santander Executive Chair Anna Botín with Bloomberg's Danny Berger. And don't miss Danny's Deals Show every Wednesday at noon New York time. Coming up, we'll get you set up for your trading day with ADP data and the Beige Book on deck. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Now a look at what's ahead. ADP data out at 8:15 Eastern. We also get ISM services at 10 a.m. Plus, the Fed releases the Beige Book at 2 p.m. Eastern. And then after market close, we get Broadcom earnings. We'll see what the market decides to concentrate on today. Certainly in the early going, we're seeing a bit of a mixed picture. So in Europe, for example, the session is higher now. We just got Euro unemployment data that was unexpectedly lower than forecast. That's playing into the calm that we're seeing in markets, but also this idea that crude oil perhaps isn't rallying as much as it did the first couple of days of this week after the war started. So we do have Brent crude above $82 a barrel, but maybe 85 is the next level to be looking at. WTI is still around $75 a barrel, waiting to see if the plan that the president put out there could actually be implemented in any way and what it might mean for cargoes stuck in the or outside the Strait of Hormuz. And that's having a knock-on effect to futures. As you can see, the S&P futures and Nasdaq futures are pointed to gains today in the session. We'll see if that holds. Of course, not much has held from the morning to the afternoon in the previous sessions. Inflation fear is still out there, according to the 10-year yield. That's it for Bloomberg Brief.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Versace in Davos, Switzerland, and this is Bloomberg.
I think the price action's reasonable right now.
There's just too much uncertainty about these larger narratives.
I think it's a buy incrementally less America moment.
There's still some more room that you could fall.
The equity market is going to have a hard time making that next leg higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, looking for stability. Crude pairing gains following the biggest 2-day rally in almost 6 years, as President Trump is attempting to support shipping through the Strait of Hormuz. And reports suggest Iranian operatives have reached out to discuss ending the war. That report is supporting sentiment this morning.
Okay, there are a couple of takeaways here from this report that isn't verified. And to be clear, is back channels discussion through another country's spy agency talking supposedly with the CIA operatives, and people don't know how serious anyone is. The fact that markets want to rally gives you a sense of people wanting to buy this dip, still wanting to hope that this is going to be temporary. On the flip side, it highlights all of the thorny questions like who's in charge in Iran? Who does President Trump want to be in charge in Iran? And then how can anyone rebuild trust in this type of circumstance?
This war is ongoing. This conflict is arguably still escalating. This from the UAE just moments ago. They intercepted 3 missiles and 129 drones just today. And the president's trying to support traffic through the Strait of Hormuz. And this is what he's trying to do, provide a framework for insurance and escort ships through the strait. In his own words, no matter what, the United States will ensure the free flow of energy to the world. The President of the United States. This is the reaction we've seen on Wall Street. RBC, we question how much planning has been done on the insurance backstop. This from ING. Naval escorts will be sitting ducks to Iranian attacks. This is easier said than done.
And frankly, getting people's confidence that they're not just going to be shot down is different than saying, we will escort you, especially because it hasn't happened yet. You also are seeing a lot of ships already getting rerouted, and already the stockpiles are full, which is a reason why you're seeing production being halted in different places. What President Trump wants to do is to invoke the U.S. International Development Finance Corporation to support some of the insurance to back these ships. That alone is going to take time. So even if there is a mechanism to do that, there is some friction between now and when it could actually get implemented.
But I'm with you on the market side. We haven't seen tremendous damage at the index level on the S&P 500 this morning. European equities supportive. Bond yields are off the highs. Haven't seen a new high intraday on crude for about 24 hours now, off that 85 level we broke through yesterday. So some subtle signs that markets are adjusting and have completed that adjustment.
When you talk to investors, they want to look through this. They want to look through geopolitics. They always say this is not going to be something that determines for a longer term unless it goes on for a long time. And they talk about the solid fundamentals. That's the reason why the pillar of what we get on Friday, the non-farm payrolls report in the United States, could be really important. Does it confirm that strength, or does it potentially throw a thorn in that particular narrative?
So what matters to markets at this point? This from SocGen. 1, the shock duration, all on board with that. And 2, the Fed's reaction function. Later this morning, in 2 hours and 30 minutes' time, we'll catch up with the biggest dove on the FOMC, Governor Myron, and a lot of questions of him as to whether this shock matters to how they set policy.
Especially because Neil Kashkari of the Minneapolis Fed, speaking to our own Michael McKee yesterday, said it potentially could take a rate cut off the table for this year, talking about how right now it's too soon to know what kind of effect this would have on inflation. Typically, the Fed looks past these types of shocks. Do we get the same kind of view from Stephen Myron?
Brent crude this morning, 82.65, WTI 75.28. Coming up this hour, we'll catch up with Sebastian Page of T. Rowe Price, with global markets whipsawed by the Middle East. John Lieber of Eurasia Group as the White House looks to support shipping, and Paul Sankey of Sankey Research following oil's biggest two-day gain since 2020. We begin this hour with stocks looking to recover as geopolitics fuels major volatility. Sebastian Page of T. Rowe Price writing this: the bear case is a prolonged war, prolonged closure of the Strait of Hormuz, and escalating attacks on energy infrastructure. Our Brent range then would be 100 to 120. Sebastian joins us now for more. Seb, welcome to the program. That's the bear case. What's the base case?
You know, our research platform's been on overdrive over the weekend, as you can expect. And I've been reading the research from our analysts. And John, I can say there is no base case. It's extremes on both sides. I hate saying the range of outcomes is wide because it always sounds like an out, but we really have two scenarios, one short, one long. And the short scenario, you know, I think the Wall Street Journal reported that this is a bit of a race in terms of the missiles and drones from Iran, and then the defenses from the Gulf countries that both are running out. And then you just reported on news that you know, there's some, I don't know if you call it rumors or something else, but there's some news items that are pointing towards the short scenario. And then the long scenario is an escalation, and you just outlined it. So, John, there is no base case. We're looking at scenarios. That's the only way to manage this right now between short and long. And what we want is, you know, geopolitical hedging in the portfolio, which we've had for a while. So we remain long real asset equities, and including energy, but also metals and mining and commodity stocks.
Seb, where do bonds fit in as we confront a shock like this one?
Yeah, you know, that's a tough question. I'm a bit of a correlation nerd, and one of the studies I've done is a study of a correlation between stocks and bonds. And if I were to boil it down, because we talk, and I know in surveillance we talk about this, we talk about stocks and bonds and the stock-bond correlation. You can boil it down pretty simply. If you get an inflation shock, both stocks and bonds can go down together. If you get a growth shock, then I still believe, and the evidence is there, that treasuries remain a hedge for a growth shock. Now, these things are always ingrained, so it's which factor dominates. Well, if you look at the current situation, the inflation risk is clearly there. One of our analysts studied, you know, several oil shocks, and he calculated that peak oil on average occurs 23 days after the beginning of the attacks or the military intervention. And then that oil rallies on average 27%. Again, these are averages, a mix of extremes. The range of outcome is wide, as much as I hate saying this. So it's a matter of hedging, and you'll see that in those cases when oil is driving and when inflation concerns are there, and you saw the one-year inflation swaps go up around these events, well, then bonds are not the same hedge as they used to be, and you have to have alternative hedges in the portfolios.
Sebastian, how important is non-farm payrolls on Friday in light of this, given the fact that a lot of whether this is an inflationary shock or whether this is potentially a shock to growth is predicated on how much momentum there was heading into this?
Look, I think the geopolitical headlines will continue to dominate into Friday. Non-farm payrolls are always important. No single data point matters, but we still debate employment quite a bit in our asset allocation committee, especially in the context of AI. I believe the unemployment picture is okay in the U.S. for the time being. You know, we're still at 4.3%. I always remind people that the long-run average unemployment is 5.7%. So the economy in the U.S. is humming. Of course, if you get a tax on the consumer in the form of higher gasoline prices, and then that can change the picture, but that won't be in the non-farm payroll numbers on Friday. So I guess, Lisa, I'll say moderately important. It's part of the mosaic, and we have to. Yeah, I like the question because sometimes we get carried away with geopolitical headlines. Of course, this is a major event. It's just like it's in some ways. Another word I hate to use is unprecedented, but I'm using all the words I hate to use this morning. But you know, growth and inflation are still major forces driving the U.S. economy, and if we're running at 5.5%, 6% nominal growth, stocks should do okay. And by the way, there's a nice study by Merrill Lynch that shows that about 60 years of geopolitical shocks and 70% positive stock returns after a year and an average of 9.5%. So that kind of consensus narrative is you buy the dip and you know, it's a buying opportunity when you get a geopolitical shock. But I think the picture right now is more nuanced, and we're advocating for hedges, including in the stocks portfolios, including real asset equities.
Sebastian, I'm going to give you another word that you probably hate using. Is this market virtually untradeable based on the lack of fundamental backing behind a lot of the potential moves?
Yeah, untradeable. Here's another one, Lisa. Thank you. I think that markets are deep and liquid, and we talked about treasuries. I mean, those can remain a hedge if we get a growth shock, which I don't necessarily expect. That's not the base case. You see oil markets behave. You know, we're already in the 80s in crude. It's been interesting to follow the oil price reaction on my Bloomberg terminal, you know, from this idea that we'll escort ships around the Strait of Hormuz and that we'll insure them. And then, you know, you saw oil prices come down a little bit, but then this morning it looks like, you know, we're back up. And so you were just reporting about Wall Street skepticism. I think this is hard to do, but overall markets are behaving, Lisa.
Seb, we're confronting a lot of shocks and have done over the past month or so. I think there's three broad shocks, AI disruption being one, the second being the jitters in credit, and now the third, the energy shock over the weekend. I'm interested in 2 and 3 and the interplay between both. The credit jitters need a rate offset, and I just wonder how you are thinking about the prospect of the rate offset being constrained by the story developing, which is 3, the energy shock. We're not getting a loosening of financial conditions. We're getting a tightening of financial conditions at a time when credit jitters are heightening. They're not de-escalating. And I just wonder how you think that's going to play out in the weeks to come.
Yeah, look, the major risk for multi-asset investors is that the treasuries don't behave as you need them to be when stocks sell off. But I think I heard Lori Calvasina say on Surveillance earlier this week, let's all take a deep breath, right? Right now, stocks are doing okay. And I think there's this narrative that geopolitics won't drive everything. You know, John, you have an AI tool now on the Bloomberg terminal. It's in beta version, right? But I was using it just for fun, and I thought I mentioned it on the show. And I was looking at, okay, what's the relationship between oil and stock prices? And only 6% of stock price volatility over time, not during specific events, you know, can drive the S&P 500. So it's a lot of different factors playing all at once. AI is a huge debate on our asset allocation committee, especially in terms of what it will do to employment and how fast. Some of us are saying, look, you know, it takes a lot of resources to clean your data and tag your data and upgrade your infrastructure. So maybe you're actually hiring people to deploy AI. This is just me being controversial, but then we all know that over time, it can replace jobs. And how is this going to play out? I was driving to work earlier this week, listening to Bloomberg surveillance, and you know, my drive's about 30 minutes, Jonathan, and it was 30 minutes I got to work, and there was no discussion on surveillance of AI because of all the geopolitical risk, right? And so I was like, wow, they haven't talked about AI or the Fed even once, and I'm at work already. It's been 30 minutes. But those factors, let's not forget that they still matter very much in portfolios. And before all this happened, we saw industries fall one after the other, which we ended up debating in our asset allocation committee. It's this idea of dispersion, John, and that's going to continue, dispersion across industries. Our portfolio managers like healthcare stocks. It's interesting. They like technology, but they also like materials and, you know, even energy stocks.
Seb, as they say, we can only focus on the shark closest to the boat. There are a lot of sharks out there, but the shark closest to the boat right now, the shark over the weekend. Sebastian, it's good to see you, as always. Sebastian Page there of T. Rowe Price and the author of The Psychology of Leadership. The psychology of this market right now, you indicated you think this is a market that wants to rally.
Clearly, that was the reaction in terms of any little catalyst, no matter how small and how second or third or fourth hand it is, giving people an impetus to buy. That said, what you said, the question that you asked, Seb, I think was a really important one. How much do a potential increased tightening of financial conditions tied to an oil shock affect the credit jitters that we're seeing? Does that accelerate some sort of shakeout and create a more violent, if maybe a shorter period of time in which this happens? Increasingly, this is what a lot of people are focused on.
That market needs an offset, and right now, it risks getting an accelerant, and that's a problem. Equity futures at the moment on the S&P positive by 1/3%, with an update on news worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran is ready to negotiate with the U.S. The New York Times reporting that Iranian intelligence operatives reached out to the U.S. government a day after the attacks began to discuss ending the conflict. After saying for days he was open to discussing a deal with Iran, President Donald Trump posting on Truth Social on Tuesday morning that it is now, quote, too late for talks. President Trump also saying the U.S. will provide naval escorts to ensure safe passage for oil tankers and other vessels through the Strait of Hormuz. The president's also saying the U.S. International Development Finance Corporation will offer insurance at, quote, a very reasonable price to help maintain the flow of commercial trade in the Gulf. And the South Korean Kospi suffering its worst one-day sell-off on record, plunging 12% in today's trading, following a 7% drop yesterday. The index seeing an AI-driven rally this year that sent it higher by more than 20%, while the S&P has turned lower on the year, currently down by 0.5%. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. The big winners of the year so far, the big losers of the week so far. Up next on the program, a pressure point for crude.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
Up next, we'll catch up with John Lieber of Eurasia Group from New York City this morning. Good morning.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equities off the lows and crude off the highs. Equity futures this morning positive by 0.4% on the S&P. On the Nasdaq up by 0.5. The Russell outperformance there up by 0.9. Turn to the commodity market, crude specifically. Almost 24 hours ago to the second, that was the intraday high for crude just yesterday. $85 a barrel. This morning, 82.56, so just off those highs. Positive on the session, but off those highs. We're up by 1.3% so far. Under surveillance this morning, a pressure point for crude.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible.
So here's the latest this morning. Iran reportedly coming to the negotiating table. The New York Times reporting Iranian intelligence operatives approached the U.S. government over the weekend with an offer to discuss terms to end the conflict. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Jumana Versace in Dubai. Tyler, I want to come to you first. The headline from the New York Times is encouraging. I think the substance less so, and the date of the outreach specifically. Can you go through the details?
Well, hey, John, good morning. I was in the Oval Office yesterday where President Trump maintained that the U.S. is going to sustain this military operation until all of its objectives are achieved. And the New York Times is even reporting that the sense from U.S. officials is skepticism that there could be a diplomatic off-ramp at the moment, and it's still unclear if Iran even wants a deal, too. Now, President Trump did say yesterday that the potential worst-case scenario would be if new leadership emerges that's, quote, just as bad as the current regime that the U.S. and Israel are trying to change. The president himself said that he hopes that a new, more moderate leader could emerge that the administration feels that it could work with, but then also mentioned how most of those top contenders that the White House had been eyeing had been killed in airstrikes. In fact, Bloomberg News is reporting that the Israeli military appeared to target a meeting of the coalition that is currently tasked with choosing the next supreme leader just yesterday. Now, President Trump, as you know, has also called on the Iranian people to take over their government as well. So there's big questions here about exactly what the administration would like to see when it comes to an outcome in future leadership in Iran. And a lot of that has to do with the timeline and how long this military campaign can go on. Now, John, as you mentioned earlier in the program, amid these questions about the timeline, President Trump did take action yesterday to announce that he is trying to stave off a potential energy crisis with this announcement of potential insurance guarantees and a naval escort. I will point out that he met yesterday with his top energy and treasury advisors, Scott Bessent and Chris Wright, about a potential plan to help those energy prices here at home.
Well, let's talk about that energy plan, Jumana. Let's focus on energy specifically. The president offering vague details of a plan with two key pillars. One, provide a framework for insurance, and two, escorting ships through the Strait of Hormuz. How well received has that plan been over in your region?
Yeah, well, I think earlier in the show you were saying that there's a bit of skepticism from the analyst community as to exactly how it's going to be implemented and which companies are willingly going to take it up and expose their vessels to some of the risk. Earlier this morning, the Revolutionary Guard once again reiterating that they have, and this is what they're asserting, full control still of the Strait of Hormuz, which is effectively shut. And you have to think about two things that are going on right now in the energy world. Number one is the effective closure because vessels are not transiting through the strait. And the other is ongoing attacks on key energy infrastructure sites around the region. Yet another attempted attack this morning on the Ras Tanura refining facility in Aramco, and that is the largest refiner in the Middle East. So this tells you, Iran isn't letting up. And I'm just going to leave your viewers with one statistic that I think is really relevant here, because they continue to lash out at Gulf states. In the 12-day war, and this is Iran-Israel, Iran sent over a total of 1,500 missiles and drones towards Israel. In the first 4 days of this war, they sent over 1,800 to the GCC states. And these are countries that Iran has diplomatic relations with. So most definitely you can say that there has been a broad escalation, and there are no signs really of things letting up right now.
Without a doubt. Jemana, thanks for that. Jemana Basechi alongside Tyler Kendall. To build on the conversation, John Lieber of Eurasia Group writing the following. The Iran conflict will likely taper off within 2 to 3 weeks as the US and Israel successfully degrade Iran's military capabilities. John joins us now for more. John, welcome to the program. What gives you the confidence that we'll end this in a 2 to 3 week time frame?
I mean, I don't have a ton of confidence that this is going to be over then, but there is an issue where the military capabilities just aren't going to be what they were when this whole thing began. So the Iranians eventually will run out of ballistic missiles. We just heard about the large number that they've been launching against other countries in the region. Eventually, they do have a large quantity of drones that I think the U.S. is going to have trouble getting access to before they're launched, which means that Iran's offensive capabilities will remain fairly aggressive for the immediate future. But at some point, this is going to taper off when they start running out of ballistic missiles and the U.S. starts to run out of its ability to defend its own ships in the region. Now, I think if you listen to what Donald Trump has been saying, he's been pretty explicit that there's more to come here, that this is kind of the initial phase of these strikes. And we think this probably escalates over the next several days to maybe a week or so as the U.S. tries to end this quickly. The U.S. does not want to be in this war for the long haul. Now, of course, they're going to remain committed to the region because what they need is regime compliance, not regime change. And the way that they enforce regime compliance is by maintaining a credible threat to bomb whoever is coming next. But we think the most intense part of this fighting likely tapers off in the next few weeks.
How concerned are you, John, about the asymmetry in cost between what the U.S. is deploying and what Iran is deploying? And I'm thinking about all those drones that you said are going to be hard to identify before they're launched. The U.S. is shooting them down with million-dollar missiles. Each of those drones is relatively cheap to produce. How much of a problem is that?
Yeah, it's a huge problem. I mean, the advantage here, of course, is the U.S.'s industrial capacity, which over time is going to be able to make sure that those ships are resupplied at any cost. Trump is trying to increase the defense budget. It seems like Congress is more or less willing to go along here. So the U.S. has a large store of production capabilities that it can draw on with time. Iran doesn't, and it won't. It probably has these stocks of drones. It's got these stocks of missiles. It will run out of them at some point, but they can cause a lot of damage in the meantime. And that, I think, is the major concern for Gulf partner states around Iran right now. Less of a concern for Israel, given the distance that Israel has from Iran.
John, just quickly, how did you and the team react when you heard the president's vague, I would say, framework to help traffic through the Strait of Hormuz?
This could work. I mean, if I'm a shipper, I don't want my tankers destroyed or sunk, so it's obviously quite risky. But the U.S. is now putting taxpayer money behind ensuring that these ships can get through. I think we have to wait and see what the details look like. Legally, it seems like he probably has the authority, some flexibility in the DFC in order to do this. But I think that, and clearly they've thought this isn't a totally slapdash plan. I think that they actually do have some reasonable planning behind this that suggests they will be able to compensate for losses. The question is, are shippers willing to take those losses and then take that risk?
Hey, John, it's good to see you. John Lieber of Eurasia Group. Two different ways to talk about this. The policy experts will look at this and they'll be very skeptical. The market participants will look at this and say, this signals a degree of sensitivity to what's emerging in the Middle East. And you're going to see more.
There could potentially be some sort of, dare I say, put from the White House to cap some of the volatility and, frankly, some of the violence that we've seen.
You can judge which is the best way of looking at this right now. Equity futures, session highs up by 0.4% on the S&P. Up next, we'll catch up with Paul Sankey of Sankey Research with crude, coming off its biggest two-day gain in almost 6 years.
for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works on an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
Programming note for you is about 90 minutes away, so 8 a.m. Eastern Time. You'll want to tune in for this. The U.S. Secretary of Defense Pete Hegseth, alongside the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon. Again, that's taking place at about 8 a.m. Eastern Time. We'll bring you some of that a little bit later. At the moment, equity futures doing okay, with the emphasis on okay. Equity futures right now up 1/3% on the S&P, off session lows on the Nasdaq, up by 0.4. As we turn to the bond market, 2s, 10s, and 30s, yields look like this morning. Two-year yields just about unchanged after repricing higher over the previous few sessions, 351.24. And in commodities, we are off the highs of crude from yesterday, $85 a barrel briefly at 6:18 Eastern Time in yesterday's session. This morning, we're back to 82.15.
As they look, traders look for some sort of off-ramp and the potential for one that was raised in the New York Times article. I think you framed it really well about how a lot of people in the policy world are saying there's a long way to go between this story about fourth-hand discussions about somehow getting an off-ramp and somehow getting to an end of the war. People want this to be short. The market believes that this will be short. The market is trying to hedge on the margins that it won't be, but doesn't want to, and that's what we're seeing in the market this morning.
The piece from the New York Times came out about 30, 35, 40 minutes ago, and this is ultimately the essence of it. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. I'm reading that verbatim from the New York Times. That's according to officials briefed on the outreach. Now, I think the date's really important. That's the day after the conflict started. I've got no idea if those operatives are still around, given the amount of damage done to the leadership in Iran. And if the off-ramp was there, it certainly wasn't taken, given the events we've seen take place over the past few days.
President Trump alone said, look, so many of them are getting wiped out. I don't even know who any of them are anymore. And this raises this question, who's in charge? Who does President Trump want to be in charge? How do you find the elusive moderate in Iranian politics, which has been something that has sort of been the holy grail over the past decade or so? And so there's a real question here, how credible an off-ramp really looks given all of these potential constraints.
Futures doing okay, up 1/3%. Let's get you some single names as we count you down to the opening bounce. Some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Raw Stores. Shares are surging 7.7% after the off-price retailer delivered a strong earnings beat. It echoes what we heard from TJX last week as shoppers flock to their stores to hunt for deals. And the big draw is that in-person treasure hunt, something difficult to disrupt from an AI standpoint. And for that reason, investors have been piling into this name. Shares were already up 8% year to date heading into the report. And we have been watching these software names closely when it comes to their earnings. And more often than not, they have disappointed investors. The latest example is GitLab. Shares are down 7% after it gave an outlook for fiscal 2027 that came in well below estimates, just adding to the AI anxiety around software. And we end on Coinbase. These shares are higher for several reasons. Shares are up 6%. Kathy Wood buying $4 million in shares. But more interestingly is this Politico report that CEO Brian Armstrong was at the White House yesterday meeting with the president, which then explains the president firing off Truth Social, criticizing banks for stalling a crypto bill. Now at the center of this clash is whether crypto firms can offer yield on stablecoins, something banks have been lobbying hard against, warning it would pull deposits out of the traditional banking system and threaten lending. John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, Iran reportedly coming to the negotiating table. The New York Times reporting Iranian intelligence operatives approached the U.S. government over the weekend with an offer to discuss terms to end the conflict. Elsewhere, the president saying the U.S. will provide naval escorts and insurance for ships passing through the Strait of Hormuz. The president writing on Truth Social, no matter what, the United States will ensure the free flow of energy to the world. And finally, the president also threatening to cut off all of trade with Spain. His comments coming after the country denied U.S. access to its air bases during attacks over the weekend.
Some of the European nations have been helpful and some haven't, but some of the European, like Spain, has been terrible. I told Scott to cut off all dealings with Spain. So we're going to cut off all trade with Spain. We don't want anything to do with Spain.
The Spanish Prime Minister saying he won't yield to threats.
To me, the reason why this is particularly notable, aside from relations between the U.S. and Spain, is what happened in the wake of the IEEPA ruling by the Supreme Court. And what President Trump and his cabinet members were saying yesterday was saying it reaffirmed his ability to use the law to take other actions, including even imposing economic embargoes. And what I view this is almost a test of how far President Trump could take this to exert the same leverage, if not even more, than what he had under IEEPA, which was struck down on the Supreme Court.
I come at this from the European angle. There's something like 27 members of the EU. This is why it's so difficult to set policy at the European level, because you have a government like Italy, right-wing, you have a government like Spain, I would say super left-wing at this point. And Spain has a different view of developments in the Middle East, also has a very different view of developments in China as well. And if you want to talk about trade and take the Middle East out of this, foreign policy is an issue with the Spanish, and I would say trade policy is an issue with the Spanish government as well. If ultimately you want to do something about getting China to change its economic model, you can't get Europe on board right now, because there are governments like the Spanish government who are preventing you from doing that.
Right now, this is absolute fragmentation in its most obvious form. It is fragmentation for the European Union, which puts them in a spot of difficulty when it comes to negotiation. And it points to the fragmentation of U.S. policy in terms of trying to figure out where leverage comes into play. That is why, when we talk to investors, it is a feeling of macro paralysis. And I'm quoting Jim Zelter of Apollo here, but really, this is the embodiment of it, with people not even feeling like they know how to trade, what headline they're going to hit by, what shock to focus on any given day.
12 months after the last bout of macro paralysis. Commodities in focus right now. Crude higher by 1%, 82.22. WTI 74.65. Paul Sankey of Sankey Research joins us around the table. Paul, it's good to see you.
Thanks. Hi.
Let's talk about this shock, and can we start with the president's plan? Two pillars, really, to support traffic through the Strait of Hormuz, accompanying these ships with some kind of military presence, and then insurance. For an expert like yourself, how did you respond to the details of that?
Well, I think the insurance move is obviously key, because that's what stopped the trade. And you've got the tankers absolutely within range of being attacked, but just sitting there and refusing to move until they get some sort of security. As you know, we've got 20 million barrels a day here in a 100 million barrel a day market. So you have to get this oil flowing. And I think talking to Javier Blas on Monday, it was like, this has to be resolved by Friday. Otherwise, the market's going to start panicking again. If we're not getting this stuff flowing within days, if you're talking 20 million barrels a day at walking pace globally, every day that passes, you're developing a bigger and bigger problem. So it's a major concern, and it's very interesting that the market isn't responding more. It had run up into this, but it was also retaining a very strong backwardation. So very high belief in future prices.
I'm interested in your perspective on the calendar. This is important. We get a lot of people on the program and we'll say, what do you think? And they'll say, it depends how long it lasts. And I'll say, what does that mean? What's circled on the calendar for you that it gets real? And they'll say weeks. They'll say a month. Let's see if it lasts a month. Why are days so important to you?
Just because of the sheer volume that comes through here. I mean, you've had the Qataris voluntarily also back off LNG movement. And it's just the sheer weight of volume of everything that moves through the Straits that's so important, which makes it really a matter of days here. When you casually say this could last 4 weeks, the market's not believing that at the moment. But I mean, if we do, it's going to be a major problem. And you've got to keep in mind, as we mentioned earlier, that with the Houthis, you haven't resolved the issue around the Red Sea. So we don't have proof that we can resolve these issues when we are threatened by terrorists attacking shipping lanes. We're talking to the Saudis and hearing they can now move 7 million barrels a day through the Red Sea. but they have an uncertainty, will the tankers be able to even go through the Red Sea? So this is a crisis of shipping, and at the moment, the solutions are not obvious. You know, it's all words.
We'll get into the Houthis and the crisis in shipping, which I think is really important. I just want to follow up, though. You're saying that if we don't get a resolution by Friday, then panic sets in. What does panic look like in terms of pricing?
Well, you're already seeing it because the release valve is the European gas price, right? So that's where you see the first action, and then the second action is in distillate. The other aspect which we've mentioned is that China, you know, is very dependent on all these flows, East Asia, and of course China has a different relationship with Iran. There's a concern that China may be backing Iran at a given point and allowing them to continue this for longer. And then we simply don't know. There's a very negative theory that Iran is actually waiting to re-release a whole nother wave of missiles, or are they actually beginning to run out of stuff to throw out there? And we just don't know whether or not they're actually running down on stockpiles or whether they're waiting for another further bigger attack. So it's a very concerning, indeed, needless to say, situation.
People are also trying to game out what kind of an inflationary pop or inflationary impulse this could be if we're looking at $130 a barrel, which some people have put out there in a case of a protracted conflict. In the case of the crisis in shipping that you're talking about, which seems very likely based on the Red Sea and the Houthis and some of the fringe groups that could potentially come into play here, how much of a premium would you expect coming into the shipping lanes, coming into transport, coming into materials that hasn't been factored in yet, that is almost structural just by virtue of this threat being exogenous and persistent?
Yeah, I mean, I think structurally what you would say is that you're probably going to have to reprice growth into the U.S. production. And so you need to take oil on a sustained basis above 80 and beyond to release another level of U.S. reserves. The oil companies here are really planning on 60, 50 lower. You need to get them to plan on 80, 90, and that would take you into triple digits on the spot price before the companies believe that it's worth drill baby drilling again. So there's that on a structural level. It's actually a reversal of what we were looking at. We were looking at an oversupplied market with the need for the U.S. to produce less. Now we're looking at a very threatened market with actually the need for the U.S. to produce more, and companies that are very disciplined now in their capex and are reluctant to do that. So that's one structural notion. The other one is that you're already seeing, I think, significant economic damage here. Obviously, the Middle East was a major economic driver. Dubai, you had 1,000 people a day arriving in Dubai, immigrating net. You know, a booming economy in the Middle East that obviously is going to be in disarray at this point. So you never want to get too carried away with your oil price forecasts, because obviously ultimately demand begins to react quite sharply. And we're already seeing pump prices in the UK. I've just come back from London, immediately up, you know, by another 5–10% at the pump before really any physical impact has occurred. So these things are happening very quickly. And we'll see. It's just lucky that we're not in a particularly sensitive time for gasoline prices. We are coming out of winter. So there's a couple of mitigating factors on the demand side. But ultimately, we saw how high you can go with Russia. You know, we got to the 125 type levels before everything just fell away. And I would say on balance, Russia was almost more of a physical shock than what we're facing here. I think they can keep the oil flowing. So I don't think that we'll surpass Russia peaks that we saw in 2022, which was already at the European gas prices with a further extraordinary shock from Russia. Here, I think there was some preparation for this kind of event happening. It's just the sheer physical weight of what we're looking at coming out of the Straits of Houthi are so big that solving the problem is going to be a major challenge that needs to be solved almost immediately.
Paul, how close are we to breaching storage capacity for some of these big producers?
We did. I mean, look at Iraq. They've had to shut down production. They just don't have the capacity to store the oil that they can't move.
Do the Saudis, they have some release valves. They have the East-West pipeline.
They do, and they're saying that's now 7 million barrels a day of capacity after Abqaiq, actually. So that's impressive. So we can take 7 million barrels a day. Going back to this Red Sea problem, you know, we could shift some significant Saudi volumes. And, of course, Saudi are very well organized around their storage. The Iraqis don't have a lot of storage, and they've had to almost immediately shut in production. And then, of course, in all this madness, you've got the whole situation in Russia, Ukraine continuing to flame. So it's a crazy world out there, and it's a measure of the crises that we've been through that we haven't seen more price action in oil, because it's, you know, we haven't seen a sustained rise structurally in oil prices since '74. But boy, have we seen a lot of crises in the Middle East since then. So there's a sort of market faith in the ability of the market of the oil industry to work around this, and that's that's pretty interesting. Again, we also had a coming glut of LNG that, you know, is sort of mitigating this. One thing I would say as well, Lisa, just on the point of demand, is that AI demand is price inelastic. So that's very interesting. These companies are going to keep spending on AI for at least 2 more years until it's demonstrably a disaster. And that means there's going to be absolutely...
That's a powerful point.
Please drop that in.
That's going to be more demand for energy. And we say that if you have an electricity crisis, if you have a shortage of electricity, it's bullish oil because your solution is distillate. And, you know, we've done some work looking at the availability of incremental distillate, for example, from US refining. There really isn't any. So there's a lot of really dynamic things here that are happening that are you know, concerning.
Paul, I've got one final question. You alluded to the shape of the curve. Can we just finish on that? Most people view this as an issue for spot and not an issue looking further out. Do you disagree with that?
Oh, I think this structurally changes a lot because the entire debate in oil had actually, the zeitgeist had shifted. As we said, you had peak oil supply concerns 2000 to 2010, 15. Then you had peak demand concerns for oil that were actually, we were going to see the rise of the Tesla and everything else. And now we've gone back to the idea of actually with AI, oil demand, according to Exxon, is going to be flat, all things equal, through 2050. How are we going to supply that much oil? And you've seen, for example, Wood Mackenzie putting out the global major oils, private major oils, need to find something like 22 million barrels a day of incremental production over the next 10 years. And it's like, I don't quite know where they're going to find another 4 or 5 Guyanas right here. So I think that, you know, that's why the equities are actually arguably better than that, discounting the long-term oil price than the spot curve. The spot curve, as you know, the price of oil basically is heavily traded in the first 3 months. And then the rest of the curve tends to be a smear of wherever you're at. It's not strictly true because at times we've had inverted and smiley curves and everything else. But broadly speaking, all the liquidity is in the first 3 months. Historically, we've argued that the equities are a better discounter of the oil price. And I've been saying this year, for the first time in my career, I've been bullish the oil equities and actually bearish the oil price. Now, I was flat wrong on the oil price, but actually, you know, thankfully, we were pushing Schlumberger, we were pushing Exxon, we were pushing all of them more or less. And that's obviously played out. What the market seems to be telling you is that we're looking at a structurally higher oil price here long term. That's why I'm buying the equities. And the spot market is as the spot market does.
Paul Smart, great framework clinic. I expected one. It's good to see you as always. Thank you,
It's a pleasure, my friend.
Paul Sankey of Sankey Research. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, Yahara has more. Hey, Yahara.
Hi, John. Chinese Foreign Minister Wang Yi is calling on Israel to pursue an immediate ceasefire in Iran. He spoke with his Israeli counterpart on Tuesday and said Beijing will play a constructive role in easing regional tensions. Wang also urged Israel to take steps to ensure the safety of Chinese citizens and firms. Airlines continuing to suspend flights across the Middle East due to the crisis. Tracking service Flight Radar 24 says more than 12,000 flights have been canceled since Iran's first retaliatory strike over the weekend. The U.S. State Department announcing plans yesterday to help evacuate Americans who want to leave the Middle East. And meanwhile, here, stateside, the results are in from the first primary races in the 2026 midterm elections. In Texas, 4-term Republican Senator John Cornyn is headed to a runoff with State's Attorney General Ken Paxton. With 88% of the ballots counted, Ken Paxton trails Senator Cornyn by 1 percentage point. The runoff election will take place in May. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, inflation getting a lift.
Prices are going to go up, and ultimately, if it persists, GDP is going to go down. Now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters, potentially.
Up next, we'll catch up with Greg Deco of EY Parthenon from New York City. You're watching Bloomberg TV.
have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Struggling to hold on to gains at the moment. Equity futures still positive, but off session highs. We're positive by 0.15%, up by 0.2 on the Nasdaq. Under surveillance this morning, inflation getting a lift.
Prices are going to go up. And ultimately, if it persists, GDP is going to go down. Now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters, potentially. It really is a complex situation because of this incredible risk that we might begin to see even more upside pressure on inflation from an already pretty bad starting point.
So here's the latest this morning. Effects of the conflict with Iran starting to add up. U.S. prices for gasoline and diesel on the rise following days of higher crude prices. Greg Dacko of EY Parthenon writing, any successful strike on critical production or processing infrastructure would generate a far more significant market shock. Greg joins us now for more. Greg, good morning.
Good morning.
Is this a shock for Federal Reserve policymakers yet?
Not yet. I think what policymakers are going to want to do is wait for more data. They've been very patient. They've signaled that patient, and there is a hawkish bias amongst Fed policymakers to essentially wait for more data and see how the economy evolves, the U.S. economy evolves, how inflation evolves. And I think one key factor that we have to keep in mind is that inflation remains above the 2% target. It's that simple for Fed policymakers. As long as inflation doesn't show any credible signs of sustainably coming back towards the 2%, they're not going to be considering much additional easing from here. So the next few months are going to be on hold. And I think the current conditions likely increase the probability of this.
Well, let's get to the current conditions. Does the labor market give them the luxury of time, the luxury of waiting?
Well, I don't know. We'll have to see what we get on Friday, because I'm doubtful that the January print was a sign that labor market dynamics are improving significantly. I'm still of the view that we are in an environment where low payroll growth is going to be the new reality, where labor supply has been significantly constrained by reduced immigration, and whereas most are saying, let's not be too concerned about the labor market because the unemployment rate is still low, I am concerned about the income shock. In an environment where you see job growth close to zero and where wage growth is decelerating, and remember, wage growth is that price gauge for how tight the labor market is, that combo leads to slower income growth. And that's what you and I depend on to spend. And that explains why there's been such a dip in the saving rate, why there's been a rise in credit usage. Those are not lasting abilities to spend in this environment. And so I'm increasingly concerned about the income shock that is coming through to the economy. economy, add to that a potential shock from inflation, and you have a mix that is somewhat concerning for the outlook for consumers.
I'm so glad you said this, because typically oil spikes are both inflationary in the short term and disinflationary over the long term because of the dampening effect of the spending power of so many people. I'm interested that the market is taking this simply as an inflationary shock. You're not seeing that disinflationary aspect of it come into play, and the market is treating the Fed as though it's going to do the same. Do you think that that's correct?
I think we have to consider the affordability constraint as a reason to essentially be careful as to what the factors are influencing affordability. Yes, prices, of course, are the key fundamental factor affecting affordability, but the income lever is very important. If you have sufficient income to essentially withstand any price increases, then you're fine. You're still going to be spending. You're still going to see different actors in the economy, businesses and consumers, hiring, spending, investing. But if that constraint becomes too high for income to continue to grow in real terms, then that's where you start to see a pullback, and that's where that starts to become a key constraint for Fed policymakers. We have to remember one thing, Lisa, is that in this environment, we're seeing an increasing number of supply shocks, and most policymakers are not equipped to deal with supply shocks. Over the past few decades, it was all about trending along potential with demand shocks around that. This environment is all about supply shocks, which tend to be stagflationary. Whether it's trade and tariffs, immigration, or oil price shocks, they're all supply shocks.
This was the common knowledge a couple of years ago, but then AI happened, and AI spending seems to be price indifferent. It seems to be inelastic in any way. Buy at all costs, invest at all costs. It feels like an existential threat not to be ahead in the AI race. I just wonder, if you get this dynamic where you have prices that are increasing, you've got people with wages able to pay for it because they're the haves, you have other people who aren't, is the Fed going to err on the side of being hawkish because of 21 and 22?
I think so. I think the Fed does not want to be burned in terms of the inflation dynamics. A number of policymakers have continued to refer back to the 21-22 period where they were a little bit late to react to the price shock that was coming from the post-COVID recovery, and then the energy price spike that we saw after the onset of the war in Ukraine. I think most policymakers in this instance, while the textbook would tell them to essentially look through a transitory oil price spike and natural gas price spike, they're likely to be more cautious in resuming any easing because they've been burned in the past. And it's as simple as the fact that inflation is above that 2% target, and they're not going to want to provide any perceived accommodation and risk being seen as being on the wrong side when it comes to policymaking.
Leadership matters, often forgotten, but we were waiting to see if Chairman Powell got a second term. And here we are waiting to see if we can get confirmation of Kevin Walsh. We're kind of in limbo right now at the top of the Federal Reserve.
And waiting to see whether Fed Chair Jay Powell is going to stay on, because Minneapolis Fed President Neil Kashkari is saying he'd love to see that.
Hey, Greg, it's good to see you. Thanks for dropping by.
Always a pleasure.
Great work last week, by the way, with Madame Lagarde. It's good to see you. Thank you, sir. Greg Dacko there of EY Parthenon. In the next hour of Bloomberg Surveillance, Chris Harvey of CIBC, Tobin Marcus of Wolfe Research, Jim Bianco of Bianco Research, Tom Titsouras of Strategas from New York City. You're watching Bloomberg TV.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Energy is the leadership. That's where we are right here.
Most of the price action is because of the traffic in the Strait of Hormuz being halted.
The math is pretty awful for oil and gas if it remains closed.
Oil prices continue to rise, then all of a sudden you have a stronger inflation impact.
The long-term impact of this, which will take weeks and months to clear out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Positive by 0.1% on the S&P 500. On the NASDAQ, up by 0.25. On the Russell, up by 0.4. In the commodity market, off the highs of the last 24 hours. The high of the last 24 hours ago, $85 a barrel, $82.60 so far this morning, up by 1.5%. The president offering very vague details of a plan to support traffic through the Strait of Hormuz. That's one pillar of support. Here's another. About an hour ago, this from the New York Times. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. That, according to officials briefed on the outreach.
This feels like the market is super hungry, and it is jumping on anything that looks vaguely like food. In this case, they're looking for an off-ramp, and this provided some sense that there could be a resolution that lasts less time than, say, 4 or 5 weeks, which seems to be the danger zone that a lot of people have talked about, other than Paul Sankey. Look, I think it shows where the bias of markets are and what the market is hoping for, and I hate to personify the market, but it highlights how offsides this market would be, Mr. Market would be, should this continue for a while.
Well, let's take that a few steps further. It depends who you're talking about in the market right now. And this isn't a judgment on one asset class or the other, just to show that we're observing different views in each. In equities, there is this sort of playbook, this bias to fade this risk. In commodities, it's a very different story. And I think we heard that from Paul Sankey of Sankey Research just moments ago, and we've heard it from Jeffrey Curry of Carlyle as well. There is a view in the commodity market that this is far more serious than some market participants are taking it. And you shouldn't fade this. This is not just about the next few days. This is about something much bigger over the longer term.
And if you take that a step further to the bond market, it highlights why people are worried about inflation suddenly, and they're worried about the Fed not necessarily responding to it by just standing pat and looking past it. There is a structural increase in cost to shipped goods, akin to what Jeff Curry was talking about, tied to some of the geopolitical threats that are very real. We have seen them time and time again. and are going to take time to work through. And Paul Sankey was talking about that, the stockpiles, just the glut of oil and natural gas that needs to move, that's getting stockpiled up, that isn't getting produced. That's going to take time to put back on the seas, and that's going to be something that's got to be baked into prices.
We hope we can get that traffic moving again through the Strait of Hormuz. We hope that can take place. And we hope there is an off-ramp here that can lead to a de-escalation and a backing away of hostilities between all of these sides right now. But when you look at the reality and read headlines like this, and I mentioned this in the last hour, the UAE saying they intercepted 3 missiles already today and 129 drones. And you're seeing that beyond the UAE and across the Gulf.
I thought Jumana Bersachi did a great job, our correspondent in the region, talking about how much more the volume of missiles from Iran have been going towards some of their former allies, their erstwhile allies and partners in the region. There are other Middle Eastern nations, even than Israel during the 12-day war. It just highlights how it's just attack everyone and how a lot of people feel incredibly vulnerable right now.
Live from New York City this morning. Good morning to all of you just tuning in. Equities are doing okay, positive by about 0.2%. Coming up this hour, great lineup for you. Chris Harvey of CIBC joins us as markets wake up to macro risk. Tobin Marcus of Wolf Research on the effort to reopen the Strait of Hormuz. And Jim Bianco of Bianco Research as rising crude prices fan global inflation fears. We begin this hour with stocks inching higher following another very volatile session. Chris Harvey of CIBC writing the market reprice risk into the Iranian military conflict. The resolution is unclear. We think it now effectively represents the macro risk. Chris joins us now for more. Chris, good morning.
Good morning.
Start of the year, you said this market was sleeping on a lot of macro risk.
That's right.
We're still about 2% from all-time highs. Have we at least woken up now?
We've definitely woken up, right? So my issue coming into the year is risk was mispriced. Your risk aversion assets were unloved and underappreciated. They've been derated all in 25. Everyone was on one side of the boat. Everyone's really, really positive, really, really constructive. And we just thought people are sleeping on tons of things, right? Whether it was a Fed transition, Fed being super positive, whether it was management of earnings. We didn't call for some of the geopolitical risks that we're seeing, but we expected it to start to increase. And so we thought you really needed to reprice risk. You have, and that's one of the reasons why I think we haven't seen this major move in and around the conflict.
3 sources of risk now.
Right.
So we go through them piece by piece. 1, of course, is the AI disruption.
Yep.
2 is the credit jitters, and 3 is the shock
Yep.
over the weekend. Are you worried about one more than the other, or just the accumulation of all the events?
I'm really more worried about, so I do think, again, with a conflict, anything can happen. So it's a wild card, but it does look like it's going to be shorter in duration. We'll see how it plays out. I think the credit issue is a bigger issue. It's going to linger for some period of time, and it'll flare up. I don't think it's going away. And one of the things that we just saw is that what happened in the equity market is happening in the credit market. We needed a repricing of risk in equities. Now we're seeing a repricing of risk in credit. IG credit got down to 71 basis points, which was a generational low. Now we're up to 84-ish, right? That's not bad. They're still very, very low versus history, but you need to reprice that. Some of the issues, I think there are people that are offsides, that got too aggressive, maybe applied too much leverage in certain situations. It's more idiosyncratic at this point in time, but I think that's the gift that's going to keep giving, and that's something we're going to have to watch, especially if the economy slows down in 2026 or later this year.
And just to build on a point that John was making earlier, if you add some of the oil shock to the concerns in the credit market, how much does that accelerate the fallout? If you do get a Fed, say, that remains offsides and doesn't necessarily cut rates anytime soon?
Yeah, I don't. The oil shock is not a big deal to us at this point in time. You really need for oil to go higher and be substantially higher for some period of time, right? What we need for credit is we need the economy to slow down. And it doesn't look like the economy is going to slow down in 2026. If anything, I think we're going to accelerate. It's more of a late 26 issue, 27 issue. Because the thing about leverage, it only bites when the economy slows down, when growth slows down, and then you can't pay your bills. Right here, yeah, there's some bumps in the road, and oil's going to be an issue, but I don't think it's a major issue. It's not, at this point, a systemic issue.
Do you think that the credit issues are going to become systemic at some point? I mean, this is something that a lot of people have been grappling with, saying a lot of it is just a rotation out of software names and trying to grapple with AI-related disruption.
Yeah, so the easy answer to that is that they'll always become a systemic issue, right? We have credit cycles, right? But what we're seeing, and what I think we're seeing, is just a repricing of this. We're seeing more idiosyncratic risk. We're seeing where people were too aggressive, and we're seeing a shakeout. I don't think, when I look at IG credit, when I look at the high yield market, I'm not so worried. The markets are functioning well. They're providing liquidity. Liquidity needs to go where credit needs to go where it's getting to where it needs to go. Sorry about that. But I don't see something systemic at this point in time. It's a concern. It's an issue. It's going to cause volatility. As we get later in the year, as we see more M&A activity, the systemic risk will go higher. At the end of the year, yeah, it's something we're going to think about real hard, and something I think we're going to see.
The end of a credit cycle and systemic risk don't necessarily have to be in the same bucket.
No.
You can have the end of the credit cycle without systemic risk, and it's intriguing to me that people at our Bloomberg Invest conference right now are talking about the end of the credit cycle, and yet the equity market is 2% away from all-time highs. Does one match the other right now?
So usually the end of a credit cycle is the end of a market, right? Because what happens is the funding markets, what you're doing is the funding markets provide the liquidity for buybacks, for property, plant, and equipment, for M&A activity, and for Main Street. And when you can't get that, the gears start to grind tighter. Now, if we're talking about, hey, it's the end of the credit cycle and spreads are as low as they're going to get, and we're going to widen out, and we need more compensation, okay, yeah, then things can still work. And I think if that's what you're implying, yeah, I think equities can still work. And that's our view, is that what you need is a little bit more compensation. You need a repricing of risk. We're getting that, but the systemic risk is just not high enough to have the wheels fall off the cart.
Mark Rowan was pretty clear yesterday. If you missed that conversation with John Micklethwaite, take a listen to this quote. This will be a shakeout. I don't think it's going to be short-term. If 30% of your portfolio is in one industry and that one industry is being impacted by technology, you've not been a good risk manager.
This, to me, highlights exactly what you're talking about. Most of the people in Wall Street are expecting some sort of shakeout at a credit cycle that doesn't necessarily bring some sort of huge downfall, but actually gives them the opportunity to distinguish themselves from other different players. It's a reason why you're seeing the Apollos of the world and the JP Morgans of the world talk about the shakeout and say, look, we'll be the ones that are still standing, so watch out.
Did you see how they met redemptions at Blackstone?
They personally put it up themselves, $150 million.
Imagine that situation.
25 partners.
The executive team goes around the partners and they say, by the way, we're going to have a whip around, okay?
With a hat.
And you're thinking, severe, serious credit risk that if you don't contribute,
right.
And you've got to figure out what's the right number. So maybe you call your partner and you try and work this out, right? What is it, 5, 10, 15 million? The league that these guys are in compared to everyday people, the whip around, like for us in the newsroom,
for like $150.
Can we raise like $20 to buy the cookies?
100%.
Okay, like the boss is selling the cookies and you
Correct.
want to make sure you buy some just so you're in good favor at the end of the year when
Girl
you get
Scout.
that eval.
Yeah.
This is like that on steroids.
This is unbelievable.
You've got to come up with what, like $150 million?
$150 million from 25 partners. I was actually thinking the same thing, where they're taking a hat and bringing it around the office. Can you spare a couple $20 million?
You've got ambitions to be the next John Gray.
I mean,
or Steve Schwarzman.
You have no choice.
You're like, okay, like,
sure,
yeah,
here.
I guess I can give you 20.
Down payment for my future career.
Chris, do you want to weigh in?
No, I'm good here.
Chris, it's good to see you.
It's a pleasure.
Chris Harvey of CIBC. Just imagine what that was like. I'd love the details of that.
I actually was thinking the exact same thing when I was reading that. I mean, how forced did people feel to do this? What were the conversations like with their wives or significant others? Do they have to go home and say, you know, look, I'm sorry, but we're going to cancel vacations? Do they actually have to cancel vacations, or is it nothing for them?
Are you telling me that doesn't count towards your compensation by the time you get to year end? Like when I'm setting the bonus pool for you, Bramo only gave us 2 mil, you know, so-and-so gave us 10.
Oh, you think that there's sort of a return on capital for the bonus pool?
Seriously.
Well, I actually think that there must be some sort of loan structure. That's what I was wondering.
I'd hope so.
I was actually thinking this is probably, they contributed from their paychecks, but there might be some sort of loan structure where they were getting some sort of lockup in the fund for a longer period of time. That's what I was thinking.
I'd also love to know, if you're the one guy that didn't put any money in the hat,
He's
reach
not there
out.
anymore.
I'd love to
He
find
just left.
That one person.
He just left the firm.
Absolutely
Sorry.
not.
He's looking for a new job. We need a producer. Come on over.
Let's get you an update on stories elsewhere this morning. We can't afford them. Let's get you a Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Just recapping that outrageous story you guys were just talking about. Blackstone's senior staff opening up their wallets to help weather withdrawals from its flagship private credit fund. According to sources, more than 25 senior leaders from across the firm putting forward approximately $150 million to the Blackstone Private Credit Fund, combined with $250 million of the firm's own capital to cover a record redemption request. Meanwhile, the South Korean Kospi suffering its worst one-day sell-off on record, plunging 12% in today's trading, following a 7% drop on Tuesday. The index seeing an AI-driven rally this year that sent it higher by more than 20%, while the S&P has turned lower on the year, currently down by about 0.4%. And Pakistan saying it's in no hurry to end its military operation in Afghanistan. A senior Pakistani security official says the duration of the operation depends on actions on the ground by Afghanistan's Taliban government in rooting out militant groups. Dozens of people have been killed since the Taliban launched retaliatory attacks last week against Pakistan's airstrikes on militant targets. That's from the brief. John?
Hey, Hara, I appreciate the update. Thank you. Up next on the program, looking for an off-ramp.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
That conversation up next with Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I'd just like to reiterate a programming note. In about 45 minutes' time, we will catch up with the U.S. Secretary of Defense, Pete Hegseth, alongside the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon at 8 a.m. Eastern Time. Looking for further details of this conflict. We'll bring you some of that a little bit later this morning. Again, 8 a.m. Eastern Time, 45 minutes away. Equity futures at the moment on the S&P 500 positive by 0.2%. On the Nasdaq up by 0.3. On the Russell up by 0.5. Holding on to gains in the commodity market off session highs for crude. We're only higher now by about 0.75% on Brent, and you're seeing us turn lower on WTI. 74.32. We're down 1/3
You have two prongs here. First, it does seem like there might be some sort of off-ramp, as indicated by that New York Times story, talking fourth person. There also is the potential for the U.S. to do something in the Straits of Hormuz to try to accompany ships. Either way, people are looking for some sort of Trump put, and they're hoping that that will happen, at least in U.S. pricing.
Under Savannah's this morning, looking for that off-ramp.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible.
So here's the latest this morning. Crude pairing earlier gains after reports suggesting Iranian operatives have reached out to discuss ending the conflict. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Let's get back to that piece from the New York Times. Just go through the details and tell us what stood out for you.
Yeah, hey, John, good morning. Well, the New York Times is reporting that a day after the attack this weekend, operatives from Iran's intelligence agency reached out to the CIA through another country's spy agency. Still, U.S. officials reportedly remain skeptical that either the Trump administration or Iran is really ready for a diplomatic off-ramp here. As the story notes, President Trump had noted over the weekend that he would be open to negotiating with Iran's transitory leadership team. But then just yesterday, in a post on Truth Social, he said that it was, quote, too late. Now, I will point out that Oman's foreign ministry on Sunday, a day after the military campaign started, did post on X saying that Iran was interested in, quote, serious efforts aimed at de-escalation. But then we heard from Iran's security chief batting down that report publicly. So at this point, a lot of this is going to come down to questions about what the future of Iran's leadership looks like. And I was in the Oval Office yesterday where President Trump said that the potential worst case scenario would be if new leadership in Iran emerged, quote, just as bad as the current regime that the U.S. and Israel are trying to change. And while President Trump has previously advocated for Iranians taking over their government, President Trump said yesterday that the U.S. is hoping that a more moderate leader would emerge that the administration feels that it could work with for a potential solution down the road. But then he noted that a lot of the contenders the White House had been tracking have been killed in airstrikes. John, one thing is clear. At the minimum, the U.S. has telegraphed that there needs to be a lot of issues on the table in any potential agreement, including an ending to Iran's nuclear program, an ending to its ballistic missile program, and a stopping in its support for those proxy militia groups in the region.
Tyler Kendall with the latest down in Washington. Tyler, thank you. There's a big question, an outstanding one. To what extent is this administration sensitive to market developments? 12 months ago, there was a feeling that they were very sensitive to market developments, particularly in the bond market. And then you see a headline like this from the Treasury Secretary, speaking to the American press just moments ago, that the 15% global tariff rate is likely to start this week. So if there is concern, it's not that great.
I think that's a really important connection here, that how great is the President Trump put? If you do see them reiterating some of the tariff increases that they had talked about before at a time of heightened geopolitical risk and already a risk-off feel in markets, just to extend this, again, yesterday, some of the tensions between Spain and the U.S., you heard about some of the other powers that they could start to deploy, trade embargoes, things of that nature to get the leverage back from IEEPA. So is this going to be reflected only if the markets allow it? Well, I don't know what the signal really shows.
Let's build on that conversation. Tobin Marcus of Wolf Research has this to say. If either economic or political costs start to pile up, Trump can look for the exits, either through negotiations or simply through unilateral withdrawal. Tobin joins us now for more. Tobin, let's get to that point, the pressure point. How close are we to it?
I don't think we're that close. I do think that President Trump feels that the military campaign is going well so far. One of the notable developments in the early innings of the war has been Iran obviously is trying very aggressively to strike some of these energy targets, regional, refineries and oil export terminals. They've, successfully threatened the strait, although not really hit a lot of ships. But if we start to see, as many people have worried about, dwindling interceptor stockpiles, those attacks starting to get more successful, our point is Trump has a lot of optionality here. The way that the objectives of this war have been defined, where it's not about regime change, it's about doing enough damage to Iran's missile and drone program, and that question about what is enough is entirely a judgment call that's up to the president. So I do think he has a lot of optionality about when and on what conditions to start to wind things down.
Tobin, there's a real question around what pushes him to want to engage with that optionality. Is it market movements? Has the oil market gotten to a place where it could potentially be raising some red alarms as you see the price at the pump increase? I mean, is there a pain point that you're focusing on?
Yeah, and I think we could get there. I certainly don't think we're there yet. He's sustained, if we're at triple-digit oil prices for, weeks or months, obviously that starts to get a lot more painful than what we've seen now. Those are scenarios that a lot of people have modeled and speculated about. And if that plays out, I think that starts to be a situation where the president would look to get out. Similarly, if we see really alarming, movements in bond markets and currencies, obviously yields have backed up a lot over the past two sessions, but they're not at an alarming level. So you can imagine that sort of reaching an alarming place too. Again, I don't think that we are there yet. I can't give you a number on the Trump put, but I will say also, if you think about the rhetoric and compare back to how he was talking before and immediately after Liberation Day, there was a lot of talk back then also about, oh, it's going to be this period of temporary pain. If we have some pain, it's going to be okay. They were sort of indicating that they were willing to weather the storm in the same way that he was saying yesterday in the Oval Office, oh, we might have this period of elevated oil prices, but it's not going to be that bad. But nevertheless, when things did get bad, they changed course, like despite what the rhetoric had been in advance. And I think that's probably still true.
How much is the Republican Congress a check on this? The idea that maybe there could be some pushback. This isn't very popular in terms of people supporting the effort in Iran. I'm just wondering, from your perspective, do you see that as potentially causing a bit of a halt to this?
Yeah, I don't think they're particularly concerned about what they hear from Congress, even on the Republican side. For the most part, congressional Republicans have been pretty supportive. And when you look at the polling, first, as we expected, the approval of the war has gone up as the war has, gone relatively well in the early innings. It's very heavily polarized, but among Republicans, support's very high. I think 85% of Republicans say they support the war. They're underwater among independents. They're very underwater among Democrats. It's not by any means a political winner, but I think in terms of their base and what he's hearing from political allies, that's not where the unpopularity is sitting.
Toby, just getting some news crossing the Bloomberg terminal. Just want to share with the audience. This from the UK Maritime Agency saying that a container ship was hit while transiting the Strait of Hormuz, struck by an unknown projectile. No more details on that other than that. Put that together with a headline that I saw earlier on this morning, and I've shared with the audience a few times, about the amount of projectiles going into the UAE, that they've already intercepted 3 missiles and 129 drones at last count today. Tobin, when you see headlines like that, and then you get excited about the prospect of an off-ramp because there was some outreach over the weekend, how excited should people be about the prospect of an off-ramp, Tobin? And I'll share this story again with our audience from the New York Times. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. Should we be encouraged by the fact there was outreach, or discouraged by the fact that the administration ignored it?
Yeah, and I think on the Iranian side, I think there is some fragmentation as the transition away from Supreme Leader Khamenei continues. So, even if some elements within the government are reaching out, I don't think that necessarily means that everyone's ready to hang it up. Their explicit messaging from figures like Larijani has been more, more that they're in it to win it, and they're prepared to tolerate some pain and weather a longer period of war. I do think that the decision is probably going to come from President Trump's side, and it's going to come as a judgment call about when enough is enough. I don't think that the offers that the Iranians are going to be able to make are going to be satisfying in the same way that the negotiations seemed kind of doomed heading into the conflict. I think what it is that we want from them are going to be really tough concessions for the regime to make. And so my guess would be that it's more a question of, doing enough damage that we feel like we've degraded the missile program to the point that we want it, or absorbing enough costs that it no longer feels worth continuing.
It's good to see you, Tobin. As always, Tobin Marcus there of Wolf Research on the pressure points for the administration right now. Look, with regards to the outreach, clearly there's a lack of trust between the two partners, and that's why talks broke down 1 and 2. Is Iran in a position to really follow through on any kind of off-ramp, even if there was an agreement, given the lack of leadership in that country right now?
Who are we talking about when we say Iran?
Precisely.
I mean, who are they even negotiating with, and is that person still around?
Coming up on the program, we'll catch up with Jim Bianco of Bianco Research as Fed officials debate the threat of higher inflation. Plus, Yohara has your morning movers, shares of Micron and SanDisk rising on memory demand. Those two names gaining in the pre-market. From New York, you're watching Bloomberg TV.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's difficult to keep up with this market, so let's do our best. So equities were firmer. Now they're down about 0.1% on the S&P, turning lower on the Nasdaq just moments ago. Moments ago, we heard from the Treasury Secretary, Scott Bessent, speaking to the American media a little bit earlier this morning, saying the 15% global tariff rate is likely to start this week. That's weighed on equities just a touch. Supporting equities just a bit was the report of outreach from the Iranian side over the weekend, that report coming from the New York Times, and maybe some increased sensitivity from the administration around the energy story, providing a framework to help traffic navigate the Strait of Hormuz and maybe a mechanism to ensure some of those ships. Now, that all sounds great. The details, though, are pretty vague, Lisa, and a lot of people are very skeptical that kind of thing can be put in place anytime soon.
Is this a tradable market? I mean, I'm asking seriously, given the fact that we're being whipsawed by headlines, and I understand that the moves aren't massive. Nonetheless, one of these different scenarios could cause a completely different outcome, and the tail risks are getting so significant. You're talking about potential off-ramps, maybe. You're talking about potential escalation, re-escalation with the trade war now. And then you're talking about what does a conclusion to a conflict look like that could get some of the prices of oil and shipping back down to where they were before.
It's a resilient market. Think about everything we've thrown at it. This shock over the weekend, AI disruption, massive moves beneath the surface, credit jitters as well. We've had credit spreads start to widen. Not blow out, but start to widen. And yet we're around 2% away from all-time highs on the S&P 500.
People do not believe there will be a recession. People believe in the resilience in the U.S. economy and say, typically you fade geopolitical risks. That's the knee-jerk reaction right now. That's what people want to believe. And the fundamentals seem to suggest that. But when do you keep paying attention to the fundamentals when they're overcome by events?
If I tell the Treasury Secretary at the start of the year that you can have a bond market close to 4% on 10s, they'd take that, right?
Totally.
4.1%-ish right now on 10s. I think the administration would take that.
Yeah, of course, we are freaking out. Does this mean a reinflationary boom? Are we too complacent about some sort of potential inflationary shock? Look, this is not exactly a volatile market on a headline figure. Under the surface, it has been whipsawed, nosebleed, people being blown out of momentum positions, and that's the reason why I think a lot of people are feeling quite different than that.
Let's finish on commodities. So $85 a barrel yesterday, very briefly. We backed away from those levels. We backed away yesterday afternoon off the back of the president's plan, if we can call it that. 82.32 right now this morning, higher by about 1%. WTI kind of inching higher as well. It's the commodity guides that concern me right now, and I keep going back to this point. A lot of other people in markets, and this again, is purely an observation. It's not a judgment about who's right or wrong. But a lot of people in equity markets are making the case, look at the geopolitical playbook, typically you fade it by the dip. But the commodity guys are very concerned about a real material spike from here to maybe triple digits, because they believe we're very, very close, days and not weeks away, from needing to shut in production because we're breaching storage capacity. That's a story that might be just on the horizon.
We've already seen that. It's actually a story in play in Iraq. Question of how long before it starts to be in play in places like Saudi Arabia that does have an off-ramp, but the UAE, as well as, of course, Yemen and others. This is a real question that people are trying to examine. as they look at the forward curve and they look at where the price should really end up.
Crude right now, 82.40 on Brent, 74.80 on WTI. As we count you down to the opening bout, 2 hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing shares of SanDisk and Micron bouncing back this morning after falling sharply yesterday, each down about 8%. The two memory chip names, as we know, have been some of the market's biggest winners, but were caught up in yesterday's risk-off mood. But now you have the dip buyers coming in because the situation has not changed. Memory chip demand is still through the roof due to the AI build-out. And it speaks to headlines like this one. We are seeing Nebius shares higher after the AI cloud company won the green light from a city in Missouri to build a giant AI factory campus. The facility could deliver up to 1.2 gigawatts of computing capacity, putting it among the biggest AI data centers being built today. So those shares up 2%. And we end on Bath & Body Works. This is the retailer that sells fragrance products. Sales came in better than expected as the company says it will exit areas that are not part of its core product lineup, like hair care. This is another one like Ross Stores that's benefiting from this in-store treasure hunt, hard to disrupt by AI. So shares had already run up 8% this year. Heading into the reports, up another 4.7% today. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. On our radar this morning, President Trump warning that any potential new leadership in Iran could be equally troubling.
I guess the worst case would be we do this and then somebody takes over who's as bad as the previous person, right? That could happen. We don't want that to happen. It would probably be the worst. You go through this and then in 5 years you realize you put somebody in who was no better.
Iranian officials suggesting a new leader could be named as soon as today. Elsewhere, the U.S. offering naval escorts and insurance guarantees to keep trade flowing through the Strait of Hormuz. The president vowing to ensure safe passage of oil from the Middle East as the conflict in Iran enters its 5th day. And finally, big tech titans meeting at the White House today, signing a pledge to absorb the rising energy costs of AI data centers. Representatives from Amazon, Meta, Microsoft, and Alphabet among those set to attend.
You know who else is set to attend? XAI. OpenAI. Guess who's not? Anthropic. I think it's going to be really interesting. Is this going to really be about energy picking up them?
They're out in the cold right now, aren't they?
They are out in the cold with the White House. They're out in the very warm room when it comes to a lot of the downloads.
They're up in the download charts
on
Apple.
Which raises a question about Sam Altman and what that relationship's going to be like, given the fact that he's trying to beg forgiveness now with his clients.
These tech guys don't have the energy problem. And we were talking about what Paul Sankey of Sankey Research said a little bit earlier. Their demand for data centers is energy price inelastic. What happens to the price of energy is not going to dictate their determination to spend this money over the next 12 months and maybe beyond. That's a problem for the administration.
Will the administration conflate some of the questions around oil prices and the shock in the Middle East with this demand from energy from AI and say, look, they're paying for our power. They can pay for the power that can offset some of this as well. I mean, could get really interesting given how much of a focus energy is right now.
It's interesting how real it's got and how quickly it's got real.
Yeah.
This meeting is taking place. This was on the fringes last year of becoming a problem over the next several years. It was a problem immediately, and they need to react to it right now. And we said repeatedly that this is going to be an issue going into the midterm elections, that your support of tech players spending all this money, you've got to help the electorate understand why it helps them. Show me the jobs it's creating. Why are my bills higher and my anxiety around the labour market is equally as high? Because of what's being spent here. You need to show me the benefits, otherwise you'll get the pushback big time.
That's the political story. From the market story, it raises a question of how long AI can keep departing from the rest of the index with people looking at this as a growth sector. Increasingly, if big tech companies are forced to absorb the costs of the energy that they use, at what point do they start being treated a bit more like utilities, given the hyper-regulation that will also come around this? And that will incur a very different valuation structure than what they currently are looking at.
Look out for that meeting a little bit later. Let's get to the Federal Reserve grappling with global inflation fears as the conflict in Iran threatens crude supply. The Minneapolis Fed President Neil Kashkari is saying it's too soon to know the full impact.
The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. Core goods inflation has been trending up because of tariffs. Now, with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. Right now, it's just too soon to know what imprint this has on inflation and for how long.
Jim Bianco of Bianco Research writing, if you want the Fed to cut rates, things just got a lot more complicated if energy pushes headline CPI to a big number later this month. Jim joins us now for more. Jim, do you think we're on track for that?
We very well could be. The price of gasoline, the national average, is up 20 cents in just the last 2 days. That's the biggest two-day jump in 21 years. And that alone, if we hold those prices through the end of the month, would add about 2 or 3 tenths to headline CPI. So everything is looking north right now on the inflation numbers. And that's going to make it very difficult for a Fed that's focused on inflation to say, oh, ignore all those big inflation numbers. We got to keep talking about cutting rates.
They will be conditioned by recent years. Do you think they should be conditioned by what happened a few years ago?
Yeah, I think that they should be, especially, too, if we were to get a little bit nuanced. The Fed prefers a measure called personal consumption expenditure, or PCE, and that number is actually going north. And the core PCE number in January, when it comes out next week, is expected to be 3.1%. The core CPI number that everybody else looks at is 2.5. That is unusual to see that PCE number way above the CPI number. Now, I think the reason is because OER, owner's equivalent rent, has been coming down a lot. That's been depressing the CPI number. The reason I bring that up is Fed officials are focused on that PCE number. So you heard with Neil Kashkari, when they talk about inflation, they're looking at that PCE number going up, and they're getting very concerned. And now we've got this energy thing. So they're really concerned about inflation, where maybe the rest of us are looking at CPI and being not so concerned.
Initially, the knee-jerk reaction to the war in Iran was the buying of the bonds, right? I mean, this was sort of a knee-jerk reaction, go into safe havens, and U.S. Treasuries were that haven. Then they started to sell off in the face of what you're talking about, a potential inflationary threat. I'm just wondering, from your perspective, how far this could go in terms of a sell-off before some of the concerns about disinflation, disruption, et cetera, brings down some of those yields?
Oh, I think it could go a lot further. It all really depends on, you guys were talking about this earlier. It depends on what happens next. If this war does not produce much more oil infrastructure damage and the price of oil doesn't go much higher, I think bonds could sell off some more. But we're at the mercy of headlines at any moment that there can possibly be more oil infrastructure damage that would elevate the price of oil even more. So we're just kind of waiting on circumstances right now to see where we go. But short of that, if all we're talking about is shipping disruption, no ships have been damaged, that can restart at any moment. I think that the price of oil could settle down and then bond yields could start back up. Remember, they were 220, 420, 430 just a couple of weeks ago.
John mentioned this earlier, and I keep thinking about it. If you do have a Fed that's on hold for a longer period of time as a result of this disruption, and you already have credit stress that's starting to emerge in certain pockets, does this accelerate that shakeout process?
I think it does, because keep in mind, the business development companies or the BDCs and a lot of these they're highly levered companies, and they're very dependent on interest rates. They need lower interest rates to lower their financing costs. And if we start seeing interest rates start meandering higher, and I'll use that word meandering to talk about the way that they're going to go, it's just going to put more stress on them. And the shakeout could be even more severe than just worrying about whether or not software companies still have their moat in the world of AI.
Jim, what do you make of how different companies in private credit have dealt with these problems independently? Blue Owl came out and sold a pool of loans, a portfolio of loans. They had some big buyers, some big pension funds, but also their own insurer. Questions asked about that. Blackstone doing the whip around and coming up with $150 million internally. That looks like they got skin in the game. Maybe you take some confidence from that. Jim, is there a better approach that you're seeing from certain players?
Well, Blue Owl also put some skin in the game, too, so let's not discount that as well. But you're right. They're all kind of scrambling around to try and figure this out. But I would say in the bigger picture, everybody goes to 11 when we start talking about gating with private funds. Since 2009, we've seen this after 2009 with Citadel. We saw this with after Brexit with the property funds in London. We saw this in 2020 with COVID. We saw this with Blackstone's real estate fund in 22. There's been over 100 private equity funds and private credit funds that have gated at one time or another in the last 15 years, and none of them produced a systemic crisis. They produced problems for those funds and problems for those investors. But if you weren't in those funds or you weren't an investor, it didn't produce a problem for you. And I think that we'd have to start thinking about whether or not this is different than all those other examples. And I'm kind of in the camp that it's not. It's a problem for private credit. It's a problem for those investors, but I'm not sure it's necessarily a systemic problem.
So let's stay on gating, Jim, and just a final question. I forget who said this in the last 24 hours, but I think it's an interesting one. Do you think gating is a feature or a bug of that industry?
It's a feature, and it's a feature because you're investing in a private fund that is priced once a quarter. It's not liquid assets. The private credit fund or the private equity fund comes up with the values that they will let you in or out of, and that they're not like an ETF. They're not at the mercy of a market that they can let anybody out at any time whenever they want. And so if there's too much of a demand to get out, gating is part of the feature. And as a matter of fact, you heard Mark Rowan say that yesterday. Look, if you want higher returns and you want higher returns because you like these private credit funds, you got to take more risk, and the risk might be gating.
Jim, it's good to see you. Thank you, sir. Jim Bianco there of Bianco Research. The risk accumulating, and we talked about the three key sources of risk right now: AI disruption, 1, the issues with credit, 2, and now this over the weekend and into this week, 3.
Yeah, and they're coming at the same time, which is different, right? I mean, we have seen this sort of rolling crisis in different sectors that are attacking the market, but they're not all at once. This potentially, with the meeting of tech titans in the White House with questions about credit funds, can you spare $6 million? And then this question about how long this conflict could go on. It's becoming a little bit more heady for a lot of investors.
We'll focus on the third source of risk in about 15 minutes' time. We'll hear from the U.S. Secretary of Defense, Pete Hegseth, alongside, once again, the Chairman of the Joint Chief of Staff, Air Force General Dan Kane, holding a news conference from the Pentagon. That briefing about 16 minutes away. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent saying moments ago President Trump's new 15% global tariff rate will likely take effect this week. The new rate was announced after the Supreme Court ruled against the president's existing tariffs. Bessent's also weighing in on the conflict in the Middle East, saying global oil markets are well supplied and the U.S. will reach out to ship owners in the Persian Gulf. In Iran, the funeral for the late Supreme Leader Ali Khamenei has reportedly been postponed. Semi-official Tasnim news agency citing the unprecedented presence of mourners as the reason. The ceremony was originally scheduled to begin today at 10 p.m. local time in Tehran and set to last for 3 days. And airlines around the world continuing to suspend flights across the Middle East. Tracking service Flight Radar 24 says more than 12,000 flights have been canceled since Iran's first retaliatory strike over the weekend. The UAE says it's starting to establish what it calls safe air corridors that will allow for as many as 48 flights an hour. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara about 30 minutes away. Up next on the program, ignoring the obvious.
We're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious.
Tom Tetsouras of Strategas joins us next, live from New York City. You're watching Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1
is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Great stats from the team over at Charles Schwab, Kevin Gordon, Liz Ann Saunders. Kevin sent this over just a moment ago, just to build on your comments about that index-level resilience. The S&P 500's max drawdown this year, -3%. The average S&P 500 members' max drawdown this year, -12%.
The surface of the market feels pretty calm. People talk about the paddling duck type of market. I'm just struck by the fact that that is not how people feel in this market. They feel whipsawed, they feel frustrated, they feel beside themselves, and frankly deceived because the trends that they focus on change in a dime.
We keep going back to this, the longest first quarter ever. Still a month to go.
Please.
It's amazing. It really is. Still a month to go. Equity futures on the S&P 500 just about negative, almost unchanged on the Nasdaq 100. Under surveillance this morning, a focus on credit, ignoring the obvious.
We're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious. And it all feels good while it's happening, and then it doesn't feel so good once it arrives. Well, some of those changes have arrived.
So here's the latest this morning. Blackstone turning to internal executives to help cover the cost of a record redemption request. People familiar with the matter telling Bloomberg that Blackstone raised about $150 million from just 25 senior leaders to put towards withdrawals from the Blackstone Private Credit Fund. Tom Tsouras of Strategas writing, we continue to see more cockroaches in private credit, along with lingering stress in office space and commercial real estate. Tom joins us now for more. Tom, we're ignoring the obvious, and welcome. What are the obvious things that we're ignoring?
Well, I think the obvious thing that we're ignoring here is that what ties all of these things together, office space, private credit, the AI risk, and the threat posed by conflict in Iran, is if the yield curve steepens, and even steepens back out to more normalized levels, you're going to have systemic credit risk. If the yield curve is allowed to remain relatively flat because the Fed maintains a big balance sheet and because the Treasury continues to issue T-bills rather than increasing coupon auctions, then we're probably not going to have systemic stress. But it's curve steepening that's the big risk.
So, Tom, this is really important, and Lisa and I spent the morning asking the very same question. Do you believe the risks in Iran right now and the market consequence of those risks materializing threaten to be an accelerant of what's playing out in credit?
They definitely do, but how we get there is you got to make some mistakes along the way. And by that, I mean, well, first of all, this conflict has to be prolonged. And as I think Jim Bianco had mentioned, if there's further damage to the oil infrastructure, that's also going to risk that we're going to see systemic risk in the U.S. But then you've got to see policy mistakes by the Federal Reserve. And I think a policy mistake would be to ease into that economic supply shock. That's a risk.
Why
now,
would
if the Fed eases, the curve is going to steepen and inflation expectations are going to have a chance to widen out and grow. And that's when you start to put pressure on places like private credit, where their borrowing costs or their funding costs or their investors are funded in the 5 to 10 year portion of the curve, or even BDCs, where again, their funding is primarily in that 5-year portion of the curve, not the front end of the curve. So if the Fed eases into an energy supply shock that is prolonged, the curve is going to steepen and can steepen quite a bit.
Yeah, but Tom, even without that, we are seeing yields go higher, and maybe the curve is flattening, but still on an absolute level, 10-year yields have been rising in tandem with 2-year yields. It is resetting people's expectation for inflation, for baked-in premia that people will have to pay to ship goods. I'm looking right now at high-yield bond spreads, which have increased, oh my goodness, to the highest going back to November, still lower than 3 percentage points over benchmark rates. I mean, how much more do you see this having to reprice just by virtue of all the potential shocks coming down the pike and the potential for an acceleration of the cycle that we're already seeing play out?
You know, that's a great question. And for what it's worth, our forecast for 10-year yields is somewhere around a 470 to 480 by the end of the year. So based on what we saw the economy how we saw the economy playing out this year, we would say there's quite a ways to go for yields to push higher. But even just a return back to 430, that 430 to 450 range would seem to be in order. And that alone will probably put some further pressure on the credit space, absolutely.
So what's the haven play here, Tom? Where do you go?
Well, unfortunately, we're still in a world where there's really not many havens at all in the fixed income space. You would want to be typically the ultimate haven in fixed income is short to intermediate duration investment grade corporates. We'll say 1 to 3 year A-rated, A+ rated paper typically has the lowest volatility profile, and that probably still is a haven. Beyond that, anything in the investment grade to treasury space, agency space, in the 0 to 2 year portion of the curve is where we would find safety in this type of economic scenario.
Hey, Tom, this was thoughtful. It's good to see you, buddy. Thanks for being here. Tom Tsutsouris there of Strategas. We keep returning to those 3 buckets, sources of risk right now: AI disruption, credit jitters, and geopolitical risk in the Middle East. 1 has informed 2. AI disruption has informed the credit jitters. How does 3, geopolitical risk, inform 2 as well? The credit problems. And it's the accelerant story that I think is an interesting one, the interplay between those 2 risks.
Those risks have gone in one direction, AI to credit risk, and then you have a third that just kind of has lingered out here as a separate entity. Does the third go to credit that then infects AI? Because that has been the ultimate question. If you get the credit taps turned off to the AI story, how much could that disrupt some of the build out and the price inelasticity that you've seen from some of these? I mean, it's a huge question, and these 3 are kind of coming together.
Yeah, in a big way, and potentially a much, much bigger way, but we keep going back to the same point. It depends how long this lasts. Now, when I ask the question, how long does it have to last for it to be a problem, we've actually had quite a wide range of estimates. The consensus seems to be several weeks, 3-4 weeks, bigger problems. Paul Sankey of Sankey Research said it's several days. You get to Friday, if that strait's not reopened, you're going to see production shut in and much bigger problems.
I could just hear Wall Street saying, but.
Of course there's
credit trading saying geopolitics never is the presiding factor in market performance.
That's the consensus position, and that's why we're around 2% away from all-time highs on the S&P. Up next, Mira Pandit of JP Morgan Asset Management, Jay Goldberg of Seaport Global, and the Fed Governor Stephen Myron, plus a briefing from the Pentagon on the other side. The third hour of Bloomberg Surveillance just around the corner.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television. You up to the minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
I think the price action's reasonable right now.
There's just too much uncertainty about these larger narratives.
I think it's a buy incrementally less America moment.
There's still some more room that you could fall.
The equity market is going to have a hard time making that next leg higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Here's the price action. Equities just about positive on the S&P, up by 0.1%. On the Nasdaq, up by 0.2. On the Russell, up by 0.4. Here's a snapshot of the commodity market. Brent and WTI volatile over the last 24 hours, pulling back now. We're down by 0.5 this morning on Brent. On WTI, we're down by 0.8 as we see some signs of support coming from the president on the traffic going through the Strait of Hormuz. And a story from the New York Times supporting sentiment earlier on this morning as well, suggesting that over the weekend there was outreach from the Iranian side looking for an off-ramp.
Look, it's Whack-A-Mole Wednesday, because ultimately, on one hand, you've got the question of how much you get an off-ramp from President Trump, from Iran, at the same time that you have oil assets being potentially targeted and hit in the Middle East, questions about how much supplies are building. And as these headlines come out, throw in a little tariff dust for that. You see the whipsaw that's going on in markets as everyone tries to digest what the latest is.
Signal and noise. It's really difficult right now. Let's go to that piece from the New York Times. This is what they're saying, and I'll read it out to you verbatim, and you can decide what you think about it. A day after the attacks began, operatives from Iran's Ministry of Intelligence reached out indirectly to the CIA with an offer to discuss terms for ending the conflict. That, according to officials briefed on the outreach.
So there are a couple of ways to take this. Number one, that President Trump didn't take this. Number two, it is unclear whether that person is still in the Iranian leadership, is still around. We don't have a sense of who's talking to who. There are a lot of question marks here, and it raises the specter of who ultimately will take charge in Iran should there be an off-ramp. How easy is it to find that.
So in just a moment, we've got a briefing, an important briefing that we'll take right here on Bloomberg Surveillance with the U.S. Secretary of Defense, Pete Hegseth, and the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane, taken to the podium in just a moment. And when they do, we'll bring you those comments. And I've got a few questions myself. One, of course, on the New York Times report. What was the outreach? Who is it from? What's the president saying about it? Can you share any details on that whatsoever? Don't know what they can say, but that question's got to be asked. Second one would be on the president's plan to escort ships through the Strait of Hormuz. Do you have the ability, the capacity, the spare capacity to lend those resources to make sure that can happen anytime soon?
Yeah, and does it include insuring some of those ships against losses? Is this a question of just the payment to compensate for potential damage done as ships go through the Strait of Hormuz? Will that be enough? I mean, people don't want the damage to begin with. Why would a ship operator want to subject themselves to that? Or is this actual military ships that will be accompanying the transshipment of goods through that strait? Look, there are a lot of questions. There's a lot of also questions about what the ultimate goal is of this conflict.
So we should get some details in the next 15 minutes about where we are with Operation Epic Fury. And then later on in the hour, we'll get some market reaction. Plus this, on the Federal Reserve, Governor Myron, about 27 minutes away. What is the Fed's reaction function as this shock plays out in real time?
So far, Neil Kashkari of the Minneapolis Federal Reserve was speaking with Michael McKee yesterday and talked about how there was likely to be a greater degree of inflationary pressure that might push him away from cutting rates one time as he previously had expected. Will that be the same kind of tone? Probably not from Governor Myron.
Let's head down to Washington, D.C. now, so we can hear from the U.S. Defense Secretary, Pete Hegseth, alongside the Chairman of the Joint Chiefs of Staff, Air Force General Dan Kane.
Today with one unmistakable message about Operation Epic Fury. America is winning, decisively, devastatingly, and without mercy. Under the direct command of President Trump, the War Department unleashed this operation early Saturday morning, just 4 days ago, which means we need to remember two things. First, we are only 4 days into this. Metrics are shifting, dust is settling, and more forces are arriving. It's very early, and as President Trump has said, we will take all the time we need to make sure that we succeed. Second, we are only 4 days into this, and the results have been incredible. Historic, really. Only the United States of America could lead this, only us. But when you add the Israeli Defense Forces, a devastatingly capable force, the combination is sheer destruction for our radical Islamist Iranian adversaries. They are toast, and they know it. Or at least, soon enough, they will know it. And we have only just begun to hunt, dismantle, demoralize, destroy, and defeat their capabilities, just 4 days in. Starting last night and to be completed in a few days, in under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. I hope all the folks watching understand what uncontested airspace and complete control means. It means we will fly all day, all night, day and night, finding, fixing, and finishing the missiles and defense industrial base of the Iranian military, finding and fixing their leaders and their military leaders, flying over Tehran, flying over Iran, flying over their capital, flying over the IRGC, Iranian leaders looking up and seeing only U.S. and Israeli air power every minute of every day until we decide it's over. And Iran will be able to do nothing about it. B-2s, B-52s, B-1s, Predator drones, fighters, controlling the skies, picking targets. Death and destruction from the sky, all day long. We're playing for keeps. Our warfighters have maximum authorities granted personally by the president and yours truly. Our rules of engagement are bold, precise, and designed to unleash American power, not shackle it. This was never meant to be a fair fight, and it is not a fair fight. We are punching them while they're down, which is exactly how it should be.
Thus far, Operation Epic Fury has delivered twice the air power of shock and awe of Iraq in 2003, minus Paul Bremer and the nation building. The campaign has 7 times the intensity of Israel's previous operations against Iran during the 12-day war, 7 times. And as President Trump said, more and larger waves are coming. We are just getting started. We are accelerating, not decelerating. Iran's capabilities are evaporating by the hour, while American strength grows fiercer, smarter, and utterly dominant. More bombers and more fighters are arriving just today. And now, with complete control of the skies, we will be using 500-pound, 1,000-pound, and 2,000-pound GPS and laser-guided precision gravity bombs, of which we have a nearly unlimited stockpile. We used more exquisite standoff munitions at the start, but no longer need to. Our stockpiles of those, as well as Patriots, remains extremely strong. The enemy can no longer shoot the volume of missiles they once did, not even close. And the chairman will lay out some of those percentages. So our air defenses and that of our allies have plenty of runway. We can sustain this fight easily for as long as we need to. And as I said yesterday, we set the terms. Now, you may not see much of it because the IRGC shut off the internet to the entirety of the country. They blind their people on purpose, just like they kill their own on purpose. Much was made of the volume of missiles Iran was able to shoot in the first few days. And sadly, as we projected, a few got through and killed 6 of our best, who will hopefully arrive home soon. We will avenge them, no doubt. But I liken Iran's predicament to a football team who scripted the first 20 plays of a game. The team knew what plays to run because their first few drives were scripted. But now that the game has started and the blitz is on, they don't know what plays to call, let alone how to get in the huddle and call those plays. Iran's senior leaders are dead. The so-called governing council that might have selected a successor, dead, missing, or cowering in bunkers, too terrified to even occupy the same room. Senior generals, mid-level officers, enlisted ranks, they can't talk or communicate, let alone mount a coordinated and sustained offensive. That's not great for morale. The Iranian Air Force is no more, built for 1996, destroyed in 2026. The Iranian Navy rests at the bottom of the Persian Gulf. Combat ineffective, decimated, destroyed, defeated, pick your adjective. In fact, last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice. Their Navy, not a factor. Pick your adjective, it is no more. In fact, yesterday, in the Indian Ocean, and we'll play it on the screen there, an American submarine sunk an Iranian warship that thought it was safe in international waters. Instead, it was sunk by a torpedo. Quiet death. The first sinking of an enemy ship by a torpedo since World War II. Like in that war, back when we were still the War Department, we are fighting to win. Also, yesterday, the leader of the unit who attempted to assassinate President Trump has been hunted down and killed. Iran tried to kill President Trump, and President Trump got the last laugh. Now, this is not a mission accomplished situation. This is simply a reality check. The combination of U.S. and Israeli intelligence and combat power will control Iran, and will control it soon. Sure, Iran will still be able to shoot some missiles, and still be able to launch one-way attack drones at civilian targets, and their proxies will attempt to attack our embassies, bases, and soft targets. They are terrorists, after all, and they need to target civilians because they can't fight toe-to-toe. But we will find them, and we will kill them. This is what the fake news misses. We've taken control of Iran's airspace and waterways without boots on the ground. We control their fate. But when a few drones get through or tragic things happen, it's front page news. I get it. The press only wants to make the president look bad, but try for once to report the reality. The terms of this war will be set by us at every step. As I said Monday, the mission is laser focused. Obliterate Iran's missiles and drones and facilities that produce them, annihilate its navy and critical security infrastructure, and sever their pathway to nuclear weapons. Iran will never possess a nuclear bomb, not on our watch, not ever. And this is why President Trump's moral clarity on Iran today is so vital. Unlike the past, where vague red lines and endless negotiations let Iran fund terror and inch ever so slightly toward a bomb, this president sees the threat plainly and acts decisively. No more half measures, especially when Iran is at its weakest. No more letting Tehran play for time while our people pay the price. His leadership ensures that we finish what we start and that we protect our warfighters by crushing the enemy before they can strike again. Our offensive operations, refined through months of relentless preparation, are unstoppable. And our defensive efforts are unprecedented. We have from the start put the protection of our troops ahead of everything else. Before we very publicly built up offensive combat power, we quietly ensured that our defensive posture and power was in place. And as we built up offensive combat power, we moved the vast majority of American troops, over 90% of Americans that were on our bases, what we say off the X, out of the range of Iranian fire. Our defensive shield is equally formidable, the most sophisticated air and missile defense network ever fielded. Thousands of Iranian missiles and drones have been intercepted and vaporized. Tens of thousands of American and allied lives protected. We have pushed every counter-UAS system possible forward, sparing no expense or capability.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcoming your family members home at Dover in the coming days. Out of respect for the other families, we'll withhold the release of their names until next of kin notification is complete. And either myself or Admiral Cooper will release those names as soon as we can ensure that all of those families have been properly notified. To our Gold Star families, to our wounded warriors and their loved ones, we will never forget your sacrifice. Our nation stands with you, and we are eternally grateful for your courage, your resiliency, your devotion to this mission and to our nation. As the Secretary said, we're 4 days in, 103 hours into this campaign. The operation was again launched with clear military objectives designed to dismantle Iran's ability to project power outside of its borders, both today and in the future. First, we are targeting and eliminating Iran's ballistic missile systems to prevent them from threatening the U.S. Forces, partners, and interests in the region. Second, we are destroying the Iranian Navy, degrading its capacity, capability, and ability to conduct operations, not just in the Central Command AOR, but as the Secretary showed in the video, around the world. Third, we're ensuring Iran cannot rapidly rebuild or reconstitute its combat capability or combat power, and those phases will begin as the campaign continues. As of this morning, U.S. Central Command is making steady progress. Iran's theater ballistic missile shots fired are down 86% from the first day of fighting, with a 23% decrease just in the last 24 hours. And their one-way attack drone shots are down 73% from the opening days. This progress has allowed CENTCOM to establish localized air superiority across the southern flank of the Iranian coast and penetrate their defenses with overwhelming precision and firepower. We will now begin to expand inland, striking progressively deeper into Iranian territory and creating additional freedom of maneuver for U.S. forces. Let me explain a little bit about how we're thinking about staying ahead of the enemy. First, over the past several weeks, Admiral Cooper and the CENTCOM team have refined their operational approach to the region. Their planners identified key centers of gravity that would allow Iran to project power outside of its borders. They thought about how to isolate critical vulnerabilities and determined where, with precision, the greatest strategic effect could be achieved. As a result of this, CENTCOM is now shifting, in day 4 already, from large, deliberate strike packages using standoff munitions at range outside an enemy's ability to shoot at us, now into stand-in precision strikes overhead Iran. As the Secretary said, this is a point of munitions transition from standoff munitions to stand-in munitions like Joint Direct Attack munitions, which are GPS-aided free-fall weapons, and other things like Hellfires, etc. This will allow the joint force to deliver significantly increased precision effects on the target. The throttle is coming up, as the Secretary said, as opposed to ramping down. This will allow us to maintain consistent pressure on the adversary over the coming days, disrupt their launch timelines, and impose cost every day around the clock. I know there have been a lot of questions about munitions. We have sufficient precision munitions for the task at hand, both on the offense and defense. But I want to tell you, teammates, as a matter of practice, I don't want to be talking about quantities. And I know there's been a great debate about that, and I appreciate the interest, but just know that we consider that an operational security matter. Let me flip to the map here. Hopefully I don't kill anybody with a laser pointer. As I mentioned earlier, and for you with the camera right there, my friend, I hope I don't ricochet off and hurt you. Over the initial days, the U.S. Joint Forces continued to attack and attrit ballistic missile capabilities as well as integrated air defense capabilities along the southern axis. Along the northern axis, Israel and the Israeli Air Force has predominantly been working integrated air defense targets along the northern flank, as well as medium-range ballistic missile capability as well. From the sea, the USS Ford has continued to project combat power here, as well as the bomber pulses that we talked about in the opening days of this briefing. Along the southern axis, the USS Abraham Lincoln Strike Group has continued to provide pressure from the sea along the southeastern side of the coast and has been attriting naval capability all along the strait and up into the Arabian Gulf at a size and scale sufficiently to address the targets required. To date, we've hit over 2,000 targets, as Admiral Cooper said in his video last night. We've destroyed more than 20 Iranian naval vessels vessels, including, in addition to the frigate outside of the area, one submarine, and effectively neutralized at this point in time Iran's major naval presence in theater out there. As the Secretary showed the video, for the first time since 1945, a United States Navy fast attack submarine has sunk an enemy combatant ship using a single Mark 48 torpedo to achieve immediate effect, sending the warship to the bottom of the sea. I want to remind everybody that this is an incredible demonstration of America's global reach. To hunt, find, and kill an out-of-area deployer is something that only the United States can do at this type of scale. Over the next 24 to 48 hours, CENTCOM will continue to strike infrastructure and naval capability, and will continue to assess our progress against the military objectives. It does take time for us to collect that information and to assess en route. Much of our intelligence, surveillance, and reconnaissance capability is currently hunting and killing ballistic missile launchers and one-way attack capability. We're precise in that assessment, and we call balls and strikes in that assessment. We take that matter seriously. Iran, on the other hand, has been indiscriminate and more imprecise in their attacks. They fired more than 500 ballistic missiles and more than 2,000 drones, striking innocent civilian targets throughout the region. Our partners are answering the call to defend themselves right alongside us. Jordan, Bahrain, Saudi Arabia, the UAE, Qatar, and Kuwait are all defending their people with their own combat capability, with precision and restraint. Jordanian air defense crews recently intercepted a cluster of Iranian one-way attack drones headed to Amman. Bahrain's air defense forces shot down an inbound drone approaching Manama's maritime infrastructure, protecting both their population and critical shipping lanes. Saudi Patriot batteries stopped a salvo of ballistic missiles aimed at energy facilities near Dhahran. The UAE neutralized multiple drones targeting Abu Dhabi's industrial zone, demonstrating speed and precision. And Qatari fighters for the first time have shot down 2 Iranian bombers that were en route to their location. Together, these nations are helping to defend themselves and project power as required against the enemy. We're 100 hours in. It's still very early, as the Secretary said, but the balance is shifting. We've always got to remember that these operations are complex, dangerous, and far from over. Our soldiers, sailors, airmen, Marines, Guardians, and Coast Guardsmen remain in harm's way, and we must be clear-eyed that the risk is still high. This is combat. Let us never forget this. As we continue, I ask that we hold all of our deployed teammates in our thoughts, those standing the watch, flying the sorties, sustaining the fight, and carrying our nation's burden. And I'll stop where I started, and that's remembering our 6 fallen who will return home as soon as possible. I remain humbled, grateful, inspired by every day the valor and professionalism of our joint force. They are quiet professionals through and through, out there doing America's work through the day and through the darkness. And with that, I'll take your questions along with the Secretary.
We've been tracking the press briefing at the Pentagon down in Washington, D.C. We'll continue to track the headlines that come out of the Q&A portion of that conference, alongside the U.S. Secretary of Defense, Pete Hegseth, there, alongside General Dan Kane. 2 notable headlines that came out of that. One from the Defense Secretary, that U.S.-Israel have complete control of Iranian skies. And 2, from General Dan Kane, the U.S. is shifting from large to precision strikes over Iran.
As they do get complete control over the skies, the initial move in markets seemed to suggest that people were taking the general and Pete Hegseth at their word, frankly, discussing exactly what would happen and getting some comfort from that. Still some questions, and I'm sure that they'll be getting them, about what the goals are in terms of not just eliminating the nuclear threat, but also exactly what they would like to constitute the government or the establishment to prevent any kind of reestablishment of the nuclear program in particular.
It's fair to say this is a fluid situation. So far, going into the cash open, futures are still positive by 1/3% on the S&P. Likewise, on the Nasdaq. In the bond market, bond yields look like this. Yields are higher by a single basis point on a 10-year. We did get an ADP report out just moments ago. That was an upside surprise. And an update on the move in energy. Crude, slightly negative. We're down by 0.2%, but still in the 80s on Brent. Brent crude at 81.21. With us around the table, tracking that briefing, Mira Pandit of JP Morgan Asset Management. Mira, good morning.
Good morning.
What are your thoughts on the shock over the weekend, how things are developing, and what it means for your world?
Seeing that press conference, you are seeing that we are projecting power and strength and control, which I think is a calming factor to the markets. But the reality is there was also a comment about as long as it takes to succeed. And that is the biggest concern for the markets of how long does this go on? And perhaps there is increasingly going to be some separation between how long does the conflict continue, and is there some liquidity, fluidity through the Strait of Hormuz that just gives us enough relief to put a little bit of pressure off of markets? But overall, as we take a big step back and we continue to debate, is this days or weeks or months or years? Ultimately, from our perspective now, thinking about more of the weeks calculus here, our expectation is that it will be modestly inflationary, but likely not stagflationary, because you still have the benefit of timing here around the One Big Beautiful Bill Act and the stimulus payments to consumers and taxpayers, which essentially will alleviate some of this pressure if we have upward oil prices, which so far have been relatively well contained. But you do think about some of that putting a bit of upward pressure on inflation. Now, as it is, we were expecting that inflation would peak about 3% or more by the midpoint of the year, given tariffs, given elevated tax refunds driving up demand and therefore prices. So this reinforces that view, but I don't think it makes it a step function worse yet.
This is one of three risks we've discussed all morning on this program, the other two being AI disruption and the credit jitters. Do you see those risks accumulating into an index-level threat? Because at the moment, around 2% away from all-time highs, it looks like we're doing okay.
We are experiencing somewhat of an index level threat as it is, because even though we're roughly flat on the S&P 500 and have skirted around that for the most part of the year, you do see that tech is still down 5 or 6% year to date. And yet, on the other hand, you have 5 different sectors that are up double digits year to date. And again, this isn't 2022 where it's just energy that's being the big driver here. You're still seeing industrials, materials, consumer staples as other big winners so far this year. So you have seen that rotation. It's just challenging in such a concentrated index where tech has been such a big part of it to see those stocks look a little bit weaker. But ultimately, I still think it's a rotation around AI from who are the innovators and around technology to who are the beneficiaries of that CapEx and where is that infrastructure layer coming in. Again, it's just a little bit less of a weight in the index to have that power to drive it forward. But very much the conversation around AI has flipped from, are we overestimating AI and is it a boom and soon to be a bubble, to are we underestimating the power of AI? So we continue to cycle through these different existential fears, which does create an issue for the markets ultimately that I think we'll look back on in 2026 and say it was this tension between sentiment and fundamentals, where the fundamentals within the market this year and so far in the economy still look strong, but the sentiment clearly is anxiety-ridden.
Well, I guess to build on where John was going with this, part of the issue that people have this morning is the first part of what you were talking about, which is the inflationary aspect of this. It wouldn't be stagflationary, it would be inflationary, which potentially could really create an obstacle for the Federal Reserve to cut rates even once, let alone twice. It could potentially pressure some of the credit jitters that we've already seen that are working their way through the system. How realistic do you see that? A tightening in financial conditions due to the inflation that could dampen some of that growth that you were talking about?
Relative to 2022, I think this time around we do have to separate headline and core inflation. Because if you do see headline inflation a bit elevated, but core inflation is still experiencing some of these disinflationary trends, then the Fed still may feel comfortable putting in a cut, especially depending on how the labor market continues to shape up. Relative to 2022, what we forget is, yes, there was an inflation spike, but it was all across the board. It was not just the oil prices and the food prices related to geopolitics, but also you still had very strong core goods prices, very strong services prices, which we're not seeing to that same extent today. So there was no room for the Fed to do anything other than stay in one direction, hiking rates, whereas this time around, we do have core inflation potentially looking a little bit softer in the back half of the year.
Sometimes when the threat is big enough, the decision is obvious. And right now, I don't think the decision is that obvious for the committee at the Federal Reserve.
Which makes it that much more difficult given the fact that they have a hawkish bias. That's what we heard earlier. Based on what we saw in 2021 and 2022, they were burned by inflation. They don't want to be burned again.
Mira Pandit at JP Morgan Investment Management. Mira, good to see you. Thank you. I mentioned that ADP number dropping just a moment ago. Upside surprise 63K, the estimate 50 with the details. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, it's kind of interesting because ADP, you've seen the numbers, filed 63,000 jobs for the private sector. And the consensus so far for non-farm payrolls of economists we've surveyed for private sector jobs is 65,000. So very, very close. However, remember last month, 172,000 private sector jobs were created, and ADP's revised number for last month was 11,000. So big miss last month. We'll see if they're any closer this month. They do show of that 63,000, 58,000 are in the healthcare area. So that hasn't changed. The sectoral dispersion of job creation is still very, very narrow out there. In terms of the payroll situation for job changers, 6.3%, that's down. Job stayers get a change of 4.5%. That's unchanged from the month before. So still no price pressures or wage pressures out there.
Mike McKee, thank you, sir. Looking ahead to the payrolls report on Friday, the next big stop for the labour market debate. The bond move continues, yields slightly higher for a third consecutive day, inflationary fears making a comeback, and some people out there trimming Fed rate cut bets. Federal Reserve Governor Stephen Myron, I'm pleased to say, joins us around the table for a conversation about that and a whole lot more. Governor Myron, good morning.
Good morning. Thanks for having me.
Thank you for being here, sir. Let's start with the shock over the weekend. What is the prudent response for policymaker confronting a shock like the one playing out in the Middle East?
Well, at the moment, I think it's too early to sort of have any firm views as a result of that. Oil's gone up a bit, but the bigger question is, does oil stay up or does it come back down? And that'll, of course, will depend on how things play out. But even that said, even if oil stays at these types of levels, to me, it's difficult to get a lot of read-through as a result of that. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
So some people who come on the program spoke to Lisa and I and said these Federal Reserve officials might be conditioned by the post-pandemic experience coming out of 21 into 22 and the inflation spike then and the energy shock that developed at the time emanating in Russia. Is this different? Are we in a different place?
I think it is. I think that attitude is a little bit of fighting the last war. And I think that the Federal Reserve for decades has had the view that, that headline inflation shocks like oil are best looked through, and you sort of focus on core inflation because it's indicative of where inflation is going to go in the future, and you focus on the labor market. And that type of reasoning leads you to look through an oil shock. Now, of course, what happened in 2022 was a bit different because the other policy settings were different, right? Don't forget, monetary policy was as expansionary as it had ever been at the time. Fiscal policy was injecting trillions of dollars into an economy that was recovering thanks to vaccines and medical improvements and COVID passing on its own. And so the policy environment was very different. And so it was very easy for a slightly inflationary shock to feed through into the broader economy and create this type of persistent inflationary problem that the Fed dealt with. We don't have that right now. We don't have fiscal policy that's slamming on demand. In fact, if anything, supply is moving out quite aggressively, and monetary policy is still modestly restrictive in my view. So the policy settings, the economic environment is different. To focus on that, as you described a moment ago, to me, is fighting the last war. That was a unique circumstance.
At the same time, some people have argued that the January jobs report raised a question about just how weak the labor market actually was. Even Governor Chris Waller came out and said, okay, now it's a coin flip for whether we should cut rates at the March meeting. If we do get confirmation of that strength with the February payrolls report that we get on Friday, would that make you rethink whether March was an appropriate time to cut rates?
So look, for me, we've got 2 years of a trend, 2+ years of a trend of gradually weakening labor markets that's sort of set in 2023. It's way too early to reject the notion that that trend continues based on 1 or 2 labor market reports. And when you look at the totality of labor market data, there's still evidence to me that it needs more support from monetary policy. When I look at things like employment levels of young folks and folks without college degrees, when I look at people who are unemployed for long periods of time, long-term unemployment, to me that's indicative of there still being slack in the labor market that monetary policy can accommodate. So I think it's too early to reject the notion that a 2+ year trend is is over on the back of one print.
Are you concerned, though, that right now the market is moving the way that any rate cut would be perceived as heightening long-term inflation pressures, just by virtue of some of the supply shocks that we're seeing, and frankly, the fact that people do see strength reemerging in certain pockets of the economy? I mean, how worried are you that a rate cut in March could be potentially counterproductive and cause the long end of the yield curve to rise?
Yeah, so if you saw evidence in inflation markets that markets were concerned about long-run inflation expectations, that's the type of thing that would give me pause. But I don't see evidence of that so far. Short-run inflation expectations have come up quite a bit when you look at CPI swaps, but that's just because of the mechanical read-through of oil prices into headline inflation. When you look at longer tenors, there hasn't been much of a move. And so as a result, I don't get the impression the market is concerned about long-run inflation expectations.
You've used this phrase modestly restrictive a few times in this conversation already. What is modestly restrictive to you? Can you put numbers on that kind of thing?
Yeah, I think we're probably about a point above neutral now. And so my view is that we ought to start by getting back towards neutral.
So the 100 basis points in reductions you want this year is not to become accommodative. You believe it's to get back to a neutral setting?
Yeah, pretty much.
What would it take for you to start thinking about the need to get accommodative?
So I would want to start thinking about inflation coming in below the target, which is a risk that I've highlighted. If I end up being, I've emphasized
housing. What's the source of that risk, Governor? What would be the source of that risk to get below target inflation?
Sure, I've emphasized housing markets a lot, that I'm expecting a faster convergence down of renewal rents to new rents, which will lead housing inflation to converge quickly to new rent levels. And there's reasons for that I've talked about at length. I don't need to repeat them here unless you want me to. But if I end up being right about housing and wrong about tariffs, and so I've also argued that I don't view tariffs as driving goods inflation. I don't view that because imported good prices are not inflating faster than all good prices, which is what you would expect to see. And given that backdrop, I don't view tariffs as driving goods prices. So if I end up being right about housing and we get a sharp deceleration in housing this year because of quirks of how housing is measured and because of dynamics of renewal rents versus new rents, and I end up being wrong about goods prices and goods inflation comes down quickly over the course of this year, then we're going to undershoot. Our target.
And you think that's a risk we need to get ahead of?
No, I'm not saying we need to get ahead of that. That would get me to argue we go below neutral.
That's the conversation we're having about how preemptive you might need to be in a moment like this. When others on the committee are thinking, let's wait and see what happens. Lisa was asking, how would you vote at the March committee meeting? Is this a moment to wait and see or a moment to act?
No, I think it's a moment to continue acting. I have projections for unemployment. I have projections for labor market. So do for inflation. So do my colleagues. And I believe it's appropriate to continue acting in accordance with those projections until you get evidence that you have to change your projections. And thus far, the evidence from events over the weekend haven't led me to change any of my forecasts for the labor market for inflation over the medium term. So it's too early to respond to them.
You said that you think that the neutral rate is a point below the 3.75 where we currently are, and I'm just wondering how quickly you think it's important to get to neutral based on the uncertainty, based on the disagreements that people have about A, where neutral is, and B, how things are going to transpire.
Yeah, so last year I was voting for 50s because we were higher away from it. And then as we made progress cutting and getting closer towards neutral, I felt it was appropriate to say, okay, moving in 25 clips. I'd prefer to still continue moving in 25 clips until we got to neutral and then to reevaluate. Because at the end of the day, I don't see an inflation problem in the United States. Now, of course, if we get evidence that what's happening in the Middle East is bleeding through into broader inflation, then that would change my mind. But thus far, there's no evidence.
Quickly, Governor, what would that evidence look like? What would you look for specifically?
I'd look for inflation expectations starting to move as a result, starting to move in a durable way.
Market-based or consumer-based?
I tend to think that the market-based ones are more important to me, or evidence the economy is starting to, in some sense, overheat again. Then I would be comfortable sort of changing that view and moving even more slowly. But at the moment, I see it as appropriate to continue cutting.
Do you have any company on the committee?
I can't speak for anyone else, and I think most people probably end up sharing my view that it's too early to draw dramatic conclusions as a result of what's happening.
But they come into a very different conclusion about what to do as a result of not drawing conclusions. They say, okay, well then don't move. You're saying keep moving. So I mean that's
they started in different. Everybody is. I think people are generally where they were last week, right? And it's just too early to change your mind based on what's going on. My forecast for inflation and unemployment, in my view, call for continuing interest rate cuts. Other other people disagree, you know, and so they also haven't moved yet. But as we get information, they'll update.
Two more things to work through.
Yeah.
So the credit jitters one, and AI another. I want to squeeze them both in if we can. So let's start with the AI jitters. So Block, a fintech company, came out in the last week or so and cut almost half of its staff. And they said they're making a massive AI productivity bet. As a policymaker for you, do you consider that noise or signal? What is that?
So that's one company. It's indicative of what you could have more of. But this is how productivity gains in technology work. They allow you to produce more with fewer inputs, with fewer resources. And so if you were able to produce the same amount with fewer workers and less capital, then your productivity goes up. That frees those workers not necessarily into unemployment, but to do other work. And this has always been the story of human technological progress and the human economic growth. We create new technologies, they destroy some jobs, and then they create new jobs. They free people to do new activities.
You don't think it's different this time?
You know, I don't have a reason for, like I said before, you know, it's too early to reject a two-year trend of labor market moving in a gradual cooling direction. It's too early to reject a tens of thousands of years trend of how technology works in the economy.
We've talked about these sources of risk, and one has been the geopolitical problems. This is another too, and the third one is connected in some cases to what's happening with AI. It's also the credit jitters as well. So this raises the question about potential financial risk for you and the committee. How are you thinking about things as they develop?
But just one last point on AI. Even as AI destroys old jobs and creates new jobs, that is the type of job transition that is typically accommodated by a central bank, right? You don't want to prevent the new jobs from being created by having policy that's too restrictive. If you have an increase in job loss due to new technology, you have to accommodate that and allow the new jobs to get created instead of preventing it.
Do we need to support what's developing in credit?
Sorry?
Credit. Support what's developing in credit?
So look, you know, I am, like with events in the Middle East, I'm not at the point where I have a strong read-through from what's going on in credit into the economy. I'm not at the point where I think there's any sort of policy response that's necessary or adjustment to forecast that's necessary. One thing that I think is interesting about what's going on in credit is, to me, it highlights a potential shortcoming of our financial conditions indices. We've got a lot of people who argue it's inappropriate to cut because financial conditions are so loose. They've been arguing that for a long time. But one hypothesis of mine that I'm exploring is that those financial conditions indices aren't showing you what's going on in private credit because you don't get the marks for them. And to the extent that private credit has been a major driver of credit growth over the last half decade or so, that's missing from the financial conditions indices. So when we get these jitters in private credit markets and then say, oh, financial conditions are so loose, it's just because we've decided not to look at the part of the financial markets that are tight.
So do you think we are seeing an unwarranted tightening of financial conditions so far?
Well, you know, sort of unwarranted is a bit of a heavy load, but I do think I would be cautious about concluding that financial conditions are so loose when you're getting these things happening in private credit markets.
I just want to ask, have you talked to President Trump recently?
Not since I resigned.
Not since you resigned. I'm just wondering how difficult it is to conduct policy with a huge unknown hanging over the committee about who is going to be the next Fed chair and what this process is going to look like past April.
Well, I mean, I think we have a pretty good idea of who's going to be the next Fed chairman. We don't have a good idea yet of exactly when he will become the next Fed chairman, but I'm hopeful that we get that type of clarity soon. I think it would be great to have that type of clarity.
Governor, is it weird being on the Federal Reserve and not knowing when you're going to exit? You're just sort of like there with an open-ended calendar on what's going to happen next.
It makes it difficult to plan.
I bet it does. For personal reasons. Governor, it's good to see you.
Thanks for having me.
Thanks for making time for us. We appreciate it. Governor Stephen Murren there of the Federal Reserve, responding to a range of issues, and we keep going back to the same three: geopolitics, credit, and AI disruption.
And at what point do they intersect? And are we starting to see a little bit of connection between the three? It will continue to be the question.
Let's turn to the financial markets then and get you an update on things. Equity futures right now, the S&P 500 positive by 1/3 of 1%. In the bond market, yields slightly higher, 10's up by almost a basis point, just north of 4%. And in the commodity market, crude slightly lower, down by 1/3 of 1% on Brent to 81.15. With an update on stories worldwide this morning, let's get to your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. ADP data showing U.S. companies added the most monthly jobs in February since last July, an encouraging sign for the labor market. Private payrolls came in at 63,000, well above estimates of 50,000, and a big rebound from January's total of 22,000. Service-producing jobs accounting for the bulk of the figures, with 47,000 jobs added. Meanwhile, Defense Secretary Pete Hegseth saying the U.S. and Israeli assault on Iran is accelerating in a press briefing earlier this hour, Hegseth adding the countries are dominating Iran from above.
In under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. The Iranian Navy rests at the bottom of the Persian Gulf. Last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice.
Hegseth also saying the U.S. can easily sustain the fight with a nearly unlimited stockpile of precision bombs. And Goldman Sachs CEO David Solomon saying he's surprised by the benign market reaction to the Middle East conflict. Speaking at Goldman's first ever Australia Week, Solomon saying it will take a couple weeks for markets to truly digest the implications of the situation. We'll hear more from Goldman Sachs CEO on Bloomberg TV at 5:45 p.m. Eastern. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. Appreciate the update. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Tyler Kendall, the latest from Washington, and Ed Ludlow previewing the president's meeting with big tech executives later on today. From New York City, you're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Even if oil stays at these types of levels, to me it's difficult to get a lot of read through it. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
That was the Fed Governor Stephen Murrin. Steve joining us just moments ago, weighing in on Fed policy. In his own words, in many ways, nothing has really changed for the Federal Reserve over the last week, at least for him. If you want to wait, you still want to wait. And if you want to cut, you still want to cut. And that man still wants to cut interest rates. Equities at the moment on the S&P 500 going into the opening bell firmer by 0.4%. Near session highs on the Nasdaq up by 0.6, on the Russell up by 0.8. In the bond market, a little bit of stability. Largely unchanged across the curve, 10s at just north of 4% at 4.06%. And in commodities, the highs of the week.
Secretary Hegseth really emphasized the idea that the U.S. and Israel now have what they are calling uncontested control over Israel's airspace. I'm sure you picked up on this quote, but we heard the secretary say, quote, "We are just getting started. We are accelerating, not decelerating." Now, he did outline that the U.S. feels it has plenty of stockpiles to sustain this fight, something that President Trump himself has emphasized as well, though we did hear U.S. officials decline to specify the quantity, saying that that would be an operational risk. Now, on the operational front, we also heard, as you mentioned, that the U.S. says it's going to go deeper into Iranian territory, and John, that will be the next phase.
Tyler Kendall down in Washington. Tyler, appreciate the update. Also taking place in the nation's capital today, big tech executives heading to the White House set to sign pledges to foot the electricity bill for energy-hungry data centers. Ed Ludlow joins us now for more. Ed, they're going to be on the hook and the pressure is building.
Yeah, they are. Very simply, this president wants the hyperscalers to pay for the energy that they need. Either they pay for it, they build the supply, or they bring it through another mean by localizing the power supply to that data center at scale. And if you go back to last July when the president launched the sort of AI action plan, the emphasis was very much on cutting red tape, deregulation, expedited permitting, allowing those names on your screen to move quickly. But when we came to the State of the Union address, affordability is clearly top of mind. And so there are a wide range of policymakers, utilities, the hyperscalers themselves that argue that if they take on the upfront cost of modernizing the grid and spread the investment over the grid, you could lower the cost of home electricity prices by a few percentage points per gigawatt. But it's very hard to believe in that. When you look at the zip codes on the eastern seaboard where data center capacity has already expanded and what prices for everyday Americans have done in those areas and jurisdictions. But that's the trade-off here. And so the names expected are the hyperscalers, OpenAI, Meta, XAI, et cetera. And, the president will get them to sign what is a pledge. It is a pledge, and it's called the Ratepayer Protection Pledge. But then they have to take that capital expenditure and do something with it.
Just quickly, where's Anthropic and what's happening?
Yeah, I mean, CBS is reporting that the U.S. military apparatus continued to use their technology over the weekend, but as it stands, the status quo from the president himself is that there is a ban on them as a supplier. So we need some certainty from the company on that. But, they are taking the moral high ground here and clearly have a set of red lines for how they feel their technology should or shouldn't be used. I'd encourage the audience to go and read the Bloomberg reporting on how OpenAI has positioned this, because Sam Altman has been communicating to his employees and publicly about their approach here.
Ed, looking forward to the program a little bit later this morning. Bloomberg Technology, a few hours away. Ed Ludlow there. Coming up tomorrow on this program, Noel Dixon of State Street, Tom Kennedy of JP Morgan, the Richmond Fed President Tom Barkin, and Michael Gapin of Morgan Stanley from New York City this morning. Good morning. Best of luck for the rest of the trading day. From New York, this was Bloomberg Surveillance.
The BNP Paribas Open kicks off in California. World number one Carlos Alcaraz is a two-time champ at Indian Wells, and after lifting the trophy at the Aussie Open, the Spanish superstar will be the man to beat. On the women's side, Aryna Sabalenka hasn't played on the WTA Tour since Melbourne. She's looking for her maiden title in the desert. And don't forget, you can watch all the action live daily on Tennis Channel.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did there.
You didn't know he was an actor?
No, I don't know. What he doing? And because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to a special edition of Bloomberg Open Interest. We are live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller.
I'm Danny Berger, and we're gathered here with the most influential voices across asset management, banking, and private capital. And what a day to be having this conversation. It's the two most dominating stories, what impact war has on these markets and the fallout from private credit.
Yeah, absolutely. And we are seeing a bounce in optimism as a couple of stories hit the tape over the last few hours. Number one, a New York Times piece that says some intelligence officials in Iran have tried to reach out through back channels through a third country to the CIA in order to give themselves and the U.S. an off-ramp in this war, and a story that President Trump said not only will he escort ships, the U.S. will escort ships through the Strait of Hormuz, but that they will ensure that traffic.
The thing, though, is both of those are so flimsy. We don't know through what method and means if Trump can actually have insurance for those ships going through the Strait of Hormuz. And two, to your point, in the New York Times article, the U.S. officials are saying, we don't know if there's an off-ramp. Who is there even left for them to negotiate with?
Right. Well, and President Trump has said as well that the people that he would have wanted as number two after the Ayatollah or number three, the U.S. and Israel have killed. So there's not many people left to take over leadership there.
A lot of important conversations to be had today. We're going to have some great voices. We're going to hear from Yi-Shi Hung of State Street, Julie Solomon of Ares, and Marsh CEO John Doyle. And one you don't want to miss, Marathon's Bruce Richards. Plus, I'll be having conversations with HBS CEO Scott Kapnick and KKR co-CEO Scott Nuttall throughout the morning.
Yeah, those will be on stage here, but we'll bring you those conversations live again. We're at the Bloomberg Invest Conference in downtown Manhattan. day 2 of this conference that has really, in some instances, moved markets. Let's take a look at what's going on right now in terms of risk. S&P futures bouncing a little here, 1/3 of 1% the gain after closing down, I think not even off 1% in the cash trade.
Down 9/10
yesterday. Exactly. NASDAQ futures down 0.5%, so up 0.5%, so even a bigger bounce for the tech stocks, but of course they have gotten hit harder, and in some cases, like memory chip manufacturers have been reeling. NYMEX crude is right now down about 0.6%, but still pretty punchy at $74.08 a barrel. The 10-year yield at 4.07 has stayed pretty much in that range after coming up over 4.1% yesterday. I just want to point out, Danny, the recovery that we've seen in Europe has been much stronger. Obviously, the drops we saw there yesterday were deeper as well, but the Kospi in Korea down another 12% overnight after I think a 7% drop in the previous session. So this is a market in which a lot of investors are highly leveraged, and those memory chip manufacturers like Hynix, like SanDisk, have been selling off. You can see the Bloomberg Dollar Index pretty steady at a little over 1,200, and Bitcoin coming back 5% at 71,000.
It's just breathtaking, the turnaround we've had this morning on just thin amounts of news. And we're going to talk to Tyler Kendall about it in a moment. But in the meantime, some of the stocks we have our eye on, NVIDIA rose nearly 2% at one point as stocks turned around positive this morning. It's up 1.33%. Also to note, billionaire Lee Kogan bought 1 million shares of NVIDIA yesterday. He believes AI is not in a bubble of Tesla billionaire fame.
Yeah, that interesting argument continues. Right now, Apple is announcing new products after hiking prices for upcoming models of MacBooks. That on the back of rising memory chip prices. We're going to give you more on that with our memory chip guru, Ed Ludlow, in just a moment. But it's really the reversal in risk that I think is the top story this morning.
It is, and it reversed after a report that Iran intelligence officials had indirectly contacted the U.S. to discuss ending the conflict. Defense Secretary Pete Hegseth addressed the public in the last hour.
In under a week, the two most powerful air forces in the world will have complete control of Iranian skies, uncontested airspace. The Iranian Navy rests at the bottom of the Persian Gulf. Last night, we sunk their prize ship, the Soleimani. Looks like POTUS got him twice.
Bloomberg Washington correspondent Tyler Kendall joins us now from the White House. Tyler, it was this New York Times report that seemed to turn around markets. What did we learn from it?
Good morning. Well, the New York Times is reporting that operatives in Iran's intelligence unit reached out to the CIA through a third-party country's spy unit to talk about the potential for negotiations just one day after the attack started. However, that report does go on to say that U.S. officials are skeptical that either the Trump administration or Iran is really ready for a diplomatic off-ramp. Now, President Trump himself had said over the weekend that he would be willing to negotiate with Iran's transitory leadership team, but then just yesterday he said that it was, quote, too late. I'll also point you to the fact that we heard from Oman's foreign ministry on Sunday, one day after the military campaign started, saying that Iran was interested in, quote, serious efforts aimed at de-escalation, but then we had Iran's security chief come out and back down those reports. So there's a lot of open questions here about whether or not there is this possibility for a diplomatic route, because we heard these U.S. officials earlier today really doubling down that the military campaign will be sustained. Secretary Pete Hegseth saying that they are, quote, just getting started. We are accelerating, not decelerating. One of the biggest questions here, Matt and Danny, is what leadership in Iran is going to look like. I was there in the Oval Office yesterday where President Trump said that one of the worst potential outcomes would be if new leadership was, quote, just as bad as the regime that the U.S. and Israel is working to change.
Tyler, it seems that the reasons the U.S. has attacked Iran are in question inside the Republican Party. There's a bit of a debate there because of something that Marco Rubio said yesterday, that Israel, in a sense, dragged us into it. Now he's saying that we thought Iran was going to attack us first, and the president says this as well. Is there any intelligence that Iran had been planning an attack?
Well, at this point, the Trump administration hasn't provided that evidence publicly to us, though there are these ongoing briefings on Capitol Hill. But as you're mentioning, there has been some disagreement within the Republican Party coming out of those intelligence briefings about exactly what was the thrust of the U.S. starting this military campaign. Now, President Trump was asked about this directly yesterday, and he still maintains that the U.S. was set to do what they are calling this preemptive defensive strike, despite what the Secretary of State Marco Rubio had said about Israel already being committed to such an attack beforehand. So there's still a lot of questions that we need answered here. But Matt, one thing is for sure, this administration appears intent that they are going to continue and to sustain this military campaign until their objectives are achieved. And that's going to be something to watch really closely, since you mentioned Capitol Hill, because while broadly Republicans have been supportive of the president's efforts, we are starting to hear some cautiousness when it comes to how long this military campaign could go on, and the fact that the administration hasn't ruled out putting American boots on the ground.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there at the White House. And I want to get reaction in markets right now with Bloomberg macro strategist Michael Ball. He's here with us at the Bloomberg Invest Conference in downtown Manhattan. And let me first get your take on the turnaround in risk sentiment. I mean, clearly, we weren't as worried by the end of yesterday's cash session as we were at the top of the session. But it seems today that a lot of investors are hoping for an off-ramp, not necessarily a Trump put here, but an end to this war before we may have expected it.
Yeah, exactly. And I think you guys were right to say these are flimsy. Yesterday was somewhat flimsy as well. It's unclear what the mechanism will be for the insurance premiums to be covered, or even if we have the Navy assets to do this. But yet the market turned around just as oil did, and we saw that both across rates and risk, and with the equity market covering about 100 points on the SPX, moving back into that 3-month range, which is a much more comfortable position when you're looking at the screens to see. Also, to your point, that some of these other stories, like the memory stock stories, have come back off as we saw some dip buying. So the market's doing what it always does. It's going back and forth between greed and fear, and generally now leaning more into the greed side as dips are being bought.
It's not just Iran, though. There are other things happening in the background. And, Michael, I wonder what meets the bar of rising to the surface. Scott Bessent saying this morning that 15% tariffs might kick in. The EU says, no, we think we're exempt. Does the market still care about tariffs at this point?
They will again, and again, it all adds to this stagflationary worry, and that's what this is all about, and this is why risk appetite now has hit another headwind. And effectively what we're waiting to see is how this affects longer-term expectations, not only from Fed easing and other central banks, but the consumer. And it'll take time for that to hit the softer data. But as far as break-evens right now and what the market's telling us, yes, there's a little bit of a shock priced into pricing and to inflation, but longer out, it's still quite stable, and that's giving comfort to basically, again, risk sentiment, which is coming back a little this morning. But again, any headline can knock that off, and we're all sort of just sitting here waiting and waiting to see if anything comes.
The interesting thing is that to see a headline that the EU expects to be exempt from tariffs.
A day after Trump said they were cutting off trade with Spain.
Well, exactly. A day after Sanchez says Spain is not going to allow the U.S. to use its resources in this war against Iran. It boggles the mind until you think about the inflation impact on the midterms, right? I mean, the Republicans can't really afford to have inflation going back up above 3%, too high for too long, and so they may have to pull tariffs off the table.
I would also add that this 15% is temporary. It's only 150 days or whatever it is. And then they're exploring new sections to lean into. That's what they told us yesterday. They're doing a study now. But the market, 150 days, this is not something that we can really price that well because, again, we don't know what's coming next. And the market usually prices a half a year ahead anyway.
Yeah, the tail keeps getting longer, fatter, whatever you want to say. It is a time of uncertainty. Michael, thank you so much for joining us. That is Bloomberg macro strategist Michael Ball. Right now, I want to take you. Apple is holding an event. They're unveiling several new products, including a MacBook Neo that was just announced. Let's get the latest with Bloomberg Tech's Ed Ludlow in San Francisco. And Ed, the background, as we're getting these announcements from Apple, is a memory chip bottleneck. How is Apple grappling with this as they're making these announcements of new products they're putting onto the market?
Well, Neo is not a surprise because there were some leaks in the last 24 hours, but it's kind of contrary to that story. They've come out with a base or entry-level Mac that uses the highest performance processor from the iPhone. So it has the 18 chip as opposed to the M5 chip, which is across the lineup of new Macs. what we had been saying going into this before the Neo was announced is that essentially there's an effective price hike from Apple because across the new range of Macs, they've raised prices from a range of $100 to $200 and also eliminated the entry-level starting point in terms of storage. So you get higher specification, greater storage, but at the entry point being a higher price point. And so very simply, like DRAM is like the working memory of chips, NAND is the flash is the storage, and there is a bottleneck and high pricing on both because the main suppliers and providers of capacity are prioritizing AI data center. The story has been as simple as that. So simultaneously in London, New York, and Shanghai, they are now giving access to the general public to these new products, but that's the backdrop that they're facing.
All right, Ed, we're going to continue to cover this story and look forward to your coverage on Bloomberg Tech as well. Ed Ludlow there anchors Bloomberg Tech and also is our memory chip expert here, as well as all things having to do with microprocessors. Check on markets right now as risk sentiment turns around just about 18 minutes until the opening bell. You can see that we have gains on S&P futures, about 1/3%. NASDAQ futures are up a little bit more with the gains that we see in NVIDIA. NVIDIA moving about 2% higher, and that's enough to power the tech-heavy index.
It's
higher
just
than
so wild to look at the Kospi have its worst decline since 2001, to see European stocks sell off 3%, to see EM carry get crushed, and oil turns around, and U.S. stocks didn't even close down 1% yesterday. It goes back to Solomon saying his surprise that we haven't seen more of a reaction in markets.
Yeah, absolutely. I think it is fairly surprising, but this is a market. These are investors who want to buy the dip.
True.
And I think the Kospi may be a special circumstance because of the amount of leverage. I'm not an expert on Korean investors, but I have been reading overnight that there's a ton of leverage in that market. But absolutely fascinating that people are waiting for a Trump put where maybe there isn't one.
Yeah. Well, some of the other movers on our radar this morning, Bitcoin and crypto stocks, they're surging with that risk turnaround, up 7.3% after Bitcoin took a hit yesterday.
LegalZoom was downgraded by Barclays as growth is expected to slow this year and AI risks to certain software stocks mount. We're going to talk a lot more about software throughout this program.
And one I don't think we're going to talk more about, but worth just bookmarking, Abercrombie shares rising as much as 6% when earnings came in line with estimates, but all of a sudden they sink 6% on lower and weakened guidance, or weaker than expected guidance, rather.
Coming up, Blackstone employees stepping up in support of the firm's flagship private credit fund, pitching in $150 million from their own wallets. We'll get the details next. This is Open Interest Live from the Bloomberg Invest Conference in downtown Manhattan.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Jamie mentioned cockroaches. I think of this as jellyfish on a beach. I come from northern Spain, and every summer when the jellyfish, you see the jellyfish on the beach, you still go in the water. You're just very careful. And we have been very careful for years, right? We have been on a risk-off for the last couple of years. We're very careful. Obviously, there's going to be sometimes you get stung a bit, but when you're careful, it doesn't matter. You can still swim.
That was Santander Executive Chair Ana Botín speaking with me about private credit fears, saying that they're not cockroaches, they are simply jellyfish. Meanwhile, Bloomberg has learned that Blackstone executives pitched in around $150 million from their own wallets to help cover record withdrawals from the company's flagship private credit fund. Joining us now is Bloomberg senior reporter Silas Brown, who's been reporting on this story. Silas, what does it tell us that senior executives had to make this move at Blackstone in order for BCred to meet the redemptions that it was seeing?
Yeah, I mean, I think the Bloomberg credit team probably couldn't muster up $150 million, $50 million if we were in a similar situation. And I think, look, I'll go back to a point that I made yesterday to you. Like, I think what's going on right now is everyone is simultaneously defending the kind of mechanism of gating and preventing redemptions, whilst also trying their utmost to avoid being the first fund to do it. And I mean, not to go in on Blackstone too much, and like everyone has their own idiosyncrasies, but I think the Blackstone situation is symptomatic of that. I mean, everyone's facing a higher amount of investor withdrawals, and at the same time, no one wants to be the first fund to do what I think everyone agrees to be a kind of sensible thing, which is to limit those withdrawals. So people are trying extra hard to find all manner of ways to avoid that.
Silas, why doesn't someone just say no? That's not what this asset is for. We don't offer that kind of liquidity, and you knew that when you signed up. We're simply not going to breach the agreements that we made with investors in the first place, and you'll continue to get your returns, and you'll get your money back at the end, or whatever the agreement was, but we're going to hold tight.
Yeah, I think that will come. I guess if I was a betting man, I would say that in the next quarter, I think people will be. It sort of seems quite likely that people will have to start implementing these withdrawal these kind of gating mechanisms. I think, look, at the moment we're in a kind of febrile time, and there's a lot of volatility in private credit, and I think people are hyper, scared to be the first person to take the headline risk of gating their funds. So they're sort of all of them are in this kind of blinking contest with each other of who's going to be the first person to do it. But I do think, look, the pressure is mounting, and I think simultaneously people are. Goldman released their shareholder letter, and they were defending the importance of of Gates. I think that's kind of widespread, been referenced in Bloomberg Invest conference as well, that it's a sort of feature, not a bug. But I think at some point people are going to have to start using this feature and kind of putting their money where their mouth is, so to speak.
All right, Silas, thanks very much. Silas Brown there in London covers credit for us, and I hope at least you could get other teams together to raise $150 million if we needed it. Joining us now is State Street Investment Management President and CEO Yi-Hsin Hung. Great to have you on the program. Have been looking at the work that you've done at State Street, and it's really impressive in terms of the amount of assets under management you've been able to accrue. I think 4 times what you had when you came in 2022. But I wonder what changes now that we're starting to all kind of freak out about the private markets, which is one of the levers that you've pulled. Yesterday, Mark Rowan was on stage with our editor-in-chief, John Micklethwaite, and said private markets are in for a downturn here.
Well, our focus has been primarily on the public markets and this convergence of private and public. And with Apollo, we launched a series of ETFs starting at the beginning of last year that was really trying to give investors some exposure to the investment-grade private markets arena. And importantly, because we're significant in the ETF space, we wanted to make sure there was good underlying liquidity. And what we found actually in the course of this year is we've provided transparency to those underlying holdings, is that the market makers are showing up. There are active bids on those underlyings. And ultimately, the ETF structure provides enormous amount of liquidity, right? We have a broad range of investors. And so in many respects, there's the secondary liquidity that exists along with the underlying.
So this is an interesting thing. I'm sure you got this a lot when you put the ETF out. Everybody's saying, is there liquidity here? Are we going to see issues of not being able to get your money back? That's not where the issues have arisen. They've arisen in BDCs. Do you think that fundamentally, that the structure, if you are going after retail investors, it needs to have liquidity? Is it an issue to have these traded products that are geared towards wealth and retail investors that are semi-liquid or maybe just have an illusion of liquidity?
Well, I think we've seen this with closed-end funds and with BDCs that they do tend to trade on the basis of yield and attract a lot of individual investors. And that's why in many respects we think the ETF structure is a really good structure because it does have such a widespread interest and following. And the spreads that we see in terms of trading activity really provides good liquidity to investors.
What are you hearing from investors? You are, I think, the 4th largest asset manager in the world. And as we enter now the 5th day of a war in Iran, we worry about, fully a 5th of the world's oil and natural gas supplies coming through the Straits of Hormuz. How are investors at State Street Asset Management reacting?
Look, I think everyone's trying to make sense of this. In many respects, I think the length of this conflict is an important factor, and ultimately, what does it mean in terms of oil production and transport? Because ultimately, I think the market is concerned about a prolonged period of time where oil prices are elevated, and therefore it's going to bump up inflation and limit growth. And so I think the reaction that we've seen so far is not unexpected. There's been a flight to safe haven assets like the US dollar and gold. At the same time, because of this worry of inflation, we've seen Treasury bonds kind of trade down. And then volatility in the equity markets, in part because, the direction of travel with inflation is not quite known yet. And if interest rates are higher for longer, that's likely to impact valuations overall.
From what you see, conversations with clients or elsewhere, do you think investors are prepared for more volatility, are prepared for a world where rates might stay sticky, might stay higher for longer? Because we entered the year with hope for animal spirits, a lot of risk buying, and it seems that some of those bets are looking more complicated.
Look, I think the questions that we were getting last year from investors were concerns about the valuations that we saw in the market, the concentration, and the advice that we've been given. A lot of our clients have done this, which is be really diversified across their asset class exposures. In fixed income in particular, I think because there was still a worry about inflation, now exacerbated, but the flows have been more in the short to intermediate term. credit spreads continue to be very tight, and so there's been more of a focus around Treasury holdings and sovereign holdings. And increasingly, we're seeing clients have more of a buffer to deal with this volatility, either cash, and we've seen enormous amounts flowing into cash starting at the end of last year. It continues today, gold, hedge strategies.
All right, Yixin, we're going to keep you with us through the opening bell. State Street's Yixin Hung staying with us. A check on the markets as we head to the bell. We're looking at risk bouncing futures higher this morning. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Both on cam 3.
Moments away from the start of trading, this is Open Interest, live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller. I thought this was our two shots.
Okay, Matt.
That's our two shot?
They're only a couple feet away.
All right.
Not too bad.
10 seconds ago, and we're looking at futures a little bit higher this morning. We've got a 0.2% gain on S&P futures. NASDAQ futures double that because of the gain in NVIDIA shares, and Russell 2000 small caps coming back about 0.7%. In terms of the opening bell, you've got, I guess, McDonald's and the Ronald McDonald House down there at the New York Stock Exchange. They're introducing a new burger. This has nothing to do with what they're doing down there, but they have a big arch burger. Have you heard about this?
No, what is
Bigger
that?
than the Big Mac. It's like over 1,000 calories,
Did someone ask for
65
this?
grams of fat.
Who wants this?
It's apparently very popular.
Seems
especially
very anti-weight loss drug era to do that.
I guess people need a break from that. Down at the NASDAQ, something that people maybe have been asking for. Hyper liquid strategies. It's actually a crypto thing.
I have an issue with this. Their ticker is PER.
Yeah.
It can't be PER. and not be animal related.
Right, it should be like
adjacent to cats somehow.
PetSmart kind of thing.
Yeah, agreed.
In any case, it's not, and none of that matters because we're so focused on what's going on in markets on day 5 of war in Iran and day 2 of the Bloomberg Invest Summit, where we're talking a lot about private markets and whether or not we could see a correction here that starts to become a real problem for public markets.
Yeah, but look at what public markets are doing. Nvidia is positive. It's not as high as it was in the pre-market. At one point it was up 2%, but it does just speak to this general turnaround that's been happening in stocks, that the world's biggest stock is still positive after we saw a massive sell-off basically everywhere else in the world.
Yeah, well, certainly in Korea, right, where these memory chip makers are widely traded, and investors there apparently highly leveraged. The Kospi was down another 12% overnight. Apple has an event. Right now it's announcing new products, including MacBooks at $600 that could threaten the Windows PC market, but I can't think of a time when Apple product announcements will be more overlooked than today. I mean, it's the last thing you care about.
Would have to agree with that. And what we care about is war and the market's response to it, which today is very muted. Goldman's David Solomon has also been surprised by the market reaction to the Middle East war. He called the stock market moves benign and noted it will take weeks before investors understand the implications of the war. Let's bring back in Yi-Shin Hung, President and CEO of State Street Investment Management. And Yi-Shin, you know a thing or two about these markets. Have you been surprised by this, I guess not lack of reaction, but the muted reaction we've seen to the events over the past week?
I think the market is really cutting through and wanting to understand what's the implications for oil prices, prolonged elevated levels, and then the impact on inflation. We've been watching ETF flows, and obviously since this weekend, it's been much more muted. But prior to that, it was an enormous amount of flows coming into ETFs. In fact, we were on pace to outpace last year's record volumes. And broadly speaking, if you look at corporate earnings, they're pretty strong around the world, led by the U.S. and emerging markets. And so that has been what we've been seeing with investor appetite. It's broadening out beyond the concentrated Mag 7 into mid-caps, small caps, and especially moving into non-U.S. markets. That's been dramatic.
I think that's an incredibly important point. Just sticking with U.S. assets first, it's hard to judge what's actually happening under the surface just looking at the index levels, right? Because you could see people taking profits from the big winners in AI, in chips, even some of them were in software, obviously not anymore, and switching into the S&P 493 or now I guess the S&P 480 or what have you. Do you see that rotation really happening?
We do, and actually it's been a longer-term trend. The concentration in the U.S. market has declined over time, and then toward the end of last year, near 50% of ETF flows from U.S. investors were going into international, developed, and emerging markets. And so that trend has continued, whether it's more diversification, increasingly gold continues to see inflows. I mean, we saw $50 billion last year, already $10 million year to date. So a lot of these have been in place, and they're just getting accentuated.
And increasingly, obviously, people are trading through ETFs more than anything else. There are now more ETFs than there are stocks. State Street is one of the biggest ETF issuers in the world.
Which, by the way, I do wonder if that's why we're seeing some of the market behavior that we are. That retail investors and single individual investors are more participating in this market. They're doing it through ETFs. They can more easily buy the dip. Is there almost a degree to which there's a floor under this market because there is so much appetite for products like those that State Street puts out?
Well, we think that the addition of retail investors becoming more sophisticated over time. They've had a behavior of buying the dip. But we've also seen the growth of model portfolios, which, again, I think fosters that sense of being asset allocated as opposed to being too concerned about where the market is, where headlines are.
And, of course, I'm getting a note from a viewer right now pointing out that people have learned to look through these geopolitical events. Your first decision could be your worst decision, right? You don't want to overreact. Right. Are you seeing that as well? I mean, you have a storied career in finance, working at the biggest hedge fund in the world, at Bridgewater, and now running State Street Asset Management. Do you see that behavioral shift?
We do. Across our investor base, it has been much more of a focus around strategic asset allocation, some tactical, but not necessarily taking bets off the table. Because, you know, the corporate environment is still quite good. And notwithstanding, you know, the potential for oil to cause inflation to spike here, we still think over time the Fed should be in a position to be cutting rates. So there are good tailwinds here that augur for investors staying invested.
Just the skeptic in me, and I'm sorry to go here, the skeptic in me just thinks maybe we've just been too conditioned, that we've been too conditioned to buy the dip, and we are talking about war that could change an entire region, that could completely change energy markets, and we've learned to look through geopolitical events, but what if this time is different? If this time is different, Yishin, what is the hedge? Because we've seen gold, for example, you talked about it moments ago. It's been acting almost as a speculative asset. Are bonds the hedge, even if we don't get cuts? What becomes the ballast in a portfolio when people are willing to continue to put on more risk?
I think it is these stabilizing allocations. And I do think gold has multiple purposes within a portfolio, whether it's a macroeconomic hedge, inflation hedge, US dollar hedge. And of course, central banks around the world have been accumulating more gold as they've reduced their dollar holdings. At the same time, cash is seeing a lot of flows as a result of now paying a good yield, and it's a good place. In the event the market does truly dislocate, there's opportunities to go in. And increasingly, we're seeing hedge strategies. You mentioned Bridgewater. We had launched a strategy along with them, all weather, that also provides some ballast within a portfolio. So demand for these different exposures is growing in an environment that we're in today.
Great to get some time with you. Really appreciate it. I look forward to your panel as well here at Bloomberg Invest. Yishin Hung of State Street Investment Management. Tonight, Bloomberg Television interviews Goldman Sachs CEO David Solomon. That's at 5:45 p.m. Eastern Time. Definitely tune into Bloomberg Television, or stay tuned to Bloomberg Television for that interview. Check on markets here as we come up to 20 minutes of the cash trade. We're looking at still gains on the S&P 500, 0.2%. The NASDAQ up 0.6%. As the price of NVIDIA increases. It was unchanged right at the start of the trade. NYMEX crude.
Oh, it's up now.
Yeah, NVIDIA. Or NYMEX crude.
NYMEX crude is up now.
NYMEX crude is up now 0.25%, $74.72. So just gaining about 65 cents from where it was when we kicked off this program. And the 10-year yield holding at 4.07%.
By the way, I wonder if this is what's turning around oil. Iran has now denied the intelligence, the report that the intelligence ministry reached out to the CIA for talks. Recall, that was why the market was able to rally. We said it at the top of the show. It's a thin reason for a rally. Now Iran downplaying those reports. Oil moves higher, but not a whole lot higher, and stocks hold on to their gains.
Yeah, I mean, that's also a thin reason to turn around sentiment. You know,
Correct.
You have a New York Times report, which all credit to them for the scoop, but they're talking about maybe some intelligence officials reaching out days ago to try and save their necks.
Right.
Right? And now some probably other intelligence officials are saying, no, that didn't happen.
I was going to say, we don't even know whether the original intelligence officials are still around to this day. There's so many questions to be answered.
All right, technology is a focus really today, and seeing some relief this morning. Joining us now is Mandeep Singh, Global Head of Technology Research for Bloomberg Intelligence. He's here with us at the Bloomberg Invest Conference, and let's start by talking about what's going on at NVIDIA, because memory chips have had ripple effects across this sector now for days or weeks even. What's happening with the world's largest company?
I mean, I wouldn't, pay too much attention to what's going on with the Korea market, because obviously there is a momentum element to.
Oh, but it's so much fun, Mandeep. I mean, not fun if you're losing a lot of money, but it is breathtaking to look at those
the country's benchmark index was down 12%. A day after it was down 7%.
It's hard for me to explain why it's happening. Obviously, it's happening. That's a reality. But there's nothing in the fundamentals that makes me believe memory companies are going to see a slowdown anytime soon. And I'm going to go with what NVIDIA guided to, for the next quarter. So for me, Broadcom reporting tonight will give a better insight in terms of what the end market demand is. And look, Broadcom plays in that ASIC complex, so they have visibility to Google orders, probably Anthropic ramping up their kind of chip expectations. So from that perspective, the Broadcom print tonight will be a better indicator of the end market demand and how sustainable it is versus what's going on in the Korea market right now.
Broadcom's had a tough start to the year, down 9.25%, underperforming both the S&P and the greater tech index. Can we say, okay, it's great for them, good, it's a low bar for Broadcom. What do they need to do to change around their narrative that they've had this year?
I thought, up until last quarter, everyone expected them to add more customers because, all these hyperscalers want to build their own chips to rival NVIDIA. What NVIDIA showed this quarter was not only do they have a very high visibility for their GPUs, they're also gaining share on the networking side. Their networking revenue grew 3x. Now, Broadcom is a big player when it comes to networking. So to me, that is a bigger worry for Broadcom on the networking side than it is, okay, whether Google TPUs ramps up or not, which I expect it to, because Google also raised its guide for CapEx, similar to other hyperscalers. So I think there will be upside on the chip side. It's just the networking side is the one that I'm watching out for.
I have, thankfully, Bloomberg clients just messaging in around this Korea move to remind me of a couple of things that I think are pretty important to highlight. Number one, the Kospi is still up 20% year to date after taking such a bruising over the last couple of sessions. Number two, if I type in the Kospi index and put MEMB Go, I can see the weighting of the companies. Samsung is worth 25% of the Kospi. SK Hynix is worth 15% of the Kospi. The next biggest weighting is Hyundai at only 2.5%. So those two companies together are worth 40% of the index.
I mean, look, we had this SaaS apocalypse here. So if you are a fund that's losing money, you do end up sometimes selling up your winning positions. And again, if liquidity can always be a driver of, you selling certain names, even if you believe in them long term, but there are times when you end up selling things that look very good from a fundamental
Things that are up
perspective.
225% over the past year.
And maybe
you might as well
we're
take some profits.
insanely leveraged on it, and you're getting margin calls, and circuit breakers are going off. What an overnight session it was. Mandeep, thank you so much for joining us. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Julie Solomon of Ares on where private capital is flowing, specifically when it comes to real estate, just getting off a panel about the new economy. We're excited to have her. She joins us right after this break. You are watching Open Interest live from Bloomberg Invest.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I effectively had one dot now for 2026. I basically had 2 and 2, and because they did 3, then I brought 1 dot forward. So that leaves me with 1 dot coming into recent events. So 1 expected cut later on this year. Now with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in.
That was Minneapolis Fed President Neil Kashkari speaking here at Bloomberg Invest on his rate cut outlook for 2026, saying now he's unsure whether we'll get that 1 cut that he had penciled in. Joining us now for a look into real estate is Julie Solomon, partner and head of real estate at Ares Management. Julie, fresh off a panel, thank you so much for joining us.
Great to be here, Danny.
There's this big question in markets happening now. What does the rate path look like? Because of an outbreak of war, of higher energy costs, that's really getting questioned to the amount that we'll have. How does that impact your outlook for the sector in 2026 if we don't get as many rate cuts as we expected?
It's helpful to first contextualize the impact of recent rate movements on real estate and on the market more broadly, because what I would say is it's actually created quite a bit of discipline within the real estate market specifically. And so if you look at what happened in a higher rate environment, asset values have reset, construction deliveries have declined, and the capital markets are now fairly constructive for real estate. So what happened as the Fed has normalized rates, we are in a period of time where transaction volume picked up. But what it does mean, Danny, is that this next chapter is going to be about driving cash flow, improving operating performance to drive returns as opposed to a lower rate environment. But we think it's created a lot of discipline for us.
Well, what does it do about all of the loans coming due over the next 12 to 24 months? There's already been this idea of can kicking. Yeah. Can we keep kicking the can? What happens when that comes home to roost?
Well, the capital markets have been available for quality cash flowing assets. So we have seen a favorable market, particularly for builders, buyers like Ares Management, where we've been actively participating in the market for a long time now. Where there will be challenges is on assets that are in second-tier markets, lower quality segments of the office market that we talked about earlier. And so, but what we see more broadly is that the lending markets will be friendly.
We talked about this during the commercial break because you're actually not invested in very much office. Before we go any further, tell us about your portfolio specifically, because you've avoided that pitfall and you have other unique holdings.
We sure do. We manage about $120 billion of assets under management, and about 85% of that, if not more, is in logistics and living, sectors that have really strong, durable, long-term demand drivers. There's a lot of resiliency. The balance is in assets that are adjacent to those, like self-storage, student housing. Data centers is a big part of our business too. And so as you think about that broadly, we feel that the current environment sets us up for a real position of growth.
Tell us a little bit more about data centers, because it's obviously a hot topic right now. And, from the private credit perspective, there's a question about how much they're financing, but from a compute perspective, we can't get enough over the next few years, right?
You're right, Matt. We can't get enough. I mean, when you think about it, the demands for infrastructure to support this industry is enormous, and that's why groups like Ares have really been able to step in a meaningful way as lenders, as developers. We have a very large data center development capability that we brought on board with the acquisition of GCP that closed just a year ago now. And the growth in data centers plays right into what we've been talking about, new economy investing, right? Which is the property types that are all supporting the way we live, the way we work, the way we're consuming. And so we feel there's a very much interconnectedness between data centers and how we're investing in real estate.
How competitive are these deals? Because this is a sector many have identified. Is it really competitive because everyone loves it, or less because you need the size of an Ares, for example, to actually participate in it?
Like any market where there's a lot of attention, you wind up seeing participants coming in with a varied set of capabilities. And so there is competition out there, but what we've been able to see, and we just talked about this on the panel earlier, is that groups that have multiple capabilities across infrastructure, across the capital structure, energy, which is such a large part of this story too, we're able to provide competitive advantages that give us an edge in the marketplace.
By the way, Matt kind of hinted at your office holdings, which is notably absent from your top calls. What would it take to get back in office? How are you just viewing that sector as a whole?
You want to buy low, sell high, right?
We've been underweight office for probably 15, almost 20 years now. There are a lot of attributes that are interesting from the super class A end of the market, but it's incredibly bifurcated. And what we found was that there were a lot of other sectors that could provide us with much more predictable, much more durable returns. And while values have come down considerably, it's not just about entry point, it's about how do you then drive cash flow from there.
You must still think about it a lot, Julie. Are we ever getting back to 95% occupancy, or no?
Well, as a resident of New York City, and certainly in a company where we very much believe in the work from office mentality, really do believe in the market. However, as investors, we think there are better opportunities out there.
Great having you spend some time with us at Bloomberg Invest. Thanks so much. Julie Solomon runs the real estate business for Ares. Still ahead, we have HPS CEO Scott Kapnick, March CEO John Doyle, and Marathon's Bruce Richards, all on this program. They're all here at Bloomberg Invest. This is Open Interest.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, happening right now at Bloomberg Invest, Lisa Abramowitz from Bloomberg Surveillance is speaking with the CEO of Temasek, Singapore Sovereign Wealth Fund. You can watch this conversation and all of the others happening here at Bloomberg Invest on LiveGo on your Bloomberg terminal. Just type L-I-V-E Go. Coming up in the next hour, Danny Berger sits down with Scott Kapnick, the CEO of private credit firm HPS. That's one we're going to bring you. We're also going to hear from the CEO of Marsh, John Doyle. He's going to join me here on set as we enter day 5 of the war in Iran. And Marathon's Bruce Richards will join us here on set as well. And I'll sit down with him at Bloomberg Invest on a panel as he publishes today on LinkedIn that we could see 15% default rates on highly leveraged software companies. That's an issue we'll delve into with Bruce Richards. Check on markets right now. We have the S&P and the NASDAQ gaining as oil turned to the upside. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talagi ko ahma ta juara pango ahma le pa manjang le ngai ko mamanya.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
$3 million in Medicaid spending. Here's a good reason to skip the junk and serve your kids real meals.
A study in Canada found that 3-year-olds who ate high amounts of ultra-processed foods had more behavioral and emotional problems by the age of 5. The study found nearly half of what preschoolers eat can be classified as ultra-processed.
CBS's Michael George. Markets are open and the Dow is down 43 points. This is CBS News. Starbucks will open a corporate office in Nashville later this year. Some workers may follow.
In an internal message obtained by the Wall Street Journal, the coffee chain says it will offer dozens of its Seattle-based employees the option to relocate to Nashville. Starbucks wants to expand its presence in the Southeast, but its headquarters will remain in Seattle. George Washington University business professor Chris Hayes says Starbucks is facing more competition at a time when people want their coffee quickly.
About 70% of every cup of coffee is now done on the go.
He suspects fewer people want to hang out in Starbucks cafes. Michael Wallace, CBS News.
A photographer who snapped an indelible image is suing Netflix.
I saw the girl running, then I took the picture of her.
Ladies and gentlemen, Nick Oot.
Nick didn't really take that famous picture.
Nick Oot, who won a Pulitzer Prize for Napalm Girl, photo of that child burned during Vietnam, claims Netflix documentary The Stringer defames him. He's suing for about $140 million. Deborah Rodriguez, CBS.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience, streaming live on YouTube, streaming live on Bloomberg.com as well. Scarlett Fu off today, not to worry. Alexandra Semenova joins us for the next 2 hours, which is a good thing. Alex, thanks for sitting in here.
Delighted to be here with you.
Got some economic data. Let's go right there. The ISM Services Index came out at 56.1. That's better than the consensus 53.5. And last period was 53.8, so a good number there. Let's check in with Steve Miller, chairman of ISM. He joins us from Aledo, Texas. Steve, what do you make of the ISM services? What are they telling you?
Yeah, the services sector is definitely heating up, Paul. We look across all of the indexes that are reported by ISM Services, and all 10 of them are in positive territory for the first time since 2021.
Steve, the employment component has been pretty volatile in recent months. What are respondents telling you about hiring plans and labor availability?
So on that, Alex, we're seeing reports on business strength and some confidence in business, as well as some strength in like construction that hasn't been there for the last 10 months. The last 2 months, it has been in expansion territory. So we're seeing some positive noise on employment, which is a little different than some of the news that we've heard over the last month. The business activity and new orders are up. Backlog of orders are up. So we're seeing real strength, and I think that will lead to continued growth in the employment area where we are seeing strength in the index.
Yeah, it's interesting. Look at the ISM Services Employment Index. 51.8 was the actual number. The consensus was 50.6, 50.3 last period, so an improvement there. Steve, any respondents talking about what we've been hearing a little bit in the marketplace about AI, and maybe AI is a threat to job creation or just jobs in general?
No, what we're seeing in the services industry is a lot of growth in information as well as in utilities to help power these things. So we're seeing positive implications right now from the AI trade.
Steve, it's been pretty incredible how resilient the services PMI has been, even as some pockets of the economy are starting to slow. Is there anything in the report signaling that demand may be starting to soften?
You know, the only thing, Alex, that I'd say in accommodation and food services, we saw that in negative territory this month, and also transportation and warehousing, which isn't unexpected after kind of the Christmas rush and in the same time period as we have the Lunar New Year. But the conflict in the Middle East will impact tourism and will also impact transportation as well as fuel costs going up. So those are, I think, two areas to watch out for.
Steve, thanks so much for joining us. Really appreciate it. Steve Miller, he's the chairman for the Institute for Supply Management. Cool kids call it the ISM. He's down there in Aledo, Texas, down there in the oil patch. I know all about that stuff. Alexis Christophers is going to join us right now and give us a Bloomberg Business Flash to get a little heads up on what's going on out there in the marketplace.
All right, thanks a lot, Paul. And this Bloomberg Business Flash is brought to you by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.6% in February? Turn your view into a trade at ibkr.com/forecast. Last trading day, March 11th. We've got stocks mostly higher. Oil is easing as Wall Street tracks developments in the Middle East. Iran is now denying a report in the New York Times that it has reached out to the U.S. to negotiate an end to the war, calling it, quote, pure falsehood and psychological warfare. The S&P 500 is now up 27 points at 6843. The Dow Jones Industrial Average climbing 116 points, while the NASDAQ 100 is now up 230 points as tech stocks bounce back. Want to shine a light on our retail roundup this morning because shares of Abercrombie & Fitch down more than 9%. Its first quarter guidance fell short of estimates, and that's despite record sales at the clothing retailer last quarter. We've got shares of Bath & Body Works also on the move this morning. It is now, it is up just about 0.5%, so coming off its highs. The company said sales will decline less than analysts expect. It's a sign that a turnaround at Bath & Body Works is starting to take shape. And we've also got shares of Ross Stores, big mover today. That company is rallying right now after comparable sales last quarter blew past estimates, and it gave an upbeat outlook. Taking a look at shares of Ross Stores right now, up 6.33%. And that's your Bloomberg Business Flash. Back over to you.
All right, Alex, thank you. Alexis, thank you so much. We appreciate that. Alexandra Semenova. I got a lot of names, a lot of new people around here.
Alexis
every day.
And Alex. My father is actually Alexander, so shout out to him.
Oh, is that right?
Yeah.
That's cool. Excellent.
Both of my grandparents on my mom's side were Alexander and Alexandra.
Is that right?
Yeah.
So no wonder I'm confused. All right, I'm just going with Alex. Alex,
you must be good, Paul.
Yeah. Scarlett Fu's not here. She'll be back next week. That is the plan. We're here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well. Looking a little bit of green on the screen here, but let's see where the stock movers are today. We can do that with Bloomberg's Matthew Griffin. Matthew, what are you looking at today?
Well, Paul, the first thing I'd like to dig into a little bit more is that Abercrombie report that Alexis was just talking about. And I think the reason there for that move is really interesting. You had first quarter net sales growth and profit trailing estimates, and the company calling out the estimated impact of the 15% global tariff that President Donald Trump has promised. They're calling out an impact as a percent of their net sales of about 290 basis points for the first quarter. So really nothing to sneeze at there. And you had Treasury Secretary Scott Bessent just saying that tariff may climb to 15% this week. I think this is a sign of what we're going to see from more companies going forward.
Matthew, a company that investors always like to hear about, Tesla. What is the latest over there?
Yes, Tesla climbing, Alex, about a little more than 2% this morning. The stock was reinstated at Bank of America with the recommendation of buy, and the reason is really interesting. They're talking about consumer autonomy, their robo-taxi services. They view them as a leader there. It's the latest in a trend we've seen with Tesla, which is that this is a company that makes its revenue by selling electric vehicles, and it is a company increasingly seen on Wall Street as anything but an EV maker. They're seen as a robo-taxi stock, a physical AI stock that increasingly drives the trading here today. Again, just the latest example of this.
All right, one more. What do you got for us?
I've been keeping an eye all week on United Airlines. They've been one of the worst hit stocks during the war. Of course, the disruptions to energy supplies threatened to raise fuel costs. You've got travel disruptions. Currently up about just under 1% this morning, but some really choppy trading there as traders have been parsing all these headlines. The report that Iran might be seeking negotiations, then Iran's denial. That comes after the stock fell 12% over the last 3 sessions. So I think this really highlights how difficult it is for investors to keep up with all of the developments in the Middle East. And I think we're in for more volatile trading in travel and other sectors like this.
All right, here's my United Airlines story. You ready for it?
Let's hear it.
Sitting on the plane in San Francisco at the gate, ready to come home on Sunday. Pilot comes, sits down right next to me, says, "Mr. Sweeney, I'd like to congratulate you. Congratulate you and thank you for your loyalty. With this trip, you will have flown 1 million miles with United Airlines."
Amazing.
Not bad. Gave me a nice
milestone.
Gave me a nice little medallion to commemorate the thing. So
And
that was
free
pretty
drinks,
cool.
I hope.
You're darn right. Yeah. So and that was a long flight back. So it worked out great. So that's I don't know. You got to fly. You get places.
That's incredible.
Back in the day, I was on a plane 3 days a week back in the day for 25 years. That was back when but that's how that all happened. So that was pretty cool in United. Matthew Griffin, thank you so much. We appreciate it. Matthew Griffin, proud graduate of the #1 ranked men's basketball team in the country. That would be the Duke University. They play against Carolina on Saturday. We're going to get avenge that loss from earlier in the year. Matt Griffin, stocks reporter, Bloomberg News. Appreciate that. Looking at the market here, we're holding on to the gains, Alex. So, I mean, it was a rough trading day yesterday, although came off the lows. So maybe that was a good sign kind of heading into today's trading.
Yeah, unbelievable, Paul, to see us up almost 0.5% on the S&P 500, given how much uncertainty there is about escalations in Iran and what that might, the impact that might have on oil prices.
Yeah, I think when we saw the market turn up today with the press conference with Pete Hegseth, as well as the Joint Chiefs of Staff General there, basically, I think the message was things are going very well in Iran. They are, quote, ahead of schedule. And I think just some of the commentary those two gentlemen were making let some market participants say, okay, this might be on the shorter end versus the longer end, just in terms of duration. And that on the margin could be positive for risk assets. And perhaps that's when we saw the market kind of turn this morning.
I will say it's kind of interesting. I've been speaking to a lot of traders, and a lot of them say that even if the White House does say something positive about how this is going, that might not be enough when you consider the long-term impact of our allies, on that war. And they point often to Russia, Ukraine, which is something that still hasn't been resolved and greatly impacted oil prices back in 2022 and inflation as well.
Yeah, if for nothing else, just from the news cycle, if we're any representation, Bloomberg News in this radio program, we've obviously been spending almost all of our time on the geopolitical front talking about Iran, not about Ukraine. And that is an issue for that whole part of the world.
Yeah.
And for our European allies and so on and so forth. So we'll see how that plays out. But again, the focus of the U.S. right now is on Iran. And again, so we had some, I guess, just on the update this morning, a sense that things are generally going pretty well. Looking at oil, because I think oil is another thing that's going to be, that has impacted and will likely continue to impact just kind of the broader risk marketplace out there. And we're seeing some, I guess, just stabilizing here, down about 1% for WTI and Brent crude here, just kind of not giving any of it back, but certainly not rising any further. And that you mentioned some strategists are calling out $100 on Brent is a number that really gets your attention.
Point. Exactly. Yep. That's the only kind of level that has been associated with negative equity returns over the subsequent 1 year period.
I'll tell you, Alexis has been reporting on the price of gasoline up 21%, 20 cents just over the past couple of days.
Just over the past couple of days. So we're really seeing the impact just overnight. And you have to wonder, though, is that just them preemptively, sort of raising these prices? Because it doesn't hit. It takes days, if not weeks, for the price of crude, a jump in the price of crude to make its way to the gas pump.
Yeah, it's interesting there. And I just think, if I'm a political advisor to the president, I'm like, the last thing we need is for gasoline prices to go up as we go into the midterm elections.
Exactly.
Because
Well, he was
that's
just
where we
talking
see
about in his speech recently in his State of the Union, wasn't he saying that the affordability fight has been won?
Yeah.
Yeah, not so fast.
Yeah, so that's kind of, I think just as consumers in general, that's one of the places you really see it, is the price of gasoline, the price of fuel for those people that are, like, unlike us here on the island of Manhattan that don't drive that much. The rest of the world, it really matters.
Yeah, and even though we've been getting these headline inflation figures that are kind of ebbing, we still talk all the time about how consumers are feeling the pain of inflation on everyday items when they're going grocery shopping. A lot of costs for them still very persistent. So.
Yep. Well, we saw the ISM services number today came in the highest since June of 2022. Prices did moderate too, so that's a good data point today for the U.S. economy and the U.S. consumer. So we'll stay on top of that as well. S&P up 0.5%, the NASDAQ up 1%, the Russell up about 0.75%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:21 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers studio. Stocks are higher. Oil is trading lower right now as Wall Street tries to assess just how long the conflict in the Middle East will last and what its impact will be not only on the energy markets but on the global economy. The S&P 500 is up now 0.7% or 49 points. The Dow Jones Industrial Average up 0.5%, 267 points higher. NASDAQ 100 now up better than 1%, a gain of 320 points. And the small cap Russell 2000 up about 1% now, or 24 points. The Bloomberg Dollar Spot Index is lower after a two-day rally as people were rushing to the relative safety of the dollar. We've got the Bloomberg Dollar Spot Index 1201.06. The 2-year yield now 3.53%. The 10-year yield 4.08%. There is a rebound happening in Bitcoin as well. It is up better than 6%, now at 72,383. Spot gold up 1% at 51.48. But let's get to oil, right? That's what everybody's been talking about. Brent crude now down 0.7%, below $81 a barrel. WTI crude down about 0.7%, now trading below $74 a barrel. Well, really quickly, a couple of stocks I want to talk to you about. GitLab, the software development tools company, expects slower annual sales growth. This is stoking concerns around the threat of AI. Shares of GitLab down nearly 10%. Moderna, though, has agreed to pay $950 million to settle litigation related to the delivery technology behind its COVID shot. We've got Moderna up nearly 9%, and shares of LegalZoom having some trouble today, down 3%. Barclays cut the firm's recommendation to underweight on slower growth and, once again, AI risks. That's your Bloomberg Business Flash. Back over to you.
All right, Alexis Christophorous, thank you so much. We appreciate it. Alex Semenova sitting in for Scarlett Fu. I'm Paul Sweeney. That conjugated all those names there. We're in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Markets moving higher, as Alexis was just reporting here. Let's check in with a professional who does this stuff for a living and how they kind of deal with, how these money managers deal with all this black swan events. Kim Forrest joins us. She's a founder and chief investment officer of Boca Capital Partners in Pittsburgh, PA. Kim, last few days kind of been a roller coaster. I guess this qualifies as a black swan event here. The markets seem to be adjusting here. How are you kind of navigating this?
Well, I think that's excellent that you bring this up. And it's one of my great ringing warnings to people who love technical analysis. Did technical analysis see a war breaking out this weekend? No.
Right.
No, it didn't. So, you know, let fundamental analysts take a victory lap. But I think the way you really need to look at this is look in your portfolio, see what is affected by it in the long term. I'm a positive person. I don't know what's going to happen in the future. I don't know what other black swans are out there. But I know the companies that I really know and like that and are in our portfolios are ones that want to not only return shareholder value, but also their client, the people who buy their products. They want to make their products for people or organizations. So that gives me comfort. So the market goes up, the market goes down. I know these companies are working for their clients and their shareholders, and that's what gives me peace at night.
Kim, Goldman Sachs CEO David Solomon today said that he was surprised by the benign reaction in markets to what's going on in the Middle East. And I have to say, it feels like the market reaction to everything that's happened this year has been benign, from Venezuela to Greenland to AI disruption. And we're just stuck in this range on the S&P 500. What gets us out of there, either to the upside or to the downside?
Sure. Well, a couple of things. I think the U.S. economy is strong-ish, right? We're not going to go over that whole K-shaped economy. There's weak sectors and there's strong sectors. What I think has been missing for a long time is housing. Now, housing will have many effects. It's not just the people who are buying a house, but we really haven't been building that many new houses. So that will bring people back into the workforce and pay them more and all of that kind of good stuff. So I think that if a couple, and I'm just using housing as one example, but there's a couple of lagging sectors. And if fundamentals turn around for those, I think that could get the market going again because that would be a driver for growth. The market is a growth forecasting machine. We're always looking forward and we're buying stocks based on what we think they're going to be worth in the future. And we have to see a path towards, a growing economy. And I think that's probably our biggest barrier.
Kim, despite all the geopolitical news that's been kind of front and center for the markets over the past several days, one story that hasn't really changed too much is AI. We're still seeing more and more AI deals. I guess I want to ask you about this deal. CoreWeave announces agreement to power Perplexity's AI inference workloads. Talk to us about what this means for these companies and what's going on still.
Well, there's a bunch of, actually, let's call it this, a handful of companies that are making large language models. And then there's an ecosystem that's going to prop that up and be vendors to it, and that would be CoreWeave. And CoreWeave has been, I guess they were spun out of a company. I can't remember which one right now because I'm thinking of other things. But, they have had a patchy go of it for the last couple of months. So this Perplexity deal is good for the company. It says that Perplexity has money to enter into longer term contracts. And I think that's really the fear because there's not a huge ecosystem of companies doing the large language model development. And those would be OpenAI, Anthropic, Perplexity, and then Meta, Amazon, and to a lesser extent, Microsoft, right? So I think any kind of new news about people putting money down and saying, yeah, we're going to do this, that gives a boost to AI. We're really all very nervous about how this is going to play out, not only for the people that might lose jobs, like that's been forecast. I'm laughing because we really don't know the future. I'm thinking that this is going to be augmenting white-collar jobs, not replacing them. But, we just don't know at this point, and it's a lot of uncertainty. So anytime somebody puts some money down and says yes to one of these build-out companies, it gives people courage.
Kim, thank you so much. We always appreciate getting a few minutes of your time. Kim Forrest, founder and chief investment officer of Boca Capital Partners out there in lovely Pittsburgh, Pennsylvania. We'll stay on the technology theme here. We're going to check in with Mandeep Singh, global tech research head at Bloomberg Intelligence. Mandeep, lots of news to talk about. I want to just start with CrowdStrike. Sales outlook kind of in line with expectations. Stock off a little bit here. Just refresh our memory. What is CrowdStrike and how does it fit into the tech stack?
Yeah, they are one of the pure play cybersecurity names, and clearly they have done quite well in terms of their top line growth over the last 2-3 years. And, like with everything in the SaaS complex, some of these names have come under pressure because of potential competition from LLM companies like Anthropic. And I think that's where you see a muted reaction today, but they had their best new ARR growth yesterday, and the guidance was a little conservative, but that's what we are seeing from all the software companies that have reported results this quarter is they want to beat and raise for the next one. And I think for a company like CrowdStrike that's growing mid 20% and very high retention rate. Things are looking good because all these LLMs should potentially drive more demand for cybersecurity. If there's one area that certainly is poised to benefit from LLM usage, it should be cybersecurity.
Mandeep, CrowdStrike has been, as you mentioned, one of the biggest beneficiaries of cybersecurity spending boom. After this earnings report, does it still look like there is still strong secular demand, or are we starting to see signs that those budgets are becoming a little bit more selective?
Not in the cybersecurity complex. So if anything, if you have more data now, which is the case with LLMs now, you are generating a lot more data, you are using it for training. And so all that needs to be secured, and prompt injection attacks is a new type of attack that you have to secure against. So from my perspective, and based on our conversations, this is the last thing any enterprise would want to cut. Yes, they are shifting budgets, allocating to AI more compared to the traditional areas. But when it comes to cybersecurity, the risks continue to get bigger and bigger in terms of data loss or, getting hacked. And so from that perspective, you're unlikely to cut back on, especially a primary cybersecurity product, which, in a lot of cases, there are point products, but CrowdStrike is more of a platform with multiple sort of threat vectors that they protect against. So from that perspective, also, they are quite insulated.
All right, folks, this is how it works at Bloomberg. Usually, Mandeep, he comes into our studio when we want to talk to him. He's not in our studio today, which got me thinking, where is Mandeep Singh today? And at Bloomberg, we can tell where everybody is at all times. You have to put where you are and who you're meeting with. It's kind of the full disclosure thing they do at Bloomberg. So I know where he is. He's downtown at the Bloomberg Invest Conference. Anytime Bloomberg gets its clients together, they all just want to talk to Mandeep. They want to hear Mandeep talk about what's going on in tech and most notably AI. So I'm going to go right there. Mandeep, what's the conversation today about AI? It went from just build, 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 build. Now people are starting to think about what are some of the ripple effects, second and third quarter effects here. What's the investor view of AI these days?
Yeah, at this conference over the last couple of days, the focus has been on the private markets. And as you know, private equity owns a lot of these traditional software companies that generate very high free cash flow. But everyone is looking at, what are these LLMs going to disrupt? And what does that mean, to the free cash flow of some of these companies? And so private markets have been a big focus, I would say, over the last 2 days.
Mandeep, there's been this trade, the Halo trade, focusing on tangible assets when it comes to deciphering, who the AI winners and losers are going to be. I spoke recently to UBS, a global wealth CIO, and she said that she's focusing on the builders and not the coders. How are you thinking about this dynamic between the companies with tangible assets versus intellectual property?
Yeah, look at all the hyperscalers, right? Most of them used to have an asset-light business model. Now we are talking about, $700 billion in aggregate capex for this year just from the hyperscalers. And this is likely a multi-year cycle. So from that perspective, we know AI is compute intensive and you need a lot more infrastructure to do AI. And so from that perspective, things certainly are shifting, from intellectual property to owning infrastructure. And that's the trend that is likely to continue.
Mandeep, thank you. As always, I'll let you get back to the Bloomberg clients there. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. A programming note, Bloomberg's Haiti Stroud-Watts sits down with Goldman Sachs Chairman and CEO David Solomon to discuss geopolitical tensions, energy risks, and macroeconomic uncertainties, and how Goldman is navigating these challenges. That's at 5:45 p.m. Wall Street time on Bloomberg Radio and Television, so check in for that. Always a fascinating discussion with Mr. Solomon. Markets higher here today. I'm going to call out the NASDAQ of 300 points. That's 1.4%. How about that? Little bounce back from yesterday. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Alexis Christoforous from the Bloomberg Interactive Brokers studio. And the stock market rally is gaining steam here after data show the U.S. service economy expanded at the fastest pace since mid-2022, while a price index hit an almost one-year low. This, of course, as the war in the Middle East clouds the growth outlook. We've got the S&P 500 up 45 points at 6861. Dow Industrials up 222. NASDAQ 100 now racing ahead 327 points, led higher by tech mega caps. We've also got oil in retreat. We've got WTI crude 74.17 the barrel. Brent crude now at 81.02 the barrel, with traders parsing conflicting signals about the conflict in Iran. Energy is actually the biggest loser of the 11 sectors in the S&P 500. We've got spot gold up better than 1% now at 51.51 the ounce, and the Bloomberg Dollar Spot Index at 1,266. Bitcoin bouncing back now above $72,000, and that's sending shares of Bitcoin holder strategy higher today. That stock now up nearly 11%. We've got the crypto exchange Coinbase up 13%, best performer in the S&P 500, and Robinhood is gaining now. It's also one of the big performers in the S&P 500, up 8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Paul and Alexandra.
All right, Alexis, thank you so much. We appreciate that. Alex Seminoes sitting in for Scarlett Fu. I'm Paul Sweeney. This is the Bloomberg Intelligence Radio Program, streaming live on YouTube, streaming live on Bloomberg.com, coming live from the Bloomberg Interactive Brokers studio here. We heard this morning from Secretary of Defense, Mr. Hegseth, as well as the Chairman of the Joint Chiefs of Staff, with an upbeat assessment of day 4 of this military conflict with Iran. That was partially, I think, helping the stock market move higher here, getting a sense that maybe this whole situation will be on the shorter end rather than the longer end of duration. But let's get a look at it from the geopolitical perspective. Jonathan Panikoff, director of the Scowcroft Middle East Security Initiative at the Atlantic Council, joins us from Washington, D.C. Jonathan, thanks so much for joining us here. What was your assessment of kind of the first 4 or 5 days of this conflict of Iran? Kind of took a lot of people, including this marketplace, by surprise here. What's your view?
Yeah, I mean, I think that's right. Look, I think the U.S. and Israel have done a tremendous job of hitting their targets. I think the Iranian reaction, frankly, was more extensive than many people expected it to be, in that they didn't slowly kind of build up towards striking Gulf states, but they did it quite quickly right off the bat in an attempt to try to pressure the U.S. and in an attempt to try to hope that the Gulf, the GCC, would come together, worrying about their own domestic economies, worrying obviously about energy markets, and that would in turn pressure the United States. We haven't seen that yet. I don't think we are there yet, but we could head there, especially if you start to see issues with, frankly, interceptor numbers by the Gulf states keep diminishing.
Jonathan, the U.S. and Israel have said that these attacks are aimed at degrading Iran's nuclear and military capabilities. Does it look at this stage like that is being achieved?
It looks like certainly the military capabilities are starting to be degraded at a much greater rate than they were even in June, right? So Israel had started this last June on the ballistic missile capabilities, but now we've seen significant strikes against the Iranian Navy and especially the IRGC naval assets. We've seen significant additional strikes against ballistic missile launchers, especially the medium-range ones. So I think there is progress. The nuclear sites, look, I think it's a little bit of a harder question. The Iranians said in June that they were opening a new site. It is buried incredibly deeply. We still don't know where the 440 kilos of highly enriched uranium that were buried at Fordo ended up. So I think there's still some questions on the nuclear side, more so than on the conventional missile side or the conventional arms side.
Jonathan, how far do you think this could go here? Is regime change on the table for this administration? Because if so, that could spell a whole new timetable.
Yeah, look, you're getting to the point, I think, Paul, that a lot of people are having a hard time with, which is the goals still are not clear. Despite, Secretary Rubio, Secretary Hegseth again this morning, President Trump all saying different goals, the problem is we don't really know what they actually are, and so therefore what the endpoint would be in leading to potential off-ramps. And I think the markets are calculating that in as well. Look, regime change is clearly the Israeli preference of where we get to and where they want to end up. For the U.S., it's not clear. I think the U.S. would certainly take regime change, but I don't know what the pathway is to really get there. The reality is regime change usually requires boots on the ground. They're not going to be American. They're not going to be European. So then, is there already a coalition that could support regime change that's coming together on the ground in Iran? It's possible. I'm skeptical of that, to be honest. And then the final point is, look, generally for regime change, you need somebody that actually has the weapons to either switch sides or to stand aside. It's possible. We saw that in 1979 with the Iranians. The security services at the time stood aside. On the flip side, getting somebody to switch sides, again, possible, but we haven't seen any indications that Iranian regime cohesion is really fragmenting, at least not yet.
Jonathan, we've already seen Iran send out missile and drone strikes on a U.S. basis. What kind of signals are you looking for in terms of whether this is contained or a bigger regional war?
Yeah, so I think there's two things to be looking for. One is, can the Iranians keep up the intensity? We actually heard from Secretary Hegseth this morning that according to the Pentagon's calculations, there's been a drop of ballistic missile strikes by 70% already. There's been a drop of drone strikes as well. But it's not clear if that's a strategic calculus by the Iranians, that they're waiting for a future moment to do a much bigger attack all at once, or it's because they fundamentally don't have the inventory. If it increases again, then I think you're going to talk about, again, more strikes are going to lead to greater chances that this spirals and escalates. That's especially true. We saw the Saudis already come out and say if there's another major attack on the kingdom, they're going to retaliate. Once the Gulf states themselves start going after in a defensive posture, but they offensively take action to go after Iran systems as well, then you're looking at the possibility of, frankly, this spiraling even more than it has.
So to what extent do you think, to prevent that, do you think the U.S. is working with the allies to say, hey, just stand down Israel and the U.S., we're kind of in charge of this thing?
I think they're certainly coordinating more. I don't know that they're asking them to stand down. In fact, I think the Gulf states are talking quite big right now, especially from the kingdom and the UAE, but they're all quite nervous and understandably so. The fundamental question, I think, is whether or not there's going to be enough protection through defensive interceptor capabilities. And that may be possible, but it's going to depend on the duration and then on the inventories. One of the positive things, I think, for the Gulf states is when the war began just a couple of days ago, look, the Europeans were very much staying out of it. The E3 wanted nothing to do with it. But now, all of a sudden, very quickly, we saw a change in tune. We see French carrier, the Charles de Gaulle, steaming towards the region. We know the Brits helped protect and take down a drone over Jordanian airspace. I think the more you see allies, then it creates greater opportunities that the U.S. and Israel don't have to do this all along, possibly greater protection for the Gulf. But again, there's probably a time limit on that as well.
President Trump assigned a 4 to 5 week timeline for this conflict. Jonathan, do you agree with that estimate? And what is the likelihood it could be much longer than that?
Yeah, the honest truth is, I don't think anybody knows. And part of the problem is, because we don't know what the goals are, it's not clear how long it would take to get there. A 4 to 5 week estimate is probably reasonable if you're saying we really want to fundamentally diminish Iranian naval assets, its standing military, destroy, maybe besiege the Revolutionary Guard's internal security forces headquarters, go after more leadership targets, diminish the nuclear program, ballistic missile program, then sure, 4 to 5 weeks based on the number of targets the U.S. might have left, makes sense. But I can't preclude the possibility that, look, it's a little shorter because the Iranians really come to the table. I don't think that's likely possible. And on the other side, it absolutely could be longer if the Iranian regime ends up having a strategy that they fire back more.
Jonathan, thanks so much. We really appreciate getting the benefit of your expertise. Jonathan Panikoff He's the director of the Scowcroft Middle East Security Initiative at the Atlantic Council, joining us via Zoom from Washington, D.C. Markets holding on to the gains here. The S&P up 40 points, the Dow up 200 points, the NASDAQ actually up 255 points. That's 1.1%. We'll stay on top of these markets for you. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Alex Semenova sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well here. I guess, Alex, looking at the oil market, we'll call it stabilizing. I don't know. I mean, kind of flattish today, which is good. No more panic buying that we saw over the last couple of days. Let's check in with Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. Zoom from Chicago? I'm not sure if that's correct, but we'll see how it goes. All right, very good. I don't know what he's doing in Chicago. He's
not
supposed to be
Florida.
in Miami Beach. I mean, come on. Mike, just give us your sense of kind of what we saw in oil over the last several trading days and how you think it might trend from here.
So, Paul, I have the honor of attending the all-day agriculture outlook in Covington, Indiana yesterday. And
nice.
They have, exactly. So I'm in Chicago office today, but we in the Midwest have the same problem we have with crude oil. Massive oversupply from the U.S., and we have a situation where the leader of the world's largest energy producer and net exporter of crude oil and natural gas wants lower prices for midterms. He's going to get them. So that, to me, as I look at this, is a classic peak kind of sign. So we've had key events to push prices up. A colder than normal winter pumped up natural gas. It's already collapsed. And then the first ever closure of the Strait of Hormuz. How long is that going to last? So you have to think to yourself, how are things going to look by the time we get to midterms? And I fully expect the whole situation in Iran will be subdued and will head towards lower prices. And a good example, if you look at Brent, it made a new high above last year's high around 85 yesterday. But that December contract, which will be front month right before the midterms, is running around 70. And it's probably heading towards 58. A good example is December last year went around 65, and that was before the U.S. Subdued Venezuela and Iran. So to me, this is a classic peak potentially in oil, unless something really goes bad with the war.
Mike, I'm an equities person, so I'm going to ask a stocks question for equity investors here. From a commodities perspective, Paul and I have been talking about how $100 a barrel seems to be the pain point for equities that Wall Street keeps citing. I know we're ways away from that right now, but what is the possibility that we could see those levels? Is that kind of off the table at this point, or is that something that you're thinking about at all?
I am, but you only hear those risks when we get kind of typically when it's time to sell. Those are usually sell signals because what's it going to take? A potentially significant military shutdown by the enemy, Iran, of the Strait of Hormuz. Right now it's shut down by insurance companies. Within a couple days, that's probably going to be completely alleviated and we'll go back to the trend. The key thing to remember is the Western Hemisphere is the price maker now in crude oil. Massive excess supply from the U.S. and Canada, running close to 8 million barrels a day of surplus supply versus demand. And this spike is just going to accelerate that trend. So you need some kind of sustained supply curtailment in the Middle East, which is unlikely. Otherwise, the trend usually ticks back lower, and potentially it's starting today. So look at the fact is by the time we get to midterms, is it going to look like this? You know, we've had 5 decades of wargaming for the world's largest military to handle this situation. If it's not a good situation, the Trump administration in midterms are going to have a big problem. I think they're going to be able to say, yeah, that one's done. And maybe even leadership in Cuba has fallen after Venezuela, Syria, and, and Iran. You see the trend?
Mike, you said you're in Covington. Yesterday you're in Covington, Indiana. So, of course, I Googled map it. We're talking the absolute middle of America, right between Peoria, Illinois, and Indianapolis. So we got to go. You're probably the only guest we can talk to and say that just went to an ag conference. What are the farmers telling you when you spoke to them yesterday? How's the farmer doing? What's the outlook?
Well, that's the wonderful thing about Covington, Indiana. There's only one place to go, and that's the Beef House. I've been going to this conference for decades. And people who wear overalls are very friendly, typically. The key theme is massive supply. Brazil is every other word, most notably Brazil. We have to find ways for demand, which typically means biofuels, which is part of that energy pressure factor, because that means more and more supply from U.S. biofuels. Ethanol, E15 going that way. They need something to support the prices, which is what we're probably going to be talking about with crude oil by the end of the year, because it's just a massive oversupply. The wonderful thing is called superabundance. It's just bad for farmers to make money.
Mike, we always appreciate what an expert you are on a swath of different asset classes, from gold to natural gas to oil, and Bitcoin is also something that you're an expert in. So I have to ask you, looks like it's rallying toward 73,000. Is this finally the breakout that investors were hoping for, or what's driving this rally?
I doubt it. Bitcoin's in a bear market. Initially, in the beginning of the year, I thought it was a worthy short around 94. Now it reached good support around 64. I think the first good resistance now to test is around 74. It has to stay above that level, but it has a key problem. The whole space is heading lower. There's an unlimited supply of cryptocurrencies. Mr. Trump probably put in the peak, and the bottom line for these highly volatile risk assets to go up is NASDAQ volatility, basically near a 10-year low, has to stay low. And to me, it's the risk of all that volatility and commodities and crude oil and precious metals trickling over to the stock market, and that's bad for cryptos, most notably Bitcoin.
Hey, Mike, what are the farmers telling you that you saw yesterday? Are they getting aid checks from the government? Is that really, and that's got to help them out, right?
It helps them, but they hate it. They said, yes, we're going to cash our checks. I mean, no denial, but they're so honest about it. We would much rather have higher prices so we can produce and make a decent profit. It's what they want to do, and they all love, corn's been the key place to go, but they don't like it. Also, they point out it brings on more supply in places like West Texas, where they probably shouldn't be growing too much corn. It means, to me, the problem is we probably have to find that low price cure before we find a bottom in prices, which I think tape around corners around 350.
Right.
And I've been pointing out in crude oil for almost 4 years now, that low price cure might be around 40.
Yep.
And these aren't profound. This is usually where it happens.
All right, great. Mike McGlone, thanks so much. Appreciate it. Senior commodity strategist Mike McGlone. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
All right, we have Alex Semenova, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Scarlett Fu out today. She'll be back on Monday, not to worry. They're coming up. We're going to play back a tape of a discussion we heard this morning. Fed Governor Stephen Myron, he was speaking with the Bloomberg television surveillance anchors here, so we'll get some of that and see how this Fed governor is feeling about this market and interest rates. Michael McKee, Bloomberg International Economics and Policy Correspondent, he's going to give us his thoughts on the Myron interview and, again, economic trends and some data we need to be following. He's going to be speaking to the Richmond Fed governor tomorrow, so that'll be a good thing down in Richmond. Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Analyst, talked to us about Bath & Body Works and some of the other retailers that are reporting earnings here. So we got a lot coming up in this hour, and let's kick it off with Mr. Charlie Feller.
All right, I thank you very much, Paul Sweeney and Alex. We have got the Dow, the S&P, NASDAQ all advancing. Equities are rebounding on this Wednesday morning after data showed the U.S. service economy expanded at the fastest pace since mid-2022, while a price index hit an almost one-year low. Right now, we have got tech mega caps pushing higher. The Dow, the S&P, NASDAQ solidly in the green. S&P right now up 60. And when you run the GIP screen, yes, best level of the day for the S&P right now, up 0.9%. Dow Industrials up 327 now, up by about 0.7%. We've got NASDAQ up 1.4%, higher by 3.2%. The NASDAQ 100 index doing a little bit better, up by 1.5%. The VIX just above 20 now, a 10-year at 4.07%, with the 2-year 3.52%. Gold up $68 the ounce at $51.57, up by about 1.4%. Silver rebounding to $84 the ounce, up 3.1%. And a retreat for now for West Texas Intermediate crude, down 0.1%, 74.46 a barrel. Brent crude, meanwhile, trading lower by 0.2%. Brent, of course, the global benchmark. Right now, we have got a barrel of Brent at 81.32. Jet fuel prices are soaring around the world due to the fallout of the Iran war, adding to concerns about global inflation among U.S.-based airlines with significant overseas routes. UAL, parent of United, up 1.1% today, rebounding from yesterday's decline. American up 1.4%, and Delta up now by about 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Paul and Alex, that is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. Alex Semenova sitting in for Scarlett Fu. I'm Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and on Bloomberg.com as well. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Carmen Reinke. Carmen, what are you looking at today?
Yeah, so the first thing I'm looking at today is Moderna, ticker MRNA. And so this is up about 10% right now, most since February 13th. So the company agreed to pay a $950 million to settle litigation related to the delivery technology behind its COVID shot. And this is important because it removes sort of a key financial risk for the vaccine maker, which has really struggled in the last few years. So this jump looks pretty significant. The other thing I wanted to point out is that year to date, it's up 86%. And this is a really banger start to the year for this stock. It's been down double digits for the last 4 years in a row. So starting to see some investor turnaround here and buying back into shares of Moderna.
Carmen, another stock that had a big turnaround, Abercrombie & Fitch. What's going on over there?
Yeah, so shares of Abercrombie & Fitch, which ticker is ANF, they're down about 4.5% right now. looking like, so just on a little bit of a declining streak there. So the retailer gave a forecast for first quarter net sales growth and profits that were lower than consensus estimates. Fourth quarter comparable sales also missed, specifically because Hollister growth failed to reach expectations. A name I haven't heard in a while. I think it's mostly geared towards teens.
Early 2000s throwback.
Yeah, seriously. So the other thing that was interesting here, the company said they see a small sales headwind from the Middle East conflict, and they noted that their guidance does include the estimated impact of the 15% tariff. They expect that to remain in effect for fiscal 2026. And they're not anticipating any potential refunds or recoveries of tariffs. So this is one that has been hit hard by the tariff story and is, continuing to see that be an overhang.
Brown-Forman?
Yes. So shares of Brown-Forman, I'm looking at the B shares, so BF/B, down 8% right now. And this is interesting because they were actually up.
This is the booze company, right?
Yes, this is the maker of Jack Daniels, among many other things. I have a full portfolio. So shares were up pre-market. It looked like, their earnings were pretty solid, sort of beat the average analyst estimate, and it sells better. But the stock has really fallen now in the regular session. So it looks like investors are reacting to headwinds from consumer uncertainty, lower non-branded sales of used barrels. And I also wanted to point out that Diageo, who owns Guinness Stout and Johnnie Walker Whiskey, had a disappointing earnings report last month. So that cut its sales guidance due to further weakness in the U.S. market and reduced its dividends. So it seems like there's just some negative sentiment here around alcohol stocks in general that might also be weighing down Brown-Forman today.
They say young folks are drinking less?
Yeah, Gen Z doesn't like alcohol.
I think it's because they're all doing gummies, chewing the gummies.
That might be true.
I think that's what's
Smoking
happening.
Vapes, cigarettes are back apparently.
Yep.
No alcohol.
No, okay. Kids, go for it. All right. Carmen Reinicke, appreciate that as always. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, this morning, Federal Reserve Governor Stephen Myron spoke with Bloomberg's Jonathan Farrow and Lisa Abramowitz. And Myron said he thinks it's still appropriate to continue cutting interest rates, given that it's too early to take a stance on the impact of war in the Middle East on the U.S. economy. Let's take a listen.
At the moment, I think it's too early to sort of have any firm views as a result of that. Oil's gone up a bit, but the major question is, does oil stay up or does it come back down? And that'll, of course, will depend on how things play out. But even that said, even if oil stays at these types of levels, to me, it's difficult to get a lot of read-through as a result of that. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
So some people who come on the program spoke to Lisa and I and said these Federal Reserve officials might be conditioned by the post-pandemic experience coming out of 21 into 22 and the inflation spike then and the energy shock that developed at the time emanating in Russia. Is this different? Are we in a different place?
I think it is. I think that attitude is a little bit of fighting the last war. And I think that the Federal Reserve for decades has had the view that, that headline inflation shocks like oil are best looked through, and you sort of focus on core inflation because it's indicative of where inflation is going to go in the future, and you focus on the labor market. And that type of reasoning leads you to look through an oil shock. Now, of course, what happened in 2022 was a bit different because the other policy settings were different, right? Don't forget, monetary policy was as expansionary as it had ever been at the time. Fiscal policy was injecting trillions of dollars into an economy that was recovering thanks to vaccines and medical improvements and COVID passing on its own. And so the policy environment was very different. And so it was very easy for a slightly inflationary shock to feed through into the broader economy and create this type of persistent inflationary problem that the Fed dealt with. We don't have that right now. We don't have fiscal policy that's slamming on demand. In fact, if anything, supply is moving out quite aggressively, and monetary policy is still modestly restrictive in my view. So the policy settings, the economic environment is different. To focus on that, as you described a moment ago, to me, is fighting the last war. That was a unique circumstance.
At the same time, some people have argued that the January jobs report raised a question about just how weak the labor market actually was. Even Governor Chris Waller came out and said, okay, now it's a coin flip for whether we should cut rates at the March meeting. If we do get confirmation of that strength with the February payrolls report that we get on Friday, would that make you rethink whether March was an appropriate time to cut rates?
So look, for me, we've got 2 years of a trend, 2+ years of a trend of gradually weakening labor markets that sort of set in 2023. It's way too early to reject the notion that that trend continues based on 1 or 2 labor market reports. And when you look at the totality of labor market data, there's still evidence to me that it needs more support from monetary policy.
All right, that was Federal Reserve Governor Stephen Myron speaking with Bloomberg's Jonathan Farrell and Lisa Abramowitz. His message remains the same. They're cutting interest rates. Michael McGee joins us here, international economics and policy correspondent, joining us live here in our Bloomberg Interactive Broker studio. Michael, if nothing else, Mr. Myron staying consistent, which is what I guess most Fed governors are doing at this early stage of the war in Iran. What did you take of his comments?
I think the most important thing he said was that he thinks most of his colleagues are where they were last week, because at this point, they don't know enough. We know that oil prices went up. We know that gasoline prices are going up, but how long are they going to stay up? The war began at the beginning of the month, so it would, if prices remain elevated, they would show up in CPI, PPI next month when we get the March data. But if it ends before then, what you would have is a brief spike, and then it goes back down again. And what the average is maybe a little bit higher, but it's not going to be enough to worry the Fed. The only reason the Fed would be concerned is if this lasted for a long time and it starts to get into the core areas that Stephen was talking about. You get into pharmaceuticals or plastics or other things that use petroleum, but that takes months. So at this point, it doesn't seem to be a major issue. But that doesn't mean it can't be.
Yep.
Mike, we had Stephen Myron defending the prospect of further easing this year, but the latest FOMC minutes had some officials floating the prospect of rate hikes this year if inflation persists. Does this conflict exacerbate the divide among officials, and how does that impact policymaking?
I don't think that they're so much divided as they are cautious. You have a group that thinks that the Fed has moved far enough because nobody can tell what neutral is, and they think that they are still, they're getting close to being too loose. And you have the group that Myron's in and Chris Waller's in that think that the Fed is still somewhat restrictive. And the people who are saying we're not restrictive enough at this point are concerned that if inflation doesn't go down or something happens where it goes up, we might have to raise rates. They're not advocating raising rates, but what they're saying is we should tell the markets that this is a possibility so we don't get a one-way trade. And that's kind of what the minutes were saying. Now, obviously, minutes are now 4 or 5 weeks old, and that's very much in the rearview mirror because of everything that happens on a day-to-day basis these days. So I wouldn't put too much stock in that, and we'll see where we are when we get to March 18th, the next meeting, and whether they want to give some sort of warning. But at this point, again, it's too early.
We thought, well, I guess the war discussion over the last several days has pushed a lot of issues to the sidelines, one of which is tariffs. But Secretary Bessent today coming out and saying that President Trump's tariff hike to 15% likely coming this week. So that's still a thing, right?
That's still a thing, but you have to remember that at 15%, the average weighted tariff on Americans is going to be a little bit lower than it was. Yep. So it's not going to be an inflation booster. Okay. What could happen is down the road when these are just temporary tariffs, when they get to the real tariffs that come under the various sections of trade law that they say they're going to impose, those are mostly sectoral versus countries, so you may have some sectors that get tariffs that didn't have tariffs before or have bigger tariffs than they had before. And so you could see some sort of inflationary pressures down the road. And that just adds to the we don't know what's going to happen situation for the Fed. And I think the weight of it is going to be on the people in the middle on the Open Market Committee who think we should wait and see what's going to happen because there's just still too much confusion.
Mike, what is the economic logic behind 15%? Because initially when the tariffs were struck down by the Supreme Court, I believe the president said 10%, now it's 15%. How are these numbers decided?
There's no economic logic. It's in the law. This is Section 122 of the 1974 Trade Act that has never been used for this before. But if there is a balance of payments problem, and that's a whole other question because there is not a balance of payments problem, then the president can put on tariffs up to 15% anywhere he wants for 150 days. He came out originally and said 10%, and I think they put a hold on him for a second to do that because then they wanted to see how this would affect once they applied it worldwide. And then they said, oh, no, we can do the 15. So they're going up to 15% because that's what's permitted. They're doing it for 150 days because that's what's permitted. There are going to probably be lawsuits, and my non-lawyer guess would be that these tariffs would be struck down too because there isn't a balance of payments problem. But 150 days, it's not going to get anywhere in the courts by then, and it'll be over. And so it's just we can get away with it, so we will.
Rebates, has anybody figured out? First of all, I'm not even sure how these tariffs are being collected, because if I'm the tariff dude like at the LA port, I've got a menu of like 5,000 different tariffs on different products. I don't know. And I'm expecting that guy to figure it out at ports all over the world and collect that money. I don't even know how that's happening.
Basically, it all goes through the computers, and the computers for every bill of lading that come in assign the tariffs due to the importer of record. So there's one company, one person, as it were, who is for everything that comes in on a particular ship or in a particular cargo container, they have to pay. And then they decide whether they're going to pass it along to the customers who are ultimately going to get this stuff.
And we just had Abercrombie & Fitch today, one of gajillions of companies identifying what their tariff cost is in this quarter. Yeah. And so they called it out. And then they also made the point, oh, by the way, we're not expecting getting any refunds. So where's the refund discussion?
The refund discussion is basically how are they going to do this? The government refunds money on this basis all the time. There's a system in place to do that to these wholesaler types. And then the question is, how do they distribute it to other people? And there's an intermediate question of will the administration try to throw sand in the gears and because they are counting on this money try to prevent anybody from getting refunds. But if the refunds go ahead, then it's who gets the money and how far down the chain does it go? I don't know if Abercrombie imports their own stuff, but if they don't, then what are they being charged by the wholesalers, the middlemen between them and the boat that comes in? That becomes the issue. You've seen some retailers come out and with ads that say, we're going to give you your money back. They give it to us, we're going to give it to you, the consumer. It may be a safe bet because they may not get it.
I mean, this is a bookkeeping nightmare from beyond any. You couldn't write a movie about this.
No, and I'm sure there are people who are going to be having to deal with this who are thinking we don't want to be movie stars.
Yeah, the Abercrombie & Fitch. There's like, forget about this. We don't know where the refunds are going to go. So anyway, all right, Michael McKee, thank you so much. We appreciate that. Michael McKee does all the economics. He is our tariff and refund tariff guy. I mean, he's the one that knows it. But I can't imagine the person in the port of LA figuring it out in terms of charging the tariffs and then giving it all back. So maybe he's got it in his pocket.
Honing their math skills.
Yeah, exactly. I mean, but that's the world we live in. So we'll see how that plays out. Market's holding in there just fine here after yesterday's sell-off. We got the S&P up about 0.7%. NASDAQ doing a little bit better. The NASDAQ is up about 1.1%. Tom from the Upper East Side asking for a VIX call out here. 21, but that's down 2.5 big sticks, so 21. We'd like to get it below 20. Anything above 20 suggests a little bit of angst in the equity markets. We'll keep an eye on that. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are looking at an update for the Dow, the S&P, and NASDAQ in this Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. S&P 500 index right now higher by 44 points at 6860. That is a gain of 0.6%. A report showing economic resilience and cooling inflationary pressures driving stocks higher. The Dow up 241 now, up 0.5%. NASDAQ up 261 for the NASDAQ Composite Index. That is a gain right now of 1.2%. NASDAQ 100 Index up 1.3%. The Russell 2000 Index up 0.9%. And the VIX just above 21. The 10-year 4.06%, with the 2-year 3.51%. Gold up $56 the ounce, up 1.1%. Bitcoin up 6.7%, and we're now seeing a retreat for West Texas Intermediate crude pulling back down 0.4%, 74.23 a barrel on WTI Brent. The global benchmark 81.16, down 0.3%. Apple shares lower, little change right now. Apple is rolling out the $599 MacBook Neo in its biggest push yet into low-end laptops, aiming to challenge Windows PCs and Chromebooks for budget-minded shoppers. Again, Apple shares little change right now. Apple higher by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Alex and Paul, that is a Bloomberg Business Flash.
All right, Charlie Pellet, we appreciate that. We've got Alex Semenova sitting in for Scarlet Food today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube and on Bloomberg.com. It's the time of the earnings cycle, the end of the earnings cycle, where we get to hear from a lot of these retailers. Today's no different. Bath & Body Works reporting some numbers here, so let's break it down. Lindsay Dutch, Consumer Hardlines Senior Analyst for Bloomberg Intelligence, joins us here. So Bath & Body Works, I know they're doing it. They're in the midst of a turnaround here. Lindsay, what did you learn on the earnings release?
Hi, Paul. Thanks for having me. Yes, Bath & Body Works is aggressively pursuing a turnaround strategy. The fourth quarter, we saw sales and earnings come in better than expected, but still down year over year. And then their outlook for 26 wasn't super surprising, kind of in line with what they were expecting 3 months ago. You know, growth is kind of off the table as they pursue a strategy that's going to attract younger customers, a broader customer base. They're moving a little bit into wholesale. They're pulling on lots of different levers to really become back to the brand that they have been historically.
Lindsay, promotions are a big part of Bath & Body Works' strategy. Are they driving traffic successfully, or are they a sign that demand is a little bit more shaky?
Yeah, great question. So promotions are a huge part of Bath & Body's historical strategy. The new management team is really trying to ultimately move away from that. I don't think 26 we will see a significant shift. They said on the call they're expecting promos to be about flat this year. They do still see success from those promotional strategies. At Black Friday, Cyber Monday, they elevated the strategy versus historical, and that deeper discount definitely drew traffic, and I think that was a key part of the little bit better results in the fourth quarter than they were expecting.
Lindsay, what's the Amazon.com play here for Bath & Body Works?
Yeah, so I think that they're really looking to broaden their brand awareness with consumers that don't shop them already. So they have, 40 million loyalty members. Some of those customers have been with Bath & Body Works for a very long time. They're extremely loyal to the product, the scents that they have. But this company is really looking to reach that younger shopper. They're pushing into new lines. They have lip products now. And the move on Amazon is similarly broaden brand awareness, reach other shoppers that they don't currently reach. So I don't see a huge push into wholesale as a new business strategy, but it's really getting that brand in front of customers that aren't going to the mall and seeing their store.
This is a company, Lindsay, that falls into the affordable luxury category. What do these results tell us about the broader consumer and trading down to companies like this?
Yes, so Bath & Body Works has historically drawn customers for their value proposition, and they have an everyday luxuries line that did very, very well in 24 and 25. They still want to maintain their piece in that seeking for value behavior, and I think that's very important for them going forward. The new management team also wants to elevate the brand and push it maybe towards that prestige level a little bit. And in beauty broadly, we've seen prestige holding up a little bit better than mass. So it's an interesting move to try to sort of elevate and move up a tier, when a lot of consumers are seeking value. But I sort of understand the logic behind that, just taking a step back where those prestige brands have held up better in this economy, probably driven by a higher end consumer.
All right, Lindsay, thank you so much. Appreciate getting a few minutes of your time. Lindsay Dutch, she's a Consumer Hardline senior analyst for Bloomberg Intelligence. She's down there in our Princeton campus doing some good work down there. Let's get back to these broader markets here. The S&P is up 50 points. That's 0.75%. The NASDAQ really doing well, up to about 290 points. That's 1.3%. Christina Hooper joins us here, Chief Global Market Strategist for Man Group, joining us here in our studio, which we appreciate. Christina, in the last few days, a lot of geopolitical uncertainty roiling the markets here. You've been in this game a long time. You've seen this before. How do you talk to your clients when they see the markets moving and we've got wars and bullets are flying and oil going all over the place? What's the message you have?
Well, I think we have to recognize that, as you pointed out, this has happened before. We just need to get a better sense of how long this could potentially last and how significant it's going to be. Because at the end of the day, something like this could last, a few more days, or it could be very prolonged, and that will have a big impact on the outcome. Also, how many countries are drawn in, the impact to oil supplies, all of that will play a role in exactly how much of an impact it will have. But I think most investors have long time horizons, and so it's also important to keep that in mind, that this is not a red alarm bell going off saying you need to get out of everything and run to cash. This is more about, let's think long term, let's keep our allocations, but also recognize there could be significant volatility in the near term, just given the potential for this. And again, there's just so many unknowns right now, but the potential for this to last a significant amount of time.
Christina, within the equity market, what is the defensive play right now? Because for so long, investors would gravitate toward big tech in situations like this. That doesn't seem to be the case anymore.
Well, it's interesting. I think that every time we have what I'll call a market scare, it seems as though recently the rules have been remade each time in terms of what actually is a safe haven. And so we're certainly seeing good news, good movement in tech today, but of course that hasn't been the case. And I think a lot of that has to do with external factors beyond what's happening in the Middle East. So, and of course, one would assume that gold would have held up better than it did. It had certainly a strong weekend, but then fell significantly. And I think that speaks to external factors. There was just such a strong rally in gold for such a long time that this potentially could have just triggered a give back because of concerns that it had run up so much. So it definitely shifts. I think the most important thing is to be very well diversified. And to have adequate exposure to alternatives as part of that diversification, and within alternatives being well diversified, because on a given day gold could perform well, but on other days it might not, and vice versa. And having hedging strategies in there, I think all of that makes sense for any kind of environment, but particularly this kind of environment.
Christina, your economic outlook has been generally more cautious than consensus. Has the events of the last several days or some of the data points you've seen recently, has that changed it at all?
No, not at all. And certainly reading that Citrini research piece didn't change anything for me. Now, I will say, of course, have read the rebuttal from Citadel. I think both can be possible. I think you could see a significant increase in structural unemployment, and then creative destruction kicks in, and you have new jobs created, more jobs created, as we've seen with every industrial revolution. But I do believe this is a year in which there are a lot of headlines around job losses.
Yep.
And some of it is companies that are putting pressure on management to cut headcount because they want to pay for AI, not having seen necessarily the benefits, the productivity, while others, of course, are likely to recognize benefits, productivity, and will be able to cut heads. Now, all of this says to me, just because there's so much media attention around it, that consumer sentiment is going to decline and that there's going to be a lot of cautiousness around consumer behavior. We've already seen lower income consumers being hit. They're certainly a lot more careful in terms of spending. I think that could certainly filter into far more of middle income consumers and upper income consumers.
You mentioned, Christina, the Citrini research report. We've since stabilized a bit on the AI front, but just a couple of weeks ago, we saw entire sectors dumped in tandem. What happens if that occurs again, if some AI startup comes out and says, oh, you know, we can do this much better than a wealth manager? How do you navigate that environment that is so disconnected from fundamentals?
Well, I think, again, it's about recognizing that we have to a certain extent, have blinders on and realize what our time horizon is and recognize there could be a lot of volatility. Change begets nervousness and jitters, and this is a lot of change. This is transformational change, arguably.
So one of the things, you guys, the Man Group, a global firm, how do you think about U.S. allocation versus non-U.S.? Because 2025 was a year where I think people really rethought that and thought, well, I can find some better opportunities outside of the U.S. markets. How are you thinking about that here in 2026?
Absolutely. I think that certainly you can't not have exposure to the U.S., but I think there are many, many investors, many institutional clients, many retail clients that are overexposed to the U.S., just simply because it has performed so well for so long. 2025, I argued in 2025 we would see better performance from outside the U.S., but I think many were skeptical. There have certainly been head fakes in the past. But hopefully that what we've seen in 2025 has encouraged many clients to look outside the U.S. and expand their exposure to European equities, for example, UK equities, emerging markets. There's a lot of opportunity there, and we have central banks poised to ease. And I think that'll likely continue and be a nice tailwind for emerging markets.
All right, Christina, thank you so much for joining us. Always appreciate getting a few minutes of your time. Christina Hooper, Chief Global Market Strategist for the Man Group, joining us live here in our Bloomberg Interactive Broker Studio. A programming note, folks, Bloomberg's Haiti Stroud-Watt sits down with Goldman Sachs Chairman and CEO David Solomon to discuss geopolitical tensions, energy risks, and macroeconomic uncertainties, and how Goldman is navigating these challenges. That's at 5:45 p.m. Wall Street time tonight on Bloomberg Radio and Bloomberg Television. So check that out with Mr. Solomon. Markets moving higher, holding on to their gains pretty much at the intraday highs here. The S&P is up 55 points. That's 0.8%. The Dow up 300 points. That's 0.6%. And NASDAQ is where the action is. It's up 300 points, 1.34%. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil lower, stocks higher. A report showing economic resilience and cooling inflationary pressures drove stocks higher at a time when the war in the Middle East clouds the growth outlook. The S&P right now trading close to session highs, up 50, up by about 0.7%, 68.66 where the index stands right now. The Dow up 273, Dow Industrials up 0.6. The Nasdaq Composite Index up 1.3%. The Nasdaq 100 Index now up by 1.5%. The VIX right around 21, 10-year 4.07%, with the 2-year 3.51%. Gold is up $65 the ounce. Spot gold up 1.3%, 51.54. West Texas Intermediate crude now down 0.9%, 73.86 a barrel. Brent 80.86 barrel of Brent down 0.7%. Bitcoin surging 7.8% right now at 73,300 on Bitcoin. President Trump could raise global tariff rates to 15% sometime this week. Treasury Secretary Scott Bessent telling CNBC the duties will kick in for 150 days under Section 122 of the Trade Act.
Those are very fulsome authorities that they have survived more than 4,000 legal challenges. They are more slow moving, but they are more robust.
Treasury Secretary Scott Bessent interviewed this morning on CNBC. After earnings, CrowdStrike Holdings up now by 1.4%. It did project quarterly sales that were roughly in line with analyst estimates. And Bath & Body Works, they're out of Columbus, Ohio, says sales will decline less than analysts expect. Bath & Body Works shares surging now by 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Paul and Alex, that is a Bloomberg Business Flash.
Hey, Charlie Pellet, thank you so much. We appreciate that. Alex Semenova sitting in for Scarlett Fu. I'm Paul Sweeney, live here on our Bloomberg Interactive Broker Studio, streaming live on YouTube and on Bloomberg.com. AI story, on just yet another angle, is how AI is being deployed by the Department of Defense and other parts of the U.S. government, but particularly about the Defense Department. We had Anthropic clashing with the Pentagon about how their AI could be used. Then we had OpenAI Chief Executive Officer Sam Altman says, we'll come in and we'll do some of the work for you. And there's a lot of uncertainty about how AI is going to be used and who will actually provide it for various government entities, including most notably the Department of Defense. Vlad Richter joins us here. He's the CEO of the cybersecurity company Fencer. Vlad, how do you think this is playing out? AI, the Department of Defense specifically, we've had some uncertainty here. What do you make of it?
Yeah, look, I think there's clearly some sort of misunderstanding internally between the departments, the Pentagon and Anthropic, seemingly because from what we're reading over the weekend, OpenAI signed an agreement, according to Sam Altman, with the Pentagon that kind of stated the outlines that I think we as citizens would very much care about, which is we don't want to see mass surveillance, and we definitely can't even imagine a situation where there would be autonomous weapons going through there. But I think this also speaks to part of the challenge within these AI companies, or specifically the models, is that a lot of the data that they're trained on is effectively the same, and so over time, the work that they're doing becomes kind of commoditized, and there isn't much of a moat. And so the government will inevitably, in my opinion, turn around and start to work with the vendors that will play ball with them and not try to strong-arm them in any single position.
Opportunistic and sloppy was the language that Sam Altman used. Pretty strong language there. What does that tell us about the rush by AI labs to secure government contracts, and how important of a customer is the Pentagon when it comes to the AI industry?
Yeah, great question. So I think from a perspective of how important the Pentagon is, or the government specifically, to these AI companies as a customer, it's actually not that much. I mean, if you look at it from the perspective of Anthropic, it was reported that the deal with the Pentagon was around $200 million a year. And I think as reported by Bloomberg today, Anthropic went from $14 billion in run rate a few weeks ago to nearly $19 billion today. It's 1% of their revenue, right? And I think for the same, probably similar to OpenAI and some of these other ones, that it's meaningful revenue, but as a percentage of the overall base, it's not significant. And instead, what you end up, we need as citizens is that the government actually chooses, and it's more important for them. I think in the case of OpenAI with the contract they just signed, it was a little bit too fast, like Sam said, and the communication was not great. I mean, there was a handful of departures, including some relatively senior people from OpenAI after the weekend that decided to go to Anthropic. And I'm not sure how much people know about this historically, but the Anthropic founding team was actually for the most part, all ex-OpenAI employees that disagreed back in 2021 with some of the direction that OpenAI was heading to and decided to leave and start Anthropic themselves. And I think today, there are roughly 70 to 80 employees at Anthropic that are ex-OpenAI, but at OpenAI, I think there are only about 10 or 12 employees that are ex-Anthropic. So you can see kind of where the movement's been going between the sort of the intelligent folks there.
Do we have any idea to what extent in the Pentagon and the Department of Defense that AI is being utilized? Are they cutting edge because they have the resources, or are they kind of an old government, plotting institution? How are they employing AI?
There's a great article, and I think it was actually from you guys earlier this morning that popped out that kind of described a little bit of, that was revealed by some source of how it's being used. And in the understanding of what was reported was that the Pentagon had decided that there were going to be roughly 1,000 places that they were going to hit initially, 1,000 sites that they were going to hit initially inside of Iran. In previous versions of this, you can't hit all 1,000 at once, and so people would sit down, they would prioritize them based on a handful of different factors, and it would probably take a couple weeks to get this done, if not longer, right? In this case, what was understood was that they were using Palantir's Maven product, which underneath the hood was also being powered by Claude from Anthropic, and they basically fed in a bunch of data that Palantir has access to from the government, and said, okay, prioritize this for us based on what we need to do in the different sort of movements, right? Step 1, step 2, step 3, whatever it may be. I think at that point, just like if any of us were using AI to prioritize some other thing for us, it pulled out a spreadsheet and said, listen, this is, I'm paraphrasing here, assuming, this is what you should be doing. And I imagine the powers that be sat down, took a look at it and said, is this really what we want to be doing? Do we want to hit these first 100 or not? But at a minimum, you're getting that done in 45 minutes, right? This is not a multi-week endeavor. It just kind of gets you a little bit faster there. It might only be 90% correct, but humans will decide the rest of it from there.
Vlad, we've seen AI leaders call for stricter regulation while simultaneously pursuing defense contracts. Is there a sense that these deals are happening faster than the industry can establish the right ethical guardrails?
Yeah, so depends on the day. You sometimes can go back and forth. What I would tell you is that it's not even sometimes so much as the guardrails from the industry, but the guardrails from the government, right? There are some significant points that I agree very much with Dario, the CEO at Dario Amodei at Anthropic on this, which is the government does need to provide some guardrails for us on what is appropriate, what is not appropriate, how do we protect U.S. citizens, at what point in time does the Pentagon decide to overstep some of these boundaries, and if they're allowed to. But I think these things are moving too quickly at this point, right? I mean, these models come out a new version of a model comes out every few months from one of these organizations, and it beats the previous one by 10, 15, 20, 30%, and all of a sudden it unlocks things that we didn't think was possible. And you hear these comments that I think Dario said this earlier this week, where he said that he believes that there's going to be exponential growth later this year. And for a company like ours, we went from 5% of our code being written by AI a year ago to north of 60% today. You start to struggle to imagine what exponential looks like by the end of the year. And so I think it's just tough to keep up with these things.
Fascinating discussion. This is a fluid discussion, and it just kind of goes to the issue of how will AI be employed and who will benefit, who will not benefit. Vlad Richter, CEO of Fencer, joining us here, talking to us about one aspect of AI applications, and that's with the Pentagon and the Department of Defense, and what are the terms of the use of AI? And so Anthropic steps down, OpenAI steps up, and there you go. So another angle to the AI story, which will stay on top of. Markets holding on to the gains here. We are sitting right at the S&P 500 up just about 0.9% towards the high end of the day. The Nasdaq's up 330 points. That's 1.5%. And the Russell is also up 1% here. So strong day in the markets. Good volume out there in the marketplace. 10-year Treasury yields pretty steady. 4.06%. And Charlie Pellet's been reporting Bitcoin up 7.7% today, $73,000 per token. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Alex Savanova sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Today, the research coming out of Bloomberg Intelligence is just amazing stuff. I think it's the best on the street here. And that includes the media research from our next guest. She put out a note today that when it drops in Philadelphia on the desk of the executives at Comcast, it's not going to be good. Paramount Skydance acquisition of Warner Brothers Discovery will trigger a media re-ranking and strategic sector reset, our guest says. We expect the industry to consolidate around three dominant players: Disney, Paramount, Netflix, leaving Comcast subscale and making further M&A likely. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence. Brian Robertson and the gang down there in Philadelphia, probably not going to be happy to read this, Geetha. What do you think Comcast will do in this new world of Paramount and Warner Brothers?
They absolutely need to do something, Paul. I mean, that has been the whole thinking. We know that they are ready to do something because last year when we had this whole Warner Brothers Discovery auction kicked off, we know that Comcast had actually kicked the tires there. They had proposed a merger of NBC Universal, which is their media division, along with Warner Brothers Discovery. But of course, because it was a majorly stock deal as opposed to a cash deal, it was, obviously the Warner Brothers Discovery team didn't go ahead with it. So they know that something needs to be done to, spin out NBC. But I think it's some kind of strategic action is absolutely imperative at this point, Paul.
Geetha, Paul and I were just talking about the language in your note, a media re-ranking and a strategic sector reset that's going to rattle a lot of folks at Comcast. Can you talk to us a little bit more about what exactly that means?
Yeah, Alex, absolutely. So if, in fact, the Warner Brothers Netflix transaction had gone through, that would have left Paramount without a dance partner, so to speak, right? And they were already considered a subscale player. They would have absolutely needed another, kind of deal. And majority of the thinking was that yes, they might then approach Comcast and look to kind of bolster up their whole media presence. Now with the Paramount and Warner Brothers deal going through, you have, obviously the media re-ranking. You have what we call the big three. So you have Disney there with almost 100 billion in revenue. Paramount and Warner Brothers Discovery will bring in about 70 billion, and then you have Netflix with about 50 to 55 billion. That really leaves now Comcast as somewhat of a subscale player. So they, this is the whole thinking. They need to do something. They need to do it quickly. It's somewhat of a unique play, Comcast, because they have both distribution and content assets. So they are the biggest broadband provider right now in the United States with over 30 million households. The problem for them is their broadband business has been under a lot of pressure. So that has kind of taken the spotlight now to the media assets. And media assets actually, for them, fortunately, there's a lot of focus, and it's a lot of positive focus, because we know that Netflix was willing to pay a 25 times multiple for the Warner Brothers studio. So you just kind of apply that multiple to the Universal studio, and they have had so many hits, whether you're thinking about the Minions or Oppenheimer or Jurassic Park, Jurassic World. I mean, that's a studio that delivers consistently. So you just slap that multiple onto the NBC studio. That should be worth at least 30 billion. And then they have the theme parks, and the theme parks are really growing at a nice pace for them. We did some analysis. We said that the theme parks for NBC should be worth at least 40 billion. So you have an asset here which is really kind of undervalued under the Comcast umbrella. So they need to do something, and they need to do it quickly.
Geetha, I've always thought two of the key advantages for Comcast are, one, their management team. I've been a big fan of Brian Roberts and his management team for a long time. And the second thing is their balance sheet. They've got a very strong balance sheet. But there's not a lot out there for them to buy. What do you think they should do?
I think the first thing that they should do, Paul, is spin out NBC. So NBC under the whole Comcast, family thing is just not working out. I think the ultimate route will be for them to spin out NBC, maybe, kind of become this roll-up vehicle. Maybe they combine with some other assets, some of the smaller players out there. Could be an AMC Networks, could be a Lionsgate. Of course, nothing is necessarily going to be transformative, but, at least, maybe once they're spun out, maybe they become an interesting target for Netflix. I mean, who knows? Netflix has already kind of gone this whole M&A route. Maybe Comcast becomes interesting to them.
I see Fox out there, and I would call them a subscale player too, but boy, they're doing fine, it seems like. They're broadcast, and their whole audience, they've got that editorial thing down. They know who their audience is. What do you think they do?
Yeah, so the end game for them is also a little bit unclear, Paul. I mean, up until now, I think Fox has made all of the right decisions, whether it has been to get rid of some of the, challenged cable TV networks, the studio with the whole Disney deal in 2017, and really kind of double down on live sports and news. Yep. The thing is, the one big thing that we're all kind of looking at this year is going to be the NFL renegotiations, and that's going to have some serious implications for all of these companies, whether it's Comcast with, NBC exposure, and Fox. Fox is the most heavily exposed to NFL programming, and they're going to have to pay up. And so, at that point, I think that there is going to be some kind of reckoning for all of these media companies.
Geetha, thank you so much. This is great research. Check it out on BI Go, folks, to get Geetha's and all of the research from Bloomberg Intelligence. Geetha covers the media industry for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories. Global business headlines are coming up in just moments, with the S&P up 55 points, 0.8%, the NASDAQ up 300 points, 1.3%. For Alex Subnova, Paul Sweeney, this is Bloomberg.
CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. American officials say the U.S. military is increasing the pressure on Iran, and CBS's Ellie Watson reports there's evidence Tehran has been weakened by the bombardment.
Iran's capabilities may be slowing down. Since the fighting began, Iran's ballistic missile shots are down 86%, with a 23% decrease in just the last 24 hours. And one-way attack drones down 73% from opening days. But they're still kind of firing these projectiles indiscriminately, which is why the State Department is urging Americans to leave 14 countries days after the conflict started.
The U.S. Senate's headed toward a vote on a war powers resolution to give lawmakers an opportunity to demand congressional approval before any further attacks. It's likely to fail. House Democrats, who are also military veterans, emerged today to criticize the war. Massachusetts Representative Seth Moulton.
This isn't a war for America. This is Trump's war for Trump.
House Speaker Mike Johnson is with other Republicans in full support.
In my estimation, this course of action was necessary, lawful, and effective, and reversing it now would weaken America.
A U.S. submarine torpedoed an Iranian warship that went down in the Indian Ocean off Sri Lanka. BBC reporter Yogi Dilamay.
When they responded, they say that what the first responders saw was patches of oil floating on the water as well as some life rafts, after which they started search and rescue operations. They said that at the time, 32 people had been rescued, brought to a hospital in the city of Gaul. And when they spoke with those people, that's when they confirmed that they were on board the Iranian ship.
And there's word a ballistic missile launched from Iran and heading towards Turkish airspace was destroyed by NATO defense systems. Correspondent Michael Wallace tells us a new report today looks at some popular brands of baby formula.
Consumer Reports says more than half the powdered and liquid formulas it tested contain potentially concerning levels of harmful contaminants, including arsenic, lead, and PFAS, also known as forever chemicals. The consumer advocacy group warned babies can be harmed by repeated exposure to those contaminants, which can also be found in water.
Scientists say coastal sea levels may be rising faster than previously thought, meaning more people could be at risk for flooding very soon. CBS's David Schechter.
New research in the journal Nature finds most studies lowballed coastal sea levels by about a foot on average worldwide and up to 3 feet higher than assumed in parts of the global south, including Southeast Asia and the Pacific.
And checking Wall Street, right now a bounce-back day for stocks. The Dow is up 313 points. NASDAQ is up about the same. This is CBS News. A new image in Washington is likely to spark some disagreement.
As part of the America 250 celebration, the administration has hung a massive banner featuring a photo of Charlie Kirk on the Department of Education. It appears beside images of 19th century educators like Catherine Beecher, Booker T. Washington, along with Benjamin Franklin, Martin Luther King Jr., and Anne Sullivan. A separate banner calls them all heroes. Kirk, the Turning Point USA founder who was assassinated during an appearance on a college campus last year, was a college dropout who called higher education a scam. Deborah Rodriguez, CBS News.
The British rapper known as Getz has been sentenced to 12 years in prison for killing a 20-year-old student from Nepal in a hit-and-run in London last year. Prosecutors said Getz, whose real name is Justin Clark Samuel, was speeding and under the influence of alcohol. I'm Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
It's day 5 of war with Iran. Welcome to Balance of Power. I'm Kaylee Lines. Joe Matthew is off today as we track the developments out of the Middle East. Things are moving fast. Defense Secretary Pete Hegseth says a U.S. submarine sunk an Iranian warship off the coast of Sri Lanka with a torpedo. This as NATO has to shoot down Iranian ballistic missiles that were heading toward Turkey. And all signals from the administration is there is no sign this conflict is coming to an end anytime soon. We'll have the latest with Bloomberg's Tyler Kendall at the White House with analysis from Wayne Sanders of Bloomberg Intelligence on the actual war aspect of this. But we have to consider the economic aspect as well, and we'll do so with Chris Kennedy from Bloomberg Economics. Plus, we have results from the Texas primary. Any other day, that would be our top story. We'll get into that with our political panel. But first, let's check on these wartime markets. With that, we look to Charlie Pellet.
Thank you very much, Kaylee Lines. We are looking at the Dow, the S&P, and NASDAQ all advancing, equities rebounding after data this morning showed the U.S. service economy expanded at the fastest pace since mid-2022, while a price index hit an almost one-year low. The S&P 500 index up 60 at 68.77, gain there of 0.9%. Dow Industrials up 328 on the Dow, gain there of 0.7%, while the NASDAQ Composite Index right now up 330 points, up 1.5%. The NASDAQ 100 Index up 1.7%, and the Russell 2000 Index of small-cap shares up 1.2%. The 10-year currently yielding 4.06%, with the 2-year 3.51%. The VIX, by the way, just below 21. Spot gold is surging 1.2%, up $63 the ounce now to $51.51. West Texas Intermediate crude lower, little change, down 0.1%, $74.49 a barrel, and Brent down 0.1%, $81.32 for a barrel of Brent. Right now, we do have Bitcoin surging 8%. Bitcoin 73,487 on Bitcoin. One of the big questions for economists and investors is what the Iran war means for inflation. Mira Pandit is global market strategist at J.P. Morgan Investment Management.
Our expectation is that it will be modestly inflationary, but likely not stagflationary, because you still have the benefit of timing here around the One Big Beautiful Bill Act and the stimulus payments to consumers and taxpayers, which essentially will alleviate some of this pressure if we have upward oil prices, which so far have been relatively well contained. But you do think about some of that putting a bit of upward pressure on inflation.
Mira Pandit of J.P. Morgan Investment Management. Oil, as we mentioned, is moving lower, and so are oil stocks. Case in point, ExxonMobil among the oil majors down 1.3%, Chevron down 1.4%, ConocoPhillips now down by 2.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your host, here she is, Kaylee Lines.
All right, Charlie Pellet, thank you so much. Again, we are now in day 5 of the conflict raging with Iran. U.S. and Israel both continuing airstrikes, and Iran continuing its own retaliation as fresh headlines are crossing the Bloomberg terminal now about residents in Abu Dhabi hearing blasts. Things are showing no sign of slowing down, and the administration is showing no sign of slowing down as it fans out across the airwaves to message this conflict, why it had to happen now, and why it is going to continue. The White House Press Secretary Caroline Leavitt is scheduled to brief the media at 1 p.m. Eastern time, so just about an hour from now. I'm sure she'll be getting questions about the president's promise yesterday to provide insurance and, if necessary, naval escorts to vessels in the Strait of Hormuz to try to stave off an energy supply shock. And, of course, we also heard this morning from military leadership. The Defense Secretary, Pete Hegseth, once again briefing the media alongside the Joint Chiefs of Staff Chair, General Dan Kane. And Secretary Hegseth signaled that the end to this conflict is not yet near.
As President Trump said, more and larger waves are coming. We are just getting started. We are accelerating, not decelerating. Iran's capabilities are evaporating by the hour, while American strength grows fiercer, smarter, and utterly dominant. 4 days in, we have only just begun to fight. America fights to win, and in Operation Epic Fury, we are.
For more, we go to Bloomberg's Tyler Kendall, who is live on the North Lawn of the White House. Tyler, the suggestion that we have only just begun, we're only getting started. How far away is the end to this conflict?
Well, Kaylee, that's one of the biggest questions as U.S. officials this morning, as you heard, reiterated that the U.S. has no intent to let up this military campaign, in part offering that the U.S. has enough weapons stockpiles to last this military campaign as long as possible, though officials did decline to quantify just how much stockpiles we have, citing an operational risk. But on the operational front, we got some more details about exactly where this military operation is headed. We heard from Secretary Pete Hegseth. They are saying that the U.S. and Israel now have what is being called uncontested control of Iran's airspace, and that we should expect the military campaign to enter into this second phase where we're going to see the U.S. advance further into Iran's territory with some deeper strikes inside of the country. The Joint Chiefs of Staff, Dan Kane, laid out here that the U.S. has now struck with Israel more than 2,000 Iranian targets inside of the country, and confirmed that for the first time in international waters since World War II, we saw a U.S. submarine sink an Iranian naval vessel. So some pretty big escalation here, as there are questions about what would it take for there to be a potential diplomatic off-ramp. I'm sure you saw the reporting earlier today from the New York Times, which is saying that Iran had reached out a day after the attack through an intermediary to the CIA to put on the table the potential for negotiations. That's putting a little bit more granular detail on what we were already expecting, considering that we had heard from President Trump that Iran had reached out, and he is saying that it is, quote, too late. Or we heard from Oman's foreign ministry in a post on Sunday saying that Iran was interested in some serious efforts at de-escalation, but then heard from Iran's security chief that that was not true. So, Kaylee, it's a very fluid situation, but the one constant seems to be that the U.S. is accelerating this military campaign. At least that's what officials have been telling us today.
Yeah, Iran pushing back on that report, of course. The semi-official Tasnim news agency called it pure falsehood and psychological warfare, and that's a quote. But Tyler, to your point about whether or not there's a diplomatic off-ramp, this is actually something that a former Secretary of State, Antony Blinken, spoke about earlier today with our colleague David Gura. Listen to what he said.
It's never too late for diplomacy. The question is there a good moment? Is this the right moment for it? I would hope so, because on one level, the Iranians have never been weaker, at least not in recent memory, militarily, politically at home, diplomatically abroad. And their proxies are for the most part gone or vastly diminished. So that's why I was hopeful before this action started.
But the action, obviously, Tyler, has now started, and it started without the express go-ahead from Congress. We are expecting a war powers vote in the Senate today. Tyler, is there any likelihood that if it passes, and if it passed, is there any likelihood President Trump would sign it?
Kaylee, I think both of those answers are probably likely no, considering that we did hear from one vote that we were watching considered to be a swing vote. That's Senator Todd Young, a Republican from Indiana, who came out today and said that he is going to vote against this war powers resolution. So it doesn't, we'll keep it tracking. Of course, anything could happen here, but let's say it did pass. Let's say it did pass the House and it ends up on President Trump's desk. President Trump is very likely to veto it. Then, as you well know, there would need to be a 2/3 majority in each chamber to override that veto. Instead, this is much more considered to be a symbolic vote, a pressure by lawmakers on this administration to continue to share more information, because, as you well know, lawmakers have been demanding it. They say that they want more about what started the thrust for the U.S. to begin this military campaign. But I would say on the Republican side, what to really watch out for is questions about the timeline, because while President Trump does have the backing of broad support, I think it's fair to say, of Republicans when it comes to this military campaign, you're starting to see those questions emerge about just how long this will last, particularly since we haven't heard the U.S. rule out the potential that we could see American boots on the ground.
All right, Bloomberg's Tyler Kendall, thank you so much. And we want to get more analysis now on the military aspect of this conflict as we turn to Colonel Wayne Sanders. He's Bloomberg Intelligence Senior Defense Research Analyst and joining me now. Colonel, appreciate your time as always. I'd like to begin with what Secretary Hegseth confirmed today, that the U.S. used a submarine and a torpedo to sink an Iranian warship off the coast of Sri Lanka. We haven't seen the U.S. take that kind of action since World War II. How significant is that?
Well, I think it's a pretty powerful message to Iran, as well as to any of our other adversaries as well. President Trump has used his submarines in the past as almost a force projection multiplier. He puts it out there and says, hey, they're somewhere out here. You don't know where they are. But now he's actually taking it to that direct action in international waters, which is saying we are prepared to escalate this beyond where we stay inside of the regional borders. And I think that ends up being a key part to this as well is, when we look at where we are geopolitically right now in the region is, hey, look, we're not going to just let you continue to do things outside of the region. We're going to take anything that's tied into Iran. We're going to take those things into consideration. And so, once again, they have put their money where their mouth is, and the Navy has been able to deliver.
Well, let's talk some more about money, because Secretary Hegseth and General Kane, like Trump yesterday, both suggested we essentially have the munitions to carry this on indefinitely. Is that true? And if it is true, at what cost?
Yeah, so I think this is one of the biggest things that I pulled out of that meeting this morning was when he talked about the difference between standoff ranges and being able to bring in gravity-fed, gravity precision bombs and other things like that. That does play a huge part. When you look at how long it takes from a production ramp to do a PAC-3 interceptor, for example, right? There's only about 600 per year, and Lockheed is building out to about 2,000 per year over the next 7 years. So it's going to take a while to be able to do that, right? So when you look at some of those higher-end munitions, you look at Tomahawks, about $1.5 million per. You put all these pieces together, you're looking for a cheaper answer and something that doesn't take as long. So when you start looking at that transition away from Tomahawks and JASSM missiles into Boeing's, like their JDAMs and the massive ordnance penetrators, RTX and LMT, and Lockheed both have these GBU gravity precision bombs, but we have a lot more of them. We have a much larger configuration of those, both in supply as well as forward deployed. And there's also, it's a lot easier to replenish those. So when you look at the larger picture here is the more we can actually use these gravity precision bombs and less of our other arsenal keeps us more military readiness at a higher level for any contingencies that would take place in like 2027 and beyond.
All right, Colonel, wish we had more time, but I'm sure we'll be speaking to you plenty in the days and weeks ahead. As Secretary Hegseth said, this has only just begun. Colonel Wayne Sanders, Bloomberg Intelligence Senior Defense Research Analyst, here with us on Balance of Power. And coming up, we're going to do some more analysis on what this conflict means for the global economy, whether we could see an energy supply shock, or whether President Trump's promise to ensure and, if necessary, escort vessels going through the Strait of Hormuz is going to be enough. We'll get into that with Chris Kennedy of Bloomberg Economics on the other side, right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, and NASDAQ all advancing. Very close to session highs on the S&P right now at midday. S&P up 55. That is a gain of 0.8%. So the S&P currently trading at 68.72. The Dow is up 312 points. Volatile week up 0.6%. NASDAQ Composite Index up 1.4%. The NASDAQ 100 Index up 1.6%. And the VIX currently just above 21. The 10-year 4.06% with the 2-year 3.51%. Gold is up 1% higher by $53 the ounce to $51.42. West Texas Intermediate crude up 0.4%, $74.89 a barrel. Brent crude 81.66. That is a gain of 0.3%. And Bitcoin up 7.3%. Now Bitcoin just above $73,000. Right now, we do have the Dow, the S&P, and NASDAQ all advancing. Apple shares are higher. It is rolling out the $599 MacBook Neo in its biggest push yet into low-end laptops, aiming to challenge Windows PCs and Chromebooks for budget-minded shoppers. Apple shares are gaining now by 0.5%. Coming up at 5:50 p.m. Wall Street time, an interview with Goldman Sachs Chairman and CEO David Solomon. Again, recapping, S&P up 0.8% with the VIX just above 21. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. And back we go to Washington. Balance of Power continues. Once again, here's your host, Kaylee Lyons.
All right, Charlie Pellet checking on the markets for us. Thank you so much. I'm Kaylee Lyons in Washington, trying to stay on top of all of the headlines we are following. Of course, there are many of them flying thick and fast in regard to the conflict in Iran and the ongoing combat operations in the Middle East. But there's another headline I wanted to bring your attention to here on Bloomberg. The White House has made it officially submitting the nomination of Kevin Warsh to be the next chair of the Federal Reserve to the United States Senate. We knew that was coming. Now it has come. Of course, it doesn't mean that there's any guarantee Kevin Warsh is going to be able to be confirmed anytime soon, as you still have Senator Tom Tillis willing to hold up any Fed nomination over the investigation into the Fed that is not yet been concluded as he so desires. And of course, Kevin Warsh, who has made the case for lower rates, is probably going to have a little bit more of a difficult time justifying that if we are to see some kind of energy supply shock emanating from the conflict in the Middle East, if oil prices go up, if that leads to some kind of reinflationary spike, it gets harder to make the case to ease policy. But of course, there's no guarantee that will happen, and there's no guarantee necessarily what the Fed will do next and how the conflict in Iran is going to factor into that. Our colleagues on Bloomberg Surveillance tried to get a little bit of insight into that from a Fed governor, Stephen Myron, who of course used to be at the Council of Economic Advisors in the Trump White House until recently, weighed in on the conflict and what it means for his thinking around the economy. This is what he told them.
At the moment, I think it's too early to sort of have any firm views as a result of that. Oil's gone up a bit, but the major question is, does oil stay up or does it come back down? And that'll, of course, will depend on how things play out. But even that said, even if oil stays at these types of levels, to me, it's difficult to get a lot of read-through as a result of that. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
So some people who come on the program spoke to Lisa and I and said these Federal Reserve officials might be conditioned by the post-pandemic experience coming out of 21 into 22 and the inflation spike then and the energy shock that developed at the time emanating in Russia. Is this different? Are we in a different place?
I think it is. I think that attitude is a little bit of fighting the last war. And I think that the Federal Reserve for decades has had the view that, that headline inflation shocks like oil are best looked through, and you sort of focus on core inflation because it's indicative of where inflation is going to go in the future, and you focus on the labor market. And that type of reasoning leads you to look through an oil shock. Now, of course, what happened in 2022 was a bit different because the other policy settings were different, right? Don't forget, monetary policy was as expansionary as it had ever been at the time. Fiscal policy was injecting trillions of dollars into an economy that was recovering thanks to vaccines and medical improvements and COVID passing on its own. And so the policy environment was very different. And so was very easy for a slightly inflationary shock to feed through into the broader economy and create this type of persistent inflationary problem that the Fed dealt with. We don't have that right now. We don't have fiscal policy that's slamming on demand. In fact, if anything, supply is moving out quite aggressively, and monetary policy is still modestly restrictive in my view. So the policy settings, the economic environment is different. To focus on that, as you described a moment ago, to me, is fighting the last war. That was a unique circumstance.
At the same time, some people have argued that the January jobs report raised a question about just how weak the labor market actually was. Even Governor Chris Waller came out and said, okay, now it's a coin flip for whether we should cut rates at the March meeting. If we do get confirmation of that strength with the February payrolls report that we get on Friday, would that make you rethink whether March was an appropriate time to cut rates?
So look, for me, we've got 2 years of a trend, 2+ years of a trend of gradually weakening labor markets that sort of set in 2023. It's way too early to reject the notion that that trend continues based on 1 or 2 labor market reports. And when you look at the totality of labor market data, there's still evidence to me that it needs more support from monetary policy.
Of course, it is not only monetary policy makers and deciders who are trying to weigh what's going to happen with oil prices. It's of consequence for those who focus on fiscal policy and politics as well. President Trump himself has acknowledged that this conflict could lead to higher oil prices, at least for a time. It's something he spoke about in the Oval Office yesterday as he was joined by the German Chancellor, Friedrich Merz.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible.
And perhaps it's because of those economic considerations at home and abroad that President Trump is now suggesting the U.S. is going to provide insurance and, if necessary, naval escorts to vessels that need to transit the Strait of Hormuz and bring, of course, energy supplies, oil, LNG, along with them. Now, our team here at Bloomberg Economics is out with some analysis on that today, writing in part questions over the bureaucratic ability of the U.S. to address insurance needs and the state of Iran's remaining military capabilities cast doubt on that effort. One of those co-authors is Chris Kennedy. He's Bloomberg Economics lead for economic statecraft, and he's here with me in our Washington, D.C. studio. So, Chris, just talk to me more about the remaining question marks here and how this might not necessarily be an instant Band-Aid to the Strait of Hormuz problem.
Sure. Thanks, Kaylee. So last night, President Trump announced that the DFC, the Development Finance Corporation, would be providing insurance for vessels transiting the Strait of Hormuz. This is not something that's completely out of the wheelbox of DFC. DFC is authorized to provide political risk insurance, including, dealing with situations of war or potential political violence. But the challenge is that we're talking about hundreds of vessels that are transiting the strait, and DFC's budget is limited, and its bureaucratic ability to do these transactions is also quite limited after a year of attrition of workforce, et cetera. So we think that there are some pretty significant problems there. There's also the political challenge. Most of the oil and gas that's flowing through the Strait of Hormuz is not bound for the U.S. There's not a direct benefit to U.S. taxpayers, and so justifying that when most of this is going to Asia might be challenging.
Okay, so you mentioned the budget constraints. What kind of price tag are we talking about here to provide this insurance?
Yeah, so some estimates suggest that each vessel, especially the oil and gas LNG tankers, would have to be insured between $500 million and $1 billion. That's a pretty substantial, yes. Hundreds, because you're talking about the risk of a potential environmental incident, et cetera, and so that's a pretty substantial hit. Now, DFC was just reauthorized and has a pretty substantial budget to work with, and of course, the way in which they score these and underwrite these policies would depend on the specific risks being faced. And if there are naval escorts, that could, in theory, reduce the risk that these vessels are facing. But that in itself is another challenge for the United States, because we do have limited naval assets, and this could tie up those assets even further when there are concerns about capacity around the world.
Well, and you mentioned the political difficulty of this, knowing that a lot of this is not U.S. bound. So let's talk about where it is bound for. Clearly, we have seen some incredible price action when it comes to natural gas in Europe. Europe is concerned about a second energy shock after the one they experienced with Russia in 2022. And then there's China, which gets a lot of oil from Iran. Is China actually the one that perhaps stands to benefit the most from the Strait of Hormuz being secure for transit?
Yeah, China gets about, I think the last number I saw was about 40% of their energy supplies from the Strait of Hormuz. Now, most of that is not actually from Iran. It's from the other Gulf countries that are producing oil and gas. And yes, I mean, the U.S. now is a net energy exporter of both gas and oil. So while we do still import, and these are complicated relationships in terms of refining and the specific products being produced, yes, Asian buyers tend to be the beneficiaries of most of the oil and gas exiting from this part of the world.
And I made reference to the idea that Europe already has contended with one energy supply shock due to the war between Russia and Ukraine. I do want to talk about Russia because you also have a piece of research out about this. I would point out that Russian President Vladimir Putin just was speaking, saying that Russia remains a reliable energy supplier. Is Russia also potentially a net beneficiary here if we are to see this plan from the U.S. not work and oil prices go higher?
Yes. So we've been following this for the past couple of months. Russia was facing a really significant budget shortfall this year, in part because of a global glut of oil. So Russia depends on oil and gas revenues for about a third of its government budget, and about 80% of that is from oil. Oil prices being so low, government receipts in January were 50% below the previous year. And, Russia was facing some pretty significant budget cuts. We estimate that if there is a full closure of the Strait of Hormuz and it persists, that could raise oil prices to close to $110 a barrel. That would effectively eliminate Russia's budget deficit. Wow. And they've been really investing in a transcontinental pipeline and getting supplies out to the East Coast near Vladivostok, which is directly, right next to the big Asian markets that they're supplying. So they're in a pretty strong position to deliver that oil to the Asian buyers that are going to be most affected by a complete closure.
It's striking to me politically that President Trump came into office saying, I'm going to lower costs, including costs for gasoline. I'm going to end wars, not start them. I'm going to bring peace. And now we're talking about a war that the U.S., well, it said was necessary because of an imminent threat. The president did decide to start, and that it could actually potentially make it more difficult to end the other war he wants to see come to a close because it continues to fuel Russia's war machine. That's the reality you're describing here.
You're exactly right, Kaylee. And so, we can't get into the president's mind, but I do think that the global oil supply glut has given this president the confidence to go out and do things like, for instance, the operation that captured Maduro, and now we're seeing an operation in Iran. We'll see how this goes. I think most people expect that at some point this conflict will have to at least tamp down a little bit. We're not going to see a prolonged closure, but your point is exactly right and reflects sort of the unintended consequences that come with a conflict as complicated as this.
And in our final moment here, when we say prolonged closure, what time period realistically are we talking about that would get us to $110 a barrel or something in the triple digits?
I mean, I think it's more about what we see on the ground. So if we do see a sustained number of attacks on vessels that are transiting the strait, that would shock oil markets and raise, the price of oil to 110 or even higher. I think Citi came out with an estimate of about 120. Now, how long that persists, I think it just depends on the confidence and whether or not we can get, commercial insurers back into the game, et cetera.
A lot of question marks, but your analysis we so appreciate as we try to work our way through all of the implications of this conflict. Chris Kennedy, Bloomberg Economics lead for economic statecraft, here with us on Balance of Power. And we still have much more ahead. We got to talk about the fact that we had primaries yesterday. We got the results, and we'll look to Texas with our political panel next, right here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. The S&P 500 index holding close to session highs, up 58 now. That's a gain of just about 0.9%, 68.76. Equities are rebounding after data this morning showed the U.S. service economy expanded at the fastest pace since mid-2022, while a price index hit an almost one-year low. The Dow up 321, now up 0.7%. Again, the S&P up 0.9. NASDAQ is up 1.5%. The NASDAQ 100 index up 1.6%. The VIX just below 21 now, with a 10-year at 4.07%, the 2-year 3.52%. Gold is up $44 the ounce to $51.33. That is a gain of 0.9%. And West Texas Intermediate crude just above $75 a barrel, up 0.6%. Brent now higher by 0.3%. A major move for Bitcoin, up 7.5%, 73,140 on Bitcoin. U.S. Treasury Secretary Scott Bessent on CNBC today saying that President Trump could raise global tariff rates to 15% sometime this week. Bessent telling CNBC the duties will kick in for 150 days under Section 122 of the Trade Act.
During that time, during the 150 days, we will see studies from U.S. TR on Section 301 tariffs, from Commerce on Section 232, and it's my strong belief that the tariff rates will be back to their old rate within 5 months.
Treasury Secretary Scott Bessent on CNBC. Earnings news. Germany's Bayer is forecasting profits and sales to be little changed in 2026 as the company grapples with generic competition for its blockbuster blood thinner and continued uncertainty over its efforts to contain pesticide litigation in the United States. Shares of Bayer, the ADRs, are up now by 0.6%, and Adidas shares tumbled to a 3-year low after the sportswear maker's earnings forecast disappointed investors. Adidas down by 4.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Balance of Power continues. And once again, your host, here she is, Kaylee Lyons.
All right, Charlie Pellet checking on the markets for us. Thank you so much. I'm Kaylee Lyons here in Washington, where conversation over the last 5 days, no surprise, has been dominated by the fact that we are in active combat operations still in the Middle East, the U.S. and Israel in war against Iran, which is why this is not our top story today here on Balance of Power. In any other context, it likely would be. We had primaries yesterday in North Carolina and Arkansas, which weren't too exciting, but most crucially in the state of Texas, where a Senate seat is in play in this midterm election cycle. And the primary results in that Senate race on both the Democratic and Republican side were interesting. On the Democratic side, you have Texas State Representative James Tallarico, who was relatively unknown until just months ago, a devout Christian, a young rising star, at least as he's seen in the Democratic Party, who says he can appeal to moderates in the general election. He beat out Congresswoman Jasmine Crockett in the Democratic primary, a victory that was perhaps marred slightly by confusion over Democratic polling sites in Dallas County, something that Crockett was very quick to call attention to, even as Tallarico celebrated.
We were able to keep the polls open, but I can tell you now that people have been disenfranchised.
Tonight, our campaign is shocking the nation. We are still waiting for an official call, but we are confident in this movement we've built together. Every vote must be counted. Every voice must be heard.
Of course, the official call has come and Crockett has conceded. So it will be James Tallarico in the general election in November. Who he'll be up against, though, still an open question, because on the Republican side, we are heading to a May runoff. It was a three-way race between the incumbent, Senator John Cornyn, Texas Attorney General Ken Paxton, and Congressman Wesley Hunt, and none of them could garner the 50% needed to cross the threshold to avoid a runoff. So we're going to see much more money spent in this race, where already tens of millions of dollars have been spent by Senate Republicans and affiliated groups in order to try to protect John Cornyn, because he is seen, at least by establishment Republicans here in Washington, as the person who would most easily defeat James Tallarico. So let's get into this now. with our political panel. Jeannie Shanzano is with me, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, and of course, Bloomberg Politics contributor, alongside Maura Gillespie, who's a Republican strategist and founder at Blue Stack Strategies. Welcome to you both. Jeannie, I want to start with you first and with the Democrats first, because that was the conclusive result from last night. What should we glean from Tallarico's victory over Congresswoman Crockett?
Yeah, I mean, and this is a guy, Kaylee, and I think you described it perfectly. Many people on the Democratic side seeing him as a potential rising star. You hear people banding about names like similar to or reminiscent of Barack Obama, Beto O'Rourke, with enormous oratorical skills. Really, really good. He's been on your show on Balance of Power, really good on the medium with social media, young. And he was, I think, 18 points behind not that long ago. And he rose up to win. And he won in a pretty substantial way. I think the last numbers I looked at, he's about 7 points ahead. So Democrats have really gotten what they want here. Texas Democrats, it's been like since 1994. Some of my students weren't even alive last time Democrats won a statewide seat in Texas. But with somebody like Tallarico, I think many Democrats feel like they are halfway there to getting the perfect setup to potentially capturing this state. You know, it all depends on what happens on Maura's side of the aisle and the Republicans, because their dream is, of course, to run against Ken Paxton. And I think Cornyn, with his, 1-2%, win there, or at least capturing more votes and getting to this runoff, really took some people by surprise.
Well, so I wonder, Maura, how you're viewing this, and if you are surprised, because we were being told yesterday and in the lead up to this primary that Republicans were concerned about Tallarico winning, especially if there is a chance that he is going to go up against Ken Paxton come November, which we obviously don't know yet. But how nervous are you feeling about this afternoon?
I mean, I think that Tallarico versus Paxton is a really good sign for Democrats, but the amount of money that's being spent on this primary alone, when you're coupling that with the messaging that Republicans and Democrats alike have been focused on when it comes to affordability, I think it really does fall flat when it flies in the face of what everyday Americans are facing. And you're just talking about tens of $billions on a primary alone, now going to a runoff, and that's even before the general election takes place. So I think that that's a conversation that needs to be had internally. As you run campaigns, it does sort of become this question of how much money are we spending in this country on elections alone, and not even just elections, on campaigns. It's one thing to spend money on elections, but it's a whole other thing on these campaigns themselves. They drag out, they cost a lot of money, and for a messaging tactic, I just think it kind of is poorly done for both sides, but right now for Republicans. And when it comes to Cornyn, yes, the NRSC, the Republican campaign for Senate campaigns are going to be putting a lot of money behind Cornyn, because they do see him as, again, think about it, last year, a few years ago, he was considered a potential, instead of having John Thune as Senate Majority Leader, Cornyn was in the running, and now he's contending for a primary. So it just really does show you where he stands in the GOP, as far as you said, establishment. But for the future of the party beyond Donald Trump, it does matter.
Yeah, it's incredible that he was one of the Johns we were talking about would be the next after Mitch McConnell. It was going to be John Thune, maybe John Barrasso, or John Cornyn, and now he is a John very much in danger. Maura, just quickly on the idea that, yes, they're going to have to spend more money between now and this runoff in May, but talk to us about runoff election dynamics. Who is likely to show up for a runoff vote? Because we already know primary voters are more politically engaged than the average member of the American electorate, perhaps in general elections. What about the runoff voter? Who would that favor?
So you would think that it would favor Ken Paxton, because it tends to lean more conservative. But it also tends to lean to people who are more motivated. I do think what Cornyn's team needs to do, and they already had that ad out, which is pretty blistering, but point out the contradictions. Ken Paxton says he's his family man, he's a devout Christian, all these things, and then he cheated on his wife, and that's the ad that Cornyn's team is running. And then he got his daughter to do an ad saying that he's a great family man. So I think that, at a certain point, voters are going to be tired of being lied to and feeling that there's a walking contradiction that's trying to tell them that he's, running on these principles. That does he have them? Does he have the values that they have? Does he share them? And Cornyn can speak to that, and I think he will. But you are seeing, this divide there, and it's going to get ugly because of these things that are going to pop up. And You're going to see Ken Paxton sling at John Cornyn about not being true MAGA, but does that really hold? And I think as we get closer to the midterms, and as we kind of get through these fracture points that the Trump administration is already having, because what they're standing for is not what they ran on. And there's a lot of conflicts within the cabinet and a lot of egregious spending and things that are going on in Trump world that don't reflect the struggles of everyday Americans and the people who elected him to be president in the first place. So I think that if Cornyn's team can draw that distinction, they'll fare better by reaching their actual voters and speaking to the people who they're looking to elect them, not to Trump world.
Well, so Jeannie, I want to get back to the money dynamics here, because as Maura was pointing to, the Republicans are going to have to spend a lot even before we get to the general election. But Democrats are going to have to spend a lot on the general election, right? This is going to be another election cycle in which we see, in the hopes of turning Texas blue, which they have hoped for decades and not succeeded in, they are going to have to deploy a lot of capital. Does this risk being kind of a financial sunk hole, if you will, for Democrats once again, when there are other states in play in these midterms as well that they need to think about deploying resources to?
Yeah, absolutely. And I think so much of it depends on the outcome of this runoff. And, you think about the 70 million Cornyn spent to get to a runoff. And then by one estimation, I heard, Kaylee, 100 million could be spent in the next 12 weeks. That is astonishing. Democrats want to try to take advantage of that if Donald Trump stays on the sidelines and get Tallarico out there for precisely the reason that you're talking about. So they have a leg up once this general election is set, and they're hoping again that it's Paxton. But, I was listening to John Thune today say that he is once again going to try to get Donald Trump to endorse for the money reason, and also because he wants to avoid what he said was would be a spirited campaign, which is probably another word for a really ugly, nasty campaign, which Cornyn yesterday said was going to be coming, and he had a lot more Oppo research to drop on Paxton. So that's what Democrats are banking, that they can get a leg up, unless, of course, Donald Trump decides to endorse. And I think that is the big thing to watch. And to your point, this cycle has always been tough for Democrats in the Senate. I don't think in their wildest imagination they thought that Texas was going to be doable. It's still a long road to hoe there. But the fact that last night they got Tallarico and may get a Paxton against him really is a bright spot for them. And I think you're going to see tons of money pour into this race to try to get them over this historic hump in Texas.
Well, Maura, I want to talk more about that elusive Trump endorsement and whether or not that's likely to come and what impact you think it will have, knowing, for example, that one of the incumbents who has officially lost his bid for re-election yesterday, Republican Congressman Dan Crenshaw, was defeated in his primary. He didn't have the Trump endorsement. Is that a lesson that if and when Trump decides to speak on this Senate race, it will be definitive?
I think when it comes to the Senate race, it's a little bit different than some of these districts where, yes, Dan Crenshaw had gotten into a little bit of trouble, and I think that the Ted Cruz late endorsement of his opponent, Steve Toth, maybe swayed some people in that area in the Woodlands. But by and large, I think for Senate as a whole, Trump has to realize, and he did realize during this first primary, right, that endorsing Ken Paxton was problematic for the party at large. And so he chose not to, and I'm glad that he chose not to. I don't know that he can get over his own ego and not endorse Ken Paxton. I think it's going to be a matter of John Thune and those in the NRSC showing Trump what they have on Paxton, so that not to embarrass the president. And if they frame it in that way, maybe he will go ahead and throw his support behind Cornyn. But I think a lot of it comes down to he wants those who are going to, I hate to say it like this, but bow down to him in order to get his endorsement. And unless they do that, he's not willing to give it. And I think that financially, the amount of money that's being spent on this campaign and this primary and to the general, it takes away from other races that the Trump administration needs. If they don't want to have a repeat of what happened in his first term with impeachment hearings and things of that nature, then they need to be putting more of their focus on winning and not just playing to the president's ego.
Okay, Maura Gillespie of Blue Stack Strategies, Republican strategist, alongside our Democratic analyst, Jeannie Shanzano, Democracy Visiting Fellow at the Harvard Kennedy School's Ash Center. Thank you both. You'll, of course, be back for more in our second hour of Balance of Power. As we shift from domestic politics back to geopolitical affairs, we are continuing to monitor the conflict in the Middle East, war with Iran now in day 5, and we are expecting to hear more on that from the White House Press Secretary Caroline Leavitt. She's scheduled to begin briefing the press just about 5 minutes from now at 1 p.m. Eastern Time. So stay with us for coverage of that and much more right here on Bloomberg.
Washington, D.C. This is Balance of Power with Joe Matthew and Kaylee Lines.
The war with Iran enters its 5th day. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines. Joe Matthew is off today as Defense Secretary Pete Hegseth says this conflict is only getting started. We'll have analysis from former U.S. CENTCOM Commander General Frank McKenzie this hour. And we'll also hear from the former Secretary of State Antony Blinken, who sat down with Bloomberg's David Gura about whether there's any path forward for diplomacy. And of course, the Middle East is not the only thing we have to follow today. There will be a meeting at the White House this afternoon with big tech executives over energy costs and how to protect consumers from rising electricity costs over AI. We're going to have an Amazon executive join this hour as well. Holly Sullivan, Amazon's Vice President of Worldwide Economic Development Policy, will be with us in just moments. But we begin, as always, with a check on the markets as they continue to contend with geopolitical risk. And for that, we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kayla. Lines just about the best level of the day on the S&P 500 index. Right now, looking at a gain of 61 points. We are at 68.77. That's an advance of 0.9%. Dow Industrials up 334 on the Dow. Gain there of 0.7%, while the NASDAQ Composite Index up now by 1.5%. NASDAQ 100 Index doing a little bit better, up 1.7%. Techs are rallying. The Russell 2000 Index of small cap shares up 1.1%. All of this with the VIX just below 21. The 10-year at 4.07%, the 2-year 3.52%. Gold is up 1%, 51.41 the ounce. West Texas Intermediate crude oil now gaining 0.6%, 75.07 a barrel on WTI. Brent up 0.3%. The global benchmark now at 81.60 per barrel of Brent crude. Big story for Bitcoin. It is surging today by 7.7%. Bitcoin now at 73,252 on Bitcoin. Coming up in under an hour, we will be getting the latest report on the economy from the Federal Reserve when we get the Beige Book report. Jet fuel prices are soaring around the world due to fallout from the Iran war, adding to concerns about global inflation. Among U.S.-based airlines with significant overseas exposure, American Airlines up by 1.1% right now. United lower by 0.6%. Delta right now trading down by 0.6%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Balance of Power continues. Once again, your host, here she is, Kaylee Lines.
All right, Charlie Pellet, thank you so much. Here in Washington, we are, of course, monitoring all of the developments from all different facets of the administration when it comes to the ongoing war with Iran and the messaging around it. We are expecting the White House Press Secretary Caroline Leavitt to speak with the media and answer questions any minute now. That briefing was scheduled to begin at 1 p.m. Eastern time, and we'll, of course, bring you any headlines from it. But we also received a briefing earlier today from the highest-ranking members of the military. The Joint Chiefs of Staff Chairman General Dan Kane joined once again the Defense Secretary Pete Hegseth in briefing the media and providing an update on this conflict, which in the words of Secretary Hegseth is only just beginning. He suggests that we are not anywhere near the end to these military operations, as he also pointed to the military's accomplishments, in his view, in eradicating some of Iran's military capability, including using a torpedo from a U.S. submarine for the first time since World War II to sink an Iranian warship off the coast of Sri Lanka. So clearly combat operations are still going. The question is there any path forward still for potential diplomacy? The New York Times, of course, reported this morning that Iranian operatives, the day after the U.S. began these strikes, did reach out for potential talks, though Iran is now pushing back against this idea, suggesting that that reporting was false and psychological warfare. So if Iran is suggesting it's not interested to talk, at least in terms of what it's pushing out through the media, and President Trump says the time to talk is over, what hope is there of talking? That's something that David Gura, my colleague here at Bloomberg and, of course, co-host of Bloomberg This Weekend, had the chance to speak with the former U.S. Secretary of State Antony Blinken about earlier today. And David's joining me now for more on what they talked about. So, David, what did Secretary Blinken tell you?
You know, he's an optimist, of course, and somebody who is a true believer in the utility of diplomacy. And I asked him explicitly during that conversation, did he think there's still room for diplomatic negotiations to talk, for these two sides to get together? And he said, yes, there is. We talked about what a potential off-ramp might be as well. And he said he's thinking about two things, munitions and markets, focusing on markets in particular. He does think that what we've seen in the oil market and the stock market is something that could motivate the president to think about this timetable more deeply and more carefully. Munitions-wise, he suggests that maybe the U.S. and Israel might think about how this is widened and think about the constraints they might have in terms of fighting what the Iranians are doing here. Look, you talked about the briefings that lawmakers have gotten here in recent days. We've heard from the president, we've heard from the chairman of the Joint Chiefs, we've heard from the Secretary of State, Secretary of Defense. I asked Secretary Blinken if, from all of that, he has a clear understanding of what this administration's objectives are, and this is what he had to say.
Well, look, the case keeps shifting, but the first thing to say is this, from my perspective. Once our men and women in uniform are engaged in an operation or in a war, my first thought is for their safety and for their success, irrespective of what I think about how we got there or even where this is going. So that's primarily what I'm thinking of. But having said that, we've heard a number of shifting rationales. But I think it's important to take into account that we've got to be able to hold multiple truths in our head at the same time. Is it a good thing that this Ayatollah is gone? Yes. Terrible tyrant. Is it a good thing, potentially at least, that Iran's nuclear program is, I guess, re-obliterated, because apparently it was obliterated last June, but maybe not so much because they had to re-obliterate it. Or its missile program diminished, or its Navy sunk. Yes, but to do that and to take on the extraordinary risks that go with it, without having made the case with the American people, with citing imminent threats that apparently didn't exist, I think that's problematic. And the chances of unintended consequences taking hold in any situation like this are very real, very serious for our partners and allies in the region, and for ourselves, and of course for the Iranian people. I think a big question that everyone has is, okay, have we done regime change in Iran or just Ayatollah change, which is the way it looks right now?
You brought up the argument that there was an imminent threat. In years past, you'd warned that there were a matter of weeks before Iran could develop fissile uranium. Is that an argument that's persuasive to you, so much as that's been made by the administration, that there was an imminent threat?
It's an ironic argument in a number of ways. First, as I said, they claim to have obliterated the nuclear fissile material program back in June. And now we're told, actually, no, we didn't. And a number of us warned at the time that one of the reasons why military action against the nuclear program might not do the trick is that the Iranians were likely to start to rebuild, maybe rebuild deeper underground, where we couldn't get at it. Whether that was happening or to what extent, I don't know, because I'm not privy to that information, but at least that seems to be part of the rationale. The deeper irony, of course, is that we never should have been in this position insofar as the agreement that President Obama reached, the Iran nuclear deal, the so-called JCPOA, put Iran's nuclear program in a box. It made sure that Iran could not produce the fissile material needed for a nuclear weapon in less than a year. And so if they chose to break out of the box and go for that, we'd see it, and we'd have plenty of time to be able to do something about it. President Trump tore up that agreement, said he'd replace it with something better. He never did, and that's the road that we then wound up on that led to, in some ways, to where we are today with Iran, yes, dramatically advancing its production of fissile material so that that breakout time moved from 1 year to a couple of weeks. But you don't only need fissile material, you actually need a weapon too. And I think, as has been publicly reported, our intelligence agencies and others, the IAEA, continue to conclude that Iran has not made a decision to actually weaponize. If and when they do, or if and when they did, most estimates had that timeline at a couple of years. There are different kinds of weapons, less sophisticated ones you could build on a quicker timeline. But the bottom line is that on the nuclear side, there was no imminent threat. There was, though, the fact that, yes, in terms of fissile material production, they'd gone from the Obama deal, more than a year, to a few weeks.
You know, it's interesting. I asked the secretary about how he feels about the negotiations that took place during the Biden administration. So President Biden came into office, and there was an effort to reanimate the JCPOA to try to get Iranians to agree to it once again. Those talks fell apart in 2022, and I asked the secretary, does he now think that perhaps they were trying to go for perfection instead of something that was a little more reduced? In effect, go for perfection is the enemy of the good. He said he does have some regrets about that, but fundamentally, he still pins this on the fact that the Trump administration, Kayleigh, pulled out of that deal back in the first term, and this is the legacy of the decision to do that.
Well, and I wonder, David, if he had any thoughts for you on the composition of the Trump administration and what they're doing here, both his successor, the now Secretary of State, Marco Rubio, but also those who are charged with the diplomatic efforts here who are not career diplomats like Antony Blinken. Steve Witkoff and Jared Kushner were the one leading these talks as the president's envoys. Did he share with you thoughts on that?
Yeah, he didn't want to criticize them directly, and he said what was probably missing the most here, and again, he said he didn't know the full details of this, was having the full apparatus of the State Department in those negotiations. In other words, having the technical experts who could come to the table when Steve Witkoff was there with Jared Kushner sitting across from Iranian diplomats. And he made what I think is a very salient point here. That is, Iran has a core of very highly trained and experienced diplomats who've been at this for many years. We remember Javad Zarif, for instance, who handled the deal during the during the Obama administration. These are folks who know what they're doing and are experienced professional diplomats. Of course, Steve Witkoff and Jared Kushner are not. So he didn't criticize them per se. He said that he assumed that they were operating in good faith, as he assumed the Iranians were operating in good faith here, but did note the fact that there was an inherent imbalance in the fact that there were trained diplomats on one side, and there are those who have not done this by practice or professional practice over the course of their careers.
And David, finally, when we consider the conversations you were having on Bloomberg this past weekend, and the ones that you may still have yet to have on Bloomberg this weekend, this coming weekend, knowing that all signs from this administration are we will still be actively at war with Iran, these combat operations will continue. If in the absence of diplomacy, when we consider the timeline here and the military aspect of this, did Antony Blinken share with you any concerns about the idea that we could get drawn into a quote-unquote forever war, as President Trump talks about? We have the munitions to carry this on forever if we so choose.
You know, I asked him if he fears that there is a point at which you're going to need to put U.S. boots on the ground. He said that's not a necessary thing. There's no sense that has to happen here. But like a lot of folks I talked to on the show in the days since, he has been apprehensive about how this is widening and how that's likely to attenuate the timetable here. It's certainly something that he's very concerned about. And we talked a bit about parallels to what's happening. And he brought up Syria. He brought up Libya as well, countries that were kind of roiled by civil war when their leaders were taken out. So those are very sobering examples of what's to come here. And I'll just say one thing lastly, and folks can listen to the full interview on the Big Take podcast this afternoon. Something that he mentioned a number of times back when he was Secretary of State is that if this were to happen, if there were to be some leadership shift in Iran, the regime could take the uranium that it had processed and spread it across the country, in effect, hiding it. At a moment where there is so much chaos and uncertainty about what's going to become of this country, knowing that much nuclear material is, again, scattered about the country is something that should be deeply worrying, he thinks, to those who are watching all of this unfold.
All right, Bloomberg's David Gura, co-host of Bloomberg This Weekend. Thank you so much. An important conversation with the former Secretary of State, Antony Blinken. You can, of course, hear more of that in full on the Big Take podcast. But I want to turn back now here on Balance of Power to our political panel as we consider the political implications of this ongoing conflict with Iran and what role, if any, Congress is going to end up playing with war powers votes set to take place over the coming days in the Senate this afternoon, though it is expected to fail. Jeannie Shanzano is with me, Democracy Visiting Fellow at the Harvard Kennedy School's Ash Center and Bloomberg Politics contributor, our Democratic analyst, and Maura Gillespie, BlueStack Strategies founder and Republican strategist. Jeannie, to begin with you on this war powers vote, which of course is being pushed by Democratic Senator Tim Kaine, all signs are that there will be no Republican support for this realistically, or at least not adequate support to get this over the threshold it needs to actually pass the Senate. How significant as a signal, as a symbol, though, could this vote still be if it clearly shows that it's still just Democrats on one side and Republicans in large part on the other? What's the point?
It is important. It is significant. And all of these senators need to look back at how the votes on the Iraq war, for instance, that we all remember, came back and really had an impact on their careers going forward. You have to think very, very seriously about this. And I was struck yesterday after the briefing that they got to hear people like Senator Richard Blumenthal from Connecticut say, we may be putting boots on the ground. He described himself as more fearful than ever. And also, Senator Warren came out and said, you know, if you had listened to what I listened to, essentially, you are right to be worried. They don't have a plan and they don't have an end strategy. And so I think as senators hear from the administration, this is an important vote for them to be put on record because their constituents, as we enter the midterms, have a right to know where they stand on what is perhaps the most significant foreign policy decision by this president, certainly, but by any president in the 21st century.
Well, so Maura, do you see a point at which a line is crossed, even for Republicans who by and large want to stand with the president on his decisions? If we do see ground troops going in, do you think that could be something of a tone shift in terms of what we're hearing from Capitol Hill on whether or not congressional authorization is needed?
For members to stay in line with the president between calling it war and then not calling it war and not wanting to call it war, I think that from the start of this, really, the White House has not given a good messaging tactic for Republicans to reiterate because they themselves don't seem to know what's going on. I think the lack of severity of the situation and not being serious with not only the why, but what the goal is, and being clear-eyed about that and consistent has been a downfall for the administration and will be a downfall for members of Congress who are looking to decide, where do they stake their legacy? Do they stake it with the Trump administration and kind of hope that it all pans out? Or do they decide what is best for not only the future of the country, but this act, right, and the powers that you're giving to the president long-term, not just right now, but for generations to come? And I do think that that's something that members should be thinking through. But to stay with the president just for the sake of it, I don't know if that's a great long-term strategy.
Well, there's also the question as to whether or not the president is going to ask Congress not for permission to continue military operations, but instead for more money to carry them out. This is something we got into last night on Balance of Power with Republican Senator Mike Rounds.
We do know that we've still got munitions available to us, but anytime you expend the munitions, you want to make sure that you're in a position to replace those munitions as quickly as possible. And so if, in the middle of this process over the next several weeks, they decide that they're going to ask for a supplemental, I most certainly would consider it, or as a part of the appropriations process. I think the president's indicated he'd like to go up about $500 billion in additional expenditures for the next coming year.
He also suggested to us that even budget reconciliation could be an option if this needed to be done on partisan lines, Jeannie. But could you see a scenario in which there actually could be Democratic support for this if it is money that is needed to replenish our stockpiles in order to provide for security, or even money that's needed to get Americans still stranded in the Middle East out?
I think obviously there would be support to get Americans stranded out, but I would be stunned if Democrats and, quite frankly, Republicans were willing to appropriate more money for this without any clarity on why we are there, what is the end game, and for how long. That would be stunning to me. At a time when Americans are suffering higher oil prices, higher gas prices, higher grocery prices, the list goes on and on. They elect a president who says he's going to focus on making their lives more affordable, and yet we are now in a war, and we are now in a war that is costing, by some estimates, upwards of $780 million a day, and that's probably on the low side. That we would be appropriating even more money to that would be stunning to me in this environment. And at the very least, the administration owes it to the Congress and the American people to be very clear on what the point is.
All right, Jeannie Shanzano and Maura Gillespie, our political panel today. Thank you so much. More Balance of Power is ahead right here on Bloomberg.
Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. 39 minutes to go until we get the latest report on the economy from the Federal Reserve in the form of the Beige Book report. The Dow, the S&P, NASDAQ are all advancing. S&P close to session highs right now, up 55. That is a gain of 0.8%, 68.71 where we stand. The Dow up 259, up 0.5%, while the NASDAQ Composite Index is up 311 points on NASDAQ, up 1.4%. The NASDAQ 100 Index up 1.6%. The VIX just below 21, 10-year 4.07%. Gold is up $34 the ounce to 51.22, up by about 0.6%. And Bitcoin is trading higher by 7.9%, 73,385 on Bitcoin. Oil, a major story today, keeping an eye on oil, rebounding now up by 0.5%, 74.90 on West Texas Intermediate crude. And Brent, the global benchmark, up by 0.1%, barrel of Brent at 81.50. After earnings, CrowdStrike Holdings. CrowdStrike is up by 2.8%. It projected quarterly sales that were roughly in line with analyst estimates. And Bath & Body Works out of Columbus, Ohio, it says sales will decline less than analysts expected. Bath & Body Works up now by 4.1%. Again, recapping the Dow, the S&P, and NASDAQ all higher. S&P right now up 0.8%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues now. Once again, your host, here she is, Kaylee Lyons.
All right, Charlie Pellet checking on the markets from New York. Thank you so much. Meantime, here in Washington, we are watching the White House as we pay attention to developments on a number of different fronts. Just a few hours from now at the White House, we are expecting to see tech executives getting ready to sign a pledge over energy costs for the AI hyperscalers in order to help insulate consumers from those rising electricity costs. We're going to have more on that in just a moment. But of course, the White House also very much is focused on what is now day 5 of the armed conflict with Iran. The White House press secretary, Caroline Leavitt, is briefing the media as we speak, talking about Operation Epic Fury, as it has been dubbed, being a resounding success, reiterating the goal is to destroy Iran's ballistic missiles, which is similar language, of course, to what we have heard repeatedly from administration officials, including from President Trump, both verbally and on Truth Social. But there's something else that just crossed Truth Social from President Trump I want to call attention to as well, and that is the president weighing in on the results of the Republican Senate primary in Texas yesterday. Yes, yesterday was a primary day amid all of this, and we are heading to a runoff. Neither Attorney General in Texas, Ken Paxton, or incumbent Republican Senator John Cornyn was able to secure 50% of the vote in the primary, so they will have to continue this race until May, knowing neither of them, at least to this point, has been endorsed by President Trump. But the president now says on Truth Social that he will be making an endorsement soon and will be asking the candidate that he doesn't endorse to immediately drop out of the race. The Atlantic reporting that the president is expected to endorse John Cornyn, though Bloomberg has not matched that. But we want to turn now to Bloomberg's Tyler Kendall, who is live at the White House for us on this and the other bits of news. So, Tyler, obviously the Trump endorsement in this race has been long sought, long pushed for by establishment Republicans. I guess it's coming.
Yeah, Kaylee, I mean, you really hit the headline there. It's pretty significant that President Trump says that he will weigh in on this race because you'll recall he was just in Texas last week ahead of the primary and did not make what would have been a critical endorsement, as we have consistently seen Trump-backed candidates in the Republican primary yesterday cruise to victory. But instead, in this closely watched race, we had that third candidate, Wesley Hunt, who ended up taking some of those votes so that neither candidate was able to get to the majority and then ultimately clinch the nomination. So as you mentioned, now headed to the runoff, it does appear, according to reporting, that President Trump could be weighing an endorsement for the incumbent, Senator John Cornyn, a 4-term senator who has a massive fundraising advantage that ultimately helped him move ahead in the polls, but not quite enough to clinch that nomination. But whoever does win this is going to go up against Talerico, who ended up, the Democratic nominee, who ended up ousting Jasmine Crockett. But I have one statistic to read you here because it's going to be a tough race come November. A Democrat hasn't won a statewide office in Texas for more than 3 decades. So it's definitely going to be one to watch, but it is so significant that given that stat, we are putting so much emphasis on this one race.
All right, Tyler, I do also want to address why it is that you are standing outside in the rain at the White House. You are watching and waiting for tech executives who are expected to be there this afternoon to talk about the so-called ratepayer protection plan, basically insulate American electricity consumers from the costs of hyperscalers investing in AI. Tell us more about what to expect this afternoon.
Well, we're starting to see some people arrive here. We're watching very closely because President Trump is set to convene some tech executives to try to... Looks like we have one that went in. No comment there. But President Trump is essentially trying to get these big tech companies to sign on to pledges so that they will pay their way when it comes to electricity related to data centers. As you well know, this is part of a bid to offset that burden from American consumers as affordability remains the top concern for voters. The thing is, Kaylee, these pledges aren't expected to be binding. There's no real enforcement mechanism here, so there has been some questions raised about how much teeth these pledges really will have, but I can say that senior administration officials have briefed us reporters and said that they feel that a formal public pledge from these companies could help offset some of those anxieties. We're expecting companies like Meta, Microsoft, Amazon, Google, OpenAI, Elon Musk's XAI to all be in attendance today. So something to watch for as President Trump convenes this roundtable.
All right, Bloomberg's Tyler Kendall live on the scene at the White House with her head on a swivel. As always, thank you so much. And we want to have more on what Amazon is doing in AWS when it comes to this ratepayer pledge, but also the wider investments Amazon is making into the U.S. in particular. As I'm joined now in studio by Holly Sullivan. She's Amazon's Vice President of Worldwide Economic Development Policy, and she's here with us on Bloomberg TV and radio. Holly, thank you so much for being here. I know that you yourself will not be at the White House this afternoon. The CEO of AWS will be. But can you just speak broadly about the relationship that Amazon has with this administration, with the White House on efforts like this and others?
Yeah, this is an important policy issue, so we're really excited for the administration to take a lead on this and happy to be participating in the conversation and the partnership today. This is one of many policy issues that we're focused on at the company, and we're going to continue to work with this administration, all members of Congress, just as we have with previous administrations.
Well, and of course, this administration in particular has touted frequently how much investment it sees itself drawing into the United States and that it wants to encourage via its policies. And you are making some news on that today, and we're bringing this to you for the first time here on Bloomberg TV and radio. Amazon last year, 2025, invested a record $340 billion in U.S. infrastructure in jobs. How much of that is directly due to the policies of this administration?
Well, let me back up. So $340 billion in 2025, which is a 20% increase from our 2024 investment. But if you go back to 2010, we've invested $1.8 trillion in the United States in infrastructure, employee compensation. And so this is part of what we do as a company, as we're always trying to deliver for our customers and also create those innovations and those efficiencies for our customers.
Well, and talk to us about where this money is really targeting and if we should expect it to be driven into the same kind of sectors and areas moving forward in 2026 and beyond.
The investment will be not only in data centers, cloud infrastructure, AI, but also in our fulfillment network. And one of the parts about this, and I think a fun fact, is in the last 5 years, 2 out of 5 jobs that we've created have been in communities of less than 50,000 people. So it really speaks to our expansion, our rural delivery network also, which is a $4 billion expansion that we'll be doing by the end of this year.
Well, so when you talk about job creation, I am curious about this aspect of it, knowing that, and I'm sure this isn't news to you, in the last few weeks, we've seen quite a bit of a frenzy around the idea that AI is going to come and displace a lot of people. It's going to get rid of a lot of jobs, even white-collar ones. How are you thinking about whether this is net creating new opportunities versus displacing or moving jobs around from things that can be automated and turned to AI into other areas?
I think we're in a unique position because Amazon's not only an innovator of AI, we're also a deployer and a utilizer of AI. So you can use it in all different sectors of our businesses, whether it be around employee safety. But I'll go back to that delivery network. So one of the tools that we can use in AI is ensuring that we can deliver for our customers, understanding what the demands are in different parts of the country, working on how we can deliver that package more reliable and consistent and faster speeds for our customers.
Well, and so when we consider the jobs that are being added and the people who are coming to Amazon perhaps from other places, I guess to get back to the question of, is this net more jobs in the U.S. economy? Do you see that as being the case? You're adding new positions via instead of just taking someone from, say, another shipper like UPS or something and bringing them over to Amazon?
There are net new positions. So in the last 5 years, we've created 500,000 jobs in the U.S. And so while we're always looking at how we innovate for those customers, we're also, growing in different new business lines too. We have our LEO satellites, drone delivery. Again, going back to that innovation. So yes, there'll be net new jobs.
And do you think that pace of job creation is going to be sustainable in the age of AI? I feel like this is the question everyone is contending with.
I don't have a crystal ball, but I can say
none of us
yes.
do, unfortunately.
None of us do. But we've consistently, I'll go back to that 500,000 jobs, and AI is not new in the last year or two. So if you kind of look back at the history of the job creation that we've had, we're going to continue to add jobs.
Well, do you think where you will be adding those jobs is going to be changing in this kind of new era as we see it moving exponentially? Because you're absolutely right, this isn't new, but it is moving very quickly, the speed of it.
It is moving very quickly, and we've added a lot of jobs in that AI and that data center infrastructure, but we've also equally added those jobs in our delivery fulfillment center and our corporate offices around the globe.
Well, and when we think about some of those physical jobs that may not be so easily displaced by technology or robots or LLM, that kind of thing, obviously there are concerns about workplace safety. Amazon has repeatedly said it is committing to that. Regulators don't always necessarily agree with the company, though, on that aspect. What do you think is causing that disconnect?
Sure, there's a true disconnect. I think it's also about how we're telling our story, and I think that's important. So in the last 2 years, we've invested $2 billion in our employee safety. Some of that is AI, some of it's robotics, and so we're going to continue to look at those innovations, but the safety of our employees is our #1 priority.
So when we think about state laws, for example, that have targeted specifically use of productivity quotas, things of that nature, do you see that there is justification for having that, or is the company able to address that without state and other governments getting involved?
One of the new innovations that we actually have, it's not so new, but been around for a couple of years now, employees actually can look on their own personal devices and look at their productivity. So they have control over what's being reported, and we truly believe that relationship between manager, site lead, and our employees is the best.
And finally, we just have a minute left here, Holly. I don't want to put you in a bad position, but we are obviously having this conversation in the context of what is now a hot war in the Middle East. We have seen AWS and data centers be either targeted or collateral damage, essentially, in this conflict. How are you thinking about the potential longer-term implications, both for physical infrastructure, but also perhaps economically?
I think first, obviously the safety of our employees in the Middle East is our priority and will continue to be our priority. And, ensuring that we can serve our customers also is going to be important. So we're going to continue to monitor and hope to, partner with this administration on how we can do that.
All right, we're all monitoring it, and it is obviously a fast-moving situation. Holly Sullivan, thank you so much. She is Amazon's Executive Vice President of Worldwide Economic Policy, Development Policy at Amazon, and we appreciate her joining us here on Bloomberg TV and radio. Again, in 2025, Amazon spending a record amount of money to invest in the United States. But we'll turn back more to that hot conflict in the Middle East we were just discussing when General Frank McKenzie joins us next, right here on Bloomberg.
Street, we do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, they're all advancing. S&P 500 index right now up by 0.9%. Equities rebounded after data this morning showed the U.S. service economy expanded at the fastest pace since mid-2022, while a price index hit an almost one-year low. The Dow up 295, now up 0.6%. Again, the S&P up 0.9%. NASDAQ up 1.5%, and the NASDAQ 100 index up by 1.8%. The 10-year 4.07%, with the 2-year currently yielding 3.52%. All of this with the VIX now under 21. Spot gold up $23 the ounce, up 0.5%, $51.11 the ounce. West Texas Intermediate crude oil up 0.5%, WTI at $74.92 a barrel. And Bitcoin, major move there to the upside, up 7.8%. Bitcoin at 73,355. Coming up in 19 minutes, it is the latest report on the economy from the Federal Reserve when we get the Beige Book report. Bayer says a U.S. judge has granted preliminary approval for a $7.25 billion settlement proposal aimed at resolving thousands of lawsuits over the Roundup weed killer, which have weighed on the German company for years. Bayer shares the ADR is down by 0.1%. And Apple today is rolling out the $599 MacBook Neo in its biggest push yet into low-end Mac tops, aiming to challenge Windows PCs and Chromebooks for budget-minded shoppers. Apple shares up now by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington as Balance of Power continues. Once again, your host, here she is, Kaylee Lyons.
All right, Charlie Pellet, checking on the markets on this Wednesday. And of course, it's not just any Wednesday. It is day 5 of the war in Iran. It is also the day after primary day, the first one here in the United States in this midterm election cycle. We're balancing 2 big stories at once. We will have more on the ongoing war when former U.S. CENTCOM Commander General Frank McKenzie joins us in just a moment. But we also do want to touch on Texas, because apparently it's on President Trump's mind today as well. Yesterday, conclusive victory for James Tallarico in the Democratic primary. The Texas state rep, devout Christian, seen as a rising star within the party, will be advancing to the race in November. We do not yet know, though, on the Republican side, who he'll be up against, as the race is going to a runoff, as neither Attorney General Ken Paxton or incumbent Republican Senator John Cornyn could secure enough votes yesterday. And President Trump apparently doesn't like that outcome, or at the very least is tired of this game, because he says he'll be bringing an endorsement in this race soon, and is hoping that whoever he doesn't endorse will drop out immediately. For more, we turn to Bloomberg Texas Bureau Chief Julie Fine. So, Julie, of course, the president did not endorse in advance of the first primary vote, but I guess now, as we look forward to this May runoff, he's changing his mind on that.
Yeah, well, he can also be looking at how much money was spent in the primary alone. And if that is spent in this runoff election, you're going to lose a lot of money from a lot of other races. What he did today was interesting. He basically put it out there that he is going to endorse in this race, and that he's hopeful that the other candidate will drop out of the race. If this other candidate doesn't drop out of the race, then the base may look at it and say, well, the president asked you to drop out of the race. It really puts the person that he doesn't endorse in a very interesting position, because they now have a decision to make. Are they going to do what the president asked, or are they going to go ahead with this runoff that, again, will be extremely expensive for the party, Kaylee?
Well, and Julie, how much of this is due to the fact that Republicans were hoping it was going to be Congresswoman Jasmine Crockett who ultimately advanced to the general election, who, of course, is not. Instead, it's James Tallarico.
And not only did she not advance, Kaylee, James Tallarico won fairly handily last night, or I should say in the early hours. So obviously there were some Republicans that felt that Crockett would be much easier to beat in a general election. So again, the president finally said today, or somebody said to him, you really need to get involved in that race. He made this decision. What I found very interesting about that tweet is, while he said he was going to endorse, he said soon. Does soon mean an hour? Does soon mean in a couple of days? Does soon mean he's negotiating with one candidate to get out of the race? We're going to find out in the I would imagine in the next few days, weeks, hours. He just has to decide when he wants to make that decision.
All right, Bloomberg Texas Bureau Chief Julie Fine, thank you so much. Great coverage from Julie and the team there over the last several days. It's been a long few days for them, just as it's been a long few days for all of us who are covering the ongoing conflict in the Middle East. It is the subject right now in the White House press briefing, where the press secretary Caroline Leavitt is speaking to reporters, saying at this time, ground troops are not part of the plan for operations in Iran. But of course, the question is, could they become part of the plan, as all administration officials, including the Defense Secretary Pete Hegseth, are suggesting that this conflict is not yet near being over.
As President Trump said, more and larger waves are coming. We are just getting started. We are accelerating, not decelerating. Iran's capabilities are evaporating by the hour, while American strength grows fiercer, smarter, and utterly dominant. 4 days in, we have only just begun to fight. America fights to win. And in Operation Epic Fury, we are.
And joining us now with his insight is someone familiar with Americans' fighting capability and fighting in this region in particular. Former U.S. CENTCOM Commander General Frank McKenzie is with us now here on Bloomberg TV and radio. He's now Executive Director of the University of South Florida's Global and National Security Institute. General, thank you so much for being with us. You have recently penned an op-ed in the New York Times that ran on Sunday entitled "Iran Got Trump All Wrong." In it, you write, on the so-called escalation ladder, the concept war planners have used for decades to evaluate how conflict might evolve, Iran still has options, but they are at the low end. At the high end of the escalation ladder, all of the options are ours. So, General, now that we're 5 days into this conflict, what options do you see us having that we have not yet chosen to act on?
Well, Kaylee, first of all, good to be with you here this afternoon. We're in execution of a plan that's been refined for many years by United States Central Command. And what we're seeing right now is the complete establishment of air dominance over all of Iran, which will then allow us to strike Iranian ballistic missiles, drones, and cruise missiles with a lot more efficiency and effectiveness. You've got to take out their air defense in order to do that. That's largely been done. Probably a little bit left, but we're working on that now. It will allow us to use non-smart weapons, weapons that don't require a big standoff range to drop against these targets. The plan, I think, is unfolding about as well as any CENTCOM commander would like to see. Now, there will be some surprises, undoubtedly, because war is the province of chance. But I believe we're on plan as we move forward.
Well, and when we consider the movement forward, can we continue to do so, to strike this many targets, to do it at this cadence indefinitely, as right now the Pentagon and the president are suggesting?
I think we can continue to do it until Iran recognizes that it's in their best interest to come to the table. And when we sit down at that table, it should not be as equals. It should be as victor and vanquished.
Well, if and when we get to that point, General, even if the U.S. accomplishes the entirety of what it said its objectives are with this operation in Iran, if it is no longer a threat from a ballistic missile standpoint or from a nuclear standpoint, clearly we will have expended a great deal of resources to do so, including from a munitions standpoint. And we can't just snap our fingers and get those assets back and reloaded and replenished. General, are you concerned about us being in a weaker strategic position, if not in the Middle East, specifically as it comes to Iran, when we consider the theaters elsewhere around the world that we may need to have those things in store for?
So the Joint Staff and the Secretary balance the global magazine for the United States. This is not a new problem. We've known for a couple of years now that our arsenal needs to be bigger. It needs to be deeper because of decisions that were made across successive administrations going back to the early 1990s. We do need to reestablish parts of the defense industrial base, and I believe the Department of War is acting to do that right now.
And speaking of right now, we are getting headlines out from the White House press secretary's briefing, Caroline Leavitt, with the press, who has just said that Trump has spoken with Kurdish leaders about a base in Iraq. He has not agreed on a plan to arm Kurdish forces, as there's been reporting about in the last few days. In general, given your former perch as commander at CENTCOM, I wonder if you have an opinion as to whether arming Kurdish forces is a good idea, what that could mean if he were to make that decision.
I think we should seek a variety of ways to put pressure on the Iranian regime. Certainly, arming forces on the ground is one of those ways that we could do it. And I would hope that we're exploring all of those ways to put additional pressure on them. So I think it's certainly worth taking a good hard look at.
Well, and this brings me to the other idea that this isn't necessarily just going to be strictly U.S. and Israeli military against Iran and the IRGC, that Iran also has this vast proxy network to consider here as well. And we know Israel and Hezbollah have been exchanging fire in Lebanon. How concerned are you by the proxy aspect here and the perhaps unpredictable nature of that component of this?
Always concerned about Iran's proxy network. Their global terror network, which is perhaps a better and more direct way to describe it, is certainly a weapon they have. They're probably trying to energize it now. Of course, Lebanese Hezbollah, one of their premier proxy terror networks, has been largely eviscerated by Israel over the past year or so. And I think Israel's now redoubling their attacks on them. We should worry about the potential of attacks in this country by Iran, although they have a bad track record of success in doing it. We know it remains an aspiration for them to carry out those attacks. This is not an easy country for them to operate in, and I know we're taking all the measures we need to in order to be prepared for that. I worry more, frankly, about attacks in the region against our friends and partners in the region. Iran's already attacked them directly with ballistic missiles, drones, and cruise missiles. So I'm certain they're going to use other methods to attack those countries as well. Although I would note that Iran's decision to engage countries like UAE, Saudi Arabia, Bahrain, and Qatar by attacking them directly, I believe ultimately is going to prove to be a profound strategic mistake for Iran.
Well, when we consider the proxy network, we, of course, have seen one of their proxies, the Houthis, already in just recent years having a very disruptive effect when it comes to global shipping in the Red Sea specifically. And the U.S. military was struggling to a large degree in order to make sure that waterway was secure and to kind of combat the Houthis' efforts. Now we're having a very similar conversation about the Strait of Hormuz. The president, as I'm sure you well know, General, has suggested the U.S. will provide insurance, even naval escorts, if necessary, in order to guarantee the safe passage of tankers and vessels through the strait. How difficult, from an operations standpoint, is that going to be for the United States Navy? And how many resources could we actually expend just on that effort, separate to the actual operations in Iran itself?
Sure. So I'm glad to see that U.S. Central Command under Admiral Brad Cooper have already undertaken some pretty significant steps to reduce Iranian naval capability. I don't know the count right now, but it's certainly over 20 ships sunk. At the same time, we're striking, I am certain, where Iran stores its mines, the mines that they can deploy into the Strait of Hormuz to make it difficult for ships to go through. So we're probably working very hard right now to reduce those stocks and make it hard for Iran to actually implement that part of their plan. The other part of their plan will be their vast armada of small craft that can get out into the Gulf, into the Strait of Hormuz, and interfere with shipping. We're going after them right now. What you'd like to do is prevent this from becoming a problem. Don't let these forces operate. Don't let them drop mines, because it's always harder to sweep the mines than it is to destroy the mines while they're still in their storage areas. We're very much aware of this problem. The U.S. Navy is very much aware of this problem. The Navy has trained for years to reopen these channels should it become necessary to do so. And I know that CENTCOM is giving it a great deal of attention right now.
Well, we so appreciate your expertise on this live situation. And finally, General, before we let you go, I do wonder your take on what happens when this is no longer an active situation, when we've reached the end game, whatever that may be. This is something I got into last night on Balance of Power with Israel's ambassador to the UN, Danny Danon. This is what he told me.
First, we are focused on degrading the capabilities, making sure there is no threat to Israel, to the region, to the world. And in the long run, we believe that there will be a new leadership that will be the responsibility for the Iranian people to choose. But we will create the conditions for them to actually take control of their future. Once we will create those conditions, the Iranian people will have to step up and actually choose their own leadership.
General, could creating those conditions actually require that this not just be an aerial campaign, but that the U.S. might need to put boots on the ground in Iran?
Well, I wouldn't claim to know that. I would think it would be wise for us not to leave any option off the table, and I think that's pretty much our stated position. I do agree that what we would like is a different form of government in Iran. That may be hard to get to, but that's where you want to go. Our track record of predicting the fall of regimes like this has been poor. No one saw the fall of Bashar Assad in Syria coming until 2 or 3 days before it actually happened. And while this regime has ensconced itself pretty heavily by killing all the potential people who could come to lead, I still think there's a possibility.
Yeah. All right, General, thank you so much for joining us, and please stay in touch with us as this conflict continues to unfold. General Frank McKenzie, the former commander of U.S. Central Command, here with us on Balance of Power, and I'll have much more on the late edition of Balance of Power at 5 p.m. Eastern Time, right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. This is Bloomberg Business Week Daily, and this is on a day as we await the Beige Book crossing the Bloomberg terminal. We know this is this anecdote, a compilation of Fed regional banks, but it gives us an idea of what businesses, individuals, what is the economic sentiment across the nation. We're going to wait for those heads to cross.
I was just going to say, we're going to wait and wait and wait, because sometimes that
They take a
happens with
while.
the Beige Book. Sometimes it's actually, just go to the website and read the whole thing. Sometimes. I don't know.
We got a show to do.
We do have a show to do. That's true. That's true. Hey, also this hour, Carol mentioned the U.S. economic backdrop. We did get some data that showed the U.S. service economy expanding at the fastest pace since mid-2022. A price index hit an almost one-year low. That's driving an advance in stocks today, and maybe a little bit of reprieve from what we saw yesterday.
Yeah, exactly. The economic backdrop, though, it's a reminder. It does matter. So we're going to get into all of that. Hey, we're also going to get into the trade, the short, the longer-term views, and the Trump put. Is there one that's out there? I think there's a little bit of a debate among traders and what Wall Street strategists thinks. We're going to get into that with Allie McCartney. She's back with Alignment Partners over at UBS. And then we're going to talk a little bit more about what's going on in the Middle East.
Yeah, off-ramps, a move for the first time since World War II, the latest on the president's war with Iran.
And then, hey, for something that we like to talk a lot about, and that is what Apple is up to. They've got a rollout, so we're going to get the latest on that as well.
I might get that new laptop.
Oh, really?
Yeah.
Wow.
$600.
Wow, it's a bargain.
For an Apple.
I know.
All right.
All right.
Yeah,
All right.
we'll see.
We're going to talk Apple. Right now, though, let's talk the markets. Let's get a check on that trade, equities, treasuries, all of it as we wait for those Fed headlines in regards to the Beige Book. Here is Charlie Pellet.
I thank you very much indeed. We got Apple shares right now down by about 0.2%, but the Dow, the S&P, NASDAQ, they are all pushing higher right now, with the S&P up 64. That is a gain there of just about 1%. The Dow Industrials up 270, higher by about 0.6%. NASDAQ up 360, NASDAQ up 1.6%. The NASDAQ 100 index up 1.8%. Equities are rebounding after data this morning showed that the U.S. service economy is expanding at the fastest pace since mid-2022, while a price index hit an almost one-year low. The VIX holding right around 20 now, the 10-year 4.07%. Big move for gold, up 0.9%, 51.36 the ounce. West Texas Intermediate crude up 0.3%, 74.77 a barrel. And Brent now trading unchanged. Brent, the global benchmark, at 81.40. Bitcoin is surging 8.3%. Bitcoin back at 73,674. So on a day when we do have oil little change right now, we've got oil shares declining. ExxonMobil among the oil majors down 1.6%. Chevron down 2%. ConocoPhillips down now by 3.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie there with the market rundown. Do want to point out we're not seeing a little bit of firming in the equity action coming off of the posting of the Fed Beige Book to the Federal Reserve's website. Having said that, quick check on treasuries. Charlie broke it down, but pretty much the same trade action, so not really too much reaction. We do want to get into it, though, and do a breakdown, because we also had some economic news this morning that did impact the trade on this Wednesday. Let's get to it with Molly Smith. She's Bloomberg News economics editor. She, like we, are poring over the Beige Book. Good to have you here in studio.
I'm on page 3.
Good for you. All right,
Thank
Mr.
you.
Speed
What a
Reader
fast
over there.
reader.
Yeah, a little show off.
Total show off.
What jumps out for you?
Honestly, it sounds like more of the same.
Yeah.
I know that's not very newsy, but that's what I'm reading, at least so far. But, Tim's faster than me, so maybe he's seen something different on page 5 by now.
Well, I go to page 2 and I go to prices, because I'm interested in what these districts are reporting when it comes to inflation. Prices increased moderately in recent weeks, with 8 districts reporting moderate price growth and 4 seeing slight or modest increases. Many districts reported that costs rose across several non-labor inputs, including insurance, utilities, and energy, metals, and other raw materials. an issue for inflation, or is that to be expected?
I mean, I think that the worrisome sign about that is that, remember, this all happened before the war in Iran started over the weekend. So those are really things that you might start to think about, particularly on the energy side, as far as what might be a risk for the inflation outlook here domestically, should this be a more prolonged conflict, if we really start to see a sustained energy shock in oil and gas markets. Too soon to say that just yet. And of course, if this starts to impact other parts of the supply chain and logistics, we're just not seeing that yet. But so far, it seems like this is a fairly benign looking beige book. Also on the employment side, stable is what most districts seem to report. And that's exactly what the Fed wants to see. And that really jives with the characterization that Powell and others have been saying, that the labor market appears to be stabilizing. Got that a little bit with ADP this morning, and we'll try to see that with the jobs report on Friday as well, but there might be a little bit of noise with some other factors in that one.
Yeah, I thought it was interesting too. I mean, that they highlighted things about firms continuing to pass tariff-related cost increases through to their customers. Others began to do so after having absorbed previous increases. And we thought we would get to a point in the stage where companies were like, got to move it along, got to move it along. And the other thing I think is interesting is in terms of labor, we saw wages rising at a modest or moderate pace in most districts, firms competing for talent in select areas, including the skilled trades. So, it just, to me, Molly, reminds what I feel like a lot of guests come say, that we're not quite there on inflation, and it feels like the scales are tipped that it could go higher. That's even backing out the war in Iran.
Totally. And I feel like what we've seen in the last couple of producer price indexes, so this is the wholesale inflation level, they've been very firm. You're not seeing that as much on the consumer price side, but PPI tends to lead what consumer prices see. So it's really just a matter of time then, if firms are seeing these increased input costs, that you usually somewhere down the next couple of months, that usually does translate to consumer prices.
Any of this, and we're going to talk about this at 3 o'clock with Steve Moore, a former economic advisor to President Trump. Fed Governor Stephen Miron said it's still appropriate to continue cutting rates.
Wait, he does?
Yeah.
What?
Well,
shocker.
I know.
Sorry.
But it does raise a question if anything that could happen, at least on a macro level, not just in the U.S. but outside of the U.S. with Iran, with prices as increasing because of shipping issues, because of, I don't know, what happens with energy, if that changes his view or changes anyone on the Fed view who is actually dovish right now.
I mean, I think we've known for a while Myron's an outlier here. Yeah. So we'll leave
his view. Hence why Carol was like, really?
Welcome to the show, Captain Obvious.
We'll put
Are you talking to me?
I kid.
We'll put his views
Tough
over
crowd.
in one bucket. But for everybody else, definitely much more wary of the inflation risks to the mandate, which is why the stance to keep rates on hold right now really is the pervasive view, and that especially with what we've seen with the labor market recently, there do seem to be signs more validating that stabilization stance. This doesn't call for a job market that needs immediate rescue in any way.
I want to ask you about going to the overall economic activity. And they said activity increased at a slight to moderate pace in 7 of the 12 Federal Reserve districts, while the number of districts reporting flat or declining activity increased from 4 in the prior period to 5 in the current. And they said although consumer spending increased slightly in balance, 2 districts reported ongoing declines. Many noted that sales were dampened by economic uncertainty, increased price sensitivity, and lower income consumers pulling back on spending. And again, not a new narrative, but you do wonder if there's still this feeling of unease. And should we assume this is prior to what happened last weekend in terms of the invasion on Iraq? None of that is included in here.
Yeah, no, this is before the Iran war. So this is
Iran.
Right.
Yes.
Iraq. No. Yeah, we're
I remember that one
behind us.
I remember that one too. Sorry, but go ahead.
That's all right. I mean, I think, there have been some economists lately who have raised some doubts about what we call this K-shaped economy. Yeah. So that idea that wealthier consumers are propelling all of spending right now and that lower income consumers are really falling behind. I think where their doubt stems from, not so much that the wealthy are continuing to spend, but just how much low-income consumers are not spending as much. How much are they pulling back? Mm-hmm. And when you see, I mean, granted, all of this is anecdotal data. Mm-hmm. Like, we don't have any hard numbers in this report. This is just what Fed presidents and their districts observe as far as activity in their areas. that still speaks to, though, that this trend is very much still happening.
Yeah.
And you do see evidence in the hard data that would support the idea that lower income consumers are spending less.
All right, going to leave it there. Listen, thank you so much. We're on to, though, the jobs report. Just real quickly before I let you go, what are we anticipating on Friday?
It's going to be a tough read, I think. The payrolls number, there was significant strike activity in February, as well as winter weather that could make the payrolls figure a little messy. So we're looking at the unemployment rate to keep it clean.
All right, good stuff. As always, so good to have you back in studio. Molly Smith, she's Bloomberg News economics editor.
Hey, just to reiterate the Beige Book, the Fed said that most districts expect slight to moderate growth. Employment levels generally stable in recent weeks. Fed also noting that prices increased moderately in recent weeks. 7 districts, Carol, saw slight to moderate growth.
Yeah, I want to bring up the market boards. This is, in terms of what the tone has been on this Wednesday, we did have a report earlier this morning underscoring economic resilience. We just talked about it with Molly, and cooling inflationary pressures, which has given some support to the equity markets despite the geopolitical backdrop. So what does that mean? Let's bring up the numbers for you. S&P 500, we're pretty much hovering at our best levels of the session, a gain of about 65 points. That's good for a gain of just shy of 1 percentage point. Flip it on over to the NASDAQ 100. Those big tech names continuing to feel that index higher. It's up almost 450 points for a gain of about 1.8%. And then if you take a look at what's been going on in the Treasury trade, especially coming off of some easing inflationary pressures, or so it seemed on those economic reports. Tim, we've got a 10-year back off to about 407, shorter end of the yield curve, 353.
Yeah, energy, the worst performing sector in the S&P 500. Not surprising given the run-up that we've seen. But if we look at global commodities, still WTI crude up 30% this year. Brent, Carol, up 34%.
All right, so let's get more. You've got the economic backdrop. You've got the Beige Book. Let's get a little bit more on today's trade. We welcome back Allie McCartney. She's here in studio, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. They've got just over $1 billion in assets under management back here. Good to have you here. How are you?
Thank you. It's been a week, but I'm no
only
different
Wednesday.
than you are.
Allie, it's only Wednesday.
Oh, yeah. It's been a week. I want to bring up something that Goldman Sachs Group Chairman David Solomon said he's been surprised kind of by the market reaction. And he does say it will take weeks to understand more about the situation. So I'm just curious, your take, coming off of the weekend news, what's your read?
So it is surprising, but I think as well, in a sense, this was telegraphed. You could tell in terms of the hedges that a lot of institutions had put on, that in a sense they were preparing, maybe not for full-blown war, maybe not for this level of altercation, but for some geopolitical tensions. I think what we are seeing, though, is that in general, geopolitical issues, unless they are prolonged, have a very muted effect on markets. They have a huge emotional effect on the individuals making those decisions, but they have a very short-lived and muted effect on markets. And when you're in a world like we are in, especially from the U.S.'s perspective as U.S. stockholders, which is largely what we're talking about, can something like this, in a largely energy-independent nation, by the way, derail...
Which is important,
which
if
is
you take us
very
back a couple
different.
of decades to
Very different,
Iraq
very different from China's perspective, very different from Europe's perspective right now, or even back then. But so can this, in the current form that it's in, or in what people are now just sort of prognosticating it could be, in best or worst case scenario, derail the 6th industrial revolution via AI, a double digits earning boom, a macro environment that seems to be all tailwinds, and the effects of the big, beautiful bill, both from a fiscal and a spending and consumer perspective this quarter? And the answer is probably no, that this is a buying opportunity.
If the war goes on for 3, 4, 5 weeks.
Yeah.
But if it's longer than that, like what would be the time period where you'd say, I need to reevaluate this?
So that's the right question, and I've seen it evaluated a lot of different ways. One of the ways that UBS did it that I thought was helpful to give, sort of give some perspective is because, again, what are we looking at? We're looking at, the first derivative effect, which is oil, the cost of energy, and hence inflation, which gives the second derivative effect, which is where do interest rates go, et cetera. So they put together something that said, if this lasts 6 months, and if oil goes up and is sustained at 90, for a considerable point in time. And in addition, natural gas goes up about 30%. That's probably going to take about 60 basis points off consumer spending. If it's 6 months and then goes right back the way we think, which is we end the year at $67, that's a really protracted amount of time.
Are we crazy, though, to think that this only goes 5 weeks, given that there's not really a succession plan in place and we haven't heard? I don't think it's political for me to say there's not a clear message from the White House about what happens next.
Exactly.
So I think that's what
and they
happened
seem to keep
yesterday.
saying we're going to do what we need to do.
So I
How
think
long
that's
it takes.
what happened yesterday when you saw the big downdraft in the morning. I think Monday you had a lot of technical action in terms of covering shorts, taking those hedges off. On Tuesday, I think the world was asking these much larger questions and going back to the Trump administration and like, is there a there there? Is there a strategy? So, but the question is when you say if this continues, I think yes, we are probably naive to say that it's over in 100 hours or 120 hours.
Yeah.
But what does this continuing mean? Does it mean from a human and humane perspective? Does it mean from a Straits of Hormuz perspective? Does it mean from in terms of really having had only 2 tankers go through there and a panic around energy? I think that gets abated by some of the things that they were talking about today.
Conversation at Bloomberg Invest before I think we got into an interview, and somebody brought up, and for those of us who remember 9/11 in New York City, is that if the U.S. has a track record of going into areas, removing a leader, or doing some things that on maybe the face value look like the right move, but then kind of leave, and then you kind of have an area in shambles. And I do think about what happens to Iran internally, which we've had the conversation. It's not easy to bring about change there. Have we created a bigger enemy that potentially somehow now has the U.S. in its sights in a big way? And what does that create?
So that's a little about why you've seen a lot of the volatility you've seen, why you've seen yields going up, as opposed to, in a sense, why you've seen this, like, I don't know if the word is weird or lovely flight to safety in large cap U.S. stocks.
Yeah.
Right? But I think at the end of the day, if you look at the macroeconomic environment, and if you really are completely arbitrary in terms of putting out numbers and times and effects of all of these things, what you say is, what is this going to do to the largest economies in the world in terms of what people are spending and what the rates are? And although everything you say could absolutely be true, and although we've already been through a massive shifting in balance of power, and this could exaggerate that, I think the worst case scenario is, what does this do if the entire area of the Middle East is out of balance, out of whack, and doesn't have the capacity or the desire to produce and send oil to the quote-unquote developed Western world? That's an issue. But from what we know and from where we think it is most likely the base case is to be going, it's probably maybe not 4 weeks, but not 6 months. The economic effects are manageable, and ultimately in the basis points, not the percents of what happens and changes to the beige book, changes to what the Fed's thinking. The things that are still the major tailwinds are the major tailwinds.
Yeah, it's kind of like your brain versus your heart or your emotions right now. Whenever you're here, I always want more, so come back soon. Allie McCartney, she's Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. Hey, one programming note, we mentioned David Solomon. He is going to be joining our team later on. That's at 5:45 p.m. Wall Street time on Bloomberg Radio and Bloomberg TV, so be sure to check that out. Coming up next, a NATO action, a first since World War II, an update on the war in Iran.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the S&P 500 index trading at just about the best level of the day. The Dow, the S&P, NASDAQ all rebounding. This after data this morning showed the service economy expanded at the fastest pace since the middle of 2022. So the S&P right now up by 1%, back at 68.82. Dow Industrials up 277. That is a gain of 0.6%. NASDAQ up 365. The NASDAQ Composite Index up 1.6%. The VIX just below 20 right now, just below 21 right now. We've got the 10-year 4.07% with the 2-year 3.53%. Gold is up $38 the ounce. Spot gold higher by 0.7%, 51.26 the ounce. West Texas Intermediate crude up 0.2%, 74.69 a barrel. Brent now trading lower. The global benchmark 81.34 the barrel, down by 0.1%. Big move for Bitcoin, up 8.5%. Bitcoin 73,784 on Bitcoin. CrowdStrike Holdings is projecting quarterly sales that were roughly in line with analyst estimates. CrowdStrike up now by 3.8%. Bath & Body Works out of Columbus, Ohio, they reported this morning. BBWI on the ticker up now by 3.2%. And coming up after the close of trading today, we will be hearing from Broadcom. Those shares up by 2.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, a bunch of headlines, of course, involving the Middle East throughout the day, throughout the morning. First of all, you've got the U.S. saying it would attack deeper into Iran, and the country's military capabilities are quote unquote evaporating as the Middle East war continues, Tim.
Also, NATO shot down a ballistic missile fired from Iran and headed toward Turkish airspace.
You've got a U.S. submarine sinking an Iranian warship in international waters. That coming from the Defense Secretary Pete Hegseth here in the U.S., marking the first time since World War II that an American sub had attacked a surface vessel.
Also, a report about a possible, quote, off-ramp for President Trump in his war in Iran. So this is the backdrop for a conversation that Bloomberg's David Gura had earlier today with former U.S. Secretary of State Antony Blinken on the U.S. war and attacks on Iran. This for the Big Take podcast.
Well, look, it's certainly something that should have been anticipated. And what's one of the striking features so far is that Iran has launched far more missiles and far more drones at the Arab countries in the Gulf and in the region than it has even at Israel, disproportionately so. And in part, that's because we have bases and a presence there, but they've gone beyond that. They've gone at infrastructure that these countries have, the oil infrastructure. They want to try to inflict so much pain that we can't sustain the effort. And that's something that should have been anticipated. And David, I think we're looking at a couple of things going forward in terms of where does this go and how does this end? And it seems to me that there are two critical factors to look at: markets and munitions. Markets. Where are the oil markets? Where's the stock market? Where's the bond market? I know President Trump is very attentive to those. And if they go in a southerly direction and stay that way, or in the case of oil in a northerly direction, that's going to be possibly a limiting factor. Then munitions. There's really a race on to figure out who expends their munitions first and fastest. The Iranians put us in a position where we've used up a lot of interceptors to deal with defense, or even our offensive missiles to take out their launchers, or conversely, did they run out and we still have what we need? I don't know the numbers here. I'm not privy to that, but it is something we have to be very, very attentive to because these things are not in infinite supply. The production times are very long, and of course, we're also using in many cases, very expensive weapons to take down $20,000 drones. That's not a good equation if you keep that going over time. What I'm worried about, one of the things I'm worried about, and this gets to the second and third order consequences, is we so deplete our arsenal, and it takes a long time to rebuild it, that puts us in a disadvantageous position when it comes to, say, a China or a Russia. All of those things need to be factored in, and again, it's one of the reasons why if you're going to undertake something like this, you've got to make sure that you've factored all of that in. And again, it really should start with explaining to the American people why you're doing something, why it's necessary, why now.
Do you see an off-ramp anywhere at this point?
I do, in the sense that, one, as I said, I think the off-ramp will be governed by this question of munitions and markets. Mm-hmm. And then what is that off-ramp? I think the president may simply declare victory. He'll say, got rid of the Ayatollah. We diminished or degraded or destroyed their nuclear program. Again, we did the same thing to the missile program. We did the same thing to the Navy. And as to the regime, well, over to the Iranian people. Good luck to them. Hope they succeed. And if they don't, it's their fault. If they do, we'll take the credit. How Iran responds to that remains to be seen.
And that, of course, is former U.S. Secretary of State under President Biden. That is Antony Blinken with Bloomberg's David Gora, co-host of This Weekend on Bloomberg TV, Bloomberg Radio. You can catch that on Saturdays and Sundays starting at 7 a.m. Eastern. You can also catch the entire Blinken interview in full on today's Big Take podcast. Right now, though, we want to talk with a member of our own Bloomberg News team as well.
Yeah, for more geopolitics, let's bring in Nick Wadhams. He's Bloomberg News National Security Team Leader. He joins us from the Bloomberg News Washington, D.C. Bureau. I was struck at what the former Secretary of State said at the end there, the idea of the U.S. declaring victory just based on certain things that have happened right now, the idea of an off-ramp. That his comments coupled with what you're hearing from Washington, what we're seeing out of Iran, what we're hearing from the Pentagon, what does it look like the end of this war would look like, Nick?
Well, every signal we're getting from the Pentagon and the Trump administration is that they really are nowhere near an end, that they're saying it could take many more weeks. And in fact, the Pentagon briefing we got this morning was really a discussion about how their strategy is changing. So whereas they had targeted air defenses, coastal defenses, ballistic missile launchers, anything that would pose a threat to U.S. forces and allies in the region, they're now planning to move inland now that they say they've gained control of Iran's skies and want to launch more precision strikes. So hitting that issue that former Secretary Blinken talked about there on the munitions, that they don't necessarily need to intercept as much of the Iranian outgoing missiles because they've decimated a lot of that capacity, and they're now shifting to using other weapons, dumb bombs, GPS-guided munitions that they have in very large supply. So far, the administration is not signaling what the end would look like or giving any indication that we're getting anywhere near it. In fact, they're saying that they're only going to ramp up operations over the next several days.
Hey, Nick, I get it that military strategy in any kind of war activity, it evolves, I guess, as the situation evolves. But having said that, is there any really clear messaging? I want to go back to kind of the original question about why we are there, what we're trying to achieve, and, you know, is this really our war? Or if Israel hadn't seemed so keen on doing something, would we be talking about this right now and about U.S. involvement?
Right. So there's been a lot of reporting out there that the Israelis, Prime Minister Benjamin Netanyahu, pushed the U.S. into this war and was really an instigating factor. So that's one concern. You've even seen that concern expressed from some of President Trump's most loyal supporters in the MAGA wing of his party, and the administration has given sort of succeeding, sometimes contradictory explanations for why it's doing this, whether it's a desire for regime change. President Trump had indicated that. Then Hegseth said, you know, it's not about regime change, but the regime has changed. They've also talked about the need to eliminate the nuclear program, the ballistic missile program, drone strikes. So you have seen them sort of gradually refine and shift that message over the last several days.
Wait, Nick, I just want to jump in. Honestly, I thought the strikes last year depleted and dismantled Iran's nuclear system and nuclear weapons capabilities.
I mean, they had said that those President Trump, the word he used was obliterated. He said that it had obliterated Iran's nuclear program, but part of the messaging you've seen them give, including President Trump in the State of the Union, was that they were continuing to rebuild that nuclear program. And that then raises the big question about the end game. So all of these capacities that the U.S. is destroying and has been targeting over the last days and then since last year on ballistic missiles, the nuclear program, drones, Iran would theoretically have the ability to reconstitute those programs over time, which then leads you to think, okay, well, the only way to get them to stop doing that is by changing the regime. But that's now what the administration is saying they don't want to do, that they're not interested in regime change. So that's why we're still asking these questions about what does success actually look like here, because you can decimate those programs. Iran has shown the capacity and the willingness in the past to reconstitute them. So the administration is not so far saying, okay, here's the end point. Now, obviously, they don't want to say that in part because they don't want to tip off the Iranians, but you get the sense that they are intentionally leaving that open-ended so they don't get boxed in one way or the other.
Hey, Nick, a lot has been made of this U.S. submarine sinking an Iranian warship in international waters. First time since World War II that an American sub had attacked a surface vessel. There's that going on. But, I keep thinking about what does the U.S. and Israel have to achieve for the U.S. to be more secure? If this is about national security, and this is we know a country, Iran has hated America, or so we laugh, it's not funny, but, chanting about death to America for a long, long time. So what do we need to do to make it so that the U.S. is actually more secure against Iran? Which I think should be kind of the end game if that's what this is all about. I don't know.
Right, and there have been a lot of questions about, the U.S. strategy, because there was a big question, well, Iran did not have the capability of hitting the U.S. mainland with any ballistic missiles, so what was the imminent threat there? I think what you're seeing in the case of the Navy is one of the things that the administration wants to guard against is Iran's ability to basically choke off the flow of oil through the Straits of Hormuz. So they say, okay, we eliminate the Navy. That eliminates a major tool that Iran had to be able to threaten global shipping. So there was that issue, but the sort of second and third order consequences there of how that would impact the U.S. mainland, well, that's a bigger and sort of more open-ended question. Obviously, if Iran were able to clamp down on energy flows, that might impact oil prices at home. But of course, Iran was not going to clamp down on those flows if the United States had not attacked it. So there's also a bit of a chicken and egg situation there as well.
So is it, forgive me for putting you on the spot, but are we less secure or more secure or TBD?
Well, so some of the president's critics have argued that the way that we would be less secure is by, if you weaken the leadership and create essentially a failed state in Iran, where does that lead? Does it lead to new terrorist threats, increased refugee flows, and things like that? Well, that's a big open-ended question and a huge unknown for the future. The president's argument is no, there was an imminent threat to U.S. bases. They say that Iran had essentially held the U.S. and Israel hostage. They said it had a conventional gun to the U.S. head over a long time, and that this was a threat that they needed to deal with now that Iran was reconstituting its nuclear program, which would have posed a threat to Israel. It was developing ballistic missiles that would eventually have the ability to hit more U.S. targets, and that it continued to harass and threaten U.S. allies through the funding of proxies in the region. So they say those threats were the imminent threats that essentially needed to be dealt with now that presidents over decades had refused to tackle, and that Trump now is the one who's finally dealing with the problem. And as they say, Iran had, it was a slogan, death to America. So that was a threat they wanted to deliver on one way or another. So, it really depends sort of on whose side you're on here.
All right, good stuff. Thank you so much for getting us up to speed. Nick Wadhams, Bloomberg News National Security Team Leader, joining us from our bureau in D.C. Coming up, we're going to switch gears.
Yeah, we're going to talk a little about the latest from Apple. That's next on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, and the NASDAQ 100 index all advancing. S&P right now just about the best level of the day, up 67. That is a gain of almost 1%. The S&P back at 68.83. Dow Industrials up 282 points now. The Dow up by 0.6%. NASDAQ up 1.6%. The NASDAQ 100 index up 1.8%. And small cap shares are advancing with the Russell 2000 index up by 1.2%. The VIX at 20, the 10-year 4.07%, the 2-year 3.53%. Gold up 0.8%, 51.29 the ounce. We are seeing a retreat as of now for crude. West Texas Intermediate pulling back by 0.1%. WTI 74.47 a barrel. Brent, the global benchmark at 81.18. That represents a drop right now of 0.3%. Crypto on the move big time. Bitcoin up 8.5%, 73,845 on Bitcoin. And we just got word that U.S. money fund assets surged to a record $8.27 trillion. That according to Crane data. Again, recapping here, stocks higher, S&P up 67, a gain of 1%. And for on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Tim Stanovic, live here at Bloomberg headquarters in New York City. Want to talk a little bit about some new products from Apple that Tim is already thinking about buying.
You got to.
Rolling out the $599 MacBook Neo, biggest push for the company yet into low-end laptops. So it's really looking to go after Windows PCs and Chromebooks for budget-minded shoppers. You're budget-minded? I know about like a coffee thing that you bought that wasn't so budget.
Well, that's because I don't spend all my money on computers. I can buy expensive
I'm sorry.
coffee
Did I say that out loud
That's
to
fine.
everyone listening?
That was a gift.
Is Dad listening?
He is. He
It
is.
was a gift.
Yeah, that was a gift.
Aw, okay.
Bloomberg News consumer tech
Sorry.
reporter Samantha Kelly joins us here in the studio. $599, a price point for a Mac that I think is not familiar to anyone.
Yeah.
Because that's so inexpensive. It kind of puts it on par with Chromebooks and with some like lower end Windows PCs.
Yeah.
What can it do?
Yeah, so this is still very much a Mac computer. It looks like a MacBook. It's a little bit slimmer. The display is a little bit slimmer, but it's still light, fits in your bag. It does everything, almost everything that you would expect from a higher end MacBook Air. However, the computing, the processor isn't quite there, but anything you would need, navigating the web, documents, some light editing, basically, to your point, like a substitute alternative for a Chromebook or a lower end PC.
Are people going to go for it for consumers? Like, have we been looking for this?
Yeah, I think absolutely. I think like students, schools, kids are using Chromebooks, businesses, I think casual users. I mean, a MacBook Air starts at $1,100. This is $600 and you're getting
for, like popping on the plane, watching movies.
Yeah, and the colors are fun.
Well, will you be able to watch movies?
Oh, yeah.
Oh, okay.
But,
Go ahead.
Absolutely.
But it also kind of is in the iPad's turf, which is interesting.
Yeah, yes. It's one of the reasons why Apple has delayed this for so long, and they actually announced a new iPad Air this week that is also the same price, $600. Oh. But, people, it's a different form factor. So, you could be on the couch, you could have, a keyboard connected, but not everybody wants that.
Yeah.
You could have a laptop experience for, half the price almost.
So why shouldn't someone get this? Like, why shouldn't I get this, and should I go for a $1,200 computer instead?
Yeah, I think it depends how you're going to use it. If you're like a heavy user, if you have, heavy, if you're a gamer, if you have like projects, if you're a professional, like an artist or something like that, you're not going to want. But if you're just going to, if you're taking notes in class, or if you're going to bring a computer on the weekend, you want to check your work email, it's basically does everything you really need. And what's really interesting is it now is powered by an iPhone chip, which is one of the reasons why they were able to keep it lower. The same chip from an iPhone 16 Pro, which is not that old, is now powering this laptop. Just kind of goes to show the efficiency, how they're able to make such powerful chips now.
Yeah.
And now they can put it in new products.
Yeah, they can do it. And it comes in citrus, silver, indigo, and blush color options. Which one will you maybe purchase?
I don't know, but I'm looking at Apple stock. It's down 0.2%. And it's not, launched. You can't really look at Apple stock on a launch day. We always do that when there's a big launch day in September or something and a new iPhone is unveiled. One thing we do, though, or one thing we don't do is really pay that much attention to this revenue line when we're looking at company earnings. I mean, people care about services. They care about iPhone. And does that, like, it's surprising to me that we're talking about a new Mac when, you know, investors care most about those much bigger categories.
Yeah. I mean, what's interesting, well, first of all, you know, the Mac in general, the category was down over the holiday season. But I think this is also a bigger play to just get more people into the ecosystem. You know, you might have an iPhone.
It goes after a whole different market.
100%.
This is way cheaper than an iPhone.
Yeah, you might then you might have, you finally get this, and then you're like, you know what? I should probably have an Apple Watch at this point. And it kind of like opens the door to more.
It's a gateway drug.
You know, guilty, because if you think about it, like we have a home that's got the laptops, that has the iPads. Like once you kind of lean into that Apple world and universe, you just kind of keep adding on. You just do, right?
Yeah.
Like, I don't know, same thing?
Yeah, you still have the first Apple Watch, though. That's the difference between us.
It was a second. It was the second iteration. And
You've been wearing that lately,
I have yet to update. I've actually gone old school, like on watches all of a sudden. And I don't know, but we'll think. But I do think about, there's got to be a point where Apple says, listen, we've got the Apple lovers, full disclosure, you know, and we're pretty transparent about it.
Yeah.
But at some point, you've got to figure out how do you grow your market, right? And who you can go after.
Well, that's exactly it. So, and it's also, you might have, you know, you might have an iPad, you might have an iPhone or something like that, but these MacBooks are expensive. So maybe you have it, maybe a partner has it, but do you really want your like 14-year-old kid to have a high-end MacBook? No, but how about a yellow MacBook Neo? It's kind of that perfect little harmony in between.
Except they go to college and then they need to do like spreadsheets and stupid stuff.
But you could do that on this.
Oh, can you?
Yeah,
Okay.
yeah. I mean, it's very much a functional laptop.
Does it
for sure.
solve, I'm going to pull a Mark Gurman here, does it solve Apple's AI problem?
It's interesting you say that. No, it certainly doesn't. It says in some ways that it will, some of the computing power behind it will be able to better handle AI in the future. I think I really do think it's going to attract more people. I think it's going to have some purchasing power, but no, there are lots of other AI problems that they're still working through for sure.
What does it mean? As we said, this gives, you know, Apple the ability to go after a different part of the marketplace and then maybe get people into the Apple universe. Having said that, what else are we anticipating comes at a cheaper price point?
Yeah, well, this week they announced, this is just one of several different products that they announced this week. So we also had the iPhone 17e, which is its budget line, also at a more affordable price as well. Does less, you know, that you would want in like a Pro or even a traditional basic line. No, it's sort of like, and it competes. And this, and this was kind of a very and you know they show the video and and I was just like, oh, that's interesting. Just as they're moving, obviously, toward, you know, AirPods, all it's different lineup there, but it is, you know,
having lost
still there.
4 or 5.
Here's the thing about
my husband actually bought me a cord.
You were wearing them yesterday.
Yeah.
And
she has these AirPod cords. Yeah. They make
Bright
the AirPods.
orange.
They make the AirPods into wired headphones.
So basically, you put it around your neck, right? You put them in.
So it's all the convenience of AirPods with none of the convenience.
Do you want to know what's crazy? Is I was walking into the Bloomberg Invest event, and then all of a sudden I look, I'm like, shoot, I lost one. Yeah. And so luckily we just went back. It must have slipped out. I must not had it in tight enough. But I'm like,
that's funny.
I can't go home to my husband and say,
yeah, right.
Again.
Because he's like, just get headphones. Like, just do it.
I do have Apple Care for AirPods, though, and I think that covers.
But think about it
when you lose them?
I don't know.
If you're a budget shopper, though, you might not have AirPods. You would need a headphone jack.
Good point.
Yeah.
Very good point.
What's old is new again.
All right.
In technology
cool.
sometimes.
Check this one out.
Great stuff. Samantha.
You get with an education discount, you can get this laptop for $499.
You citrus kind of guy, indigo
off.
blush,
I don't,
silver.
The price is right.
Come on.
It doesn't matter.
Lean into your blush
You can
side.
get a 6-pack of these for like the price of a
Yeah,
couple
you can be
computers.
bold with the color. It's like you can just
citrus.
It's okay. Yeah,
he's not going to do citrus.
Summer, leading into the summer.
All right. When we come back, a look at the markets and stocks on the move. This is Bloomberg.